3 crore impounding order for allegedly manipulating the newly introduced closing auction session for Sensex on the 13th of August. This comes after the SEBI chief warned against closing auction session manipulation.
And the RBI defends its proposed curbs on NBFC's revolving credit. Deputy Governor Shirish Chandra Murmu says that the move is aimed at bringing greater clarity for businesses, stressing that revolving credit was not permitted for NBFCs in the first place. He also defended the early closure of the FCNR deposit window, saying that the RBI has to respond to evolving conditions.
All right, let's take a quick look at Asia then. Well, it seems to be clawing back after yesterday's bruising, but Taiwan does not seem to be mirroring that sentiment. But now it is coming onto the green. It was a tepid start, but now, as we can see, Taiwan is pretty much in line with other regional peers. Hang Seng also up about 1% or so. This is after what we saw yesterday happen in semis, likely to continue in Taiwan as well. But Japan's Nikkei has recorded a positive start this morning, seeing gains of about 1.1%, as you can see it. Now, remember, it shed over 3% yesterday, and the Kospi, which was at the epicenter of that sell-off with a 5% fall. In today's trading session, it's in the green, seeing gains of over 6% now. Major reason being SK Hynix, the big boy, announcing a record buyback. The other trigger seems to be Washington. The US Treasury doubling its long bond buybacks pulled the 30-year yield back off 19-year highs. And then there's oil. Though oil could be a sticking point for us, Hormuz Brent is at 92 and going up. Let's also look at Nifty implied open. It was indicating a positive start and continues to about 100 points, much like the Asian peers. What do you think?
Well, the bulls would definitely be hoping that this sustains for now, keeping their fingers crossed to gap up after a fairly long time for the index. But starting off with updates from West Asia, then US President Donald Trump has announced launching of an unprecedented crushing economic operation against Iran after it failed to reach a deal, warning that any country offering Tehran a lifeline will face severe financial retaliation. He also said that the US may resume talks with Iran at some point, stating that American demands remain focused strictly on preventing Tehran from obtaining nuclear weapons. Meanwhile, Iran's parliament speaker Mohammad Bagher Ghalibaf said that the US is now seeking honorable exit from the Middle East as he promotes a new regional order. Additionally, an Iranian lawmaker said that a Strait of Hormuz plan under discussion with Oman would place the waterway under the control of Iran's armed forces. And with oil prices continue to remain at elevated levels, Manisha Gupta is here with all the updates from the commodity space. Manisha, good morning. Oil, gold, it's been a busy morning for you.
It has been, absolutely. When you look at the crude oil prices, well, this is a third weekly gain that we are looking at. $92 a barrel is holding, and we've seen 3% of gains in the crude oil prices till time. Well, as you were mentioning, the uncertainty in West Asia as US and Iran not just remain at impasse, but they have been giving out various statements as well, is what is bothering the market. The other part really is about the UAE announcing a suspension of financial and economic transactions with Iran. Well, that also tells you that not all is well within that region as well. And then the markets also are looking at US inventories increasing. Distillate stocks, of course, have seen a decline, but the inventory increase is what is keeping the prices in check at this point in time. But, well, yes, it has been a very strong gain coming in for the precious metal prices. Gold was up 4% overnight, silver 5.5%, platinum 5% as well. The sharp retreat in US Treasury yields and heightened uncertainty in the Middle East is what is leading support for many of these precious metal prices as a safe haven buying.
All right. Thank you so much, Manisha, for that update. But now, how will overnight Qs impact our Indian market? We have our research team joining in with how the trade setup looks like and the stocks that are likely to be in news. We have first Hormaz to take us through the market set.
You know, the GIFT Nifty is indicating a gap-up start and the bulls would keep their fingers crossed that this sustains. But as of now, after 7 days of losses where the Nifty has lost over 500 points, it is now at very, very precarious levels. More so because three very important levels on the index are now within 150 points of each other. The first level is the fact that it closed below its 50 DMA yesterday. The first level that comes on the downside is 24,045, which is the 61.8% retracement of the recent rally. The next level is the 24,000 mark, of course, and then the third level that comes to mind is the 100-day moving average, which is 23,920. That is something that you would have to watch out for. So these are the three levels that you should be keeping on your mind. for the index. Of course, today being the Sensex weekly expiry as well, that also needs to be accounted for. The streak of lower highs and lower lows needs to be arrested. That's the first thing. And the Nifty Bank too, every time it is reaching that 57,000 level, it manages to see buying interest, as it happened yesterday as well. And that 57,000 level was also the intraday low yesterday. So that remains the most important one to watch on the downside for the Nifty Bank. Of course, there could be some relief rally on the upside, but the lack of upside triggers continue to remain. Oil prices remain at elevated levels. The currency reaction needs to be watched out for as well. But the IPO market is in a league of its own, and that could also keep some of the upsides in check because of a lot of the liquidity moving into the primary markets as well. But for now, the GIFT Nifty is indicating a 115-point gap up. We mostly open above or close to the mark of 24,200. That is something that the bulls would take a lot of heart from, and that hoping that they would sustain.
All right, thank you so much, Hormas. But now let's go over to Ananya, who will list out the stocks to watch out for in today's trade. Good morning, Ananya.
Good morning. So let me walk you through the same. Let me first start with HDFC Bank. So what happens if they got RBI approval for LIC to raise its stake to 9.99% here. Now, KFin Technologies saw a 1,200 crore block deal by General Atlantic at 9.56 per share. Now, Aditya Infotech, they approved a 1,500 crore fundraise. Shiprocket, they saw Goldman Sachs buy 52.7 crore worth of shares. Strides Pharma closed its US FDA inspection with a VIA outcome. Now, Titagarh Rail here, they received an approval to supply up to 1,200 traction motors annually to Indian Railways. HDFC Life, they received IRDAI approval for the 5-year reappointment of Ms. Vibha as MD and CEO, along with Mr. Neeraj as ED and CFO here. Now, Hyundai Motor, they have planned a price hike of up to 1% from September here. And finally, EMS, they won a 1,900 crore Rajasthan water project. So watch out for these stocks today.
For that update there, over to Sudarshan now with cues from the FNO space. Sudarshan, the GIFT Nifty is indicating some optimism. The street would want to hear some from you as well.
Good morning, Hormas. First, global cues are largely positive, and that's reflected in the GIFT Nifty. It's indicating a start with a gain of more than 100 points. If you talk about yesterday's session, major action as per the options data, we have seen between 24,000 and 24,100. 24,100 was the strike rate where both call and put option writers were the most active, and that's the reason at the end we managed to hold on to the levels above 24,000. But if you talk about the FIs, they continue to add position on the short side. Yesterday also in the index futures, they have sold more than 2,400 crore. They have done minor buying in the stock futures, but the problem is the addition on the long side. Now, their overall short exposure is above 2 lakh contracts for the first time that we are seeing since July 28. So, today, there is a positive news flow. There are positive cues, so we might see some short covering. Hope we manage to and above the levels of 24,100. In the options data on the put side, 24,000 and 24,100 have seen maximum change in the open interest, while on the call side, 24,100 and 24,300 were the most active ones. So first support level, 24,000 for Nifty, resistance would be 24,300. 3 stocks are in the band. LIC is out of the band. 2 stocks that I'll keep an eye on. First one is Muthoot Finance because of the sharp spike in the gold prices. And lastly, BSE because they are exploring to launch FNO contracts in agreement with MSCI.
All right. Thank you so much, Sudarshan, for that update. But now let's slip into a break. Up next, we get you all the cues from the Wall Street on the other side. Welcome back. You're watching Power Breakfast on CNBC TV 18. In the US market, Wall Street ended higher on Wednesday, snapping 3-day losing streak as the Treasury moved to ease bond yield pressure. CNBC's Christina Partsanova gets us a wrap of all the action on Wall Street.
U.S. markets were up fractionally across the major indices Wednesday after the Treasury Department made moves to relieve pressure on bond yields by more than doubling its buyback program. The Dow was up 120 points. The S&P 500 gained just 16. Tech-heavy Nasdaq was up 41 points. Shares of Moderna, though, soared more than 175% Wednesday after an experimental melanoma skin cancer vaccine showed positive results in its first-ever late-stage trial. Moderna is developing the vaccine with Merck, combining its mRNA shot with Merck's immunotherapy drug Keytruda. According to the companies, the vaccine significantly extended the time patients live without melanoma returning after it was completely removed by surgery. It also reduced the risk of the cancer actually spreading to distant parts of the body. Shares of Merck, which, by the way, are more than 10 times the size of Moderna by market cap, jumped 10% on the news. And according to minutes released Wednesday from last month's Federal Reserve meeting on interest rates, officials indicated they would need to raise rates soon unless inflation comes down. The committee ultimately voted 9-3 to keep rates steady. According to these minutes, those who voted for an increase judged that doing so would help delay the need for steeper, more costly moves in the future. That's what's happening here in the U.S. Back to you in Mumbai.
Thank you so much, Christina, for that update. But here, the minutes of the last monetary policy meeting are more hawkish than the policy statement that was released after the status quo decision on rates. This has opened the doors for a potential hike in the repo rate later this financial year. RBI Governor Sanjay Malhotra said inflation is expected to peak in Q3 before moderating, and he prefers to wait for more certainty on the trajectory. However, he also added that if inflationary risks become more broad-based, policy tightening may be needed. Deputy Governor Poonam Gupta ruled out any chance of easing policy rates at this current juncture. She believes a case for a rate hike could emerge during the course of the year, but at present, she says, the best course of action is to wait and watch. Indranil Bhattacharya, the other RBI member in the panel, also argued for a wait and watch approach. He said the decision to pause preserves flexibility, but he also added that it does not necessarily imply an extended pause. Now, RBI Deputy Governor Shirish Chandra Murmu has defended the proposed rules curbing revolving credit for NBFCs. He was speaking to Lata Venkatesh at the 4th edition of the Banking Transformation Summit. He said the aim of RBI's regulations were to bring more clarity for businesses. Listen in.
Actually, this is not a new regulation. It has been there all along. Okay. Revolving credit as such was not permitted even now for NBFCs. But what we are proposing in the draft is we are trying to bring more clarity. Okay. And so that's why the definition has been emphasized in the draft regulation. And with this, we feel it will help better compliance. Our regulation will not come on the way of any business activity. So that is very, very important for all of us. The idea is not to prevent anything. Idea is to do business in a certain way, keeping in mind the risks.
All right, that was RBI Deputy Governor Murmu. But now let's slip into a break. Up next, we get you all the latest on SEBI chief's warning on cash manipulation.
Welcome back. Now, SEBI Chairman Tuhin Kant Pandey has warned that any attempt to defame the closing auction session through manipulation will be dealt with sternly. Speaking at an event, Pandey said that the new system is intended to improve transparency and any attempt at manipulation can be detected relatively easily.
कैश सिस्टम में मैनिपुलेशन पकड़ने के आसान मतलब जो हमारा वो है वो ज़्यादा अधिक है हमारी कैपेबिलिटी पुराने वीवैप सिस्टम से की अपेक्षा जो कैश सिस्टम में हम रिलेटिवली इजीली मैनिपुलेशन को पकड़ सकते हैं तो इसलिए ये आपको ये देना होगा कैश ट्रांसपेरेंसी के लिए है और वो लेकिन यदि कोई ये समझ रहे हैं कि हम उसका कैश को नाम बदनाम करने के लिए मैनिपुलेट कर लेंगे तो वो बहुत ही धोखे में होंगे.
And hours after SEBI Chairman Tuhin Kant Pandey warned cash manipulators of strict consequences, the regulator released an ex parte interim order pulling up 2 investment and brokerage firms for allegedly manipulating in closing auction session in Sensex on the 13th of August, the expiry day. The regulator has charged Copthall Mauritius Investment and Mansi Share and Stock Broking with a fine of 3.7 crore rupees as they allegedly manipulated the markets during the newly introduced closing auction session to determine closing price.
Now, shares of pharma giants Moderna and Merck soared in trade after an experimental skin cancer vaccine jointly developed by the company showed positive initial results in a late-stage trial. Interim results found that treatment met both its primary target of reducing cancer recurrence and its secondary goal of keeping cancers from spreading to other parts of the body. Here's Moderna CEO Stephen Bankel and Merck President Dean Lee on how the vaccine works and its role in changing modern medicine.
It's a big moment for medicine, a big moment for patients. We believe that this is just a first step for intismeran plus Keytruda. We're excited what it is going to mean for patients. Already, just hearing stories from patients in clinical studies has been really heartening. And so I'm very thankful for the team that have worked on this for 10 years.
You're taking Keytruda, which many people know is a really important cancer drug that's approved in 20 different types of cancers. And if you add this personalized cancer treatment based on the technology of Moderna, and you treat patients with a really deadly disease, melanoma, you reduce that risk of recurrence, which essentially means that patients have a better chance of being disease-free and for longer. And the question will arise as to how long could they be disease-free? So we're going to run this trial out and see.
Well, a vaccine against skin cancer, Hormaz, that definitely sounds like a good news. But that's all we have on this edition of Power Breakfast. Bazaar Morning Call comes up next.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Thursday morning, we are coming to you live from the CNBC TV 18 Motilal Oswal studios. Markets looking better, worse. It's kind of tough to say, but globally, things are, I guess, on the US Treasury side, a little better. So I guess that's a silver lining. Otherwise, I mean, it's fairly mixed. Oil's at about 92. Lots to track. I'm Prashant. With me, my colleagues Nigel and Rima. Guys, hi, morning.
Hi, and it's not just any Thursday morning. It's everyone's favorite anchor, Prashant's birthday and Shireen's birthday. So here's wishing you guys a very, very happy birthday. Lots of love, happiness, and continue sitting with next to him.
Absolutely, Prashant. Wishing you a very, very happy birthday. After so many years in the industry to look like this, well, you've done something right. And kudos, you know, because it's a high-pressure job. You wake up so many mornings for the last 20, 25 years, 22 years, I think so.
Don't give away his age now. You just said he looks young.
No, and look like this.
You know, last night I convinced someone, although I think it was, I'm just convincing myself. So he asked me, how old are you? I said 27. He said, 27? When did you get married? Well, you know, then he started back calculating the age of kids, etc. But I think I got somewhere with maybe not 27, but maybe 33 or 35. But
well done.
That'll be an improvement on the actual age.
Have a good day and have a cracker of a year ahead.
And you know, it's not just looks, right? To get the respect over so many years and decades now in the job. So, you know.
Thanks very much. Super. Thank you, guys. Well, you know, let's just sort of take it from the top in terms of what you need to know as far as the session is concerned. And you got, as I said, oil at about 92, actually just under 92 right now. And there's basically two news items that I want to highlight with regards to oil. One, of course, is this Truth Social post from President Trump, which will come up on your screen. And the gist of it basically is that the US is now saying, actually, President Trump is saying that we are going full hog with the economic sanctions. I mean, you look at the, you know, words in caps. I am announcing the most crushing economic operation ever taken against any country. He himself says this will be economic warfare and isolation on an unprecedented scale. I mean, it's the equivalent of D-Day, economic D-Day. So quite something, right? Now, we'll see what this actually translates into because Iran has been in isolation, under sanction for decades. So what else can happen, we'll have to see. The other report was Axios, the news website, the political news website out of the US, essentially saying that the US military has established a shipping corridor in and out of the Strait of Hormuz to transport about 10 million barrels of oil per day. And this also was something which markets took note of. Actually, oil, you know, was higher and then it cooled off a little bit into the US close, that is. But, you know, it's fairly high still. The other bit of news flow, which is positive. Remember, we've been talking about and worrying about the US bond yields, the 30-year at 20 highs, etc. Guess what? The US Treasury is saying it's doubling what it will buy or buy back in terms of debt issuance. And it's doing it in the 10-year tenor and the 30-year tenor. So I think each single shot will be, instead of $2 billion, can go up to $4 billion. I think that's the size. And obviously they're responding because, I mean, it's just about 2 weeks ago that they announced a plan for buybacks, etc. But it's all changed up because of what the market has done and fears that maybe market interest rates are moving up too sharply. So the 30-year fell from the near 20-year high. The Treasury yields flattened. So you look at the 2-year over the 5-year, 2-year over 10-year, they all flattened out. The 10-year was down about 7 basis points or so. Equities were up modestly. So there was, of course, this bond news, the buyback news, which helped at the margin. And, of course, earnings, which I'll get to. The S&P basically ending about 0.25%, just under 0.25% higher. The Nasdaq was up a little bit as well, but nothing one way, this way or that. Now, this is pretty significant, right? Moderna, which is the drug innovator, the innovator pharma company, along with Merck, essentially said, and by the way, the news hit in the pre-market session in the US before actual trading started, that they have positive results for a melanoma vaccine, a late-stage melanoma, which I think which is actually fantastic news for, of course, I mean, people suffering from cancers around the world and blood cancers in this case, liquid cancers in this case. But this is late stage. These are positive trial results. They've still got a distance to go. But of course, markets very, very enthused by this. And Merck ended 177% higher. Well, that's the power of innovation and markets rewarding. Merck, of course, was also up sharply in that sense. ST Lauder was up 16%, strong CEO commentary on revenues. So a bunch of positive sort of news flow around earnings, etc., which helped as well. I'll just wrap up with the levels. Nifty has been in a downward move now for almost 12 or 13 trading sessions. Lower highs, lower lows every day, and is kind of grinding lower, has been grinding lower for a while. But we are in slightly oversold kind of zones. You look at RSI levels, Nigel will talk about the PCR levels, etc. So these are oversold indicators which don't tell you at what exact point the market will start to bounce, but you need to start to be aware that we've gotten to a point where things can start to turn a little bit. Trigger, no trigger. I mean, they can be short-lived bounces, can be bigger bounces. That depends on the news flow and the tailwind, etc. But, when you get to these kind of levels, you start to look at perhaps what can happen on the other side. We've, by the way, also closed below the 61.8% retracement on the Nifty. The 61.8% retracement is 24,052. We left off at 24,000. Okay, after the cash session got us a close above it. We were kind of trading under it. But I think this is the first support in that sense, the first pivot in that sense, 2450. And then, of course, the next big support level is, what we've bounced off earlier many times in the past, which is 23,800 or so. So this is the structure that we find ourselves in. Trading activity is thinned out a little bit. There are lots of blocks, IPOs, primary market action, etc. But secondary market, as we've been pointing out, post-earning season wrapping up, the action has quietened down quite a bit. GIFT Nifty will come up, give you a quick sense of how we're likely to start. It is 100 points higher to begin the session. That's the indicative start. Nigel has walked across the wall with the F&O cues, positioning. Nigel, take it away.
Well, let's take a look at the Troika first. The Brent crude prices remain elevated despite the comments that he got in from President Trump. And the hope is that maybe, in fact, there will be some economic sanctions that will be imposed, which are already in place. But hopefully this fighting does stop. That's the hope out there. For the time being, Brent crude prices remain elevated. The good news is it's not driving on from here. It's not moving towards the 100-odd mark. The dollar index, that's more or less stable. In fact, that's cooled off a little bit in the last few trading sessions. It's now sub 99-odd mark. And the 10-year yield, well, that cooled off, as the Treasury Department said that it will double the government debt repurchase size. So that's good news. So 2 out of the three actually are not too bad. Moving to the flows, yesterday you had both the institutions that were buyers, and that's good news. But what do the FIs do on index futures? Before we get to that part of the data, it appears right now that coil is getting pulled back a little bit on various parameters, technical, the FI shorts in the system as well. And it appears at some point of time that coil will have to reverse a little bit, because it's getting stretched in one direction. So let's see whether or not that happens. So let's pull up the FI index futures data. They added 15,000 short contracts in trade yesterday. That takes the short contracts, the absolute number, to 2.09 lakh contracts, which is the highest we have seen all the way since July 20th. That's quite a large number that we're looking at. And remember, in the last few days, it's moved from around 1.5 lakh contracts to around 2.1 lakh contracts. So the shorts are in the system. On stock futures, though, in yesterday's trading session, they added more longs than shorts. The short positioning now is holding at around 90%, a little bit above that. A few sessions ago, it had come down to around 86%. So on index futures, the FIs, they have loaded on the shorts, and that's not such bad news. Well, moving to the options data then, the PCR is holding at around 0.8 approximately. That's been in the vicinity of around 0.75 to around 0.8. And a couple of strikes should come up for you on the screen. The 24,100 call, the premium out there, in fact, is holding at around 130 rupees. But there was massive writing that we saw. Now, interesting to see if the markets can get some kind of momentum. These call writers that were sitting pretty, they could come in under pressure. So we'll have to see how that goes. On the downside, though, 24,000 put, well, that's added a fair bit of open interest. So just looking at a broad range, I'm looking at a 400-point range. And I've taken out the simple daily moving averages for you. So the reference point on the upside is around the 20 DMA. On the downside is around the 100 DMA. This is the broad band that you're looking at in the near term. But I'll get you another data point. For the past 12 sessions, the Nifty has failed to make a higher high. In fact, we're making lower highs on a day-to-day basis. The prior time that we saw this sort of, lower highs being made was more than 10 years ago in 2014, when the Nifty made lower highs for 9 straight sessions. But Samco put out this data and they said, what happens post that isn't too bad, because after this sort of lower highs that we've seen in the past, at least data from 2010 To date, which is close to around 9 to around 10 instances, the follow-up hasn't been so bad. So the bulls will clutch under this and hope that maybe in fact that elastic has got pulled in one direction, and maybe some kind of relief is what we could see from here. The 23,900 odd mark though has to hold out.
Thank you very much for that. And today is the Sensex weekly expiry. So let's see whether some support comes from there. And in terms of earnings today, it's Manipal Health Enterprises. I think it should be the first one post their numbers. A quick check on Asia before we proceed. Let's get the early rates up for you on your screen. Well, it looks like a mixed picture. You've got a downtick, a flat opening rate coming through on the Taiwanese markets. Hang Seng is holding up in the green. It's the Korean market which is surging now. So Kospi is up nearly 5.5%, 6%. So that's the one which is up and about, while the Chinese markets are up close to about 0.3%. The two big headlines. Okay, before we get that, let's get in on the show. Alicia Garcia Herrero, Chief Economist, Asia Pacific and Middle East at Natixis and Corporate Investment Bank. Thank you very much for joining in. How about we begin with the latest Trump tweet, the most crushing economic operation ever taken against country to enforce absolute financial isolation on Iran. And Alicia, this was done in his signature all caps formatting, with Trump declaring the implementation of the economic D-Day. So, and this time it's not just about the economic chokehold on Iran. It's also about the secondary sanctions, because he is talking about threatening financial penalties against any nation that supports Iran. So how would you read this development? Broad basing of the war, risk of retaliation by Iran, or is this just rhetoric which can eventually tackle?
Well, we have to start by saying that Iran has been under secondary sanctions for years, and this is, if everybody can recall, a Huawei's case, CFO men being arrested in Canada because of basically supposedly unlawful financial transactions with Iran. So, this is not new. I think Trump is only reminding mostly China that they should stop feeding Iran with dual use exports, military related, and financing Iran. I think that's what it is. But again, it's not new. If that's your question, this is really not new. It's just Trump reminding us of something that the U.S. has been doing for years.
The other one, Alicia, and good to see you. Thank you for joining in. Has been the U.S. Treasury sort of stepping in to rescue, so to speak, right? Which is calmed nerves. Bond yields have retreated. What do you make of it?
Well, first of all, I think Bessent surely should have known, and probably I don't know how prepared this was, this rescue, as you call it. But what is quite clear is that once the Supreme Court decided to eliminate the tariffs, the U.S. Treasury should have known, and probably it did know, that it would reach the 40 trillion kind of max number, unbelievably high number, 40 trillion, very, very telling, sooner than later. And that is now, as we speak, 40.05 or whatever trillion in U.S. debt. And, that number is scary if you think about a third of that, so from 30 trillion to 40 trillion, having happened since 2022, basically after COVID. So, the accumulation of debt is such that I think that this has been like, I think the reaction has been like a panic reaction, if you ask me. I think that's why the bond market has been so volatile. And I don't think this is a reaction that I wouldn't react it this way, because it shows the market that the U.S. Treasury is worried about the level of debt to the point of intervening.
Hi, Alicia. Good morning and good to see you in. Thanks a lot for joining in on the show. Alicia, what about emerging markets, and where does India fit in? Because if I look at all the emerging markets, actually India is relatively underperformed. Do you look at it as in in terms of global markets, emerging markets first? Where does that fit in, and where does India fit in terms of the pecking order?
So maybe I should say that I just wrote a piece on India's need for kind of renewed inflows. I focus in that piece on foreign direct investment and what India should be doing to attract more. But I think the most immediate need is really portfolio flows. That's basically the main reason, in my view, why the rupee is so weak. For portfolio flows, I think India needs two things: a clear end to the Iran war. I mean, something substantial that kind of takes away the high oil price risk from the rupee. And the second, of course, is not a non-AI trade. I mean, we have had a little bit of that during the summer. We had a lot of losses with major AI hyperscalers and you name it. But still, it wasn't enough. I think it was not considered to be structural. I think India will benefit from some sort of, maybe global regulation on AI, something that really shows that the AI drive will be softened or will decelerate. That would be really, really good for inflows into India and of course, a potential appreciation of the rupee. So for me, it's all about getting inflows from the rest of the world. Not only resident inflows or, issuing bonds by banks, or I think genuine inflows, people who say, okay, this is the trade today. India is the trade today because it's the best hedge against AI. It's the best hedge in favor of the end of the war.
Yeah. Alicia, actually, in the last month or so, at least the selling has reduced on India. We had the FI outflows that had really ballooned up, and that seems to have turned the corner a little bit. We've got a couple of $1 billion, which is heartening to see after the kind of outflows. So given that we are hoping that economic recovery takes place, earnings get into place as well, and hopefully that AI trade, as you mentioned, cools off a little bit, do you think you'd be a little bit more optimistic on India's prospects?
Yeah. No, I am. I mean, first of all, I think if you think of purchasing power parity, the rupee is the best trade you can ever do if you want to hold it long term, because it's so cheap for India's long-term growth. And therefore, I think it's a very good trade. The point is, where do you enter? I mean, I talk to a lot of investors, and their question is not whether they should invest in India, is when does it stabilize? You see? So yes, you're right. We're seeing a little bit of the end of the tunnel, light at the end of the tunnel, but investors still worried that there will be a rebound on AI, strong one, and then India will suffer again. So we need to see, that kind of more stable situation remains in place for investors to come in fully. Yeah.
Okay. Well, Alicia, we'll leave it there. Thank you very much for joining us, and good speaking with you here on CNBC TV.
Thank you.
Thank you. Let me just quickly run you through what's lined up here on the program. So there's lots lined up. 8:35, we get you excerpts from the Reserve Bank of India Deputy Governor Shri Chandra Murmu, CNBC TV 18 Banking Summit Interaction. So he touched upon a whole host of issues. 9 o'clock, Renu Baid of IIFL Institutional Equities to decode the first quarter earnings for capital goods companies and assess the impact of rising input costs of the war in West Asia. 9:20, Deepika Mundra is going to be with us of MNG Investments. She's going to be talking markets. 9:30, we have the management of Premier Energies to discuss the impact of ALMM2 extension for India's solar ambitions. Tilaknagar Industries management at 9:40 to talk about their F527 outlook and beyond. 9:50, we have the management. We have Kotak Investment Banking's Kaushal Shah and Kaushal Shah, beg your pardon, and Equirus Capital's Bhavesh Shah to decode the strong run for IPOs. New listings, I mean, they've been all the rage. Towards the end of the program, Lata speaks with external MPC member Saugata Bhattacharya on the minutes of the August 5th policy, which came through yesterday evening.
Well, time to slip into a quick break. We go full tilt on stocks on the other side of the short break. For the time being, I give you a sneak peek into the list. We look at Hyundai, BSC, United Spirits, HDFC Life, Strides. They'll all be reacting to positive news flow out of the list. Titagarh Rail, EMS, and Shiprocket. On the flip side, KFIN, well, there'll be a large trade, so that's why, in fact, that one could be under pressure to start off, and a neutral reaction is what we're looking at on Aditya Infotech.
back. You're watching Bazaar Morning Call. It's time now to talk stocks. Our research team is standing by with CNBC TV 18's list of top stocks for the day. Good morning, everyone. Vivek, how about we go first with that KFin block deal with General Atlantic looking to pair their stake, and Aditya Infotech on your radar.
Well, that's right. So let's first start with KFin Technologies. Like you mentioned, last evening, or late last evening rather, there's a block deal launched in KFin Technologies. So the seller here is General Atlantic Singapore Fund. You know, the floor price for this particular block deal is at close to 920 rupees a share, which implies almost 3% discount to yesterday's closing price. The size of the offer last evening, was 1,200 crore. It's now been upsized to 1,400 crore given the strong demand, indicating that there is more than 8% of total equity that is expected to change hands. And remember, General Atlantic held almost 21.9% stake in the company at the end of the June quarter. The other stock on the radar is Aditya Infotech. The board has gone ahead and given an approval for a fundraise of up to 1,500 crore rupees. This could be via the QIP route or any other equity raising route, going with the neutral as far as Aditya Infotech is concerned.
Okay, all right. Thanks a lot for that, Vivek. Well, let's hop across to Sudarshan. He's here to tell us about some stocks that he's tracking this morning. Hey, sir. Morning.
Good morning, Nigel. So we'll start with the Hyundai company has announced price increase by up to 1%, and that will be effective September 2026. This is the third price increase that company has announced this year, and it would be across the portfolio. Second one is BSE looking to launch F&O contract, and that would be in the agreement with MSCI for MSCI indexes, and that can be positive for BSE. Last one is United Spirits. Remember, food regulator FSSAI had issued an order in the month of June regarding the labeling, and also had prohibited the sale of a McDowell's #1 rum which is manufactured at Baramati units. Now that order is revoked, so that can be positive for United Spirits. So I'm going with green for Hyundai, BSE, and USL.
Very much for that. Over to Ananya now for more stocks in the news.
Well, yes, a host of stocks will be in focus today. Let me first start with HDFC Life. So what happened here is IRDAI approved 5-year term extensions for both CEO Ms. Vibha and CFO Neeraj Shah here. Now in healthcare, if you look, Strides Pharma, they received a US FDA establishment inspection report with a clean VAI status for its flagship Bangalore plant here. Now moving to rails, Titagarh Rail, they won Indian Railways approved vendor status for 3-phase locomotive traction motors, unlocking an annual capacity of around 1,200 units. Now in infrastructure, if you look, EMS Limited, they emerge as the lowest bidder for 190 crore water supply project in Rajasthan under Amrut 2.0. Now, finally, newly listed Shiprocket, they saw Goldman Sachs pick up 40.24 lakh shares via 52.7 crore bulk deal at 131 rupees following its strong debut. So watch out for these stocks today.
Thank you very much for that. General Atlantic, back to that KFin, has made so much money in KFin. They had acquired a controlling stake of about 83% in November of 2028. Then they sold part of it in the December 2022 IPO. At that time, the IPO price for KFin Tech was 366. So from 83% holding at a private level, much lower. They've been periodically selling their stake. In December 2022 at 366. Then 490, 720, 1040, and now with this latest block deal as well. Let's do a quick recap then of the top stocks. Stocks with positive news flow are Hyundai Motor, BSE, United Spirits, HDFC Life, Strides Pharma, Titagarh Rail, AMS, Shiprocket, or KFin Tech could open up in the red, while Aditya Infotech mixed news on the back of the fundraise plans. But now it's over to Manisha for a complete roundup of all the action in the commodity space. Manisha.
Morning, and thank you for that. I'll start with the crude oil prices because we're looking at prices holding above $92 to a barrel. It has been a 3% gain in this week as well, and it's a third weekly gain that we are looking at in sense of crude oil prices. Well, the uncertainty in West Asia as the US and Iran remain at an impasse, and also interestingly, UAE now announcing a suspension of financial and economic transaction with Iran also seems to be adding to the premium. But the best of the gains clearly came in for the precious metal prices overnight. You had gold gaining 4%, silver 5.5%, platinum at 5% as well. Stronger gains have continued in the overnight markets, also when it comes to some of these base metal prices, including zinc, which is now trading very close to its 4-year highs. The tightening near-term supplies, production disruptions, low inventories, all of that seems to be supporting zinc prices overnight as well.
All right, Manisha, thank you very much for that. So an eye on some of the commodities which are top of mind as well. We'll take a quick commercial break here. We'll come back and as promised, excerpts of that conversation yesterday with RBI Deputy Governor Shri Chandra Murmu. He was, of course, this happened on the sidelines of CNBC TV 18's banking summit. He spoke with Lata on a whole host of issues, so we'll play that out in just a bit.
Welcome back. You're tuned into Bazaar Morning Call here on CNBC TV 18. Well, the minutes of the August 5th meeting of the RBI and the MPC is more hawkish. The statement and the government's press conference replies as well. Lata is here with all the key takeaways from the minutes. Lata?
Well, that is the first takeaway from the minutes, that they sound more hawkish than the MPC statement on August 5th, as well as the governor's answers or replies in the press conference. And this is not just me saying, this is a CNBC TV 18 poll. We polled 10 economists and 10 out of 10 agreed that, they ticked the A, which is more hawkish. The 80% of them also see 2 hikes in the remaining part of FY27. Two of them did not see hikes. Now, what are the signs of hawkishness? First of all, the governor's the MPC statement itself said that inflation is not getting generalized. That was the statement. Whereas now what the governor says in the minutes is limited signs of generalization of inflation are, he can see. He also says a recalibration of policy rate is required once there is clarity on the persistence and level of inflation. Actually, this paragraph was there in the statement, but it is much more beautifully explained by the governor, saying that for the past 1 year or all of 2025, inflation was 2%. Now it is a gradual coming back to normal. But when it normalizes, they expect that even X of gold, the core inflation will go towards the 4.3% mark. But how it normalizes and at what level it normalizes will determine our recalibration. Policy calibration will be needed at that time. So it's very clear that they are open to the idea of changing from the neutral stance. The DG Gupta, that is Poonam Gupta, also says, sounds pretty hawkish. She says a case for hike may emerge during the course of the year. It can't get clearer than that. Which explains why most of the people are now factoring in a rate hike. But she adds, of course, that there is more data that they have to wait for to get clarity. Again, the RBI Executive Director Bhattacharya, who is also a member of the MPC, says pause in August does not mean an extended pause. Now, it can't get clearer than that again. I'm just plucking one sentence from each. External member Saugata Bhattacharya says, elevated household inflation expectations are already there. But he goes on to say that the risk of persistent fuel pressure generating generalized inflation, we have to wait for more data for that. The risk is there. And finally, external member Ram Singh says, if external shocks worsen or second round price effects spread widely, MPC will act swiftly and adjust policy to protect the macros. So I'm just plucking out statements to show that the minutes do sound like there is a rate hike sometime in FY27.
All right. Well, thank you very much, Lata, for that. Well, this is, of course, the next one, which is also with relation to what the Reserve Bank of India has done recently. And there was clarification, important clarification, which came through yesterday. So RBI Deputy Governor Shri Chandra Murmu spoke with Lata yesterday on the sidelines of the CNBC TV 18 Banking Transformation Summit, defended the proposed rules curbing revolving credit for NBFCs. So just want to play that out because this is essentially top of mind across the board for NBFCs with regards to the impact it may have if it is implemented in the current form. Listen in.
You all say revolving credit should not be allowed to NBFCs, but you don't define revolving credit, you define actually term loans, saying that they shall issue term loans. So what exactly will be forbidden?
Actually, this is not a new regulation. It has been there all along. Okay. Revolving credit as such was not permitted even now for NBFCs. But what we are proposing in the draft is we are trying to bring more clarity. And so that's why the definition has been emphasized in the draft regulation. And with this, we feel it will help better compliance.
At the moment, because of the FCNR deposit flow, the worry about deposits has been postponed a bit, maybe by a year. By the way, sir, why was it stopped early? Any guess you can give us?
About what? About
FCNR? Why was the FCNR deadline advanced?
See, I cannot give you exact answer to that, but I can only generalize my response, saying that, see, we have to respond to the situation. So there is nothing early or late. We have to be able to respond to the evolving situation.
Sir, coming to the MDR, is there any guess you can give us as to what will it be, say 2,000 crores, 2,000 rupees as minimum? Will it be 2 crore merchants, people with sales above that? Any guesses as to where the threshold will come and when?
See, I will not hazard a guess, but it will come definitely now that what we hear. See, we are as much as we have got as much as information as you might be having in this area, because this is work in progress.
The rules will come from you or NPCI?
See, it will come from NPCI. Okay. It will come from NPCI, but we are part and parcel of the discussion.
Will you postpone the decision on Tata Sons exemption because there is a lot of confusion? Or will you advance the decision?
You have been asking this question, I think, in every
For as long
policy.
As the exemption was applied.
We are giving the same answer only. I don't think any banker is worried about deposit growth.
No, now, because of FCNR, they are not.
I don't ever they are worried about, because that is where they start with their banking. And they are very comfortable with any sorts of challenge when it comes to deposits. And they are very, very, I think they are very, very capable of responding to the situation, and they have been able to do that. And right now, there is no such challenge. Whatever you are referring to, some time back, there was the difference between the credit growth and deposit growth was a little wider. But I think hopefully things are improving.
Okay, well, that is the RBI Deputy Governor. The big talking point for NBFCs has been RBI's draft circular, essentially saying that NBFCs can't sort of give out loans which are OD-like products, revolving credit, flexi loans, whatever you want to call it. So this is Piramal Finance's MD and CEO, Jairam Sridharan, in a frank way describing what he made of this when he saw it and, I mean, the implications it may have. Listen in.
In original form, when we first saw the circular, थोड़े तोते उड़ गए हमारे कि यार ये क्या है? So it's a part of the business which has, I don't think, caused any particular challenge. It hasn't really driven any particular problem in the industry. It has largely been targeted at a segment which clearly needs that value proposition, etc. So I really hope that the way the industry first read the circular is incorrect, and the interpretation that I'm hearing now is the correct one, that it is supposed to be clarificatory in nature with respect to definition of businesses.
Okay, that is an important issue, which is sort of an overhang on the NBFC sector per se. And there is still no clarity on that because it's a draft regulation on the revolving credit. But let's move on now and get to the big movers from yesterday, which saw heavy volumes. Hormis joins in.
Morning, Reema. And of course, there's some movement yesterday in cash. The turnovers again was above the mark of 1,000 crores, 1,300 crore to be more specific. But one name that stood out in that was Bharti Airtel. Take a look at the turnover as well on Bharti Airtel. The stock ended below its reference price, but the turnover yesterday on the stock was 318 crore. That's possibly the highest you've seen in a stock since the implementation of cash, because most of the times the turnover hasn't crossed 100 in any of them. So that was the standout amongst the cash stocks yesterday. And the rest, of course, HDFC Bank, Reliance, ICICI Bank, Mahindra and Mahindra, all of them the usual suspects that made it to the top 5 list. But the second best on HDFC Bank, the turnover was only 57 crore. So that shows the difference between A, Bharti Airtel, and B, for HDFC Bank as well. Reliance Industries had a turnover of 45 crore, ICICI Bank had 41, and Mahindra too had a turnover of almost 34 crore rupees. Now, going beyond the cash names, Himadri Specialty Chemicals was one such name that underperformed yesterday. The stock ended 5% lower. 3.5 crore shares were traded on the stock, and the 20-day average here is only 54 lakh shares. A quarter of those were marked for delivery, so around 72 lakh shares on the delivery front. The 20-day average is just around about 15.5 lakh shares here as well. ICICI Prudential AMC was an outperformer yesterday. A positive note coming in from Motilal Oswal. The stock surged 5%. The 11 lakh shares were traded yesterday. The 20-day average is only 2 lakh shares, and 42% of those shares were marked for delivery. And 4.7 lakh shares on the delivery front. The 20-day average here is only 1.5 lakh shares. And lastly, Zaggle, of course, has been in the news all week. Yesterday, the stock ended 12% higher. Close to 4 crore shares were traded yesterday on Zaggle. The 20-day average is only 21 lakh shares, and this was the third straight day of more than 1 crore shares being traded on Zaggle in a single session. 11% of those were marked for delivery, so around about 44 lakh shares on the delivery front. The 20-day average here is 7.5 lakh shares, so significant buying here on the delivery front in Zaggle as well.
All right, thanks a lot for that, Hormus. Well, let's welcome Deepan Mehta, Director Elixir Equities, on the show. Hi, Deepan. Good morning. Good to see you in. Deepan, a quick word on KFin. That's the large trade of the day that we're going to be looking at. What's the view on this particular name? The stock has seen a big run, I think, from the recent low. And now there's going to be a large trade that takes place today. General Electric is the one that is looking to sell, and I think the book as well has been upsized. I had the term sheet with me. What's your view?
Najib, good morning, and thank you for having me on your show. I think it's been generally a good stock, created good value, decent returns. But end of the day, I think we are seeing stagnation in the entire industry, whether it's KFIN or CAMS for that matter. And the R&D industry per se is very heavily dependent on the mutual funds. And the number of folios in the mutual funds are not, really galloping. So they had a great time when the mutual fund industry was growing leaps and bounds. But now I think it seems to have kind of flattened out. And when we are particularly playing the capital market investment theme, because that's what these stocks are, I think there are better choices. Could be exchanges, could be wealth managers, it could be even discount brokers. So I feel that when you want to play the financialization of savings investment theme, there are better choices than stocks like KFIN or CAMS. It's reasonably valued as well. And as I think that, the kind of growth rates that other entities within the ecosystem can deliver is far higher than what a R&D agent can deliver.
Dipan, hi, morning. Ship Rocket went out of the orbit yesterday on day one of its listing, 47% up. What's your sense of the company, the prospects, the opportunity? We know there is opportunity because the entire quick commerce, logistics, enablement is all growing. But with the unit economics of the company, how do you feel after this kind of an up move? Give us your analysis of this company.
I saw the company, and typically when a loss-making company comes for IPO, I tend to kind of stay away, because these companies are very difficult to track as to when they will become profitable, how much profit they will get. And being public market analysts and fund managers, we cannot understand all these non-profit related valuation ratios. And I think that I thought the issue price was well priced, and it's rallied 50% after that, so it beats my logic. All I would say is that somebody else understands the business far better than I do, and they feel that the stock is 50% is a good investment, 50% higher than its listed price, and considering that it's still loss making. And it's not that the industry is all that easy. You have competition from pure play logistics players who are trying to offer solutions to the larger players, and then when the smaller players become larger, then they offer solutions over there. So, in my opinion, I would look at Rocket after they have had some sort of trading history, some quarterly history. For the time being, I think within the space, the best stock we look at is Shadow Fox. The returns have been good. The results have been exceptionally good. And what we like best is that they are very much focused on the quick commerce space, which is the fastest growing space within the entire logistics industry.
Okay, got it. Deepan, what else then? From the tech space, do you like something out there? Some of those tech stocks have come off the lows, and then, they've seen a fresh bout of selling. Something that's coming on your radar?
Not really, I think. And I think you all reported about CLSA saying that, their growth rates are going to be subdued for 3, 4, 5 years. That's what I've been saying all along. That large cap tech is on a secular stagnation mode. And really nothing comes to mind where they can go out of this particular low single digit kind of a growth rate. So that entire sector is avoid. There are a few outlier stocks, mid-cap stocks, which are very aggressive and which are growing, and we all know their names: Coforge, Persistent Systems. So these are the companies which come to mind, which can deliver superior growth rate. Apart from that, I think steadily we are kind of avoiding the sector. Disappointed with even numbers which came from companies which we like within the space, like Orion Pro, Newgen. They also disappointed us with their numbers. So my conviction in avoiding the industry is only growing stronger by the day.
Your stake in, Orion and Newgen, or you're still holding on?
No, we have exited these stocks.
You exited.
Because at the end of the day, the results are very disappointing. See, Rima, what is happening time and again is that managements are very, very vocal when it comes to, sharing good news. But they are not that transparent when it comes to there are problems, could be transient. And companies, the management which do not manage expectations well are really punished quite badly. And that's not a very good trend which I'm seeing in this particular earnings season, where bad results are not explained well by the management. And there was no clue of these bad results or disappointing results for several quarters before that. So I'm not, I'm very worried about this particular trend.
All right, quick word on gold financiers. The likes of Muthoot, Manappuram, they've seen quite a sharp correction from the top. IIFL Finance, the stock that we discussed earlier, I recall it's up 500 rupees. That's actually rallied close to 20%. And yesterday they had management that sounded very, very optimistic. What are you making of gold financiers or maybe some of the jewelers as well, given that gold has bounced more than 10% from the recent low?
Nigel, it's now a well-discovered investment theme, and it's extremely competitive as well. I think you had the Muthoot chairman on your show, and he avoided that question about the competitive intensity within the industry. And it's really growing, I think, very strongly over there. IIFL Finance, particularly, I think it's playing catch-up because valuation was significantly lower than some of the other multi-product NBFCs. So it is just kind of, recovering lost ground on a valuation basis. And the past few quarters, the results have been exceptionally good. So I would say that it is well priced as a sector. It is well discovered. And within the NBFC space, we remain quite positive on multi-product companies like Bajaj Finance, L&T Finance, which are also into gold finance and to several other products. But I think those business models are far more safe than single product NBFCs. Although IIFL Finance also is a multi-product, so we prefer such businesses. But end of the day, as I said, it's a well-discovered, well-understood space. And it may give average returns, the supernormal returns maybe elsewhere, I think. I don't know where they are, but it doesn't seem to be so in the gold finance.
Got it. All right, stay with us, Deepan. By the way, that large trade on KFin Tech, that's got cleared out, 1,400 crores. That's the total value. So we'll keep an eye out on the stock. Many a time, the stock is under pressure because we know there's a large trade in the offing. And once that gets absorbed, probably you see some kind of relief rally. Let's see whether or not that happens this time around as well. Slip into a break, come back, we'll focus, try to get you further details on this large trade. Our technical experts will be with us, and Deepan Mehta as well will be joining back.
Okay, welcome back. There's 9 minutes to go for the pre-open session to kick off. Lots of stuff, right, in terms of cues, etc. There is a bit of a bounce which is appearing, solidifying in that sense. At 8 o'clock, there was 100 points. It's about 160 odd points this morning as we approach the pre-open timeline. Deepan, a little later in the day, we'll have the management of Tilaknagar Industries join us. Yeah, I know you have a view on some of these Alcobev names, but yeah, just your thoughts. What do you like in that space? There is this price hike in Telangana, which I think, of course, benefits some players more than others. There is, of course, stuff happening perhaps in Tamil Nadu as well with the new government in place. Just wanted your thoughts.
No, I think that Tilaknagar is a very gutsy company, and you should be asking them about Imperial Blue. I think with the acquisition of Imperial Blue, they're among the top 3 or 4 alcobev companies within India. And that particular acquisition is playing out really well and kind of de-risk the business model, because I think the main brand, Mansion House, there is some legal issue, and you should quiz them on that as well. What is the status over there? I think the brand is belongs to someone else, but they have got the license to use it. But there are some gray areas and some controversies around that. But that notwithstanding, I think the new acquisition have been fantastic for the Tilaknagar Industries, and they are expanding the geographical footprint also with Imperial Blue. So very positive on the company, but debt has increased, and one really needs to see whether the kind of growth rates which they are seeing in Imperial Blue, how that is sustaining. So we remain quite positive on entire alcobev industry and Tilaknagar Industries as well. I think it is slightly cheaper than some of its peer group companies, be it United Spirits or even I think Associated Alcohol, Allied Blenders, not Allied Blenders and Radico Khaitan. So from that point of view, I think from a risk return profile, it offers the best opportunity.
When we chatted with Tilaknagar Industries post the earnings and we asked him about debt, he said it currently stood at 2,100 crore rupees. The target is to bring it down to 1,700 crore rupees, but the receivables from Telangana, which are more than 500 crore rupees, that remains the swing factor. But we'll chat and once again get a sense on that. But Dipan, Indomim, that's one of the recent listings and the stock's been a doubler. The issue price was sub 500 rupees. It's now closer to 1,000 rupees. It's again in that niche manufacturing space, growing well. The company's got backward integration plans in place, which gives them security for their raw materials and will in a way aid their margins. And the company, when we chatted with them yesterday, spoke about a 20% top line growth with margins being stable, 28-30%. Indomim?
No, I studied the company when the IPO came, and I thought it was a great company. It's bang in the middle of this precision engineering investment theme, and there are companies like PTC, MTAR, KRN, Heat Exchangers. There are these companies which are there, which are supplying high quality precision components, which are difficult to manufacture, and that basically is their mode. But look, what are we paying for the growth? That's something which I'm not able to get my handle on. That these companies, the manufacturing companies, they can grow 20-25% top line, maybe 30-35% bottom line, but to pay 70, 80, 100, 150 times their growth, I think a lot of it gets captured inside. And then, sometimes soft quarters do come. There are delays in, contracts, delays in delivery. So I think that to an extent, these stocks are well too overpriced, and a lot of the future growth has got captured in the stock price at this point of time. It was pretty reasonably valued when it went public, and now I think it's doubled. So my guess is the P multiple would be quite expensive.
Yeah, okay. Dipan, we'll leave the conversation here. Thank you very much for joining in. Sudarshan is now joining in for the brokerage call of the day. Sudarshan?
So first one is Godrej Consumer. New CEO has been meeting with brokerage firms, and on the back of this, 2 brokerage firms have returned today. Godrej Consumer maintains buy call and target price is 1,175 rupees per share. It says company is committed to continue investing behind existing strategic initiatives, and there will be a focus on significantly improving execution, especially in India business, and initiatives on portfolio transformation will continue. Macquarie 2 maintains outperform call. Target price here is 1,150 rupees per share. It says there is renewed focus on execution, especially on core categories, and it likes companies' focus on execution and potential pickup in growth profile, especially of core segment. But it awaits clarity on margin delivery and need for investments in medium-term growth opportunities. Next one is Turtle Mint. Jefferies has initiated coverage with a buy call and target price is 190 rupees per share. It says point of sales person is amongst fastest growing insurance sales channels, and company in this segment has a market share of 20%. Granular POSP network and tech stack drives better profitability on a smaller base, and growing scale drives FY29 estimated adjusted EBITDA margin to 10% versus loss that company had registered in FY26. Last one is Vodafone Idea. Citi maintains buy call and target price is 17 rupees per share. It says management has highlighted improving subscriber and ARPU trends and network investments translating into better customer acquisition, retention and monetization metrics, and recent progress related to funding and AGR relief materially improved capex visibility, and also companies confident of securing balance fund imminently. And these are some of the factors why Citi is positive on Vodafone Idea.
Thank you very much for their target price 17. The key line there is management is confident of securing that bank debt funding and even operationally. Remember, Q1 was the first quarter since the merger in 2018, I think, that the company reported a positive subscriber addition number. So that was taken well by the analyst community. Get into a break. On the other side, we'll get in the pre-opening rates. Renu Baid Pugalia of IIFL Institutional Equities will join in to decode the Q1 earnings for capital goods companies and assess the impact of rising input costs.
Welcome back. Well, let's get in Sudarshan Sukhani as well as Mitesh Thakkar on the show. Hi, gentlemen. Good morning. Good to see you all in. Mitesh, you go first. What's your view? You know, for 12 straight sessions, we have seen that the Nifty has been making lower highs. That's something we haven't seen in the last 12 years or so. But history suggests, I was looking at a Samco note, they are saying post that things actually look quite good. What's your view? The structure still punctured? Are we heading lower? Or do you think we're bracing for a bit of a relief rally?
Good morning, Nigel. So I think we'll get that answer today, possibly. You know, I also highlighted this point yesterday, during the closing session that we have been falling regularly and we are quite oversold on the intraday charts and are liable for a bounce back. Now, the strength of this bounce back will help us decide whether, we shall sustain at higher levels and aim for a reversal, or if we fail to capture 24,250, 300 zones today, then I think it might be a bounce which might get sold into. So I think I'll keep a close watch on 24,250, 300 levels. If that zone is cleared, then I think the Nifty should get back into some kind of an upward move.
Okay. What about you, Sudarshan? Do you think a bounce back is imminent? The GIFT Nifty seems to suggest so.
Yeah, good morning. Well, 24,000 was a support level, and support levels don't have to hold. But yesterday it held. And once the support holds, that gives a message. So I would think that this is a buying opportunity rather than chase the gap up, wait for a minor consolidation or a minor dip during the day. Your stops are 24,100. It's a very tight stop. If this market is willing to go higher, 24,500, 24,600, then the stops will hold. So look to buy on a small dip, small consolidation, keep a stop at 24,100 and just ride it.
Got it. All right. What about individual stocks? Sudarshan, you go first.
Well, it's a mix. Paytm is a buy with a stop under 1550. My algos, I think, have some equity in Paytm. JSW Steel is a buy with a stop under 1260. So two buys, Paytm and JSW Steel, and two sells, Oro Pharma with a stop above 1655 and Havels with a stop above 1315.
Mitesh, what about you?
I have a similar kind of an outlook, two buys, two sells. On the buy side is ICICI AMC. After a good correction, there was a very strong rebound yesterday. Could suggest a short-term trend reversal, and on the upside, could look at targets of 3420, 3450, or even 3500, and that's a buy with a stop below 3180. Then I have a buy on Dalmia Bharat Cement with a stop at 1839 for targets of 1950. And on the selling side is CG Power with a stop at 881.5 and look for targets of around 825 here. And Cummins also, yesterday broke below the recent swing lows, so could see some more profit booking at decline. That's a sell with a stop above 53.20 for targets of 5,000.
Okay, thank you very much for joining in. Let's invite Renu Baid, the Pugalia Senior VP Research, IFL Institutional Equities on the show now. Renu, morning. Thank you very much for joining in. So Q1 earnings season digested, done. What are the key trends? What stood out? And what would be the triggers going forward?
Well, I think 1Q clearly reflected the weakness in performance, both P&L execution and margin headwinds, which were anticipated to be glaring in the first quarter, and that is how it panned out. But this is more of a transient impact because cost increases are already underway. And in 2 quarters, as the newer orders, recently priced orders come up for execution, we will see improvement in margins coming through. But I would say the key silver lining for the first quarter results are very strong inflows. This was across the board for short cycle as well as long cycle orders. And that reflects the underlying resilience in demand and the confidence which companies and managements are expressing in terms of growth coming back comes from this side. So I think clearly order inflows were very strong. Management comments were confident of growth coming back. And the fact that this was a combination of base orders as well as long cycle lead orders coming in from power sector, grid equipment orders, data centers, oil and gas, hydrocarbon, definitely adds a lot of strength to the cycle that we see over the next 18-24 months.
Renu, hi, good morning. Any opportunities stock-wise? You think it's all priced well now? I mean, what we've seen and from the commentary, etc.
Well, definitely, I think opportunity is always there. Quite a few cap good names have also corrected around the same time when the earnings have been weak. So clearly, if you look at CG Power, stock has been sub 900. That has been among one of our preferred picks for the strong resilience that they have on the power segment and industrial now bottoming out. So that continues to be one of the top picks. We see strong resilience there. MTAR Technologies, another name which we like, very strong tailwinds of growth coming in from the US anchor customer with whom they deal on the cogen for solutions for data centers. So there, the company's capacity expansion plan has been on track, and we will see sequential jump in execution volumes coming through. And clearly, even in the US market, fuel cell-driven solutions for powering data centers is preferred. So we are seeing strong tailwinds on that side. And definitely large caps, L&T with the kind of order backlog that they have today, resilience in terms of the working capital cycle building up. We think that again is a high quality name to own. But yes, the outperformance will take its own time as we see the tailwinds on the execution picking up for the company towards the second half of the year. So L&T, CG Power, MTAR has been among the top pick preferred names for us in the sector.
Yeah. No, I mean, MTAR has, of course, been an absolute rocket. In sharp 10-15% corrections along the way as well, but I mean, they've been bought into quickly. I think the high was almost 10,000, right? And about 7,044 at this point in time. One other name which kind of was, which came up, I think you covered it, Renu, is Aditya Infotech, right?
Right. This is also one name which we like. Aditya Infotech or CP Plus has very strong brand franchise. If you look on the IP camera base, they have been at the fore to localize the entire value chain of IP cameras. And I think what the company has now built up is not just a lead versus the other domestic peers of 18-24 months, but they are very progressively investing in new designs, technology, which is building up the premium segment of the portfolio and giving them a play in the enterprise and the government infra basket. So clearly, this is another name which we like. This would be our fourth in terms of the preferred pick in the space that we have. I would say stock relatively post results has been a bit soft. Performance was good. Given the near-term challenges on electronics value chain, company has been slightly more cautious. But this is again one name where we see our earnings forecasts are ahead of consensus, and we clearly believe companies should be able to deliver 40-45% revenue CAGR and margins sustaining at 14.5-15% plus range, and they're delivering nearly 45-50% earnings growth over the next 2 years. So this is again strong franchise, but on a differentiated end market on surveillance, and clearly with Chinese players being out of the market after the STQC requirements, they have built up a significant lead before the next range of domestic peers start to catch up.
Got that. Renu, just before we wrap up, I think you have coverage on data patterns, BEL, a few of these defense names as well. Anything which stands out to you there from that space?
Well, defense, we have another analyst who covers it. But I think as a house, as far as I know, Bharat Electronics has been a preferred pick. So I would not want to make too many comments there. But clearly, the larger company system integrators have had their own lead in terms of order book and deliveries that we have seen.
Got it. Renu, we leave it there. Quick conversation, quicker than usual. Thank you for joining us, and always appreciate your time here on CNBC TV 18. Thank you. Well, I think we'll just quickly get you through the 9-10 trade. Sudarshan is with us, and so is Mitesh. Sudarshan, what do you have?
It's JSW Steel. Buy JSW Steel with a stop at 1260.
Okay, and Mitesh, what about you?
I'll go with a buy on ICICI AMC for targets of 34.20.
Okay, JSW Steel and ICICI Pru AMC are the two calls from Sudarshan and Mitesh respectively. Now, SEBI has ordered action against two entities and has slapped over 3 crore impounding order for allegedly manipulating the newly introduced closing auction session for Sensex on the 13th of August. Hormuz is here with that. Hormuz, take it away.
As the quickest possible SEBI order that has come in, it pertains to the expiry that took place last week, and two entities, Copthall Mauritius Investment and Mansi Share and Stock Broking, are the entities at which the order has been taken. The SEBI order states that the price manipulation happened during the last 10 minutes of the Sensex weekly expiry on the 13th of August 2026, and the gains that have been impounded, they pertain to around about 3 crore rupees for Copthall and around 72 lakh rupees for Mansi Share and Stock Brokers. Now, what the order says is that both Copthall Mauritius and Mansi have been barred from the market pending the probe completion. Now take a look at the chart that the SEBI order has mentioned in there. There are 3 spikes that you want to pertain to, which took place between 320 and 330. One of them took place at 320, the other at 323, which was a fall, and then the 2 subsequent spikes that took place as well later. Now the first spike took place at 320.41 to 320.43. In just 2 seconds, the Sensex moved from 76,661 to 78,023. That was a move of 362 points in just 2 seconds. The second spike took place between 1524 or 324.08 and 324.20. That 12-second period, the Sensex moved from 77,707 to 77,840. Then that was a 133-point up move in just 12 seconds. And last one took place between 325.49 and 326.17, which was a 28-second time frame during which the Sensex moved as high as 405 points. And in between all of this, there was also a period between 321 and 326 where the Sensex declined from 77,991 to 77,893. However, this drawdown was interrupted because of the spike that took place later, causing this deviation to take place during that closing auction session. Now, SEBI has made some observations with regards to Copthall Mauritius, and that is with regards to all the 3 spikes that took place between 320 and 330. Take a look at this. The first spike that took place, Copthall Mauritius had played 32 out of the 86 limit buy orders that took place that were worth 66.5 crore rupees, and there were 99% of those total share as a percentage of the share value that was placed. All of these orders were placed 3% above the reference price, and all of these orders were placed on all Sensex contracts at the same time. That's what the SEBI order states. Now, the second spike saw 108 out of the 165 orders, limit buy orders placed by Copthall Mauritius, and 32 out of the 176 limit buy orders in the third spike were also placed by Copthall Mauritius, which was almost 85% of the total buy orders that were placed during that period. And that is what SEBI states in that order. Now, what is the observations that SEBI has made on Mansi share and stockbrokers as well? They have said that during that 321 to 326 period, the sell orders were placed at lower prices. They were valued at 145 crores, and these orders were cancelled between 326.02 and 326.05, and these cancellations led to the Sensex IEP surging as much as 232 points. They also observe that 6 Sensex stocks saw sell orders being placed worth over 100 crore rupees. Those 6 stocks included the names like Reliance Industries, SBI, Eternal, ICICI Bank, L&T and Infosys. Now, these orders were placed between 1.5 to 3.5% below their reference price, and 99% of those orders, or 12.5 lakh sell orders, were cancelled during cash. This is what SEBI has observed, and these sell orders were prima facie meant to suppress the Sensex IEP instead of performing a legitimate sell transaction, and therefore these 3.6 crore rupees that have been impounded, they will be moved into fixed deposits with access to with mark to SEBI as well. Market access for both entities has been banned, and even participation in cash has been banned until further orders. No withdrawal from banks will take place without permission of SEBI. The transfer and redemption of mutual fund units and securities has also been blocked. Both entities have now been barred from selling off any assets or properties without permission from SEBI. The full asset disclosure has to take place within the next 15 days, which includes bank accounts, demat holdings, properties. They have been given 3 months to close out any open derivative positions and 21 days to file objections or request a hearing as well. So an important order coming in on cash, the SEBI taking action against these 2 entities, a big order indeed.
Hormuz, and as you said, literally, you said perhaps one of the fastest orders, but maybe this is the fastest order because I think we're talking about all this happening last Thursday, right? 13th of August. So it's basically 3.5 working days.
Yep.
That this order has come through. And, the last point is interesting. Essentially, what you referred to is what is called spoofing, right?
Yep.
You show a large bid or a large sell order and then withdraw it.
Right.
I mean, affecting the price, influencing the price and moving away. This is, I think, also we had Anant Narayan, who was, of course, one of the people who was on this issue when the regulations, etc., were being formed. And I remember him making a point that his point was that actually, if anything, because the cash session is concentrated and you're trying to create liquidity, all the liquidity in that 10-minute window, perhaps it'll become much easier for the regulator to track what's happening because you're not looking at things or suspicious trading activity through the course of the day. It's all kind of concentrated in that last cash window. So I think maybe this is an example of that, but I think much needed. Because I think sends a very strong message that SEBI is watching with regards to the cash session and any sort of suspicious trading or manipulation which may take place. I think that will be discouraged. We've got market opening. Hormuz, thank you very much. It's an important story. We'll build on it through the course of the day. The Nifty, by the way, is up 137, 140 odd points. So it's starting in line with what we kind of thought. The Sensex is up about 540 points. You've got the Nifty Bank, which is up 330 points. Midcap index is up about 400 points. And I think you've got the small cap index, which will come up, which is also starting in the green with about a 0.5% kind of a pop at this stage. So 1,500 up, 200, 300 lower. But this is too early to look at market breadth to make anything out of it. I mean, it's obviously one-sided. But it's a good start after, 12, 13 days of kind of neither here nor there, but basically the market grinding lower. So we're back about 24,200 to begin the session. This is the first 1 minute of the market open. The Nifty heat map comes up and gives you a quick sense of how we're likely to start. And 3 names are lower and everything else is up and about. So Infi, Shriram Finance, Bajaj Finance and Wipro are the top gainers. On the other side, you've got ONGC, Coal India and HUL, which are starting in the red. So that is the picture. 47 up and about 3 stocks lower on the Nifty 50 pack. Rima.
Well, fairly broad-based in terms of gains, at least for the large cap screen. As you can see, only 3 out of the Nifty 50 stocks are in the red right now. IT is clearly leading. Sectorally, the Nifty IT index is up more than 1%, 1.25% up for the Nifty IT index. So that's opened up well, and I don't see a single sectoral index which is currently in the red, so it is fairly broad-based. Capital market stocks are doing well, financials are higher, the Nifty financial index is up close to about 0.8%, the small cap index is a gain of about 0.8%. Individual stocks, well, Shiprocket continues with its rocket move. The issue price was, I think, 99, got subscribed 99 times. And since then, I think the stock's been on a tear. 150 rupees crossed on that. Gold and silver had a very strong session yesterday. Gold crossing that $4,500, an ounce mark. And today I can see all the silver ETFs, HDFC Silver ETF, Growth, Tata Silver, Nippon. These are up nearly 4.5%. Turtle Mint, there is a brokerage note, so that's keeping the stock active. Strides Pharma in the news, that's one of the big movers. EMS Limited won a small order of about 191 crore rupees, so that's got the stock excited. And even KFin, I think the deal happened in the block window, so KFin is, it's not declining today, it's up nearly about 0.5%.
Well, that's right, Rima. Because of the bounce that we've seen on gold prices, Muthoot Finance, just take a look at that stock, a stock that's corrected from around 4,000 rupees to sub 3,000 rupees. It's seeing a bit of a relief rally in today's trading session. Yes, the competitive intensity worries continue. And in fact, valuations weren't very, very cheap. So that stock, in fact, is up and about, seeing a bit of a relief rally. MCX, if global commodities itself are active yet again, then that's good news for MCX. So MCX bounces back close to around 3%. And Hindustan Zinc is gaining because it has exposure to silver. So explains why all those stocks are bobbing around in trade today. Besides that, keep an eye out on a few more names. Bajaj Style Retail, that stock is up close to 3.5% and volumes are very, very large on that one. So that stock should be on your radar. And the recently listed company Leap India as well, that's up and about in today's trading session. Net, it's a good start. Can we break that streak? That's going to be important to track. And just one more word, because of this bounce that we've seen, I think that streak of seeing lower highs, that's actually got broken finally.
Yeah, let's hope the close is like the open is in that sense, and we'll have to. That'll be the determinant, but it's a good start, no doubt about it. 24,200 is where we're at. By the way, Turtle Mint, there's a Jefferies initiation, but the point is, it ran up. The stock was trading below, I think the numbers came out 10 days back. The stock was below the IPO price. And from there, it had a one-way kind of a rally into this now, which is the initiation. They're an insurance distribution company, like Policy Bazaar, but unlike Policy Bazaar in terms of how they operate. They're more sort of feet on the ground, tier 2, tier 3, unlike, Policy Bazaar, which of course is online, mostly digital, and of course, is also, I think, size also, of course, much different. Policy Bazaar is about 10 times the size of, Turtle Mint, but there's an initiation, so just thought I'll highlight it. Deepika Mundra is with us, Director of Equity Research India at M&G Investments. Deepika, good morning. Good to have you with us here. Thanks very much for joining us. Just to kind of kick this off, Deepika, if you will, give us a sense of where you're at post the quarter earnings that we've seen. What have you done during the quarter? Any additions, any subtractions? And how are you positioned now?
Well, good morning, and thanks for having me in the show again. It's a real pleasure. To kick off with earnings, actually, so quite good, I would say, overall. I think the first quarter for the financial year has turned out slightly better than expectations. Yes, expectations to begin with have been modest, but some of the underlying data points have been quite encouraging, whether it is the broader commercial vehicle demand growth, which is a good indicator for the economy as a whole, credit growth in itself. So I think that the economy has fared slightly better than what we would have thought coming off from the West Asia crisis. In terms of earnings, both the large cap to the mid and small cap earnings have been slightly above expectation on balance. The broader markets, of course, have seen much higher earnings growth. In terms of what we have done, so we follow an approach of having a curated universe of stocks that we are close to, and we tend to draw concentric circles around those. So sticking to that, we would have added more exposure to precision manufacturing and industrial companies, electrical components in some of the correction that we have seen around the margin pressures. metals, which we believe to be quite transient, and auto components. So these would be some of the incremental names that we have added in the portfolio in the last couple of quarters.
Deepika, just a broader question if we zoom out. Now, M&G Investment is a part of the broader UK-based global investment group, M&G. So how would you assess India's importance in terms of interest right now, in terms of capital allocation? Is it getting money only as a part of the broader EM portfolio, or are we seeing interest in terms of active, India allocation? So how would you assess, since you would have a global perspective as well, in terms of how money and interest is moving?
That's a great question, given in the context of what we've seen in FII flows over the last couple of years. But at M&G, we run multiple strategies. So we have an Asia X EM, as well as India dedicated, Japan dedicated, and China dedicated strategies. Our India dedicated strategies have been very consistent in terms of AUM. So we have not really been sellers of in the India market over the last couple of years, as we've seen some of the foreigners behave. In terms of the broader strategies, again, I think the interest levels in India remain fairly robust. Asia has seen very solid earnings growth, partly backed, of course, by AI, but the earnings growth there has also been very promising. But over the last quarter, I would say that allocation from the broader strategies towards India have also been increased somewhat.
All right. Hi, Deepika. Good to see you. Ben, just hold on to that thought. We have some news that's coming in there. The gold loan business is going to get even more competitive because Aditya Birla Capital has entered that space. They're going to be opening close to around 1,000 gold branches in the next 3 years or so. So explains why that stock is a little bit excited. New vertical for them. And it's up close to 2%. One of the big outperformers, actually, if you've seen in the last, I recall Tata Capital had come out with their IPO. And at that point in time, people were pointing out that actually Aditya Birla Capital has valuation comfort. And that one has rallied from, I think, 290 rupees to 400 rupees. Yeah, Rima.
No, I was saying we should also pull up some of the competitors like Muthoot, because I remember Muthoot's Q1 numbers, yields had corrected very sharply and the street was disappointed. So although there was growth, the fear was that competitive pressure is putting pressure on the yields. But of course, Muthoot today is holding up because gold prices themselves have surged overnight.
Yesterday, the event yesterday evening, the Banking Transformation Summit, one of the focus areas was, of course, gold. And one stat which really stood out was that 3 years back, or was it 4 years back, the total industry gold loan AUM was 4 lakh crores.
Okay.
Right? 3 years ago. In 3 years, that 4 lakh crores has become 21 lakh crores.
Okay, wow.
4 has grown to 21.
We should also find out how many players have also entered into this space, right? It's the existing players are quadrupling, but also so many new entrants
have come in. For example, L&T Finance, they bought this company last year. The gold loan AUM was about 1,300 crores. 1 year. I mean, I think it's exactly going to be 1 year now. The book has grown almost 4 times in 1 year.
Correct.
So, I mean, it's just, it is been tremendous.
And I think that it'll be a lot of tonnage as well, because if you're saying that 4 lakh has become 21 lakh, you have gold that's up to doubled. Yeah. So that would be a lot of tonnage as well.
He said they acquired a company, right?
The overall industry.
No, they acquired 1,300 crores, but obviously they've been adding like 10 branches a month and, really expanding. I'm told, by the way, it's hard to find people, because you need trained people. It's not an easy business. So apparently attrition is 70-80% in this particular segment, employees, right? And you have to offer, and where are you going to get people? You're going to get people from the established older names. Yeah. So, but yeah, I mean, I think you pointed to yields, right? So this is a natural consequence. Yields have to come down. Yeah. They can't stay at so high, right? With these number of players, newer players coming in and all the other stuff which is going to happen. Deepika, I don't know if you have any thoughts here on the space, and did you own anything here?
No, actually. So we don't have any direct exposure to the gold NBFCs. We have, of course, exposure to the broader NBFC, slightly the more diversified names, which have been seeing an increase in their gold loan books, but not direct exposure.
Hi, Deepika. Good to have you on the show, Deepika. I recall a call that you had made earlier, and you all were bang on. I think you all had an underweight stance on IT services as well as consumer staples. Now, that's played out well. Some of the stocks have seen a sharp correction, and some of the staple companies as well have seen a time-wise correction as well. You'll maintain their underweight stance, or are you selectively getting a little bit more optimistic on either of these two sectors?
So, yes, See, we're always looking forward. We don't look at what has happened in the past. And if we think about it prospectively, yes, IT multiples have corrected, but do we see the same earnings power as we have seen in the past? We don't think so. I don't think we're there yet. Plus, in the US, some of the IT services names are available at single-digit PE multiples. So just in terms of the valuation gap as well, India still stands out, which is not in its favor. So we remain underweight on IT services. Similarly, for consumer staples, we believe that the distribution change with quick commerce and newer platforms has disaggregated the market to a large extent and brought in a lot more competition with D2C brands and private labels. So I think that even for consumer staples, you can't have both growth as well as increasing margins. So we continue to remain underweight that space as well. Although our stock selection is very bottom up, but broadly, we don't see any meaningful opportunities in both those sectors just about yet. What we like, though, is healthcare services. That's a space we are significantly overweight on. And the reason being that we are seeing several opportunities over there, from hospitals to diagnostics, dialysis companies, CDMOs. A lot of these companies are likely to have very good earnings power from a much more medium term perspective. So that's a space that we like. I already mentioned precision manufacturing, auto components, and aerospace. We were recently in Bangalore, and the kind of progress that we're seeing on capacity addition to cater to some of these newer developing supply chains that are coming to India is quite interesting. So that's another space which we find where the earnings power could last for a much more medium-term perspective.
Deepika, possible for you to share some names in this precision manufacturing, electronic components, or even in the healthcare space with the disclosure?
So unfortunately, I will not be able to share single stock names. But in healthcare, of course, some of the leading hospitals, dialysis companies are really quite interesting. In precision manufacturing, the opportunities are multifold. One is aerospace in particular, because of European supply chains coming to India. You can get some of that exposure via the auto ancillaries as well, which are well suited with their manufacturing capabilities to cater to that market. And then also within the auto component space, we're quite focused on companies that have their own IP. So whether you have unique suspension technology or ECUs, so essentially in areas where companies have their own IP rather than just being metal processors.
But can you buy at this juncture? I suspect that you all have also entered in at lower levels, because this now seems to be a pretty well discovered theme. So I get that the earnings visibility is going to be strong for the medium term, maybe 3 years, 4 years down the line, but markets are very quick to price it. Markets price it in a span of days. In 2-3 days, you move up 30%, and then you've priced in the upside. So at this level, would you be comfortable buying these stocks that you like in your portfolio?
We always say that volatility is our friend and velocity is the more difficult challenge to handle, particularly in the India market. So you're absolutely right. The valuations have increased in this space quite dramatically, and it's always more challenging to get in at these levels. But I think that we continue to find opportunities here. I think the end markets over there are quite diversified, and the number of opportunities are quite large. So I think it's still quite interesting.
We haven't spoken about the big sector, banks and NBFCs. That's a large chunk of the index. What's the view?
So we continue to prefer the private sector banks. We see that there's quite a bit of valuation support there. I think that's fairly consensus, so to say. But again, like I mentioned at the beginning, credit growth remains quite buoyant. But I think that overall, I'd say that what we used to hold in the portfolio 5 years ago in terms of private banks as weight is lower what it is today versus 5 years ago. The reason just being that the number of IPOs in India, the broadening of the market and the opportunity set has created a lot more opportunities for active investors. So your portfolio no longer looks like the old banks, IT and consumer that it used to 5 years back.
Okay. We leave the conversation here. Deepika, always a pleasure having you. Thank you.
Thank you.
Make more trips down here. All right, let's move on now to the next management on the show, and that is Premier Energy. Vinay Rustogi, Chief Business Officer at Premier Energies, is now joining in. The company clocked in a good quarter. Q1 revenue growth was about 35%. The absolute EBITDA jump at 30%. Margins came in at 29% compared to 30% in the prior year. Cell utilization was strong at 92%, and the order book healthy at 15,000 crore rupees. Vinay, thank you very much for joining in. I think the concern is, let me start with a broader concern, is that competition is going up for modules and capacity is also inching up. So while you have guided that margins will remain in that 29-30% mark, there is still some skepticism how you will be able to achieve it with competition and capacity coming on stream. Help the investors, the shareholders get some confidence. How will you be able to achieve this margin guidance?
Yes, sure. Good morning, and thank you for having me. So I think in terms of the competition, what I would say is that, if you look at the demand, let's look at that first. The demand has been obviously much stronger than expected. We are seeing quarter after quarter of record installations, particularly in the Surya Ghar Yojana and the Kusum schemes. And then on the other hand, supply, yes, of course, everybody has been concerned about supply. But if you see the capacity utilization and the volumes that are coming out, the supply is taking a much longer time than expected to fructify. So our view is that because of the strong growth in demand and the supply taking time to catch up, there is a far healthier demand-supply balance in the market overall. On top of that, we have an order book of about 15,000 crore rupees, which is almost 2 times of our revenues in FY26. So, we have a very healthy order book, which gives us visibility over bulk of our revenues and margins in FY27, and even I would say going well into FY28. So because of that, the overall demand-supply balance and a healthy order book, we feel very confident that we can protect our margins.
When do you think the module industry goes into overcapacity? I was looking at some reports and they said that India's domestic absorption is about 50 to 60 gigawatts annually. The current ALM listed module capacity is about 139 gigawatts and expected to cross 200 gigawatts in FY28. So correct these numbers. These are numbers that I picked up from some reports. But as you're saying, right, the module capacity is it's planned, but it's still not come on stream. So at the moment, the demand supply is well balanced. But at what point does it tilt? And if you could give us the demand and supply equation today and how it's going to change.
Sure. So, you got the demand numbers spot on. But on the supply side, I think let's go into a little bit more detail. When you look at the supply side, you have to understand the entire value chain, which is starting from polysilicon to ingots and wafer cells and then modules. Modules is the final product, but making modules is quite easy. There we have excess capacity to the extent of about 250 gigawatts, which is obviously very, very high. And because of that, the margins in the module making business have actually completely kind of evaporated. So today we are operating at a zero margin level at that part of the value chain. But the interesting thing is that the more further backward you go into the value chain, currently we are at cell, and 2 years onwards, based on the government policy, we will all be getting into ingots and wafers. Now, these backward integration stages are actually where we have a real supply crunch. In cells, for example, the current capacity is only 32 gigawatts, and the supply is only about 22 gigawatts. So that is where, that is resulting in a bit of an undersupply situation in the market, and pricing and margin levels are obviously very, very healthy. And we expect that to continue, I would say, at least over the next 2 years or so. The interesting thing is, after 2 years, even assuming that you have more capacity comes online, that is the time when the industry will be moving further backwards into ingots and wafers. And that is, again, going to take some time in terms of ramping up of capacities. But the further backward we go, I think the competition is going to reduce. And that is for 2 reasons. One, this is a highly capital intensive business, operationally very complex. Technology adoption takes time. Building new plants takes time. And that is why we feel that if you look at this entire value chain, the business is going to be dominated more and more by companies who get into ingots and wafer and cell business. And that is what is going to dictate the market volumes and pricing, and going to create a differentiation between different companies in the industry.
So integrated players like you will have an advantage. It's the non-integrated players who don't have cells and wafers, etc. over a period of time. They are going to be, in a way, squeezed out of this entire demand supply. So for you, you are confident about the next 3 to 5 years. What would be your 3-year projections in terms of revenues and margins?
Yeah, so, as a company, we don't formally issue any kind of guidance, but if you look at the industry, the analyst estimates, our FY28 analyst estimates are around, average is around 18,000 crore rupees, with an EBITDA of about 4,500 crore rupees. And we believe that we can do, I think, much better than that. And that is why we feel that we can kind of maintain margins in the current kind of ballpark territory.
All right. Hi, Vinay. Good to see you, Vin. If I got that number correct, you're saying that your EBITDA, absolute EBITDA number in the next 2 years can go to around 4,500 crores, right? If I got that number correct, which last year was around 2,300 crores. So effectively, you're confident that your EBITDA number doubles in the next 2 years. Got that out of the way. Give us a few more details then. I was looking at your con call transcript, and you're talking about a big opportunity in the exports market as well. How do you see that panning out? Currently, exports as a percentage of business is how much? Where is it headed? If you could give us some details. And also, how has the order inflow been in Q2 so far?
So, in terms of exports, the industry export opportunity historically has been limited to the US. Now, US, of course, has been kind of clamping down on imports from not just from India, but from all over the world. And there is a threat of new tariffs, countervailing duty, anti-dumping duty, and so on. So I think exports to the US are increasingly looking like not a very viable business proposition. On the other hand, and that is why, if you see our solar business, the share of exports has been basically almost zero. We have a small share of exports in transformers, so which is about, I think, about 20% of the business comes from exports. Now, going forward, interestingly, the European market is opening up. Europe has been very dependent on China, but they're increasingly saying that we either have to make in India, make locally in Europe, or we have to start buying from other countries with a much more kind of friendly relationships. So we are looking at that market. That market. Their target is to have 30 to 40% of their capacity addition coming from non-China supplies by about 2030. So we see that market growing from about 5 to 7 gigawatts next year to almost 30 gigawatts by 2030 in terms of the export potential. And that is where we are focusing our energies on right now.
Okay. And you wanted to give us a sense in terms of order inflows as well so far, particularly in the DCR segment in Q2 so far?
Sure. So, in terms of the order flows, the orders have mainly come from, I would say, in Q2 so far, NDCR modules. The NDCR module market in the last few quarters has been slow, but with the government giving an extension for LMM2 until December, we have seen a pickup in NDCR modules. And then, of course, the DCR segment, the DCR demand is very, very strong. So we are seeing a pretty healthy clip of orders even in the DCR modules. On the sales side, we already have a pretty strong order book going all the way into FY28. So as we go forward, we are kind of keen to grow our DCR orders at the cost of the sell side. So you will see the sell orders slowing down over a period of time, and the focus will be more and more on DCR modules going forward.
Just one more word I wanted to ask you on the foray into BESS. That will be effectively packaging stuff. These will be different cells that you'll have to import, I guess, package it and then supply. So you're looking at getting to a end-to-end, player in the BESS, segment. Tell us, what is the plan out there? What kind of investments you will be making, and what kind of an opportunity is it for a company like yours?
First of all, I think it's very exciting what is happening in the West market because we are adding so much solar and wind capacity. The grid is facing a huge imbalance issue. If you look at the 24-hour demand supply, that is where storage comes in. we are seeing that market going from zero as of last year to something like 40 gigawatt hour from next year onwards. So, that is about 40,000 crore rupee market annually from next year onwards. So it's a very large market which is opening up. Our intent is that, as more and more solar projects integrate with storage, these solar projects are buying solar modules from us. And we obviously want to use our relationships and our track record to leverage that to start basically winning market share in the storage business as well. In terms of our plans, what we have announced is that we will first get into the assembly business, use imported cells, and then assemble them into battery packs and then containers. And then over a period of 2 to 3 years, we will look to examine a further backward foray into battery cell manufacturing. The rationale for this kind of planning is that at this point in time, there is the Indian market is still allowed to use imported cells and batteries, and competition is very strong. And until and unless the Indian government brings in more duty measures and non-tariff barriers to support domestic manufacturing, we want to kind of limit the capital exposure and the technology risk in the business. And mind you, in the battery space, there are many competing chemistries which are becoming more and more promising. The pace of technology change is very high, and hence we want to take a slightly paced approach over the next 3 years, starting from the front end, and then over a period of time going into further backward integration.
Very, very quickly, Vinay, that 5,000 crore of fundraise, is it an enabling resolution, or are you planning to raise it? If yes, by when?
Yeah, so I think we've been actually very, very transparent and categorical that our current capex plan, 12,000 crore rupees going into FY29 is fully funded. In fact, we have a very healthy balance sheet. Our debt to equity ratio throughout this entire period of capex is expected to be less than 1:1. In fact, in the last week, we have had a credit rating upgrade from CRISIL. Our long-term credit rating is now A+. So really, there is no need for any external funding at the current capex program. The reason we have taken an enabling resolution is that we do see a lot of interesting organic and inorganic growth opportunities. And as and when these crystallize, we want to be able to kind of capture them and obviously raise more capital. But that is something which is in the future. Nothing is imminent as per our current plans.
Okay, we'll leave the conversation here. Vinay, thank you very much for joining in.
Thank you so much.
Get into a break. On the other side, the management of Tilak Nagar Industries will join in to talk about FY27 and the way forward.
Welcome back. Well, let's focus on Tilak Nagar Industries. That's been one of the outperforming stocks from the broader markets. To help us out with how business is moving, we have Amit Dhanuka, the CMD of Tilak Nagar Industries, who joins us on the show. Hi, Amit. Good morning. Good to see you. Well, we have been tracking various IPOs, Milky Mist and the likes. For the time being, it appears people are only drinking brandy. The way your stock has moved, I think it's up close to around 25% or thereabouts. So it looks like demand appears quite strong on ground. Give us an insight into that. How are volumes moving? And also with regard to Telangana, a few details is what I ask you. Tell us what is the contribution coming in from the state and where are we in terms of that price hike that the street has been looking forward to?
Well, good morning, Nigel, and good morning to all the viewers. I think at the outset you mentioned brandy, but let's keep in mind that today we are predominantly a whiskey company. Post-acquisition of Imperial Blue, now 70% of our business is whiskey. Coming to the Telangana point which you raised, yes, we have made representation before the government authorities for a price increase. Usually the government gives price increase to the suppliers every 3 years. So the last increase was 3 years ago. So we believe the time is ripe now to seek a price increase in Telangana. Where it stands is the government had formed a price fixation committee. So all the companies were called. They had to give their representations as to why a price increase is warranted due to the input cost increases which have happened over the last 3 years. So all of that has been done.
Okay.
And now I believe the committee will give its recommendation to the government for final approval.
When will that happen? And, when they did that price increase a few years ago, if I'm not mistaken, it was around 12%. You're expecting the next price increase to be in the similar vicinity?
Yes, we expect that the next price increase also should be in a similar vicinity. As far as the timing goes, I think it's hard to really give a firm date, but we expect perhaps within the next 2 months it should happen.
Okay, and since you corrected me on that, now you're more whiskey than brandy. I wanted to ask you this question. People, when you went ahead and bought Imperial Blue, many said that, those that didn't get the asset actually were lucky losers, because Imperial Blue in terms of volumes were actually degrowing. And then you'll have gone in there and bought it. And in our last interaction, you mentioned that they're actually gaining market share. So give me a few numbers. At its peak, what kind of volumes was Imperial Blue doing? Then at the low, what did it fall to? And at current run rate, where is it headed?
Okay. So, yes, Nigel, it was certainly a large acquisition for us, a large asset to digest. And the last 12 months have been very intensive in terms of the integration. But we had the first quarter of the integrated performance was quarter 4 and quarter 1. And the volumes have shaped up quite nicely. In fact, for quarter 1, the Imperial Blue volumes were about 5 million cases. So, at an annualized rate, and keep in mind that quarter 1 is the weakest or the leanest quarter. So we should be expecting the annual volumes to be somewhere between 23.5 to 24 million cases, which would be a healthy growth over the business. When we had taken over, the annualized rate was around 21 million cases. So I think the brand is now, we are positioned it on the right trajectory. And there are a lot of industry tailwinds as well. So we are expecting for a good year.
Got that. Amit, good morning and good to see you here. Prashant this side. So we've spoken about Telangana, we've spoken about the Imperial brand and your aspirations and ambitions with it. Let's talk about another state, right? And I think this is one of the largest markets, but in a way it's kind of closed. I'm talking about Tamil Nadu, where there is a change of government, state government after many years. Lots of reports essentially floating around that there perhaps is going to be a change in policy, which will happen. Now, for our viewers, and correct me if I'm wrong, Amit, the way it works is it's basically run by the state government. There is a body called TASMAC, which runs all retail outlets. It procures from an approved set of vendors in Tamil Nadu, right? I think about 11 odd companies it buys from. And I think the rule says that to be able to sell in Tamil Nadu, you've got to make in Tamil Nadu, right? That is essentially what it is. Is there likely to be a change to that rule? What do you think, Amit?
So good morning, Prashant. Tamil Nadu is a large market. I think out of the roughly 450 million cases of IMFL sold in India, large portion, approximately 65 million cases, comes from Tamil Nadu. So it is one of the largest markets, and a very large brandy market at that. I think out of the 65 million, 50 million cases odd would be brandy. Yes, it has been a little restrictive. Currently out of our total business, less than 1% comes from Tamil Nadu. Perhaps for some of the reasons which you have mentioned, I think the policies have been fairly restrictive in nature. But yes, there has been a change in the government. There's a new regime which has taken guard, and almost after 30 years, we have a new party which is at the helm. I mean, otherwise it was oscillating between two parties. We have a third party which has emerged now. We also have heard a lot of noises in terms of the progressive action which the government is seeking to take in the liquor sector, across sectors, but liquor as well. Yet we are yet to see concrete action on the ground. The government is displaying intent in terms of what it wants to do in terms of making the policies more progressive and more open. and more far-sighted, but we are yet to see any concrete action on the ground.
But is there a
But are
policy?
you hearing, I mean, sorry, are you hearing specifically that they may, so there is a lot of change, right, with regards to, they've shut shop. There is another, I think the PMK is, some representatives have been talking about all kinds of stuff floating around. But what will be consequential for companies like you and others, national companies like you, Radico, etc., maybe as well, is if they decide to open up the number of players they buy from, right? And they, so, I mean, you are one of the 11 players or whatever, 13, 15, 20 players that the TASMAC buys from. That is the change. Are you hearing something specifically on that, Amit?
So we are not hearing anything specifically on that. Well, as a company with a large brandy portfolio and a national footprint, we have made our representations as well to the authorities and what we feel would be in the best interests of the consumers, the manufacturers, and the state exchequer. So we have made those representations, but it remains to be seen as to what policy initiatives are really taken by the government.
Okay, Amit. It's not as if you are not present in Tamil Nadu, right? You already have a bottler, you sell through them, I mean, they bottle it for you. And you said about in terms of your business, only 1% comes from Tamil Nadu, right?
Correct.
And it's one of the largest markets. Why is that? I mean, if you have a bottler in place, why is, and the products are popular, why is it so small? I mean, you should be able to sell through the bottler, right? Even if you're not there directly.
So, Prashant, I wouldn't like to get into too much details in terms of, the operational issues which are there in terms of scaling the business, but certainly there are some. But yes, as a percentage of our overall business, it's very low. And we see a lot of headroom available in that state, but we need some policy frameworks to be slightly conducive to make it easier for national manufacturers to operate in that state.
You think if this policy change is made, what is the opportunity in your opinion? I mean, just back of the mind, if you're able to, if you are impaneled directly, what is the size of the opportunity? We know the numbers in terms of the cases sold, you said, right? But what does it mean for Tilak Nagar? What could it mean for Tilak Nagar?
So I could put some context. I mean, since Tamil Nadu is predominantly a brandy market, we'll speak about that. Out of the 50 million cases of brandy sold in Tamil Nadu, maybe 10 million would be the prestige and above segment, which is the more relevant segment for our business. And nationally, if you see, our market share in prestige and above and brandy is close to like 45 to 50%. So perhaps that could be an indication in terms of the headroom which could be immediately available. And
sorry, I missed that. You said 50 million cases of brandy are sold every year in Tamil Nadu, and your market share in?
I said 50 million cases is total brandy market in Tamil Nadu, out of which 10 million is prestige and above.
Prestige and above.
That would really be the relevant segment which we would look at addressing. And if you see nationally in brandy, prestige and above, our company enjoys approximately 45% market share. Whereas in Tamil Nadu, currently the market share in prestige and above is around 5%.
Got it. All right. So big brandy market for you and big potential, both whiskey as well as brandy. Very quickly, the stock has seen a big run. And there's always that speculation that probably the promoter entity is looking at raising some money. So a couple of questions here. You have some outstanding warrants. By when do you intend on converting that? Point number one, I think that is sub 400 rupees. So in all probability, you should go ahead. And the other question is there a QIP in the box?
So as for the promoter warrants, yes, we have warrants which are outstanding to be converted, and we have to convert it by end of March next year. So certainly I'll be converting the warrants. As for the next question, as regards to the QIP, so Nigel, no immediate plans as of now. I think the balance sheet looks, fairly comfortable. I think quarterly performance given by quarter one, I think we're on the right trajectory. I think we should have strong cash flows emerging. But we'll keep in mind that companies always open to opportunities. If there are opportunities available to accelerate growth, we would be open to the idea at a future point, but nothing right now.
Lovely conversation. Thank you very much for coming on, Amit, and kind of giving us a sense and size of the opportunity. I mean, a lot of these are policy changes. It's a strictly regulated business that you're in. But of course, I mean, the opportunity is large. Price increases in one state, imminent perhaps, and of course, a policy change, if it so happens. Of course, it's in the realm of, if right now. We don't know if it certainly will go through, but the opportunity is there. Thank you very much.
Thank you.
Okay, well, I think we've got IPO discussion lined up next. And we have Kaushal Shah, MD and Head of Equity Capital Markets at Kotak Investment Banking waiting. And we have Bhavesh Shah, MD and Head of Investment Banking at Equirus Capital, also waiting by. Thank you for being patient, gentlemen. Great to have both of you here. Appreciate your time. If I can start with you, Kaushal, and, with a lot of guests that we've had on the show, we've been sort of course, talking about the super listings that we've had lately. Not just on day one, but on day 2, day 3, day 4, the continued run-ups that we've had. What is it, according to you, Kaushal? Are bankers suddenly becoming benevolent, leaving a lot of money on the table, or this is a mix of things? In some businesses, they're unique, first to the market in their category. Maybe that is that element. Some amount of FOMO, perhaps, euphoria around certain businesses. Give us your sense.
Yeah, thank you. No, I think there are multiple factors. One, of course, is the fact that a lot of the negative aspects or the overhang which was there, whether it is because of the West Asia crisis or maybe the corporate earnings, there was an overhang with respect to the monsoon. I think that all has been factored in. And which is why if you look at the last 1 month, the number of IPOs that are around about 13 to 14 IPOs that have happened, totaling to more than 40,000 crores. And this, by the way, is more than around about 55 to 60% of all the IPOs that have happened in this calendar year. That just highlights in terms of the positivity with respect to the investors' mindset of wanting to invest in IPOs. And the other aspect clearly is that the companies which are coming and doing the IPOs are quite differentiated. There's a significant tailwind, especially with respect to the manufacturing sector. And hence, there is a urge of having a stake in these particular companies. So there are multiple factors why you see a lot of interest. And that is also driving in terms of how the prices have behaved.
Bhavesh, you want to come in? Are we seeing a genuine, revival and interest in the IPO sentiment, or is it the fact that, as Prashant was asking, bankers have been a little more generous with the valuations this time around? And what happens once the large ones come in, NSE and Jio? Will that crowd out some of the smaller mid-cap IPOs? What's in the pipeline?
I'll take that, Rita. So I think if we were to really look at this year's IPOs, we have seen a return of something 11% on listing, if you were to look at an average of all the IPOs that have happened this year. But if you were to look at an average of only the IPOs which have come from July onwards till August, the returns have gone up to around 25% on listing. And if you were to look at IPOs which have just started in August, the returns have gone up to 36%. So clearly, I think what is happening is the investors or the companies, investors who are coming in as the anchor investors, and the pricing which is happening, there's a lot of margin of error, or there's a lot of margin of safety that is actually built into the pricing. And with the the returns starting to come in, I think we are seeing this kind of a phenomenon where now we will see more and more IPOs coming in. And as was discussed earlier, these businesses are some of the fabulous businesses which have been set up in the last, I would say, 10, 15 years, and they've grown very well. So I wouldn't be surprised, if we see a good momentum of this continuing into some larger issues going forward. At the start of the year, my expectation was that we will raise about $20 billion. This year, we already raised about close to $7 billion. We're in August, and we have quite a few large issuances coming up. So, so I think we are on track to raise a good amount of money this year as well compared to the previous years.
Okay. And once Jio and NSE IPO come, is it expected around Diwali? Should we expect a Diwali dhamaka? And at that point, will we see any mid-cap, small caps, or they're just going to simply stay away to make space for these?
So I think, some of us are BRLMs to those issues. So it wouldn't be fair on our part to kind of really comment on the timelines. But yes, I think the work is on, and I think as soon as the things are in order, to launch some of these issues.
Okay. Kaushal, what's the lesson from Zepto delaying its IPO? Much awaited. Everyone was looking forward to that. But clearly, investors are not willing to aggressively back high loss-making companies with high valuations. But after that, you got a Shiprocket, much, much smaller in size, but again, a loss-making company. And that, while it may have been well priced around the time of the IPO, since then, it's given a 50% return. So what is the takeaway from what we've seen with respect to these new age tech companies and Zepto in particular?
I think we have seen enough number of new age companies, digital tech companies, that when they are going for an IPO at that time, they may not necessarily have the profitability. But the way the investors look at it is in terms of what is the growth profile of the companies. And especially growth is a big factor as far as India is concerned. And that's why the multiples in India are better than what you see in the mature markets. So if the companies are going for growth, going for market share, and if they look at over the next 3 to 5 years, because investors are not necessarily looking only for that particular year, if the business model is strong, where you see that the margins are expanding, where the return profile is building strong, the companies are gaining market share. I think all these factors go into deciding in terms of the investment themes, as well as in terms of how the investors take it up at the time of IPO. And of course, post the IPO, depending in terms of how the results and the performance is, you will see organic growth in terms of the multiples expanding or the prices going up. And that is something that we have seen. It's not only in Shiprocket, we have seen many of the other new age digital tech companies right from the time of 2021, whether it was Zomato, Swiggy, PB Fintech, and many others.
Got that. Let's talk about one name, Kaushal, which is not done so well since listing, and it's the biggest of all these names we've spoken about so far. SBI Funds, right? I mean, remains below issue price. I mean, I don't know if you have any thoughts there. There was a huge amount of interest going into the IPO. All the premiums in the grey market, etc., suggested a super pop. And of course, I mean, we've seen what happened since. Any thoughts on what's happened here?
No, I think, see, if you look at the way the response has been both from a domestic as well as from foreign investor participation, it has been pretty strong. It's a large IPO, so to that extent, the demand that you saw at the time of IPO or even post the IPO in terms of the buying was pretty solid. Now, as we see going forward, a lot will depend in terms of how the results are, and it will effectively track the results in terms of how the price performs. And I think that is what the investors will be looking forward to in terms of how the quarterly performance, especially in the next 3 to 4 quarters, post the IPOs.
Got it. Okay. All right, gentlemen, thanks a lot for joining in and giving us those insights. We look forward to chatting up with you all more often as the IPO market actually hots up, particularly in the final leg of this particular calendar year. It's Sensex weekly expiry though, so that's what will add to the volatility, particularly in the last hour of trade. But for today's trading session, at least we are starting off on a positive footing, which is good. The index of the day really is the tech index, because that actually is outperforming in today's trading session. The last I checked, the tech index was up close to around 1.5%. Now, there are various strikes that are fairly active in today's trading session. And after a while, we're actually seeing put writing. Just take a look at the put writing. Because of this move that we're seeing on the Sensex, the 77,400 put, the premium is down to around 77 rupees. At the end of yesterday, it was 480 rupees. So that's the kind of writing that you're seeing on that particular strike. 77,300 put as well. The premium, the last I checked, is down to 50 bucks, 45 bucks approximately. At the end of yesterday, it was around 415 rupees. So that's a massive drop of close to around 90%. So the writers are at play. The bulls believe that now, in fact, that coil needs to pull back a little bit in the opposite direction. And that explains why, in fact, you're seeing a lot of writing. However, on the upside, this is going to get tricky because the 77,500 call as well, the premium is at around 100 rupees, which is telling you the 77,600 mark just for today's trading session could be a bit of a resistance zone, while your reference point on the downside comes in at around this 76,900 odd mark. So that's the broad range you're looking at, the broad range for the day. I think the bulls will actually want to get closer to around the 77,600 mark and actually take that out. That's what will get the call writers into a little bit of a panic. So we'll see how that goes. For the time being, we slip into a short break. But on the other side, Manisha Gupta is waiting for all of you. She's going to tell us what's going on in the commodity markets.
Welcome back. Let's talk commodities now. Manisha is joining in, and I think Manisha is looking at all things precious and sparkling today. Manisha.
Oh, I'm absolutely doing that because overnight has been such a great market. When you look at the gold prices, well, we've seen prices gain up by 5%. It's trading at a 2-month highs right now. You have silver, which has gained almost 5.5%, and platinum trading at a 5% of gains as well. So this is multi-month highs that we're looking at in all of these prices. Platinum is trading at a 9-week highs, gold at a 2-month high, silver as well trading at around 2-month highs in the international markets therein. Well, there have been various reasons on why you have seen the precious metal prices gain up. To begin with, it has to be about sharp retreat that we've seen in the U.S. Treasury yields from near 30-year highs in the U.S. markets therein. There has been U.S. Treasury Department with more than double repurchases of 10 and 20 and 30-year debt in the markets there and in the next few months as well. And that is what led to buying come back very strongly in case of gold and silver. The geopolitical tension is your second point to watch out for because the heightened uncertainty that we are looking at in West Asia with US and Iran not talking, no negotiations. Instead, you have very, very aggressive statements coming in from both of these countries has led to the crude oil prices trading at $92 a barrel. So crude-led inflation is yet another thing that the street is watching out for. Add to that the fact that there is also sustained central bank buying that we are looking at. China, for example, has been buying for last 20 months now. And not just China, various countries in Europe, in Asia also have continued to buy. There are more newer countries getting added to that list where the central banks are buying gold. The ETF buying, the whole financialization of gold also has led to a lot of new investors coming into the market. So after that losing streak, July actually attracted 3 billion in sense of net flows in the global ETF markets there. And if August numbers are anything to go by for the first half of August, we are looking at stronger numbers therein as well. The dollar index as well, trading at around 3-month lows, has been a supportive factor because all of these commodities are dollar denominated. And then the Indian festival demand, the wedding season demand, the global Christmas, New Year, pre-bookings, all of that seems to be on the positive side as well. There also is a lot of speculative short covering, return of safe haven demand that seems to be supporting gold and silver is the reason after hitting 4,000 and below kind of levels, we are trading at around $4,500 an ounce right now. So $500 of a jump up from the kind of lows that we've seen in this year till time. I also want to take you through India ETF buying that has been on the stronger side as well. Just about 22,000 crores in 2023, cut back to 2026, and we are at 1.7 lakh crores. So that's the kind of run-up that we've seen in sense of AUMs into gold ETFs there. When you look at the last couple of months as well, whether it has been about June and July, we've turned positive here as well. June was quite strong, July also in the positive, and August, again, as I said, the kind of initial conversations that we are looking at or numbers does show positive numbers yet again. Interestingly, when this 2026 as a year started, S&P Global Commodity and Bloomberg Commodity Index, both of these show this is the kind of commodities anyways is a smaller part of portfolios. But when you look at the overall commodities as well, all of these indexes basically have gone very, very strong with energy. Agriculture is second, metals third, and gold has been a poor fourth, by the way, when it comes to allocations in sense of weightages. So 7 to 14%, well, the markets believe this is way lower in sense of allocations. Energy clearly has moved a lot. Agriculture, multi-month, multi-year highs for many of those as well. And industrial metals also saw all-time highs. Zinc is trading at a 4-year highs. But most of the markets analysts still believe that the way the year has gone by, it still is under allocations that we are looking at. And finally, on how the rest of the year can be for the gold prices, well, we have bullish cues coming in for that one. $5,000 to $6,000 an ounce coming in from JP Morgan, Goldman Sachs, Metal Focus. They all believe that the gold prices can be looking at higher highs for the rest of this year. That's exactly the view coming in from Deutsche Bank, HSBC, ING, which look at gold prices trading anywhere between 4,600 to 4,900 in the fourth quarter of this year, much higher from where we are trading right now.
Manisha, thank you very much. So gold is in focus in more ways than one. Was a big topic of conversation yesterday with regards to NBFCs, banks, etc. We'll play out some of that stuff from our Banking Transformation Summit as well. Thank you. We'll take a break. We are back. Lata speaks with the external MPC member, Saugata Bhattacharya, on the minutes of the August 5th policy. Important to take note. Stay tuned.
The minutes of the August 5th MPC are clearly more hawkish than the monetary policy statement on August 5th and the governor's replies in the press conference that followed on that day. While the statement said there is no evidence of generalized inflation, I'm quoting the statement, the governor in the minutes says that, and I quote again, there is limited evidence of generalized inflation. The RBI members, both the DG and the executive director and the external members, are clearly sounding a little more worried about the evolving inflation situation as far as the minutes tell us. Well, today I have with me Saugata Bhattacharya, external member of the MPC and established economist for many years. Saugata, thank you very much indeed for your time. In the deliberations of the MPC, was there a heightened worry that, the fuel prices may pass on into second round? I think you're on mute.
Yeah, sorry. I think the biggest, most clear evidence of an underlying worry are the projections of inflation. 5.9% headline inflation. Of course, a large part of that is getting driven by food inflation. But again, the target for the MPC is headline inflation, not core inflation, not generalized inflation, not core inflation, nothing, headline inflation. So I think given the projections of inflation, given the 4.3% forecast for core inflation that's there in the MPC minutes, in the MPC statement, I think it should be relatively obvious, should have been relatively obvious, particularly if you see those numbers, the forecast, in conjunction with the last para of the monetary policy statement, that inflation is getting normalized, and then this would probably need a recalibration of the policy. I was a little surprised, frankly, when I read the commentary post this statement, that the minutes sound dovish. I thought, given and I agreed with the language of the statement. Of course, you cannot give forward guidance because the problems, but to the extent that the forecast of inflation gives you a sense of where price pressures are moving, and together with this, with a noting that this might need a recalibration, I thought it was relatively obvious. What the next move, whenever the next move happens, I have no idea when that next move might be needed, but the next move I thought was clearly indicated.
Okay, we had two clues. Poonam Gupta says a case for a hike may emerge during the course of the year, and we did a poll, and the poll indicated that 2 hikes are likely. That is 80% of, 8 out of 10 people voting were expecting hikes. But Saugata, the difference this time is both you and Professor Ram Singh are upfront discussing the real interest rate. Both of you point out that we have to keep an eye on that because that will affect investment and savings. Was that a big discussion that we can't allow to have negative real interest rates probably for 6 months now, if as and when 5% inflation kicks in?
Yeah, so obviously, I'm not talking on Ram's behalf. These are my opinions. This is not the first time that I've mentioned the real interest rate. I've talked of this before as well. So to a certain extent, I think that given the inflation projections that we have in front of us now, that's the information set that we are working with as of this point during the MPC review. Given that, and given the past analytical exercises that the RBI has done on the real natural rate, etc. So given that, my sense is that if this inflation trajectory, particularly core inflation and underlying inflation, etc., if they were to increase a little bit more from the 4.3%, and of course, again, I'm emphasizing that the headline inflation is our target. So if food prices, fuel prices, or whatever, that's the target. To my sense, I'm sticking my neck out a little bit here. I think if that 5% average inflation for FY 27 actually were to hold, then my sense is that the 5.25 is a little bit too accommodative to be able to control anchor inflationary expectations. You've also seen the numbers, the inflation, household inflation expectations are also quite elevated. So we do not want to get in a situation where we fall behind the curve, which will need more aggressive tightening. So this was not the time to move the thing, because there are too many moving parts, too much uncertainty still within the system, and that might persist over a period of time. But if these inflation numbers actually were to hold, and particularly remember that these are not put down in the statement, but a whole bunch of others. You would have a much better idea of this. The results, Q1 non-financial company results that we have seen, the extent of credit growth that we are seeing, margins are getting protected. So that, to my mind, is a sense that there is emerging a sufficient amount of purchasing power in the system for companies to be able to pass on their higher input costs. That's the generalization that we are worried.
Okay. Well, you do say that also in your minutes. But does real interest rates figure in the discussions when you all have on those 3 days, August 3rd, 4th, 5th? And is there a certain sacredness to that 140 basis points, which is the last RBI study we have, that should be the positive real rate? Is there some sacredness to that number?
No, but all of these, monetary policy is not, that number is a guide. Beyond that, you have to use your judgment. This is as much an art as you've heard multiple times before as it is a science. So it's not a sacred number, but it is an indicator. It is an indicator. Beyond that, you look at multiple other numbers, metrics, trends, etc., to be able to put that 140 basis points that you're talking about. That's not a public number, by the way. The last public number, to my mind, is the 150 to 190 basis points, and that's not on the repo. That's on the 30-day, on the 90-day T-bill rate, the risk-free rate. Yeah. So given that, you have to put that number in the context of the current and evolving inflation and growth dynamics, balance of dynamics.
Okay. Thanks for correcting me. That only makes the case stronger that the real interest rates may be too negative for the savers. Yeah. Saugata, you also refer to the external situation, as do everyone. Now, over the past 10 days or so, we have seen a lot of weak numbers from the United States, the CPI number, PPI number, retail sales. So there, actually, the fears of a rate hike this year are practically erased if you look at the CME, Fed Watch, etc. Yeah. Does that impinge on our decisions?
Yes, of course. It's not put out. Governor, I think, has said this many times before, that it's largely domestic conditions which influence our domestic rate decisions. But you cannot escape the actions of the Fed, the ECB, the Bank of England, other central banks, because we are operating in an open macroeconomic environment. So the Trinity, impossible Trinity, does hold for monetary policy making. You cannot wish that away. But again, that is a factor that needs to be kept in mind when we are setting domestic rates. But largely, the decisions are made on domestic inflation and growth, the trade-off between the domestic inflation and growth. Of course, all manner of foreign global influences do impinge on domestic inflation, on our exports, imports, growth, etc. So these are factors, and these are built into the projection, the forecast of growth and inflation that you have in the statement. These are built into those projections. But keeping that in mind, the decisions are largely based on domestic economic conditions.
Okay, fair enough. Ram Singh had, I was hoping that your colleagues will also join the show, but they are busy elsewhere. Ram Singh was the one who had actually argued for going back to accommodation. But in the current minutes, he's arguing very strongly that he's already seen evidence of, global fuel price and other inflation, other price hikes passing on, like commercial LPG, plastics, rubber. He actually mentions, the hike price, second round hike has already gotten passed on. Would you say that the dangers of that second round are higher than lower?
Well, Ram has to address this. I'm not.
I'm asking yours, yes.
Ram has to address that. So all of that. But from my own perspective, and obviously, I mean, you've heard Lord Keynes say that the facts change, I change my view. So obviously, when the situation changes, you change your view. I mean, I'm not talking of Ram, I'm talking of myself. But I mean, there is, irrespective of whatever Ram's observation, there is now, I mean, after the policy, this is the July inflation numbers, CPI inflation numbers that came in after the policy, which has not been built into the statement or the minutes, right? I mean, this is the new information that we have now.
Yes.
There does seem to be now evidence of further pass-throughs of input prices, input costs, etc., into output prices.
Yeah.
Yeah. So, I mean, that is the new information. That is the updated information set post the monetary policy review that we.
Okay. You know, there is one sign of timing of the rate hike in your minutes. You say that any delay may require even more aggressive tightening later, or something to that effect. I'm paraphrasing you.
Yeah.
Therefore, the market is veering around to the view that the hike should not be postponed. Is that a fair assessment, fair draw?
Yes. So we are awaiting one more inflation data print that we will have before the next meeting. So if the trends that we have seen in the July CPI numbers actually begin to get more embedded, I mean, that is to say the momentum. You know the RBI's diffusion index, which tracks the momentum of prices in the so the month-on-month price increase adjusted for seasonal effects, etc. If the diffusion index begins to become stronger, the diffusion becomes stronger, that might argue for a earlier rate cut. If it doesn't, if just like what you're saying, as you said, in the US, there's again a fall in price pressures, maybe we can afford to wait long. But that depends on the data. You cannot have a priori commitment to a October, December, whatever rate hike. That depends on the data that will come in. Together with
you're becoming a classic central banker, yaar. This way and that. Okay, that leaves us not any the wiser.
I thought that was the description of an economist, not a central banker.
Okay. Okay. Well, a central banking economist. Thank you very much, Saugata. That certainly clarifies a lot of things for us, and what you in the committee will watch out for in the days to come. Certainly, to what extent the second round.
Thank you so much. Thank you so much. Always a pleasure to be on.
Thank you. Thanks for that, Saugata. We have to wrap up on Bazaar on that note. After a break, time for Chartbusters.
The Indian market makes a strong start despite elevated crude prices as yields on long-term US government bonds ease on the Treasury's debt repurchase plans. The Nifty reclaims 24,200, led by IT stocks and financials. The broader market gains in line.
Gold prices surge 4% overnight to 2-month highs as US bond yields ease. Gold financiers surge in trade.
The US FTA issues an EIR, or an Establishment Inspection Report, for Strides Pharma, indicating that no mandatory corrective actions are required for the company's flagship Bangalore unit. The stock surges.
Shiprocket continues its rally after its seller listing yesterday as the follow-up buying does continue. There was a block trade as well indicated that Goldman Sachs bought 0.5% at around 131 rupees in yesterday's trading session.
Aditya Infotech rallies nearly 5% as the board approves a fundraise of 1,500 crores via QIP or issue of equity shares.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, with me is Ekta, and it's good to see we have some green to contend with early this morning. Remember, for the last 12 trading sessions, the Nifty has been making lower highs. But today, Ekta, thankfully, that has broken because the Nifty has made a higher high after 12 sessions. So.
Well, yes, Nigel, you definitely got the color right for today. The Nifty is managing to hold at around 24,200. We have the Midcap index, which is up around 0.3%, along with an advanced decline ratio, which is on the positive side. In fact, significantly positive for the advanced decline ratio. Advances at over 2,300 on the Bombay Stock Exchange, with the decline standing at around 1,274 at this point in time. As you can see, the gap is nice and wide. But we also have the Bank Nifty, which is outperforming. So we have the Bank Nifty, which is up around 0.6%. Good time to get a technical check then. We have Sachitanand Uttekar joining in to tell us what he's tracking this morning. Sachitanand, hi, welcome to the show. IT seems to be leading the pack in terms of the Nifty gains today. Just give us a sense, where do we go from here? What would your intraday call be?
Good morning, Ekta. Good morning, Nigel. Clearly, I think it's a relief rally that we have seen today after almost 14 days of decline. The Nifty is trending above its previous day swing high for the first time. So certainly, the level at 24,000 yesterday was defended well. But on the higher side, it is still trending below its 20-day exponential average resistance. So this particular level is placed somewhere close to around 24,320, 340 in that particular zone. So it's very important for the Nifty to sustain above this 24,000 mark and also try and attempt to close above that 24,300 hurdle. So I think going forward for the day, we may see oscillation within this particular range. On the higher side, 24,280, 300 could act as a very strong resistance. On the lower side, we don't see the Nifty, closing below that 24,180 mark. So for the day, I think Nifty could be range bound, and hence we believe that it's better to keep a long short position going forward. On the long side, metal stocks are doing very well. In fact, they have seen a good reversal from their previous day swing lows. Vedanta is something that we have recommended to our clients. We've already seen a swift move in today's session, but we expect this particular move to extend towards 276 during the day. And a positional target is placed at around 288. So we are recommending building fresh long positions in Vedanta. One can keep a stop loss at 266, which is the open low for the day. On the short side, Bharat Forge, the overall structure is a bit concerning. For the last 4 trading sessions, we have already seen it defending that 2,000 mark. But on the higher side, it is failing to sustain about the 2,100 level. It has already started trending below its 5 and 20 exponential averages. So we're expecting further weakness in this particular counter. One can create fresh short positions, keep a stop loss at 2,082 on closing basis. During the day, we may see a drop towards 2,000 levels, but positionally, we expect the decline to continue towards 1940.
Okay, all right. We're going to let you go on that note. Thanks very much for bringing us all of that perspective on the technicals. We'll take a short break now on Chartbusters, but once we're back, the management of HEG will be joining in. Stay tuned for that conversation.
Welcome back. You're tuned into Chartbusters here on CNBC TV 18. Well, let's speak about HEG. That company is in focus. Remember, the NCLT has given their nod for the demerger that they had proposed earlier. To help us out with how things pan out from here on, we're now joined by Riju Jhunjhunwala, the Vice Chairman at the company. Hi, Riju. Good morning. Good to see you in. The long-awaited green signal has come about. So that's good. Be a relief to your shareholders as well, and relief to y'all because y'all have been talking about big value unlocking possibilities. Let's get a few details out. In the next 1 month, do we see 2 listed entities?
So the first listed entity, the new company, would be listed by, I would say, the first week of September. And thereon, the graphite company would have to go in for a fresh listing, which would be anywhere between 45 to 60 days.
Okay, so by October, we should be having 2 listed companies. One will be the HEG, which will be HEG Green Tech, which will be the current listed entity, will be renamed as HEG Green Tech. And later on, we'll have the graphite electrodes business as well. That will be listed separately. Let's focus on...
It will actually be listed as HEG Advanced Materials. So
yes.
not HEG Green Tech.
HEG Advanced Materials. Got that. Now let's focus on HEG Advanced Materials as you're talking about that, because some part of the street is very hopeful that Riju and team are going to unlock big value on that one. But the other part says this is still, business that you're trying to evolve, you're trying to make your mark into it. But let's get your guidance on this. In the next 3 years or so, do you think this advanced materials business, which predominantly is the renewable energy business as well as what you're trying to do on the anodes front, do you think it can do around 1,000 crores of EBITDA? Would that be possible?
So Nigel, like I said earlier, I think we are really on the cusp of a big energy kind of transition. Now that can be played in many ways, whether it is renewable energy, whether it is lithium-ion battery cells. And we've really taken a position over there of being the leading supplier of the supply chain for the lithium-ion battery space. For that, we're putting up this anode plant, which should be operational by the first quarter of next financial year. Things are progressing well over there. We have a lot of LOIs, etc., in place. So we're expecting a good order book, starting the plant itself. And I think whatever we've been talking about so far, we are already, talking internally on how to, increase everything in terms of scale over there. And when I say advanced material, we're also looking at many other materials such as graphene, etc., things that we have been working on behind the scenes very, very well in the last 2 years. And now we are seeing a time when we can actually commercialize those. Okay. So a lot of action on that front, and really the company, the way we are looking at it, is a long-term, very hardcore research and development based and quality-based battery supplier. Battery material supplier. So yes, I think what you're saying is absolutely true. We stick by that, and I think we should be able to exceed what you're saying.
1,000 crores of EBITDA is what you're going to be working with. And just to clarify, on the Bhilwara Energy vertical, which is going to be housed under this advanced materials business, over there, I think the listed company has what, around 40%?
So the listed company has 40%, but that company will merge with the HEG new entity, and then HEG new entity would own 100% of that. So that's a huge, kind of backbone support of 20-year-old hydroelectric plants, which are supplying green power to us, and fully depreciated plants. So a lot of, back-end support from there as we go along building these new businesses for the future.
Okay. All right, Mr. Jhunjhunwala, this is Ekta. You did mention LOIs and an order book just a few minutes back with regards to the anode segment. Can you just elaborate a little more in terms of what the pipeline is looking like when it comes to LOIs? What is the order book looking like at this point in time? And what might you be targeting?
So, Ekta, because of, the strong confidentiality things, because you're working with the battery manufacturers and the tier 1 OEMs. And for the last 2 years, we've been doing a lot of supply to them from our pilot plant. So the way we are seeing, I think in the first 1 year, we should be able to at least do a 50 to 60% of capacity utilization. And going forward in the second year, we expect 100% capacity utilization for this for the first 20,000 tons that we're talking about.
Okay. What is the capex as well as the debt levels for the for HEG Green Tech or the newly listed entity?
So in the next 3 years, I think we'll be making a capex of more than around 6,000 crores. And that would be funded. I mean, today we are already well funded with around 1,500 crores of equity that is there with us. And the balance equity will come from the running projects. And I think around 60 to 70% will be funded out of debt. And a lot of these are, long-term kind of projects. And we are really seeing a lot of good work on the ground. And India, the way it's growing, I mean, in terms of the lithium-ion battery space, a lot of companies are putting up the cell plants, as you can already see. And apart from that, we are quite hopeful that at least 70% of our revenues in the first few years are going to come out of the exports. And exports to US, Europe, and any non-China based countries where they want supply from, of the product from a different source than China.
Okay.
And we are going to be fulfilling that quite substantially.
And capex, you said, will be around 6,000 crores, right?
Yeah, 6,000 crores will be the approximate capex in the next 3 years.
And the peak debt will be around 4,000 crores.
Peak debt would be around 4,000 crores, but that would be repaid very, very soon, I think in the first 3 or 4 years itself.
Got it. The anode business is going to be interesting because you're sounding very optimistic that 50-60% capacity utilization levels will come. But I'm looking at the trends in China itself. This pricing has come down. Do you expect prices to stabilize at these levels? And do you have enough of inquiries that are coming in there that business can actually progress according to what you have planned? Because a 20,000 ton plant is what you're looking at commissioning.
So 20,000 tons in the larger scheme of things, Nigel, is a very small capacity if you look at the overall China capacities. And we are looking at only 4 or 5 customers who will be needed to fill up this kind of capacity. In terms of pricing, yes, the prices did come off in the last 2 years. But now as we are seeing all the prices of the raw materials, etc., strengthening, I think we've reached a kind of bottom at which even China is not supplying material today. And we, of course, expect to get at least 8 to 10% premium on the Chinese products that are being supplied, simply because of the fact that, ours will be a more niche, a smaller kind of base, and also companies that are looking for buying anode material and other battery materials like graphene, etc., that I spoke about. I think over there, a lot of traction we are seeing of people ready to buy from us. So yes, at these levels of today, we are seeing healthy EBITDA margins on paper.
Okay. Just leave us, Mr. Jhunjhunwala, with some guidance with regards to your core graphite electrode business. How is it tracking in terms of EBITDA? There are some estimates that maybe it could move to around 1,000 crores in terms of EBITDA by 2029. Is that a fair estimate?
So the graphite electrode space is more cyclical in nature. And what we've seen in the last 2 years is really like the bottoming out of a very low cycle. And going forward, most definitely, as we saw, in the first quarter itself, I think prices are hardening. The September onwards, we will start taking some price increases. And going forward, the way the electric arc furnaces are being put in the US and Europe, and no extra graphite capacity has been created in the world in the last 20 years, I think we should see a very comfortable situation of demand supply for us.
Got it. All right. So, but directionally from Q3 onwards, I think that's when the price increases come in there. And just to clarify, needle coke prices as well have been moving up, but the price increases will more than offset the input cost, right?
More than that. So needle coke prices would move up by around 20%.
Yeah.
And so the effect of that for us also would start coming on the third quarter. But we'll more than happily pass on those, comfortably pass on those prices. Because that's for all the graphite companies all over the world. And if you see the overseas company, the way they are bleeding in the graphite space, they have no option but to go in for price increases. And HEG will be the clear winner out of that.
Riju, more than happily, the customers as well need to accept it. But I think going by what we have seen, the pain we have seen in the last few years, it appears the industry itself is on the cusp of a bit of a turnaround. Quick question before we let you go, since now you'll have a separately listed business that will be focusing squarely on the core business, which is graphite electrodes. There are 2 large players, Graftech as well as Resonec, that could probably be on the block. Have you heard of that? And you have already financial investment in one of them. But will you look to be adventurous and go ahead and buy probably one of those entities out?
I can't say anything about that right now. I mean, when the time comes, we'll actually look at that. But really, the cost at which we are sitting at to produce graphite electrode in India is far superior than them. But as and when the situation comes, one can really look at, such an option.
But both those
we
two
are
are
more than happy, I mean, in terms of the way we've grown from 80 to 100 and now going to 115. I think that itself should take us a long way ahead.
But both those two on the block. Both those two assets are on the block, is it? Those two companies?
I mean, it's not that they're on the block, but definitely we all know the financial situation of those companies. And yes, I mean, sooner or later, they would need funds in the company in one form or the other.
Okay, all right, Riju, we appreciate you joining in, giving us, broad analysis with regard to how you expect both these two entities to pan out. We look forward to the listing and we re-invite you on the show as and when that newly incorporated business does progress. All the best to you and the team.
Thank you, Nigel.
Well, we'll slip into a short break, come back, continue to focus on markets.
Welcome back. You're still tuned into Chartbusters on CNBC TV 18. Now, I just want to point out that there was some positive news which came in on Lupin, so that stock should come up for you. They have, in fact, entered into an exclusive licensing agreement with Vusis Therapeutics. This is to basically commercialize an Opthal product, which is basically an eye drug. And this is in the European Union, the United Kingdom, Switzerland, Norway and Iceland. So that's stock in focus on account of that particular piece of news. flows. But the RBI Deputy Governor, Shirish Chandra Murmu, has defended the proposed rules curbing revolving credit for NBFCs. He was speaking to Lata Venkatesh at the 4th edition of the Banking Transformation Summit. He said that the aim of RBI's regulations were to bring more clarity for businesses. Our colleague Lata has asked him what exactly is revolving credit that the RBI wants to forbid for NBFCs, and this is what he had to say.
I think most of you are aware, those who are practitioner NBFC, actually this is not a new regulation. It has been there all along. Okay. Revolving credit as such was not permitted even now for NBFCs. But what we are proposing in the draft is we are trying to bring more clarity. And so that's why the definition has been emphasized in the draft regulation. And with this, we feel it will help better compliance. That is the idea. But nevertheless, as you are aware, like this is a draft only. Okay, we welcome any suggestion and any practical issues which the regulated entity might face. Those kind of feedback are welcome, and like I said, this is a draft only.
Okay. So can NBFCs assume that most of the activities that they now do, like loans against shares or loans against mutual fund units or inventory funding, all that will continue to be allowed? Since
obviously, see, our regulation will not come on the way of any business activity. So that is very, very important for all of us. The idea is not to prevent anything. Idea is to do business in a certain way, keeping in mind the risk. So what we are trying to do is bringing more clarity. But as far as operation is concerned, I think it will not cause much problem.
Okay, all right. Well, on that note, though, we'll wrap up on this edition of Chartbusters. You stay with us. Trading Hour comes up next. Stay tuned.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormas Patakia, and from a different pin code today is Ritu Singh. Ritu, good morning.
Good morning.
Well, finally, after 7 days of losses, the markets are finally seeing some green, and the bulls would hope that it stays on.
Yes, the bulls would hope it stays on above the 24,200 mark today, and hopefully that is the resistance zone that we're able to support through the trading day today. But Hormas, plenty of other action in trade today, and we'll get to the macros in just a bit.
Indeed, and that's been the case for the market all through and through. After 7 days of losses, the index is finally trading higher. Of course, we've been around that 24,200 mark all morning. We've not moved significantly from that. We'll get to that in just a bit. But of course, how are the macros looking like, Ritu? Because those have not changed significantly at all.
They haven't, and you have oil prices that are remaining well above that $90 a barrel mark. In fact, as we speak, about $91.67 a barrel. So it's trading steady and it remains elevated. It's in fact the highest level that we've seen in almost a month after that multi-day winning streak, and remains where it is. And of course, there's expected to be some impact on the rupee, but there's a bit of an appreciation on the other side that we've seen today, now trading at about 95.6 to the dollar this morning, and that's recovered from that 3-week low we saw on Wednesday. That was 95.75 against the dollar. And why is this happening? It's largely thanks to that sharp drop in the denominator. So the US dollar index, drop is helping the rupee despite the higher oil prices. Quick look at the benchmark bond yields as well. There's a sharp spike we've seen, about 4 basis points this morning, currently about 6.8485. That's where the yield is at, and that's a 4-week high. The big reason for that, of course, is the more hawkish than the policy, the MPC minutes that have come in, where you have both the RBI governor and the deputy governors making it very clear that there is a possibility of a rate hike in the coming months if this inflationary pressure persists. So all of that is weighing on the yields today. Of course, the higher oil prices, as always, stoke inflation fears, and that is not helping the sentiment as far as the bond markets are concerned. But let's, as always, put the spotlight on the individual movers and shakers in the market. Hormas has walked over to the wall to get us that list.
Well, there's no significant change from the opening levels, at least on the index. The 24,250 level now is the first one to watch on the upside. The bulls would also hope that this lower highs streak has also ended in today's session. So 24,215 is where the index currently is. Still a 60-point divergence between the spot and the futures price. The Nifty Bank, by the skin of its teeth, had managed to defend the 57,000 mark yesterday, and it's a significantly higher up move today. So now back above 57,500, and the difference here too, around about 130, 140 points between the spot and the futures price. Beyond banks, IT is also contributing to the gains on the index this morning. Both Coforge and Persistent Systems are doing well. Infosys too trading with gains of around 1.5%. Coforge is now up 4% as we speak. It's the top gainer on the Nifty IT index. A lot of brokerage commentary came in earlier in the day. MV Photovoltaic had a positive note from Jefferies. The stock is up 4%. HDB Financial was upgraded by Morgan Stanley. That's up 3% as well. PFC was downgraded by Morgan Stanley, as was REC. Both the stocks are down today. And Aditya Infotech has received an initiation from Motilal Oswal. That's doing well as well in today's session. Look at the newsmakers. Aditya Birla Capital is now planning a gold loan foray. That stock is up 3%. Muthoot Finance, of course, because of the higher prices of gold in the global markets, is doing well for itself. LIC, out of the F&O ban, opened lower but has recovered healthily from there. And Strides Pharma too, trading with gains of around about 4.5% after the clearance to its Bengaluru unit. Look at the recent listings. They have been the ones that have been in the news all day. Bihari Lal Engineering too continues to move higher. Shiprocket continues to move higher as well. Some profit taking seen in Milky Mist in today's trading session. So sub 200 is where that stock is. And lastly, look at the names that are at record highs. Look at Man Industries, Bliss GVS Pharma, another 5% added to that tally, and Shilpa Medicare too doing well for itself, 2% higher today, but at record highs, Ritu.
Well, yes, plenty of action there, Hormas. Thanks very much for putting that into perspective. And portfolios must be feeling good today on the back of all this action. In fact, the market breadth is quite strong today. You have more than 2 stocks that are advancing for every 1 stock that is on the decline. So about 2264 stocks on the rise versus about 895 that are trending lower. For the Bank Nifty as well, holding up above that 57,600 odd mark, seeing gains of almost 0.7%. That is helping the market, and was also helping on the other end is the IT pack. Strong show today, trading with gains of 1.3% as we speak. But let's move on and get you some important voices coming in. We had the SEBI chairman, Tuhin Kantapande, who warned that any attempt to defame the CAS or the closing auction session through any kind of manipulation was going to be dealt with sternly. He spoke at an event where he said that the new system is intended to improve transparency, and any attempt at manipulation can be detected relatively easily.
कैश सिस्टम में मैनिपुलेशन पकड़ने के आसान मतलब जो हमारा वो है वो ज़्यादा अधिक है हमारी कैपेबिलिटी पुराने वीवैप सिस्टम से की अपेक्षा जो कैश सिस्टम में हम रिलेटिवली इजीली मैनिपुलेशन को पकड़ सकते हैं तो इसलिए ये आपको ये देना होगा कैश ट्रांसपेरेंसी के लिए है और वो लेकिन यदि कोई ये समझ रहे हैं कि हम उसका कैश को नाम बदनाम करने के लिए मैनिपुलेट कर लेंगे तो वो बहुत ही धोखे में होंगे.
Well, there you have the SEBI chairman talking about that closing auction session manipulation and how it will not go undetected. Of course, that big order that came in that we'll put the spotlight on in just a bit. But the chairman also earlier making it very clear, the CAS is here to say it's not really going away anywhere, even as the SEBI, of course, is tightening its vigilance there. So, hours after that, comment came in, he's warned CAS manipulators of strict consequences. In fact, released an ex parte interim order pulling up 2 investment and brokerage firms for allegedly manipulating in the closing auction session on the Sensex expiry on the 13th of August. Hormas has more on this development.
There's a big order that came in last evening, and this came in very, very quick time, in just 3.5 sessions of what transpired last Thursday on the 13th of August. SEBI issuing an order against these 2 entities, Kotak Mauritius Investments and Mansi Share and stockbrokers. Their gains were impounded. They were barred from the stock market as well, and many other steps that were highlighted by SEBI in its order. Now, they say that the price manipulation took place during the last 10 minutes of the Sensex weekly expiry, which took place last Thursday, and the gains that have been impounded include almost 3 crore rupees for Kotak Mauritius and close to around 72 lakhs for Mansi Share and stockbrokers. And now take a look at what has happened here is that both these entities have now been banned from the market pending probe, and they can't operate in the CAS as well. Now take a look at the chart which SEBI has highlighted in its study. It highlights 3 important points where their spikes were taking place on the Sensex. The first spike, which took place at around 320, saw the Sensex move up by 362 points in just 2 seconds. 5 minutes later, there was a drawdown, and once the drawdown took place, we'll get to that as well, there was another spike that took place. In just 12 seconds, the Sensex moved 133 points. And then came the last big one. In 28 seconds, the Sensex went up by well over 400 points in that last spike, which took place around about 3:25 and 3:26 p.m. And in between all of this little drawdown that you see, that was also took place between 3:21 and 3:26, where the Sensex moved from 77,991 to 77,893. But it was interrupted by that spike which took place, causing that temporary deviation to take place. Now take a look at what SEBI has observed in the activity of Kotak Mauritius during that period. Now, the first spike had Kotak Mauritius placed 32 out of the 86 limit buy orders worth around 66 crore rupees, and around 99% of those shares value. All of these orders were placed at a 3% reference price higher, and for all the Sensex constituents at the same time is what SEBI has highlighted in its order. For the second spike as well, 108 out of the 165 orders were placed by Kotak Mauritius, and 32 out of the 176 in the third spike were placed by the entity for all Sensex companies, 3% above the reference price, all of them at the same time. Now take a look at what it has observed for Mansi Shares and stockbrokers. Between 321 and 326, sell orders were placed at a lower price. They were worth 145 crores, and these orders were cancelled between 326 in a matter of 3 seconds. And these cancellations led to the Sensex IEP going up by well over 230 points during that period. What they have also observed is that there were 6 stocks on the Sensex where Mansi Shares and stockbrokers had placed sell orders worth over 100 crore rupees. They included the likes of Reliance, SBI, Eternal, ICICI Bank, L&T and Infosys. And these orders were placed 1.5 to 3% below their reference price, and 99% of those sell orders were cancelled during CAS, is what SEBI has observed. And therefore, it prompted SEBI to come to a conclusion that these sell orders were prima facie meant to suppress the Sensex IEP instead of performing a legitimate sell transaction. And therefore, in this order, it has also barred these entities from the market. They have given them 3 months to liquidate all of their derivative positions and many other steps that have been highlighted as well. So a big order in very quick time, and SEBI has, with this order, it has definitely given out a message that not just CAS is here to stay, but the regulator means business as well.
Well, thanks very much, Hormaz. An interesting case and very quickly caught by SEBI. So hopefully brings a breath of relief, for the traders there. Take a short break on that note, but up next, we'll get you all of the bond market action with Manisha Gupta, as always. Welcome back. As promised, let's get you all of the latest action from the bond markets. Manisha Gupta is standing by to fill us in. Manisha.
Well, thank you so much for that. The bond markets today absolutely reacted to the RBI August policy review meeting minutes, where there is a hint of a rate hike in coming months if the inflationary pressures would just about continue to persist. And that is the reason you saw the 10-year government bond yield open slightly on the higher side therein. But the other thing really is about the crude oil prices, because we are looking at stronger gains continuing into that one as well. A one-month highs and prices trading at $92 a barrel is clearly an inflationary concern for a country which imports anywhere between 82 to 85% of its crude. And in the last few months, we've seen constant gains continuing there, so much so that we are trading 50% higher for this year when it comes to the crude oil prices. And then when you look at the activity in the markets therein, the bonds maturing up to 2029 were the most actively traded into the markets there yesterday as well. I also want to bring to you on what the secondary market deals show us. So when you look at Tuesday and then Wednesday clearly has seen some higher number coming in sense of trading there. Most actively traded companies, by the way, in the secondary market have been NABARD, REC, Sika Ports and Terminals, Tata Power Company also attracted quite a bit of an interest. And then you have SIDBI, Manappuram Finance also were quite actively traded in the secondary market. But you have more bond issuances coming in the markets today as well. Cholamandalam, for one, should be on your radar, because you're looking at market tapping for 10 billion of issuing there. It's a reissue of 10.64% July 2029 bond therein. The other one to watch out for is going to be Poonawalla FinCorp, and they are into the market for $2 billion, and they are looking at a reissuances of 8.43% April 2036 bonds therein. There also is Home First Finance Company Limited, where there is a board meeting happening tomorrow. This is as per the communication that has been sent to exchanges. The meeting is on Friday, and they're looking at an approval of an issuance of NCDs, which is worth 1.5 billion, and that can be decided upon in a meeting tomorrow. So that's another thing that the street will keep an eye on.
All right. Manisha, thanks very much for getting us that update. So let me do a short break on that note, but we'll get you a lot more action from the markets when we return.
Welcome back. Still holding on to that 24,200 mark on the index, just by a small margin though. And today is the Sensex weekly expiry as well. So a very important second half lies ahead of us. What are the F&O trends as of now? Sudarshan is here to tell you the latest. Sudarshan.
You have just said the biggest positive thing, that we have been able to sustain the gains that you had seen in the opening hour of trade. And the another part is the call writers who were active at 24,150 had to cover their positions. Now we are seeing aggressive put writing above the levels of 24,150, and that's reflecting in Nifty PISA, which has moved above the level of 1 versus previous day's level of 0.80. So come to the options data. On the put side, 24,200, 24,250 and and 24,150 are the most active, where we are seeing a maximum change in the open interest, while on the call side the most active one is 24,250. So support for you can be 24,150 and first resistance for Nifty can be 24,350. As far as Nifty Bank is concerned, support would be 57,400, that's your 20 DMA, and resistance can be 57,900. Some of the stocks that are seeing fresh longs or fresh shorts, KFIN, AB Capital are seeing addition on the long side, while Hindalco is seeing addition on the short side, and LIC, after coming out of the band, is seeing short covering.
Indeed, I see now at 2% higher out of the band in today's session. Sudarshan, thank you for that update there. Take a short break. On the other side, Mahesh Nandurkar joins us from Jefferies, and we decode the earnings season gone by and the road ahead for the markets as well. Stay tuned.
Welcome back. You're watching Trading Hour. Let's get you some important, interesting comments coming in on RBI's latest draft circular on revolving credit, which came in at the 4th edition of the CNBC TV 18 Banking Transformation Summit. Now, we had Jairam Sridharan, who is the MD and CEO of Piramal Finance, tell us that if RBI's draft circular read literally, comes into play, it could disrupt loans against shares, flexi loans, credit on UPI, and be quite disruptive for the industry overall. Take a look.
See, in original form, when we first saw the circular, थोड़े तोते उड़ गए हमारे कि यार ये क्या है? So it's a part of the business which has I don't think caused any particular challenge. It hasn't really driven any particular problem in the industry. It has largely been targeted at a segment which clearly needs that value proposition, etc. So I really hope that the way the industry first read the circular is incorrect, and the interpretation that I'm hearing now is the correct one, that it is supposed to be clarificatory in nature with respect to definition of businesses and processes. But if it were read in its original form or to the letter, it would be very disruptive to a lot of products and that target the MSME segment and products which are perfectly safe, like loan against shares, etc. Very hard to see what the difference is in terms of overall risk and why you would want to kind of shut that down.
Just one quick thing, Jairam, on for NBFCs, wasn't it always the case that you had to have a defined kind of limit, defined duration? It was always the case, right? So how is what the RBI is now saying inconsistent? Actually, you could argue that it is consistent, and what was happening till now was inconsistent.
Okay, now you're going to get me in trouble. See, there is a letter of what revolving credit means and what term loans mean. In general, everything that NBFCs are doing sticks to the letter of being term loans and not revolving credit. However, there is a broader way you could invoke the spirit of revolving credit, which is that you're not underwriting the customer again and again, but you're taking the same underwriting and then you are carrying it through renewals, etc. A lot of the ways that products like loan against shares or products like Flexi in personal loans, etc., have been implemented as term loans, right? If you look through how the loan actually shows up to the customer, it does show up as a term loan.
Yeah, the design is like a term loan, but it works like an OD product.
Yeah, so the effect is like some sort of a credit which is available to them on tap. I would not use kind of the technical word revolving credit because it's not meant to be that, but it is kind of an on-tap credit available. Disabling that from a kind of spirit perspective would create shutdown of a lot of products that are out there. It would also disqualify a lot of the areas where investments are going on right now. I saw the previous interview where Ritu was asking Sohini about lending on UPI. All that stuff will go away if NBFCs can't do it, right? So it's important to keep in mind that the broad usage of that language will kill a lot of products that are currently being done.
So you're saying loans against
contemplated.
shares, loans against mutual funds, credit on UPI, Flexi, of course, personal loans, all those.
Yeah, everything goes. So and a lot of the supply chain type products are, sometimes also set up like that.
Lending against gold digitally, I mean, those kind of things as well, which is
exactly. Digital loans which have revolving component. A lot of that stuff goes out, and many of these are sunrise sectors, sunrise products. They're not very big right now, but they are sunrise products. So people like us are all making investments in them. So it would be very disappointing if they were all to be disallowed.
The big conversation there from the banking summit last evening. Take a short break. On the other side, we continue our conversation with Mahesh Nandurkar from Jefferies. Stay tuned. Welcome back. Well, Balrampur Chini is now moved to the highs of the day. The stock is at a record high now, 8.5% higher on the stock. Continues to do well for itself, and a lot of these sugar companies are continuing from where they left off in yesterday's trading session. Be it Bajaj Hindustan, be it Dwarikesh, Ugar Sugars, all of them trading with gains of anywhere between 9 to 11%, and most of them are trading at the highest point of the day. And of course, just before we move on, Solara Active is another name. That's the top gainer on the small cap index today, 13% higher on that stock, and it continues to move higher as well. Over the last 2 weeks, the stock is up almost 20-odd%. But the June quarter results have come in stronger than what the street was anticipating, with growth broadening across financials, autos and consumption. Now, Jefferies believes that the earnings momentum has accelerated sharply, driving the highest upgrade ratio in 5 years, although rising input costs continue to keep margins under pressure. Amidst all of this narrative, how is growth shaping up over the quarters to come? Let's extend that discussion and welcome Mahesh Nandurkar. He is MD and Head of India Research at Jefferies. Mahesh, so good having you on the show today. Good morning. Thank you for taking out time. The earnings season, well, the street was expecting it to be a dull, drab quarter. It was anything but that. Do you believe that this is the start of the turnaround of the earnings growth in India after a prolonged period of lull? And if so, what are the pockets that will lead this sustainability of the earnings growth going forward?
Thank you so much for having me here. Yes, it's after a really long time that we've seen such a strong performance, at the quarterly season over the last 4 to 5 years, maybe like in 4 years to be precise. We have gotten used to seeing every sort of quarterly season, we end up seeing earnings getting revised downwards, maybe by 1% or 2% or something like that, almost every quarter. And in the backdrop of that, what has happened in this quarter is really a positive surprise. And this is coming in despite the fact that the June quarter was marred by the tensions in the Middle East and the oil prices going up, the gas shortages and all that. So it's really, fantastic to see this type of performance. We were actually getting an inkling of that already because many of the other high frequency economic data points that we were tracking were surprising on the positive side. So to that extent, the corporate result season is actually a culmination of some of those data points.
Mahesh, hi, good morning. The earnings seasons may have been fantastic, sure, but the market remains weak. I mean, is that strengthening your case to stay with the defensives, or where would you put incremental money?
Yeah, see, the thing is, I would distinguish between the corporate and economic performance. So versus the market performance. The simple reason is that the market continues to still be very expensive. So in fact, if you look at on a relative to the emerging market index, we are now almost double the P multiple, so almost 100% premium. So I would distinguish between the two factors. Yes, the variety of economic data points, be it credit growth, and now we are seeing deposit growth as well, the car volume, the earnings number, etc. They've all been strong, but I think the market is already factoring that in. And at 20 times 1 year forward P multiple for the broader market and for the mid caps, the numbers are even higher than that. I think a lot of those positive factors are there already in the share prices. And also the other factor to keep in mind is the equity supply. And now we are beginning to see almost $7 to $8 billion of monthly equity supply hitting the markets as well. So I would still say that at the market level, we need to stay selective. The broad-based improvement in the economic performance and the corporate performance doesn't necessarily mean that the market as a whole is going to do that well going forward.
Mahesh, since you mentioned the broader markets, even as the index has not gone anywhere, the broader markets are continuing to do well. There are a lot of names that have surged 70, 80, maybe even 100% already on a year-to-date basis. Where is your preference within the broader market areas? And if you are preferring an equity allocation more towards the broader markets compared to the larger caps, or because of the fact that the larger caps have not done much, your preference would lie there?
Yeah, over the last 2 years, what you've seen is the mid caps have done fantastically better than the large caps. And that difference in the performance was solidly backed by earnings growth differential as well. So between FY24 to FY26, those last 2 years, the small and mid cap earnings growth was about 18%. The large cap earnings growth was 8%. So there was a gap of almost 10 percentage points. Going forward into the next 2 years, including FY27 and FY28, we expect that this earnings growth gap will bridge to some extent. And one of the key sectors within the large cap that will help bridge this gap is actually banking sector, where the valuations are also very attractive, in our view. So when we say that, one should be selective, I think one needs to keep in mind the valuation considerations as well. And as I mentioned, within that, the banking sector, the NBFC sector appears to be very solid, where the valuations are attractive, the fundamentals are improving. And as I mentioned, the earnings gap is actually reducing as well. So that is definitely one of the large cap sectors that we would be looking to own. Some of the other large cap sectors continue to kind of languish with lower EPS growth. So we just about like neutral on IT services. We recently changed that stance, about a month or 2 months or so ago. So we are still neutral on that, not really very bullish. But our, still the bullish call still remains on the real asset as the theme or hard asset as the theme, which includes power utilities, real estate, select ports, airports, etc. So that still continues to remain our top idea.
Got that, Mahesh. Let me just quickly pick up on the financial space you talk about. What about the gold financiers? You like the NBFCs, but let's say on Muthoot, you've downgraded the call from buy to hold. With all this gold price movement and the run-up that we saw in these companies, is the upside capped from here?
I cannot comment on individual stocks as our firm policy, but what I can say is that at a broader macro level, gold is making a comeback because there have been now rising concerns on global inflation. There are concerns on the US yields going up, and there is probably going to be some increase in the rates in India as well. So in this type of an environment, gold and gold derivatives usually do well. So at a broader sectoral level, I would say that the gold and gold derivatives should be doing well.
So continuing with that theme, Mahesh, is the bond markets globally bigger or possibly the biggest risk right now for the global market sustainability at higher levels? Because we may be struggling at an index level, but there are plenty of other markets that are at record highs. But the bond yields too, other than that intervention that you saw from the US last night, of course, that doesn't change the debt picture much, but does the bond yields or the bond market the biggest risk now?
See, the thing is, globally, the markets and, also, on the, in the Asia region, one of the themes that still continues to dominate the investor mindshare is the AI as the investment theme, right? And although we've seen a bit of a softening in that over the last couple of months, especially some of the Korean sort of memory stocks seeing large corrections, but that still by and large remains one of the core themes globally, and that is clearly predicated on huge capex being undertaken by the hyperscalers. And I think the point that one needs to keep in mind is that now the CDS spread for many of these hyperscalers is actually going up. Also, the bond yields, as you rightly mentioned, in the US, they have been generally speaking going up as well. Although last night some intervention, we have seen some a 6 to 8 basis point reduction in the long bond yields, in the US. But I think that still continues to remain a source of worry. So I would say that global growth is a function of AI capex, which in turn is a function of cost of funding for a lot of these hyperscalers. So yes, to answer your question, I would say that one needs to keep a really sort of tight watch on where these yields are moving globally. And at this point in time, it does look like there is an upward pressure on these yields. And if that continues, and if if we begin to see that kind of thing ultimately beginning to impact the capex outlook for hyperscalers, and then the whole AI trade begins a bit of a question mark once again. So that is definitely a global risk that we need to keep in mind. And while India might outperform in that type of an environment where the global AI trade is slowing down, but if there is any major dislocation, it would still have an absolute level negative impact on Indian markets as well, although Indian markets might fall less than what you might see elsewhere, because India hasn't really benefited as much from the AI theme.
All right, Mahesh, we'll leave it at that. Thanks very much. Interesting comments coming in from you. You've given us plenty to think about. Thanks very much. Appreciate your time here on CNBC TV 18. Take a short break. Up next, we're going to discuss RBI's forex policy with Anant Narayan, who is SEBI's former whole-time member. Stay tuned for that conversation.
Welcome back. We're just talking about how SEBI and its actions on two brokerage entities with regards to the manipulation in the Sensex weekly options expiry session last week. There's some important comments coming in there from the market regulator. We talk about this and of course a lot more. Ritu will talk more about the currency and the RBI forex policy as well with SEBI's whole-time member Anant Narayan, who's joining in on the show. Anant, good morning. Thank you for taking out time. Before we get to the RBI, this step from SEBI that has come in almost record time, is this the regulator's way of telling market participants that, okay, we mean business, don't try acting funny, because whatever has happened, the reforms are here to stay. And if you try doing something like this, you will be caught sooner or later.
Morning, Hormuz, and thanks for having me. First, I'm a former whole-time member, not the current whole-time member of SEBI, as you know. I haven't gone through the full order that SEBI came out with yesterday. I've only seen the headlines that you've put out. Two broad points I'll make. First is, as the chairman of SEBI has reiterated on several occasions, as the circular from SEBI has also said, with the CAS, the ability of the exchanges and SEBI to closely monitor how the closing goes through is very, very heightened, which means their ability to detect any kind of manipulation is far stronger now than it was in the earlier VWAP kind of edifice. And that's not to say that things were weak earlier. It's just that it's a lot more stronger right now. And I think the market should take confidence from this. The fact is, even in the past, we've had murmurs once in a while about quiet closes or explosive closes, etc., and people wondering as to if something is happening in the background. I think those kind of whispers should come down going forward, including for options expiries, etc. The second thing I think, which is a takeaway, a larger takeaway, is clearly we've got to ensure that the liquidity in the CAS goes up over a period of time. I'm sure SEBI is doing a lot of work on that alongside with market participants to figure out how that's done. I think two areas where this can actually lead to some good progress. One, amongst mutual funds, the arbitrage funds, there should be natural players in the CAS to ensure that the prices are kind of kept under control. They might have to change their operating model a little bit, taking on a little bit more risk to be able to do what they have to do. That I think might require a discussion and dialogue with SEBI. The second thing, of course, is making sure that the SLBM works a lot more seamlessly, so that normal participants, practitioners can step in and provide countervailing prices whenever the markets move out of the equilibrium. So I think good takeaways from all of this. It's still early days for the CAS, but I do think once this settles down, there'll be a lot more confidence in the ecosystem going forward.
You mentioned turnover and participation as well. At least the last 2 days, the data that has come in has been a little heartening, especially considering the fact that yesterday being a non-expiry day also had a fairly healthy turnover compared to usually what you see on expiry days. But Anant, one more on cash before we hand it over to Ritu. Is this now settlement that or a reform that the market will have to make its peace with eventually going forward? Because even today there are many concerns. The SEBI chairman has said that there will be concerns, they will be addressed based on due diligence, but unless and until participation does not increase, the concerns are more or less likely to stay. What more can be done to increase the participation from the market participants according to you?
So first, as we know, this is a process which is followed practically in every major exchange in the world. And we were the kind of the outlier in many ways in not having a CAS. So there's no reason why we can't adopt it. Of course, the dialogue with market participants should continue. And two specific areas which I mentioned, I think, which hold a lot of promise for ensuring that liquidity and confidence of liquidity goes up. One is, I think, if SEBI and the mutual fund industry can work together to ensure that arbitrage funds play a greater role during the course of the CAS, to make sure that they are there on both sides of the CAS band. I think that can go a long way, because they are normally the natural participants who should be coming in and providing a kind of a balance to the whole process. And the second thing is, I think, one good thing which will come out of this is that the securities lending and borrowing mechanism, which unfortunately has not really taken off in India, will see a lot more of depth going forward. And that should be very good for the overall cash market as well. One of the reasons why cash market volumes have been restricted compared to derivative markets is our SLBM really hasn't taken off. I think steps to deepen that will also follow as a result of what we're going through. It'll be great both for CAS as well as for the cash markets overall. Overall, I think, look, this is a good step. It is something which should bring confidence to the market. I know we're going through teething issues, but I have full confidence that between market players and SEBI, we will come to a situation where these things settle a lot more faster. Already we are in the right direction. I think this will continue even further.
Well, fingers crossed for that. But Anant, before we come to you on rupee, let me quickly set the context for our viewers that are tuning in. Some very interesting comments being made by Anand Narayanan here. Narayan here. In his recent article, he's basically outlined something called the monetary policy trilemma. Now, Anant is basically saying that RBI needs to look at its policies across markets as one connected system. So take the rupee first. Now, RBI, of course, keeps repeating it does not target any particular rupee level. It intervenes only to prevent excessive volatility. But the scale of the intervention from RBI has been enormous. I mean, in the last 10 years, RBI's forex intervention has averaged about $60 billion a year. And when you are buying or selling dollars at that scale for a sustained period, you inevitably influence the level of the rupee, not just volatility. Now, the second interesting part that Anand talks about, and that is how RBI also influences domestic interest rates through bond purchases and liquidity management. So in FY26, for instance, RBI bought about 7.2 trillion rupees of government debt, which is roughly 40% of the incremental government borrowing. Now, the argument he makes is that keeping interest rates low can make fixed income assets less attractive, and therefore they can push savings towards equities and reduce the incentive for foreign investors to bring money into India, and that can create even more pressure on the rupee, which then requires more forex interventions. That is a trilemma. You cannot independently manage interest rates, capital flows, and the exchange rate. What you do in one market affects the other. So let's bring in the author of the report, Anant, back on this. Anant, you call this a very interesting trilemma for viewers that may not be familiar with the term. Just simply, if you could explain to us this trade-off between interest rates, capital flows, and the rupee, and what RBI now needs to explicitly recognize.
Thanks for that background, Ritu. That's very useful. So if I can just expand on what you mentioned, during the course of fiscal year FY26, the RBI bought 8.8 lakh crores of bonds, central government bonds. And as you said, the net number was about 7.2 lakh crores. And that's intervention was significant to bring down the yields in the government bond markets and in the money markets and interest rate markets. Now, of course, the RBI was following through on the MPC's rate cuts and trying to ensure transmission of the monetary policy framework and trying to ensure that credit growth, took off and so on and so forth. But the point is, it was keeping interest rates much lower than where they would have been had it been left to a freer market where discretionary savings would determine where the interest rates are. So at one point of time during FY26, the 10-year bond yield came down to as low as 6.1%, and the spread between rupee bonds and the US treasuries for the same tenor came down to about 2%. Now, these have consequences, and it's not just bond flows coming into the country, it's far more than that. Now, first of all, when interest rates are kept so low, discretionary savings in India do not go into fixed income because on a post-tax basis, frankly, your returns become far lower than your expected inflation. And therefore, you start looking for other assets. You start looking for gold. You start looking for overseas assets. You start looking to put money into equity markets. And over the years, we have seen a lot of retail flow going into equity markets. Not a bad thing, but it does cause pockets of overvaluation in equity markets. Now, that makes it very difficult to get in net both foreign direct investment and foreign portfolio investments because the valuations are seen to be on the higher side. So in a funny way, therefore, your interest rates being kept low is pushing out foreign investments, both into debt as well as into equity. There is another issue which comes up. Once your spread between global interest rates and domestic interest rates come down to very narrow levels, the forward price of buying dollars against the rupee becomes that much more cheaper. So not only do you have a situation where foreign inflows are not coming through, you're finding it easier to buy dollars rather than sell dollars because it's cheaper, which means that both for hedging against imports and against rupee investments, as well as for speculating against the rupee, it becomes that much easier. And during the course of FY25-26, we did see that coming through. A lot of the RBI dollars that were sold, RBI sold $192 billion across spot and forward markets in FY25 and 26. I estimate that about $117 billion out of that was essentially going towards people hedging their dollar payables or buying dollars as a speculative bet against the rupee. So this becomes a vicious cycle, and then you're forced to intervene in the FX markets to try and douse the volatility here. So on one hand, you're pushing down interest rates, causing volatility in the FX, and that itself requires you to intervene in the FX markets as well. So the point I'm trying to make is that especially when RBI is intervening in any of the markets, bond markets, money markets, or currency markets in a big way, it has to be very conscious of these interlinkages. You cannot divorce yourself and say, I will look only at interest rates or only at currency markets or only at one particular part of the curve. You've got to see things holistically. And even now, Ritu, the point is interest rates are where they are thanks to this FCNRB scheme. Because we've got this flood of deposits which have come in, that's keeping the banks buying bonds at this particular level. These rates are not being sustained by you and I putting discretionary savings into fixed income markets. So therefore, something has to give in terms of getting more sustainable markets across fixed income and equity and foreign exchange markets.
Got that. Anand, we've run out of time, so very briefly in a line or two, where do you draw the balance then? I mean, at the cost of tighter financial conditions, higher interest rates, you get foreign money in to support the rupee, or where do you draw the line then?
I would start by trying to achieve a self-sustained interest rate market where discretionary savings sustain the interest rates rather than either RBI intervention or one-off situations such as the FCNRB deposit scheme. One way of doing this, Ritu, and I understand that we want interest rates to be low so that growth is given a chance. One way of achieving that is to reduce the tax burden which is there on interest income. If currently we pay the marginal tax for discretionary savings on both fixed income, on interest rates, as well as on debt mutual fund investments, right? Which is why discretionary savings are not going into fixed income. Now, if you were to bring it on par with other capital market instruments, so, bring back LTCG 12.5% beyond 1 year, and maybe have a lower interest tax income, let's say at 20%, or the band whichever is lower, that might allow for the markets to stabilize on their own without RBI intervention, keep interest rates, the headline interest rates low. And by the way, once you have one free market, the other market should become free as well. I think there are win-win solutions possible rather than intervention.
Take that point. Completely out of time, but very interesting conversation there. Anand, thanks as always for joining us here on CNBC TV 18. And with that, we'll wrap up this edition of Trading Hour. Hormaz and I take your leave, but stay with us. More news and updates will continue right here.
Stocks climb after US Treasury says it will buy back long-dated securities to cool bond yields. IT, realty and financials lead the leg up while energy is the notable drag.
SEBI bans Coptal, Mauritius and Mansi share and stock broking from the market and impounds 3.68 crore of their funds for manipulation in cash on August 13th. SEBI's chair issues a strong warning to manipulators looking to defame CAS. The price of sugar jumps to a record high, rising 10% in a month as the opening stock for November hits a historical low. Government imposes a 15-day inventory limit for bulk users, but tight supply props stocks of sugar mills. Minutes of RBI's Monetary Policy Committee meeting suggests there is a case for a rate hike. RBI Governor Sanjay Malhotra, while preferring to wait, warned in the meet that high input prices could lead to broad-based inflation.
RBI Deputy Governor Shirish Murmu tells CNBC TV 18 that MDR for UPI is on the cards. Revolving credit was never permitted for NBFCs and the decision to close the FCNRB window early was in response to the evolving situation.
Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Bhatra and with me is Sonal Bhutra. Well, it's turning out to be a session where we are seeing some amount of green on the screen, so we're going to take it with both hands. So above 24,200 is currently where the Nifty is at. Just want to put a couple of technical figures into perspective. So today's intraday high was around 24,226 and the last time we were above 24,200 was on the 18th of August, which was earlier this week, and the intraday high then was around 24,269. So that would be an important level to get past for us in today's trading session, or whether we manage to sustain above 24,200 in the next session. For the intraday low, however, it is positive news because today's intraday low is 24,184, and that is better than the intraday low that we had hit in yesterday's trading session, which was around 24,025. So it's a higher intraday low that we've made in today's trading session, but we still need to recoup back above the levels of an intraday high that we were sitting on the 18th of August. Hi, Sonal.
Hi, Ekta. Well, 24,050, that continues to be an important support at the lows. Yesterday, we at least maintained levels around that level, didn't cross that 24,000 mark, and today there's a recovery from those levels as well. In terms of sectoral moves, media doing well. We do have IT, which is one of the top gainers. All the constituents of Nifty IT are in the green today. Financial services, be it the realty pack, all of them are contributing to the gains on the upside as well. We'll discuss individual names and a lot more, but let's tell you what we do have on the show today. SEBI acts against two entities for manipulating the newly introduced Sensex closing auction session on August 13th. We'll discuss all this and more with Dheeraj Relly of HDFC Securities. There'll be spotlight on sugar as well because prices have touched record highs and the government has tightened stock holding limits. Prashant Biyani of Elara Securities will join us on the show to decode the impact of this on the stock markets. Later, Jonathan Birat of ETO Markets will join us to discuss the overnight surge in precious metal prices. Let's move on to the big story now. SEBI Chairman Tuhin Kanta Pandey has warned that any attempt to defame the closing auction session through manipulation will be dealt with sternly. Speaking at an event, Pandey said that the new system is intended to improve transparency and any attempt at manipulation can be detected relatively easy.
कैश सिस्टम में मैनिपुलेशन पकड़ने के आसान मतलब जो हमारा वो है वो ज़्यादा अधिक है हमारी कैपेबिलिटी पुराने वीवैप सिस्टम से की अपेक्षा जो कैश सिस्टम में हम रिलेटिवली इजीली मैनिपुलेशन को पकड़ सकते हैं तो इसलिए ये आपको ये देना होगा कैश ट्रांसपेरेंसी के लिए है और वो लेकिन यदि कोई ये समझ रहे हैं कि हम उसका कैश को नाम बदनाम करने के लिए मैनिपुलेट कर लेंगे तो वो बहुत ही धोखे में होंगे.
Okay, and hours after the SEBI chairman warned cash manipulators of strict consequences, the regulator released an ex parte interim order pulling up two investment and brokerage firms for allegedly manipulating in the closing auction session in the Sensex on the 13th of August, the expiry day, in fact. Hormuz has more on this. Hormuz, over to you.
There's a big order that came in last evening, and this came in very, very quick time, in just 3.5 sessions of what transpired last Thursday on the 13th of August. SEBI issuing an order against these two entities, Copthall Mauritius Investments and Mansi Share and Stock Brokers. Their gains were impounded. They were barred from the stock market as well, and many other steps that were highlighted by SEBI in its order. Now, they say that the price manipulation took place during the last 10 minutes of the Sensex weekly expiry, which took place last Thursday, and the gains that have been impounded include almost 3 crore rupees for Copthall Mauritius and close to around 72 lakhs for Mansi Share and Stock Brokers. And now take a look at what has happened here is that both these entities have now been banned from the market pending probe, and they can't operate in the cash as well. Now take a look at the chart which SEBI has highlighted in its study. It highlights 3 important points where their spikes were taking place on the Sensex. The first spike, which took place at around 320, saw the Sensex move up by 362 points in just 2 seconds. 5 minutes later, there was a drawdown, and once the drawdown took place, we'll get to that as well, there was another spike that took place. In just 12 seconds, the Sensex moved 133 points. And then came the last big one. In 28 seconds, the Sensex went up by well over 400 points in that last spike, which took place around about 3:25 and 3:26 p.m. And in between all of this little drawdown that you see, that was also took place between 3:21 and 3:26, where the Sensex moved from 77,991 to 77,893. But it was interrupted by that spike which took place, causing that temporary deviation to take place. Now take a look at what SEBI has observed in the activity of Copthall Mauritius during that period. Now, the first spike had Copthall Mauritius placed 32 out of the 86 limit buy orders worth around 66 crore rupees, and around 99% of those shares value. All of these orders were placed at a 3% reference price higher, and for all the Sensex constituents at the same time is what SEBI has highlighted in its order. For the second spike as well, 108 out of the 165 orders were placed by Copthall Mauritius, and 32 out of the 176 in the third spike were placed by the entity for all Sensex companies, 3% above the reference price, all of them at the same time. Now take a look at what it has observed for Mansi Shares and Stock Brokers. Between 321 and 326, sell orders were placed at a lower price. They were worth 145 crores, and these orders were cancelled between 326 in a matter of 3 seconds. And these cancellations led to the Sensex IEP going up by well over 230 points during that period. What they have also observed is that there were 6 stocks on the Sensex where Mansi Shares and Stock Brokers had placed sell orders worth over 100 crore rupees. They included the likes of Reliance, SBI, Eternal, ICICI Bank, L&T and Infosys. And these orders were placed 1.5 to 3% below their reference price, and 99% of those sell orders were cancelled during cash, is what SEBI has observed. And therefore, it prompted SEBI to come to a conclusion that these sell orders were prima facie meant to suppress the Sensex IEP instead of performing a legitimate sell transaction. And therefore, in this order, it has also barred these entities from the market. They have given them 3 months to liquidate all of their derivative positions and many other steps that have been highlighted as well. So a big order in very quick time, and SEBI has, with this order, it has definitely given out a message that not just cash is here to stay, but the regulator means business as well.
Okay, thank you for that neat summary, Hormuz. But we'll do one thing. We'll slip into a short break now. And when we come back, we'll connect with Dheeraj Relly of HDFC Securities to discuss this and a lot more on the other side. Welcome back. You're still tuned into Halftime Report. As we were discussing earlier, SEBI has banned Copthall, Mauritius and Mansi share and stock broking from the market and have impounded 3.68 crore of their funds for manipulation in cash on August 13. There is a strong warning from the SEBI chair to manipulators as well, looking to defame cash. To discuss this and understand more about what's happening in this market with respect to cash, Dheeraj Reddy, the MD and CEO of HDFC Securities, is joining us now. Mr. Reddy, thank you so much for joining us on the show today to discuss this, which is very important for traders in the markets as we speak. Now, the penalty that has come by on some of these market participants, is this raising concerns that there can be manipulation even under cash? And what do you make of this warning that has come in from the regulator, and with the changes that are coming in September, do you think those issues could be resolved?
Sonal, first of all, I think we should compliment our regulators, SEBI and exchanges for doing a wonderful job. Within few days, they could able to figure out the manipulations and unusual, volumes in the markets during the cash session. And that's where they could able to figure out and penalize also in a record time. So I think it's a great work done by the regulators. This is part and parcel of exchanges and SEBI's ecosystem, where they have a very active surveillance going on different types of orders and manipulations and unusual transactions, either on buy side or sell side. So this is an outcome of those surveillance tools the exchanges and SEBI have been using. My take is that these are one-offs only. It's not a rampant practice in the market. So we don't need to unnecessarily get perturbed about it.
Okay. Dheeraj, hi. Thank you for joining into this conversation. What, according to you, might be the guardrails which need to be put up by SEBI to prevent any kind of incidents such as these going forward?
I think the clear message to all participants and stakeholders that SEBI and exchanges have been monitoring it closely, and they could able to showcase in the last expiry on 13th August how, at what time, what kind of orders were placed, and which entities could able to place unusually high orders, and that hence led to the manipulations, and whatever gains they did, they could be impounded. I think it's a very strong message from the regulator side. Proactively, you can't stop people placing the orders, but banning some of these entities and impounding the gains is a very strong and clear message. And I think the regulators would also look at doing something on a real-time intervention and not just the post-facto work. At our level, at brokers level, I think all of us have our own risk management processes in place whereby we can track and block unusual volumes and transactions.
Okay, so Mr. Relly, SEBI is also allowing the change that's coming from September is accepting orders in the first 5 minutes of the closing auction. How will this help at the broker end and the investor or the trader end as well? Does it help better price discovery, or does it help higher liquidity, or is it impacting both?
I think, Sonal, if you permit me, I will explain in a very simple language what exactly CAS is and how it has changed the ecosystem for markets. See, right now it is applicable for only 209 stocks, and all other stocks are in CTS, continuous trading session, between 9:15 to 3:30. So the impact is only on the FNO stock, which currently are 209 stocks only. Now, what has changed for the 209 stocks? The CTS will now be at 9:15 to 3:15. Between 3 to 3:15, as per the weighted volume method, the reference price is calculated, and that is the price which is used for the cash session, and cash session timings are 3:20 to 3:30. Okay. And there is a time in between where the transition happens from a CTS to cash, which is closing auction session. So that 5 minutes window is which is for deriving the reference price. Now that 5 minutes window is also available for accepting the aftermarket orders. Yeah. So
okay, no, please go ahead. Please go ahead.
Yeah. So in the 5 minutes, the brokers can accept now aftermarket orders, and they can place these orders or push these orders at 320, which means that this will help us to get the more participation and more better volume in the cash session.
Okay. So Dheeraj, everyone we've spoken to in terms of experts have said that this is just teething issues, which, the market is going through at this point in time. Do you think that the possible recommendations which would be out in September is probably going to iron out all of these teething issues? And what would be the top recommendations or what the participants want to hear in September?
What is changing in September is also the opening session for the cash also. It will also be similar to what we have between 320 to 330 now in the morning between 9 to 9:10 a.m. So that's one change. I think that will go live from September 7th. As of now, what we are doing, we will all start accepting the aftermarket orders between 315 to 320. As my understanding is, couple of brokers have already started accepting these aftermarket orders at after 315. All of us have been working overtime to ensure that we start this practice. Most of us will not even wait for September and start doing it as fast as our systems permit. So that's one. The other thing you must know that there are, what happens between 320 to 330. In between 320 to 325, you can place both limit and market orders. You can modify these orders as well. After 325, you are only allowed to do only limit orders and not market orders. And after 328, anytime randomly the market closes, and that's what is used for calculating the closing price.
Okay,
I think the market participants are taking some time to understand these nuances and dynamics, and that's where it's creating some confusion, and that's where participation is less. All of us are doing a lot of activities, including webinar, reach out through media like you to explain this in simple fashion so that people can understand and get the activity going. And after 330 to 340, now F&O derivative markets for these are also on, and that's where the underlying asset is not available. So for derivatives, actually, the market timings have increased by 10 minutes.
Okay, take that point. Thank you for explaining that. And that's what we've been trying to do on the channel as well. Make it easier. As you said, there have been some teething issues with this new implementation as well. So, Mr. Relly, you spoke about the changes that could come in September. Will that impact price discovery, or will it make it better is what I wanted to ask. Will it improve liquidity and price discovery going forward? And does it also mean, since you said the teams are working longer, higher operational costs from a broker perspective? Is it a lot of change that you're bringing in your risk management and technology?
Not a lot of change, some change, of course, in this system, and I don't think so. It's going to add any significant cost. It's of course it requires us to work on some of these changes, and that too at a fast pace. But this was done with the proper calibration, proper consultation process. So I have no complaints against the regulator that we were pushed to do this in a shorter span of time. I think we've been given enough time, and we were all ready. Most of the brokers were absolutely ready. It's just about the understanding issue and not about the systems issue anymore. And what will happen after accepting this AMO? I think the 5-minute window between 315 to 320 was a vacuum, and that will get amply utilized. And when HNIs and retail investors understand this piece, they'll start placing orders. I believe even institutional players will have increased their participation, particularly mutual funds and arbitrage funds. So that's where we'll see the more activity and more volumes coming in.
Okay. But, we were, Dheeraj, talking to Anant Narayan earlier with regards to the cash discussion. And one of the things that he said that the securities and the lending borrowing mechanism will see a lot more depth going forward, which will aid cash volumes. What is your perspective?
I think not much work have been done by the market participants in the last few years on the cash side. Only thing is that we've seen that there is a surge in the margin trade facility significantly, but that's also just about the less than 2 days volume for the market, not very significant. but the SLBM is still, there are very limited volumes, and we don't have a short selling ecosystem available in Indian markets. SEBI have been working on it. I am part of the secondary market advisory committee. There also we've discussed at length the short selling possibilities, and that's where some more work has to be done. Once the short selling and SLBM both will go live, and go live and will drive more volumes. I think that will help us to get the more cash volumes.
Okay, take that point, Mr. Reddy. Thank you so much for joining us today with your thoughts and insights on this development. Always a pleasure speaking with you. Well, that's the update on CAS and a lot more, but we have to address another important story, and that's the spotlight that we have on the sugar sector. Prices have touched record highs and the government has tightened stock holding limits. Prashant Biyani of Elara Securities will join us on the show to decode this.
Welcome back. Well, for the markets, it's holding up very steadily. So the Midcap index is up around 0.7% at this point in time. We have the Bank Nifty, which is up around 0.6%, and an advanced decline ratio, which has been absolutely spectacular from the get-go. So around 2,500 stocks plus, which are advancing to around 1,600 stocks, which are declining on the Bombay Stock Exchange. One set which is doing particularly well in today's trading session and has been for the past week odd has been the entire sugar space. So Balrampur Chini, for example, is up 16% this week. We have Dhampur Sugar, which is rallied around 16% this week. Triveni Engineering, which is also up at similar levels. And we have something like an EID Parry, which is rallied around 4 to 5%. And the price of sugar is one of the key reasons for that. It's jumped to a record high, rising 10% in just a month as the opening stock for November hits a historical low. The government has imposed a 15-day inventory limit for bulk users, but tight supply props the stocks of sugar mills. Prashant Biyani, who's the VP Institutional Equity at Elara Securities, joins us to discuss this. Prashant, hi. Thank you very much for joining in. So all of these stocks have seen a good price performance just in the past couple of weeks. Give us a sense in terms of how much the prices of sugar have risen and what is your expectation in terms of realization and how could this translate onto the P&L?
Prices have gone up in a quarter from, I think, around 41, 42 odd levels to right now north of 50. There's a new high every day. I think yesterday it was somewhere between 52 or 53. So there can be measures in between from the government to rein in this price increase, but the gist is that sugar prices will remain higher on a YOY basis, and it is going to trickle down to significant EBITDA growth in Q2 as well as the remainder of financial year for all sugar mills, be it your UP-based, Maharashtra-based or anywhere. All kind of mills will benefit from this price increase.
Okay, so there will be a price increase. Just if you have some estimates on that, how much does a 1 rupee per kg increase in sugar prices impact the EBITDA? Is there a calculation for that?
See, right now, I think the entire 1 rupee goes to the EBITDA because cost inflation has been factored in. For companies like Balrampur, the benefit for the financial year can be to the tune of 300 to 500 crore incremental from here, just because of the sugar price increase, depending on the extent to which prices run up. But gains are going to be significant for all.
Okay. Just give us a sense in terms of which are the stocks that you look at, Prashant, at this point, because I'm sure a lot of your clients must be questioning the move that we've seen in sugar stocks, whether it's the right time to buy. So what are your recommendations within the sugar space, and do you expect this kind of rally to continue?
See, we cover Balrampur in the space, which is going to benefit from sugar price increase as well as the PLA plant that they're starting this Q3. So it is now a 3-year structural growth story for Balrampur. Higher sugar price has aided that. And outside of our coverage universe also, I think all sugar mills should benefit from this price hike for sure. Because the remainder of the till December, we are going to see a heavy policy action time, depending on decision on ethanol price hike. All these things will hog limelight, which, depending on the type of decision from the government, may be a bit sentimental, negative or positive for the short term. But I think all of this will be superseded by the fact that sugar realization is higher, and at the end that is going to benefit sugar mills.
Prashant, you spoke about some more regulatory action. There are exports banned till September. You expect that to continue to be extended as well. And what kind of stocks or production are you factoring in because of which the realizations could continue to be higher? Is there a number that industry is guided for, or you are anticipating as well on an industry level?
No, actually, everyone is right now on a wait and watch mode because right now the crop is in an evolving stage. Crushing generally starts from October in the beginning or end. But there's no production estimate as such, but certainly because the inventory situation is tight in the market, even to replenish inventory and cater to the yearly consumption also, it will take time for inventories to get replenished to a normal level. That is what is the main driver of sugar price, which is going to remain high.
Okay. All right. Well, Prashant, just before we let you go, just wanted to understand, didn't quite catch what you are estimating in terms of the realizations that we can see for the sugar companies. I think you were estimating around 10 odd %. And what might be the exit rate for FY27?
Ekta, because there is a daily, there's a new price daily, so it is quite difficult to estimate a price right now. But we have built in for the time being between 45 to 47 for this year. But if this kind of run rate continues, then there is a upside risk for that as well.
What is that upside risk quantity? I mean, percentage, anything that you can share?
Difficult to say right now because a lot of policy interventions also keep on happening between sugar and ethanol. But I think we have a new base price for sugar for sure, which is going to be substantially higher from last year.
Okay. Take that point, Prashant, and take your point that there could be a lot of regulatory action going forward. We'll take your leave for now. Thank you so much for joining us today with your thoughts on the space. Time for a break now. On the other side, Manisha Gupta will join in with Jonathan Barrett of ETO Markets to discuss the overnight surge in precious metal prices. Stay tuned.
Welcome back, and joining us on the show is Jonathan Bharat. He's CIO ETO Markets. Jonathan, hi, thank you so much for joining in. And while, of course, the commodity markets just about continue to be very volatile, but the major moves overnight clearly have come in for gold and silver. 4% of gains in gold, 5.5% of jump in silver overnight. This clearly is after the US Fed meeting minutes and, of course, the decline in US dollar index. But at these current levels, what's your sense on what trading strategy or what prices can we look at from here on?
Manisha, good afternoon. Look, good to see the move. Yeah, we sort of feel we're quite positive on gold and silver. I think it's the move we saw overnight has more to do with the Treasury action in terms of the buybacks they did in the 20 to 30 year area. And that effectively sort of put yields a little bit lower, which sort of in a funny way is the Treasury's way of supporting liquidity, which actually helped that US dollar lower. So I feel that if this is a policy that Treasury has put in place, and we've gone from 2 billion to 4 billion, this is going to support the precious metal markets.
The other concern clearly has been about the rising debt that the US markets are looking at, heading towards that 40 trillion. Would you say that for a slightly foreseeable future, we perhaps could continue to see money flowing into safe havens?
I think so. I think when you look at the size of that, and you can see that the government's trying all these various measures to increase that liquidity without actually moving rates, you get a sense that whilst this has not been addressed, this is a policy that will stay with the US Treasury. Remember, it's different to the US, to the Fed. And I think that policy, if it stays and grows, is something that they're going to try and address, and that's going to support a weaker dollar and also support the precious metal markets.
Jonathan, would you want to guess on numbers therein, on where do you see the dollar index going forward, and what are your targets for gold and silver by the time we end the fourth quarter of 2026?
Yeah, I think when you look at the US dollar, when you look to see where it has just been up around that 101, I could actually see it come back into that 90 to 95 level. That's the extent of the move, which I think is supportive. So when I come back and look at the precious metal markets, I think you can see silver, have another positive move upwards. 75 is the first target, moving on to 100 if the policy stays in place. And that puts gold back through that 5,000 level. So quite bullish, because now we've got some macros which are going to support the moves.
Where do you see also the buying coming in for precious metals going forward? Because central bank buying has been one thing that we've been talking about all of last 12 to 18 months. The financialization, that is the ETF buying, clearly seems to be coming back in support.
I think from a lot of the funds, the ETFs, I think will come back in, because people will now realise that this is a sustainable play that the US Treasury has put in, and it's something that they will continue. And as a result of pushing that liquidity in, it makes gold quite attractive to hold. So as a result of that, I think you'll see more people, stick with equities or try and roll out of equities and come back into gold, because they can see there's more future in it.
As we move forward from here, what's your sense also on the base metal prices? Because we're looking at some consolidation onto that one. Zinc is back near those 4-year highs. Aluminum, of course, down on some profit taking. Copper off its all-time highs as well. But movement here from here on, what are you anticipating?
I think generally speaking, when you look at the base metal complex, you've still got that structural support particularly coming out of China. And I've always mentioned that I've always liked copper because of the good green play that we see, and also silver. But when I look at the base metals, I think they're going to be quite well supported as we move into and consolidate sort of the greener economy. So I think copper, as we know, has been in a structural deficit, and we've had some mine issues. So there's nothing bad about having a bit of a rest, but I do see we're in a structural bull market for copper.
As we move forward from here, what is it that you think that the money is going to keep rotating in? Is it going to be safe haven, gold, or you think silver, which did see some outperformance in the first quarter, can it go on with that, or you think gold is the place to be?
No, I think silver is the place to be. Okay. When you look at imports of silver ore or ore-bearing silver into China, was up 62% year on year. That is a trend that's not going to go away. And that's a trend that China needs silver for all its, becoming the market leader in things like solar panels, etc. So when China's the market leader, she needs this product. And as a result of that, silver, I think, will be in demand. And I think silver at the end of the day will continue to outperform gold from where it is at the moment.
Jonathan, apart from central bank buying and ETF buying and financialization and having gold and silver in your portfolios, how much do you think that the festival demand will add to all of this?
Oh, look, I think it's just going to continue. People will see it's a store of value. It always has been. I think when we come into that period, people will say, well, it's at a good level, but it's going to continue. So there are good fundamentals around it at the moment, reinforced by what happened to our Treasury. So, yeah, got to be quite supportive for the long term for it.
All right. Jonathan, thank you as always for joining in. So gold and silver continue to be in favor, and silver more than gold, as Jonathan puts out. That is where you're looking at not just investment and safe haven buying, but China industrial buying as well. And that perhaps would continue to support prices. Gold could go to 5,000, silver to $75 an ounce is the view coming in from Jonathan. But with that, let's go for a short break. We'll get you more on markets and stock specifics on the other side.
Welcome back. Well, the mid-cap index is surging. The markets have added on to the gains that we've been seeing since the start of the day. In the broader markets, of course, the sugar stocks are doing well, but we do have MMTC, which is surging. NetWeb is the other one which is doing well in trade today. We do have Z Entertainment and MCX, some of these stocks which are buzzing on the upside. LIC is the other one, has been doing well since the company reported its numbers and is at a week high as well. So some of the stocks that we wanted to highlight for you, but let's get company specific now. Kubota is putting India at the heart of its global growth strategy, a 2,000 crore rupee new plant that will also serve as an export base. Shivani caught up with Kubota's global CEO Shingo Hanada and escorts Kubota's CMD Nikhil Nanda to talk India expansion plans. Listen in.
Trying to invest in the Indian market, and we are going to increase market share. That is a very important thing for our global business. However, at the same time, because in the tractor market, there are two trends. One is more sophisticated, smart agriculture type things, but the other trend is that there is a trend for more economical standard tractors demand globally. So that's why we are going to invest in the India to strengthen the power of Escorts Kubota. That will help us to get more market share globally outside of India as well. A good potential for the construction equipment market for us because we are a very small player at this point. However, we see the market growth as well, and we are confident in increasing the market share there as well.
Okay. Since April, May, June, July, we have gained market share, and that's because of the products. So that is a confidence we have for growth. So Faridabad, we have 170,000 tractors. Today, Hanra-san did the groundbreaking, where we will be investing 2,000 crores, and we are putting a capacity for 60,000 tractors. So we are ambitious, confident, with Kubota's support for this capacity to add value both domestically and internationally. More than number, I see Escorts Kubota driving the value chain and the farm mechanization change in the country.
Okay, all right, we need to take a short break, but we'll get you a lot more in terms of specific stocks as well as the market on the other side. Stay tuned. Welcome back. Well, let's bring you a conversation from the Banking Transformation Summit. Piramal Finance's Jairam Sridharam explains why the pace of MSME loan against property growth is making him uneasy.
The thing to focus is loan against property. The MSME lending lab business has been growing at a CAGR industry level of 30+% over multiple years. Pricing has held on and risk has not deteriorated, right? But it has been slowly but steadily inching up, right? It first started in 2024 with some of the micro lap players actually coming up with results which were a bit of a shocker to people. And then it stopped. It felt like, oh, we have all avoided the problem. Nothing is happening around. And since then, I think the problem is building. I think loan against property over the last 2-3 years, the industry growth is extremely high. And we've all got to step back and kind of think about whether the small businesses in India are indeed growing at that rate that that they can absorb this level of capital. And by the way, a lot of the gold conversation that we had before, a lot of it is finding its way into business as well, right? A lot of the gold loan is essentially business loan in disguise, where the guy had a tough conversation with his wife in the bedroom the previous night, right? And they've turned up here. So there is a lot of credit that has gone into MSMEs in recent times through one form factor or the other. LAP is a business I worry about in terms of where it is headed.
Okay, on that note, we're going to wrap up on Halftime Report. Business Lunch will take all of the action forward. Thanks for watching.
Stocks climb after US Treasury says it will buy back long-dated securities to cool bond yields. IT, realty and financials lead the leg up, while energy is the notable drag. SEBI bans Kotak, Mauritius and Mansi share and stockbroking from the market and impounds 3.68 crore rupees of their funds for manipulation in cash on the 13th of August. SEBI chair issues a strong warning to manipulators looking to defame cash. The price of sugar jumps to a record high, rising 10% in a month as the opening stock for November hits a historical low. The government imposes a 15-day inventory limit for bulk users, but tight supply props stocks of sugar mills. Minutes of the RBI's Monetary Policy Committee suggest that there is a case for a rate hike. RBI Governor Sanjay Malhotra, while preferring to wait, warned that in the meet that high input prices could lead to broad-based inflation. And RBI Deputy Governor Sirish Murmu tells CNBC TV 18 that MDR for UPI is on the cards. Revolving credit was never permitted for NBFCs, and the decision to close the FCNRB window early was in response to the evolving situation. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormus Fatakia, and the markets have taken a leg up today. Finally, after 7 days of losses, the Nifty is finally in the green, and it is at the highs of the day as well. So it's a good start to the trading day, the good first half as well. And now the last few minutes have seen another leg up for the markets. So 24,250 is where the index is currently placed at. That is another important level on the upside to watch out for. Today being the Sensex weekly expiry as well. That is something that will also have to be taken into account, and therefore the cash today assumes even greater significance, as there has been a lot of action with regards to cash that took place last Thursday. Of course, the broader markets as well. Leading the Nifty higher though is the Nifty Bank, mind you. The Nifty Bank too, after defending that 57,000 mark on the downside in yesterday's trading session, has managed to claw its way back towards the 57,700 mark. So good going for the Nifty Bank as well. The broader markets are doing well, sugar stocks are doing well, and a lot of these gold financiers too are in the green in today's session because of the rise in gold prices. We'll get more on the markets as we go ahead on the show. But SEBI Chairman Tuhin Kanta Pandey has warned that any attempt to defame the closing auction session through manipulation will be dealt with sternly. Speaking at an event, he said that the new system is intended to improve transparency, and any attempt to manipulate this can be detected relatively easily.
कैश सिस्टम में मैनिपुलेशन पकड़ने के आसान मतलब जो हमारा वो है वो ज़्यादा अधिक है हमारी कैपेबिलिटी पुराने वीवैप सिस्टम से की अपेक्षा जो कैश सिस्टम में हम रिलेटिवली इजीली मैनिपुलेशन को पकड़ सकते हैं तो इसलिए ये आपको ये देना होगा कैश ट्रांसपेरेंसी के लिए है और वो लेकिन यदि कोई ये समझ रहे हैं कि हम उसका कैश को नाम बदनाम करने के लिए मैनिपुलेट कर लेंगे तो वो बहुत ही धोखे में होंगे.
And hours after SEBI chairman warned cash manipulators of strict consequences, the regulator released an ex parte interim order pulling up 2 investment and brokerage firms who are allegedly manipulating the closing auction session in the Sensex last Thursday, which was the 13th of August. The regulator has charged Kotak Mauritius Investment and Mansi Share and Stockbroking with a fine of 3.7 crore rupees as they allegedly manipulated the markets during the newly introduced closing auction session to determine the closing price. Earlier, we also caught up with Anand Narayan, the former whole-time member of SEBI, on this recently launched cash and how it can improve liquidity during the session. Listen in.
Clearly, we've got to ensure that the liquidity in the cash goes up over a period of time. I'm sure SEBI is doing a lot of work on that alongside with market participants to figure out how that's done. I think 2 areas where this can actually lead to some good progress. One, amongst mutual funds, the arbitrage funds, there should be natural players in the cash to ensure that the prices are kind of kept under control. They might have to change their operating model a little bit, taking on a little bit more risk to be able to do what they have to do. That I think might require a discussion and dialogue with SEBI.
Let's now get you an exclusive story. Yash is picking up some details on Rishabh Instruments. Yash, tell us more.
What we've been given to understand, what sources tell CNBC TV18, is that promoters of Rishabh Instruments are eyeing a stake sale which will give controlling interest to the new investor. What we've been given to understand from our sources is that the promoters at this point of time are in conversation with multiple bidders, with one large German entity being in the lead as far as those conversations with respect to promoter stake sale in Rishabh Instrument is concerned. Totally, promoters have about 70% stake as far as Rishabh Instruments is concerned. Part of it is in the conversation to be sold to a new investor, which is expected to trigger an open offer in the company, which will help the investor raise its stake beyond what the promoters sell in the first tranche of it. What we've been given to understand is that if these two moves, that is the promoter stake sale as well as the open offer, gives the new investor a controlling interest, which is about 51%, then the transaction would end there. But if these two moves fall short in giving the new investor that 51% stake in Rishabh Instruments, then of course the promoter would also be willing to sell more stake to finish or to complete that 51% in the interest of the new incoming investor. Also, what sources tell us is that promoters are looking at a valuation which is in upwards of about 3,000 crore as far as this particular transaction is concerned. We've written to Rishabh Instruments on this particular development. A response from the company still remains awaited.
Yash, thank you for that exclusive story there. Take a short break, get to the latest updates on how auto imports from the UK are set to get cheaper. Abhimanyu gets us more updates on the other side. Stay tuned. Welcome back. Now, RBI Deputy Governor Shirish Chandra Murmu has defended the proposed rules curbing revolving credit for NBFCs. He was speaking to Lata Venkatesh at the 4th edition of the Banking Transformation Summit. He said that the aim of RBI's regulations were to bring more clarity for businesses. Listen in.
Actually, this is not a new regulation. It has been there all along. Okay. Revolving credit as such was not permitted even now for NBFCs. But what we are proposing in the draft is we are trying to bring more clarity. Okay. And so that's why the definition has been emphasized in the draft regulation. And with this, we feel it will help better compliance. Our regulation will not come on the way of any business activity. So that is very, very important for all of us. The idea is not to prevent anything. Idea is to do business in a certain way, keeping in mind the risk.
Now, talking about RBI's draft circular on revolving credit at the 4th edition of the Banking Transformation Summit, Sudipta Roy of L&T Finance said that the circular will have a multi-dimensional impact, while Abhimanyu Munjal of Hero FinCorp said that it will have a systemic impact not only on NBFCs but a larger retail borrower pool. Listen to what they had to say.
This has got multi-dimensional impact. This is not an easy thing. Primarily because, it touches, it's not only about the flexi loan product, it touches supply chain, it touches inventory funding, it touches, some part of personal loans, derivatives which were there with some of the fintechs, it touches that. And frankly, whether it touches loan against shares, etc., it's a slightly gray area because it's a secured asset on the other side. So frankly, first and foremost thing, I think, very cogent interpretation is needed as to what it touches and what it does not touch. I think the Deputy Governor's clarification in the evening gives us a ray of hope. But, the total outstanding that we're talking about is anywhere between, the numbers vary, but I think it's ballpark between 1.5 lakh to 2 lakh crores that have this sort of structure.
Around this, in this form, which
especially done by NBFCs.
So around 2 lakh odd crores from
between
NBFCs.
1.5 to 2 lakhs. We don't have the exact number, but our ballpark is between that number. Now that's a pretty large number, and the fact is that again you talked about UPI on credit. Though it's not open for NBFCs as of now, but the fact is that if this regulation were to apply in its entirety, that goes out of the window, right? So as I said, it's got multidimensional impact.
My reading is, from an SME perspective, this does not bar invoice discounting. There is a license of factoring, which RBI has issued, and we are one of the factoring licenses, and we do it we have a decent sized book. So it doesn't discount, it doesn't bar us, because that's a license issued by RBI. Right, which is a revolving credit, which is I'm factoring so that doesn't bar us from there. Trades, it doesn't bar us from there. So I really feel the problem is the derivatives of personal loans, right, where OD getting converted into EMI after 3-4 years, and it would have, I don't know the numbers here which he's talking about.
1.5 lakh to 2 lakh crores.
Could be bigger, yeah, is what I sense. But FIDC would have the number. We've not gone deep onto the number. But this will have a huge ripple impact on those borrowers. Because if those borrowers are used to that line, to really lend into that line to pay other obligations. So a systemic impact not only on NBFCs, but a larger retail borrower pool, which is a cause of worry.
Now, automobile imports from the UK are set to get cheaper under the free trade agreement, meaning premium brands like Rolls-Royce UTs. Abhimanyu is here with more details on that. Abhimanyu.
India is set to shortly green flag the import of over 10,000 cars from the United Kingdom under the FTA between both the sides. Cheaper British premium cars like Aston Martin, Bentley, JLR, McLaren and Rolls-Royce are going to cross yet another lap in their journey to Indian roads. Sources have indicated that the government order is expected in a week to allow imports of 10,480 British automobiles in 2026 as per the India-UK Trade Pact, and India is going to issue the order for allocation of the tariff rate quota under the FTA. Now, under a TRQ order, the government allocates import quotas to importers under yearly allocation limit as per the Trade Pact. No duty cuts will be made in the first 5 years of the Trade Pact for British EVs, hybrids and hydrogen vehicles priced below 40,000 British pounds. Under the CETA, import duty on 3.78 lakh conventional engine passenger cars are going to fall from 110% to 10% over a period of 15 years. India had opened the application window over a period of 15 days last month for 27 tariff items for the calendar year 2026. It remains to be seen what's going to be the kind of response and which exactly will be the cars which are going to be imported into India from the United Kingdom.
Abhimanyu, thank you for that update there. Take a short break. Back with more on the other side. Welcome back. On to the latest developments from West Asia. Then US President Donald Trump has announced what he calls the most crushing economic operation against Iran, warning countries, providing Tehran a lifeline of severe financial consequences. The UAE has also suspended trade and financial dealings with Iran after reported missile launches. CNBC's Dan Murphy gets us the latest updates.
President Trump is dramatically escalating the economic pressure on Iran. Trump says the United States will launch what he calls the most crushing economic operation ever taken against any country, threatening severe consequences for foreign banks, businesses and governments that help Iran to evade sanctions. The targets include oil smuggling, currency swaps, cash transfers, exchange houses, ship registries, and front companies, including the networks that Iran uses to move money and maintain access to the global financial system. No specific details of the measures were given, but the president also threatened severe economic consequences against any country that provides any kind of lifeline towards Iran. The new measures put several countries in the spotlight and could be a pressure point for Russia and China, which have maintained some diplomatic, economic, and energy ties with Tehran. However, the UAE's decision to halt trade, commercial exchanges, and financial transactions with Iran just yesterday also marks a major escalation in a relationship that has long underpinned Iran's access to global commerce. For decades, the UAE, and Dubai in particular, has served as Iran's main trade and re-export hub, with bilateral trade estimated at around $27 billion, and thousands of Iranian-owned businesses are operating in the Emirates. The UAE has provided a critical gateway for goods, shipping, finance, and cross-border capital flows. The biggest impact is likely to be on Iran, which risks losing one of its most important commercial and financial corridors at a time of heightened regional tensions. But the key question for markets is the financial side. If the suspension extends to banking, trade finance, and capital movements, it could affect everything from business payments to property transactions and even Iranian wealth held here in the UAE, raising the prospect of a much deeper economic rupture between the two countries. CNBC has contacted major financial institutions, government agencies, and financial centers in Dubai and Abu Dhabi for comment.
Dan Murphy there with the latest updates. Now, there has been a notable breakthrough on a cancer vaccine. The Merck Moderna's mRNA melanoma vaccine trials indicated a 49% lower chance of recurrence or risk of death. Ekta is here with more on this. Ekta.
Well, yes, Moderna shares surged 177% yesterday, which was the biggest ever one-day gain, while Merck rose 12%. The reason? Encouraging results from a personalized melanoma cancer vaccine. Merck, which is the maker of Keytruda, which is a very big cancer drug, and Moderna announced positive phase 3 results from a trial involving over 1,100 melanoma patients. Now, what makes this particularly interesting is the technology. The vaccine uses mRNA, which is the same science behind Moderna's COVID vaccine, but instead of training the immune system to fight a virus, it trains it to recognize and attack a patient's own cancer cells. And this is personalized. Doctors remove the tumor, analyze its genetic mutations, and use that information to create a vaccine specifically for that patient. Earlier data was particularly encouraging, so the vaccine combined with Keytruda showed a 49% lower risk of reoccurrence or death versus Keytruda alone. Melanoma, remember, accounts for around 3.38 lakh new cases globally each year, and India sees an estimated 5,600 cases annually. But this is not a treatment available yet. Moderna and Merck still need to take the vaccine through the regulatory approval process. Now, if approved, though, this could be much bigger than melanoma, potentially opening the door to personalized cancer vaccines for several other cancers, say experts.
Ekta, thank you for those updates there. A big breakthrough indeed. And let's now listen in to Moderna CEO Stefan Bankel and Merck President Dean Lee speaking on how the vaccine works and its role in changing modern medicine.
It's a big moment for medicine, a big moment for patients. We believe that this is just a first step for intismeran plus Keytruda. We're excited what it is going to mean for patients. Already, just hearing stories from patients in clinical studies has been really heartening. And so I'm very thankful for the team that have worked on this for 10 years.
You're taking Keytruda, which many people know is a really important cancer drug that's approved in 20 different types of cancers. And if you add this personalized cancer treatment based on the technology of Moderna, and you treat patients with a really deadly disease, melanoma, you reduce that risk of recurrence, which essentially means that patients have a better chance of being disease-free and for longer. And the question will arise as to how long could they be disease-free. So we're going to run this trial out and see.
Well, that was, of course, Moderna, 177% surge in a single trading session, almost tripling in value. That was the big story there on the cancer vaccine front. Some flashes at the bottom of your screens. NSE is looking to seek allowing trades under the permit to trade category and the trading its own stock in its ongoing IPO roadshow. This is what sources are telling us. We'll get more details on this in just a bit. Currently, there are 144 companies that are listed on the Bombay Stock Exchange that are permissible for trade on the NSE, and NSE might seek SEBI's permission to permit the trading of its own stock on its own platform. Now, that is a big development that is coming in as per sources, and well, you get more details on this. Of course, the mega NSE IPO is on the anvil. Yash has been on top of this right from the NOC to its DRHP and the potential valuations that it might seek as well going forward. They're looking to allow this trade under the permit to trade category. They are looking to take permission from the market regulator SEBI on this front, and currently, as what you can see at the bottom of your screens, there are 144 companies on the Bombay Stock Exchange that are allowed to list or trade on the NSE as well. So that is an important story that's coming in with regards to that. Get you more details as the day goes by. Take your leave on this edition of Business Lunch. Thank you so much for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar, live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Vivek Iyer. Good day for the markets. We are seeing gains of around 0.9% on the Sensex, 0.7% on the Nifty, building onto the gains as well. That happened around 12:30 p.m. So we have continued to consolidate at those levels. Midcaps are gaining in line with the benchmark.
That's right. Almost 11 sessions where we didn't see any kind of green on the screen today. Driven by the kind of risk-on rally that we saw globally as well as in Asian markets. Indian markets are taking a positive cue from that. But a lot lined up on the show, an important conversation with a company that's looking to get listed on the exchanges as well. So let's start off with the top headlines. Stocks climb after the US Treasury says it will buy back long-dated securities to ease bond yields. The Nifty gains over 150 points near 24,250 levels, with the realty and IT stocks leading the rally. Broader markets trade in line.
Video security and surveillance major Aditya Infotech zooms in trade after 1,500 crore rupee fundraise nod. Separately, Motilal Oswal initiates coverage with a buy rating and a target of 4,200 rupees a share.
KFin Technologies gains post a large block deal with almost 8.7% of the total equity exchanging hands, and the size of this particular deal was more than 1,400 crore rupees, which happened at 925 rupees a share. Sources tell CNBC TV 18 that General Atlantic is the likely seller.
PFC REC shares fall after Morgan Stanley downgrades both stocks, citing a sharp moderation in loan growth and a widening gap with power sector credit growth.
Aditya Birla Capital shines in trade as it enters the gold loan business through its NBFC arm, with plans to open 1,000 dedicated branches over the next 3 years.
All right, those are the top headlines that we are tracking. Midcap doing well in trade today, so are the small caps. So it's a good time to know what are some of the broader movers in the market as well. This is our special segment, Midcap Movers. We have Upasna as always to take us through the midcaps that are moving around in trade. Upasna.
Well, first up, let me address the Nifty Midcap Index. It's up more than 0.7% today, certainly on the gaining side. Now let us look at some of the top gainers in today's trading session. First up is NetWeb. Certainly the stock continues to remain in focus. If we look at the 1 month move, it's up more than 20% in 1 month and 7% as we speak. Muthoot Finance also continues to remain in focus, up nearly about 4%. Strides Pharma also up nearly about 3.5% as we speak. Solara Active Pharma up nearly about 15%. Sharp surge seen in the stock. And lastly, Aditya Birla Capital also in focus as the company enters the gold loan business. Now let us place focus on sugar stocks. They continue to remain in the sweet spot as due to the record high sugar prices. For the likes of Balrampur Chini, Dhampur Sugar, Sri Renuka, Awadh Sugar, all of these stocks seeing a sharp run up from 5 to nearly as high as 12%. Now on the flip side, let us look at some of the top losers in today's trading session. Topping the list is Aster DM, down nearly about 3%. Chennai Petro, that saw a sharp run up yesterday, has corrected today, down nearly about 3.5%. REC PFC taking a hit on back of that downgrade by JP Morgan. And lastly, coming to Zentech, it's down nearly about 2.5% as we speak.
Well, thank you so much, Upasna, for joining us and giving us all the top movers and shakers as far as the broader end of the markets are concerned. But we are now on to a very interesting story. Sources suggest that NSE may seek SEBI nod to permit trading of its own stock on its own platform. Yes, joins in with more details.
Well, so far, all the chatter, all the interesting conversations have been with respect to the listing of the National Stock Exchange. But there is something which will keep the whole exchange scenario excited post NSE's listing as well. What we've been given to understand is that once the National Stock Exchange debuts on the exchange because it would only list on the Bombay Stock Exchange. After that, the National Stock Exchange could seek market regulator SEBI's permission to be traded on its own exchange, that is National Stock Exchange itself. This is permitted as of now under the permit to trade category, where a company is only listed on one exchange, but through a permission or an approval process from market regulator SEBI, it gets traded on the other exchange as well. Of course, the regulations only permit an exchange to list on its parallel exchange, and no self-listing is allowed, which will be followed by the National Stock Exchange, which means it will list on the Bombay Stock Exchange, but then right after it will seek the regulator's permission to be traded on the National Stock Exchange as well. Currently as well, there are about 144 companies which are listed on the Bombay Stock Exchange but get traded on the National Stock Exchange as well. This is under the permit to trade or PTP category. The same is expected to be followed by the National Stock Exchange, where a permission would be sought from SEBI to be traded on NSE as well, but remaining to be listed on only the Bombay Stock Exchange. Of course, the final approval will lie with market regulator SEBI, but at least a permission would be sought.
Okay, all right. Thank you so much, Yash, for joining us with all those details. BSE stock is at the day's low on the back of a possibility of that happening. But as Yash said, permission will be sought for this. Let's step into a short break. We'll connect with the top management of Tempson's Instruments as their 650 crore rupee IPO opens today. Stay tuned for that conversation. Welcome back. You're still tuned in to Midcap Radar. Well, Tempson's Instruments IPO opens for subscription today. It is a thermal engineering and specialized cable manufacturer, and it is a 650 crore rupee issue with 95 crore fresh issue and 555 crore offer for sale. Let's welcome Vinay Rathi, the MD, and Arun Rathi, lead of global sales at Tempson's Instruments, to talk about the issue and the usage of funds as well. Gentlemen, thank you so much for joining us today. Mr. Vinay, let me start with you first up. If you can briefly explain the business that you are into into? What kind of breakup do you have between different segments? And the reason for offer for sale, because the company has been growing well, it's a big chunk that you're offering for sale in this particular IPO.
Yeah. The thing is, the company Tempsons is in thermal and cable domain. So what we do is temperature sensors, electrical heaters, and specialized cables. So these products are going into all kind of industrial environment, be it steel, cement, power, petrochemical, glass, and all the other segments. And we are supplying not just in India, but worldwide. The company has manufacturing in India and also 5 locations outside India. The proceeds of this IPO, 95 crore rupees is going for the fresh issue, in which will be for reducing some debts and also for some expansion in the company. And the rest is going for the other shareholders. Our family would be fully invested in the company, but there are some other shareholders who don't have an executive role in the company, so they would be exiting partially during this IPO process.
Okay, Mr. Rathi, two-part question. Like you mentioned, the majority of this particular IPO is an offer for sale. So number one, explain to us the timing, of this particular IPO. Why are you coming out, and trying to give an exit to some of the shareholders at the current moment of point? And number two, post the IPO, what will be the shareholding of these stakeholders? And we would understand, quite obvious that going forward, they would want to go ahead and trim their stake to nil in case they do not have any controlling or any say as far as the management of the company is concerned.
Sure, thanks. So our family is having about 55% shareholding in the company. So we remain fully committed and we see a good possibility for the company to grow in future. So out of the 45%, the 3 families, partially they are exiting. And 15% of them would be remaining as of now. And we hope that about 10% of these other shareholders would be with the company for a long time. So we expect maybe around 55 plus 10, 65% of the shareholders would be working with the company for a long time.
Okay, all right. So you maintain that confidence as far as shareholding is concerned. Arjun, coming to you then, you're the lead of global sales and you do export to different countries as well. What is the current export percentage? Are export margins higher than your domestic business?
We export to about 80 countries worldwide, and that makes up about 30% of our revenue right now. And historically, the export growth has been a little higher than what we have grown in India, and we expect to maintain a similar kind of growth going forward as well. That is mainly due to the newer kind of companies we have set up outside India, especially in geographies like Mexico, Poland, and Korea.
When you say export markets have grown faster than domestic markets, what has been the growth in export markets versus domestic markets? And is it a more profitable business versus domestics? Are margins higher there?
So you can say that on our, natural kind of growth, exports have been about 10% higher in terms of growth versus the domestic markets. And the margins are slightly better for these kind of markets.
Okay. Mr. Rathi, give us a sense, how should we look at the company, especially in terms of capacity? What is the current capacity utilization of the plant? We also understand that there is an upcoming facility as far as Udaipur is concerned. What is the capex that you will require? How much will the IPO actually go ahead and help you with? And given the fact that there will be no debt reduction, what are the current finance costs you're working with?
Yeah. The thing is, right now our capacity would be utilized about 80%. So there's also already a 20% spare capacity which is available. A part of the IPO proceeds will going towards capital expansion in the company in the field of heaters and also specialized cables. So we see that there's enough scope for the company to increase its sales volume with these kind of capacity what we are adding.
Okay. So what is the current capacity utilization across your plants? You have 15 of them, out of which 5 of them are abroad. Since you're adding one more plant, I'm assuming that you're working at peak capacity utilization already. When will this plant come on stream? Will you pay off your complete debt from the IPO proceeds as well?
Yeah, we would pay off our complete debts from the IPO proceeds, and our plant capacity are running about 80% with a single shift. So we see that this additional capacity would take care of the increased demand. Also, the facilities outside India for the newly set up geographies. So we see those capacities are being utilized pretty less now. And as we gain more market share in those kind of markets, so those also would kick in and would add to the volume for the company.
Okay. Aryan, a couple of quick points. Mr. Vinay, please feel free to jump in as well. Why did the free cash flow or cash flow from operations actually decline from 54 to 42 crore in FY26 in the year gone by? Inventory days too have increased quite significantly from 125 to 170. What is the reason for both of these metrics, moving the way they did?
Right. So essentially, we have had we have had these dynamics because our facilities are backward integrated. So we have to keep inventory at each stage, but that helps us with higher margins. The comparison is, the difference is because we had acquired some companies at the end of FY26, so their balance sheets got amalgamated, but the incomes didn't. So that is why you see a jump in the working capital, but they should normalize by FY27.
Okay, take that point. I had a follow-up on that, but we are short on time. So, Mr. Rathi, quickly coming to you, what are the growth prospects? Will you continue to see what you've seen? And a lot of the raw materials are some of these commodities. Has that impacted you? And is this something that you buy on a spot basis, or do you have contracts frozen in already?
Yeah. The thing is, the growth prospects are the tremendous growth prospect. One is because of the R&D capabilities of the company, we've got about 80 people on R&D side, and we have developed a huge number of new products, which we see a great market potential. And with our sales network worldwide, we can push these products worldwide. So typically, the company has been working mostly with the heavy industries for the projects and the replacement market. But now we are working with a lot of OEM players in newer segments, be it automotive or other newer segments. So we see a huge prospects over there. And regarding your second question, can you please repeat the second question?
I just wanted to know about the raw material prices. You do have a lot of commodities, copper, other things as well. So have you locked in prices for that? Because commodity inflation is something which has been eating into margins of every company this time.
Yeah. So our contracts are normally short-term contracts, and we have 4 to 4.5, 5 months of order book. So we kind of price in the current pricing of the commodities. So it is like a cost plus basis. So those are passed on to the customer. So we are not having any much risk of the commodity price change.
Thank you so much, Mr. Vinay, as well as Aryan, for joining us. We wish you all the best for the upcoming IPO. And when you do join us on listing day, we will expect a lot more answers, especially in terms of the prospects of the company going forward. Well, we'll now slip into a short break. We'll get you more on the markets and also focus on Crompton Greaves consumer, which is buzzing in trade. Stay tuned.
Welcome back. You're still tuned in Midcap Radar. A lot of stock-specific action. So Crompton is one of them. Gains in trade after unveiling its FY29 and FY31 growth outlook at its Investor Day. Upasana is joining us now. The stock is surged to the day's high. Upasana, tell us more.
Well, the company held its Investor Day today, in which it has laid out the targets and the outlook for FY29 and FY31. Now, for FY29, the company sees revenue growing at a 13 to 40% CAGR, and it expects it to double 2 times from the current levels by FY31. Now, if we talk about the industry growth rate, the India's consumer durable sector is expected to grow at a 11% CAGR by FY29. So certainly much above what the industry is growing at. Now, profit growth, company believes, for both the years, that is FY29 as well as FY31, will be higher than the revenue growth, is what the company has indicated. And for FY29, EBITDA margins, which the street was estimating around 9.5 to 10%. Here, the company has given a guidance of 11 to 12%, so certainly higher than what the street was penciling in, and a 12% plus is what the company has guided for in terms of margins for FY31. Smart and connected mix, which is one of the core things of the company, it's likely to form 15% of the revenue by FY29 and 20% by FY31. Now, coming to the company's new businesses, in which the company feels that the diversification is the key going ahead, it's likely to form 14 to 15% of the revenue by FY29, and 20% is what the target is laid out for FY31. Overall, if I talk about the fan market share, the company has given a target to improve 100 basis points here over the FY26 levels, and the premium contribution, which was one of the key drivers for this quarter's, that is the Q1 results. For premium contribution, company believes that will nearly be 30% of the sales, which is an uptick of nearly 500 basis points over FY26 levels. So overall, certainly a good set of targets laid by the company, certainly higher than what the street was estimating.
Well, thank you so much, Upasana. The company is having an investor meet, where analysts are present, and thank you so much for bringing us live updates and also going through the presentation that the management has uploaded. But moving on, bringing you conversations from the Banking Transformation Summit, Jairam Sridharan, MD and CEO of Piramal Finance, says large NBFCs are unlikely to ignore the gold loan segment, but rising competition could fragment market share and put pressure on yields. Let's listen in.
The market in gold was 4 lakh crores 4 years ago, and nobody cared. Nobody cared to enter into it. Everybody was sitting by the sidelines and saying, okay, whoever is playing can continue playing, like, doesn't really matter. All of a sudden, over the last 2 years, it has jumped to becoming 21 lakh crores. At 21 lakh crores of AUM, it is a business that I cannot ignore. No large NBFC board is going to allow them to not be in this business. They'll be like, what the hell are you doing? It's the second largest business out there. How can you be, let's say, an upper layer NBFC and not be in that business? So everybody will be there in that business because of the nature of how the business works. It's the only high yield, low credit cost product out there. और कोई प्रोडक्ट में आपको 18% का इंटरेस्ट और आधे टके का रिस्क नहीं मिल रहा है, तो ये एक ही बिजनेस है, तो सब लोग करेंगे इसको, कोई इसमें दो राय नहीं है, सब करेंगे. Now the question is, what does that mean for the industry, and what are the risks if something goes wrong in this business? What it means for the industry, of course, is that the competitive structure will change, the market structure will change, the more dominant position that a few players have had will probably go away, and this business will start looking like every other lending business in the country, where even the top players have single-digit market share. So much more fragmentation is probably one outcome. Lower yields in general is probably a second outcome. But then the risk side, what happens if gold prices break is an important question. Gold is $4,300 an ounce today. At peak, it was $5,300 an ounce. So it's already corrected about 20%. But it has grown at a CAGR of 13% over the last 10 years. It used to be $1,300 an ounce 10 years ago. So it has grown at a CAGR of 13% over the last 10 years. If instead it had grown just by inflation, which is what the 100-year trajectory has been, that gold rises by global inflation, if that's what happens, then gold can go to half its current price. right? So
and what happens then? If that were to happen, anything is possible. I mean,
really bad things happen to incumbents. For challengers, not a whole lot happens. Because for challengers, you don't have a big back book to protect. So you don't really worry about it. You take a little bit of hit and you dust yourself off and move on. But if you're an incumbent who's built a 1 lakh crore book on the back of this price, and then suddenly prices fall by 25 to 50%, there is hell to pay. So the impact is not uniform on everybody. Impact completely depends on how big your back book is.
Well, a very interesting conversations that we had whole of last evening as far as the banking summit was concerned. But with that, it's all the time we have on this edition of Midcap Radar. MF Corner when we return.
Hello and welcome. You're tuned into MF Corner on CNBC TV 18. I'm Sonal Bhutra, and today on the show we are going to be discussing different options available for aggressive investors when it comes to mutual fund investments. Before we go across to our guest to understand what does this aggressive investor really mean and what are some of the categories that they should be looking at, let's take you some of the categories that are focused on being helpful for an aggressive investors and which aggressive investors can consider for their portfolio as well. First up, in the equity focused category. We do have small cap funds, highest growth potential here, highest volatility as well, and that is something that shows the way they are valued and the way they move in stock markets as well. Mid cap funds, a step down in risk from small cap, but they are growth oriented again, and of course depends on different market capitalization as well as per SEBI definitions. We do have sectoral or thematic funds, which are concentrated bets, which will be on specific sectors itself. You do have health funds, pharma funds, there are defense funds and other funds, to name a few. There's PSU, manufacturing. So they just concentrate on one fund, but it does have higher risk because if the sector sees a downtake, they will not do well. The second one would be small and mid caps combined. There would be focused funds, which are concentrated portfolios for high conviction bets. We do have growth style or momentum funds as well, which focus on the momentum pricing and momentum investing as well. So you will have flexi cap funds or multi cap funds, which an aggressive mandate which is put by the fund manager. You do have value versus growth style funds. So growth style funds would be where aggressive investors lean towards growth or momentum cycles, and that is how they invest in this particular category. Then you have leveraged or derivative-based funds, which are the smart beta or factor funds, which are basically focusing on momentum. They're quality factor funds as well, and a lot of them are actually getting introduced in the markets as well. We'll discuss that in greater detail. Then you have the international or global exposure funds. You have, say, the tech-focused funds. There's emerging markets. There's China-specific for diversification and for high growth as well. So these are some pockets they can consider. But do remember there are limits to that right now. So not a lot of funds are open for subscription. Then you have the hybrid aggressive options. High equity allocation with some debt cushion. It's a bridge category for investors not fully comfortable with equity, but of course it's somewhere where you can get equity exposure as well. Multi-asset allocation funds with high equity tilt are the ones which would be okay for aggressive investors as well. You do have high risk, high reward niches as well. If there are NFOs in emerging themes which have not come before, or products which have not been introduced to the markets, there are contra funds for contrarian, higher risk reward. So these are some of the aspects that you can consider if you're looking at investing as an aggressive investor. But of course, we'll drill it down as well and understand more from our guests today. We are now joined by Deepak Shenoy from Capital Mind Mutual Fund to discuss this and understand what works best for an investor who wants to be aggressive in his or her style. Deepak, thank you so much for joining us today. Always a pleasure speaking with you. And usually on the show, we talk about a balanced portfolio, talk about every class of investors. But let's get and let's take a deep dive into who would an aggressive investor be. Is it about risk? Is it appetite? Is it time horizon? Or would you say a person who's younger is more aggressive, and as you grow older, you become more conservative?
Very good question here, Sonal. And we've seen a lot of investors. A few of them, it's not really time horizon or age. Sometimes the age works against you. Younger people tend to have these home loans and, kids' school fees and immediate payments to take care of. So they're more worried about losing money. And the person who's retired, who's kind of paid off for his house and has no loans and has no liabilities, is potentially a lot more aggressive and can be, because the risk appetite is there. The risk appetite is a bigger thing because, people who are uncomfortable losing money typically do not do very well in an aggressive style, especially when the risk plays out. And, quickly you find that in momentum-oriented times, when people come into more aggressive strategies thinking, I can deal with the downside, don't worry. And when the downside actually happens, they kind of back off and say, well, I was not ready for something like 20% down. And 20% down is a very common thing in an aggressive strategy. So then they shift to becoming more balanced or less aggressive, more conservative in that sense. And then, time usually changes character of a person. And sometimes we feel people who are retired, they come in and say, everything's taken care of. I have an income. Why would I not be able to risk at all? I would like to take more risk. So it's a very different sequence that plays out in real life. And I don't think there's one formula, but risk appetite, I think, primary determining character of whether you can take risk, whether you're able to stomach this 20-25% downsides, that is what defines whether you should take an aggressive strategy or not.
That's a very important conversation because usually, you know, when people are advising their clients, they would say, oh, you're closer to 60, let's build you a little conservative portfolio so that you just get regular income and not maybe bigger bets. But that's not really the case. It depends from person to person. But if we talk about a reasonable minimum investment horizon before someone should even consider, say, small cap, sectoral funds or any aggressive category, does it work that way or you immediately start with these categories?
So I would say the time horizon in any cyclical long-term investment should surpass an up cycle and a down cycle. So that means in a market, you should have at least 5 years in equities, 3 years perhaps in some of the larger cap strategies, but 5 years in, when you include small caps or mid caps, because then typically you'll pass through at least one up cycle and one down cycle. And that gives you the ability to get returns in the long term. Unfortunately, we have treated long term as 1 year. And that's not really a useful test. And most people get disillusioned after the first year itself in any aggressive strategy. But typically, I would say horizon should be 5 years. If you're doing something that is way more aggressive, like, F&O or Bitcoin or something like that, your horizon may differ in those because the cycles there are in different time frames. But I would say for equity markets, you should have a 5-year horizon to play at least a cycle.
Okay, 5 years definitely. That is the time it takes to at least for you to start seeing your portfolio perform for you in the best possible way. But if we call somebody or somebody calls themselves an aggressive investor, how much of the portfolio should realistically go into high risk categories? Is it 100% or it's always best to have something in other categories as well?
So, Sonal, I don't call it a percentage-based mix. It's typically a mix of, have you fixed your emergency fund, which should never be in equities. It should be in an FD or a liquid fund or something really, really safe. Have you planned for your needs on a personal level at retirement, a loss of income after your age of 50, building towards a corpus towards that. Those things need to go in more balanced or diversified strategies where you may have some mid and small caps, but you want a balanced portfolio for something like your kids' education, your retirement, paying off your home loan, things like that will require a balanced portfolio where I typically say you might want 50+% in the larger or top 100, top 200 kind of stocks, and then lesser in mid caps, and then maybe a bunch of debt and gold or other asset classes as well. And anything beyond that, which is available to you. Now, you may be a fairly rich individual for whom none of these things matter. Then you can even have 90-95% of your portfolio in equities. But you may also otherwise be relatively not even have enough money for your emergency fund, where I would say 0% equities. Build your emergency fund first. So a percentage from an aggressive investor matters after he has taken care of the basic needs of the family, of himself, which are in more balanced and diversified opportunities. After that, you can get really aggressive in the rest of the portfolio.
Take that point, Deepak. We do have a lot more questions for you, but we have to get into a quick commercial break. When we come back, we'll continue our discussion on the other side and understand more and focus more on where an aggressive investor could invest in the mutual fund industry. Stay tuned for that. Welcome back. You're still tuned into MF Corner. We still have with us Deepak Shenoy from Capital Mind Mutual Fund, and we are discussing investment options for aggressive investors. Deepak, we usually, talk about small caps, mid caps, sectorals. These are some of the categories which do carry high risk. But recently, we've seen a lot of NFOs in the factor fund category as well. Momentum also does carry some amount of risk. First, which one do you think carries the maximum amount of interest? And if you had to rate them, let's put it that way, which one would you call the riskiest and then go below in that category? And what is up with factor funds and this aggressive products being launched in the market? Is that positive momentum or thought process coming back in the industry?
So I'll answer your first question first, Sonal. I think the aggressive investor has choices, and often we confuse risk with volatility. If you look at the long term, 5 years plus, small cap funds have actually generated decent positive returns no matter when you've looked, for the most part. But often in the 1 year or 2 year timeframes, you see that they may have lagged, they may fall substantially more. So if you have a 5 year cycle, your volatility at a 5 year level is usually much lesser. It's more at the 1 year or 2 year level that you see this volatility. Small caps are therefore a relatively less, from a risk perspective, long term. If you have a spread wide diversified portfolio, individual stocks may still be more risky, but a portfolio of small caps typically tends to be a little less risky on the risk parameter list. So if you look at the sectoral funds, those sectoral funds go through cycles. Some of those cycles can be really long. Even the thematics can be extremely long, take extremely long. There are cycles that play out in commodities. There are cycles that play out in certain sectors where sector does really well for 2 or 3 years and has 4 or 5 years of nothingness in it. And that sectoral fund may actually be more risky than a small cap fund, if you look at it from that perspective. And then you get the thematics, some of the concepts that you mentioned, the factor-based thematics, and we do a quantitative approach to markets. So we've seen that as more from the data perspective. They can be less or more. You can design a factor-based strategy like a momentum to have varying degrees of risk as well. But typically, again, among the factors, momentum tends to be very volatile. It's given great returns in the long term, but over a 1 year, 2 year, 3 year cycle, you can see substantially lower returns and deeply negative returns as well. So it is for a person who has the stomach to deal with it, right? And a fund like a dividend yield fund typically does not have great upside or downside. So it tends to be flatter, but there's no reason it should be. There's no reason some of these high dividend yield stocks may not fall 30 or 40% also. So there is a potential risk on the downside, but not that much of an upside either. So it does tend to, skew your risk return or risk reward sensibilities in that sense. And, there will be other kinds of funds which are either plain commodity based or a fund that is on gold or silver or something like that, where we're very happy when the upside comes, but there have been 20-25% downsides as well. So you perhaps should have a portfolio that contains multiple of these, that gives you the diversification, and it's perhaps for that level of sophistication where a person should get into this sectoral or thematic only if they understand the concept behind the strategy, rather than getting into it just because of performance or recent performance.
With sectoral or thematic funds, the general word is, if you do not understand it, as you said, do not even look at it. Like it's best not to be a part of your portfolio overall, because the down cycles can hit you really bad. But when we talk about aggressive hybrid funds, Deepak, do they fit for someone who wants high returns but they're not ready for 100% equity volatility? How should they look at this particular category?
Yeah, so I think the good thing about something like an aggressive hybrid is it keeps a certain percentage in debt, and that aggressive hybrid can actually go, up to maybe 80-90% plus in equity as well. So they balance out the exposure according to the way they see the markets. This is usually okay for a person who's aggressive and does not want the same volatility. So if I give a 65% equity portfolio, then I get only 65% of the upside in that way. The remaining is a fixed income upside. So I reduce the volatility that I have in my portfolio. This is great because otherwise I would put 100% equity into one fund and 35%, I mean, 2/3 of my money in one fund that is 100% equity, and another 1/3 that is in another fund that is only debt or fixed income. But then I'll have to keep rebalancing it because the equity fund may go up and go down. Here, the manager does it themselves. It is useful for what I call a semi-aggressive investor. I want equity, but I don't want too much equity. That's the kind of person that would want to go in. If you notice, most of the aggressive hybrid funds, they also don't take very aggressive equity positions. You don't find a fully small cap oriented aggressive hybrid fund. So even the aggressive hybrid funds go across the spectrum. They are very large cap involved in most of the aggressive hybrid funds, with some small cap and some mid cap as well. So even they understand that this person does not really probably want that kind of volatility in their portfolio.
You actually answered my question. I was going to actually ask you, this would not be so much for a very aggressive investor, as you said, a little less than that aggressive category. Since you mentioned fund manager and there are active funds which do see churn quite a bit, how important is the fund manager tenure and consistency for very high risk categories? Is that something an investor should check before they're looking at investing in such funds?
So I think at some level, the industry has moved away from a culture of having everything depend only on the fund manager. There's usually a process and a strategy that actually follows that process, right? So the idea being that I have to articulate as a fund manager how I select my stocks, whether it is, even if I'm aggressive, I might have a set of parameters that I use to select those stocks. And those stocks, those parameters allow me to select the portfolio that may be potentially giving me much better return than whatever perhaps the index itself is giving me. And so I'm going to deviate away from that index in that sense, but I am going to try and get you a better return. That's the kind of philosophy a fund manager has to have. And the fund literature itself should be able to articulate that part of the process. Tenure doesn't matter quite as much as the clarity of thought in terms of how you're approaching the market. If it's a standard strategy that, if it's a strategy that actually says, I want stocks with high ROE, relatively lower position, some layer of momentum in the prices, and so on, this attributes means that the fund manager also has to be flexible enough to be able to say, I want to either add more stocks to my universe, add more stocks to my portfolio, perhaps deviate away from large caps and go into small and mid caps whenever I want. So you want some flexibility given to the fund management team, but at the same time, you want a clarity of thought on the process. It isn't so much the tenure of that particular fund manager, but I think the clarity of thought matters really. And if you, especially when it's an aggressive fund, you should definitely understand what the fund manager has to say and the fund management team has articulated in their literature.
Okay, take that point. So the processes are set in place. We just need to understand what methodology is used for that fund construction. Last question before we let go of this very informative conversation, Deepak. Expense ratio. Does it matter more or less in aggressive categories, say compared to large cap funds or other schemes?
So I mean, the fund management industry as a whole probably charges at a max now 2.1% as fees, so rest of it is transaction costs and stuff like that. As a fund manager, we are always measured after our costs and after our fees. So to that extent, if I have to beat the index, it has to be after costs. So you can't keep the costs so high that, just the costs take you below the index, which means you have to try and beat the index by more than 2% before costs. So you want to beat the index by, let's say, 5%. A reasonable jump would be that is the bare minimum you need to try and focus your efforts on, so that, transaction costs and fees take away 2%, 2.5%, you're still left with 2.5% alpha. So the fees matter a lot, perhaps, if the fund size is very large and there's not much alpha to be created. But in smaller funds, there's more flexibility. They have the ability to go to smaller cap stocks, which a large fund cannot. They are able to change their strategies relatively quickly because liquidity is not so much a concern. So their fees can be higher and tend to be higher in the initial parts. But every small fund, as it grows bigger and bigger, the fees come down. So you have to look at it from a long-term perspective. If the fund is able to gather more and more AUM, your costs actually come down over a period of time. So not so concerned about fees.
Economies of scale in the fund management business as well. Deepak, always a pleasure speaking with you. Thank you so much for joining us today with your thoughts in this particular investment strategy. We'll speak to you very soon again. But with that, we'll take your leave on this edition of MF Corner today. Stay tuned for Closing Bell to take you through the last hour of trade.
Market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Japan's Nikkei has recorded a positive start this morning, seeing gains.
I am announcing the most crushing economic operation ever taken against any country.
The SEBI order states that the price manipulation happened during the last 10 minutes of the Sensex weekly expiry on the 13th of August 2026.
The Nifty, by the way, is up 137, 140 odd points.
The first quarter for the financial year has turned out slightly better than expectations.
Yes, mid-caps have done fantastically better than the large caps.
What you do in one market affects the other.
The RBI bought 8.8 lakh crores of bonds.
But I think we have a new base price for sugar for sure.
Good day for the markets. We are seeing gains of around 0.9% on the Sensex, 0.7% on the Nifty.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, with me is Rima, and it's been a pretty okay trading session actually, because for the majority of trade, we've been sitting with a gain of more than 100 points. Hey Rima, good afternoon.
Hi, good afternoon. So finally snapping that 7-day losing streak. We had a gap up opening. We've built on it. We crossed 24,200 and now almost at the 24,250 mark. Across the board, broad-based gains. We've got a percentage point gain of close to about 0.7, 0.9%. And this is despite a rise in the crude prices. So Brent crude prices are now closer to $94 per barrel. When we started trade, we were at a slightly lower level. More green than red. The advanced decline ratio also nearly at 2 stocks advancing for 1 in the red. So let's run you through what we have for you on the show today. We've got 1 hour to go, and that's going to be the weekly Sensex expiry as well. Stocks upbeat. The Nifty consistently above 24,200. Mid-cap, small caps in tandem with the large caps. Real estate, IT lead the charge. Shares of Rishabh instruments crack. Sources, in fact, tell your channel that the promoter entity may be exploring a strategic exit by selling a controlling block of their 70% stake. Crompton rises to the day high on an ambitious growth guidance for fiscal year 2029 and 2031. A deep dive into where the company sees growth headed. Also coming up on Closing Bell, the centre steps in to arrest the sharp increase in sugar prices, record levels and curb hoarding. India imposes stock holding limits on bulk consumers, tightens curbs, and the stocks perk up in anticipation of improved mill margins. All that and more in the next 1 hour. But for now, let's get you a few trading ideas. How should you position yourself in the last hour of trade? Bonanza Portfolios, Mitesh Thakkar now joins in. Mitesh, almost at 24,250. Where does it go? What's the trade that you've taken so far, and what would you advise?
Good afternoon. So in the morning, I was saying that capturing 24 to 300 would be important. We are just there. While we haven't done that, I think the strength is there, which shows that we can possibly, get past 24 350. Once that happens, 300. Once that happens, I think we might be.
All right. Let's come back to you, Mitesh. Let's come back to you. We'll get you on a little bit of a better line. Devin, good afternoon. Good to see you win. Let's ask you about a couple of stocks then. Dixon Technologies, the stock is making a strong run in today's trading session. The last period it's been strong as well. Your view on this name?
Well, hi, Nigel. Good afternoon. Well, I think the more or less the thrust is coming largely because of, I think, higher amount of execution visibility that we are seeing in many of the EMS companies, including Dixon. And that's where probably I think the actions are there. Not completely sure as to, I think, what is the new buying at this point of time. But the fact remains that I think they are adequately priced, fairly priced in my viewpoint, though the tailwind remains very strong with the execution visibility that we are currently experiencing.
Okay, that's Dixon Tech. What about Aditya Infotech? Devin, is this a stock that you look at? They are the owners of CCTV cameras, a security brand, and they sell by the name of CP+. So today, Motilal Oswal came out with a note, and they're bullish. So for starters, they believe that this industry is going to grow very well. So the India surveillance market is expected to double by FY30 from FY25 levels. And in that, they believe Aditya Infotech will be an outperformer. And they're penciling in a 44% revenue growth CAGR over the next 2-3 years. Devin, is this a stock under your coverage?
No, the stock is not under coverage. We have looked at this particular company from the other aspects, and particularly we believe that, yes, I think the TAM is remaining very, very strong for the surveillance business. And that's where probably I think the larger amount of order books are flowing into some of these companies. Do not know exactly at this point of time as to what would be the complete execution as far as I think the company is concerned in next 3 to 5 years. But believe that I think the order book remains quite healthy for them from the newer projects that they are basically buying these orders from.
They have a market share of 44%, and I think Motilal Oswal sees it increasing further to 58%. This is in CCTV cameras and other surveillance products, so pretty strong, dominant position, 44% market share. Devin, hold on. We've got some new. Okay, we've got, I think, Yash now joining in. Where sources say NSE may seek a SEBI note to permit trading of its stock on its platform, not just BSE, but BSE and NSE. Yash joins in a bit more. Yash?
Well, so far the chatter and the conversations have been about the interest of NSE listing, but it was widely assumed that once it lists, which it can only list on the corresponding stock exchange, which is BSE in this case, then the trading would also naturally happen only on that exchange. But what we've been given to understand from our sources is that there is a technical scope where NSE, despite it lists only on the Bombay Stock Exchange, it can still make itself available for trading on the National Stock Exchange. Now, the share pool remains the same, which gets listed on the Bombay Stock Exchange, but the script is available for trading on the National Stock Exchange as well. This is under the category which is called permitted to trade category, under which a company can apply for it to be listed on an exchange where it's not listed also, and NSE is likely to use the same category for making itself getting traded on the National Stock Exchange, which is on itself as well. There's a very interesting precedent for it as well. MCX initially for a few years was only listed on BSE, but since the day one of listing, it was always traded on NSE as well, which was under the same category which was permitted to trade. NSE looks to use the same scope for itself.
Got it. All right. Thanks a lot for that, Yash. Yash, stay on. Actually, I think you had another story as well, exclusive information coming in on Rishabh Instruments. Fill us in with that.
Well, what we've been given to understand here is that, promoters are looking to sell their stake in Rishabh Instruments, and they're looking to bring an investor with a majority control in the company. The promoters currently hold about 70% stake. What we've been told is that part of this 70% stake is likely to be sold. The intention is likely to sell the stake, which is likely to trigger an open offer in the company. Together, the first step, that is promoter selling stake, and the open offer is expected to drive the new investor to a majority ownership level, which is about 51%. If there is any shortfall which comes to that mark, which is of 51%, then the promoter might consider selling more stake to help the new investor, which is coming in, to reach that 51% mark. What we've been given to understand also from sources is the promoters are seeking valuation of nearly 3,000 crore as far as this particular transaction itself is concerned. And we've written to Rishabh Instruments on this particular story. A response from the company still remains awaited.
Got it. All right. Thanks a lot for that, Yash. Deven, your view on both these two names, BSE as well as Rishabh Instruments?
Well, I think Rishabh is definitely driving hard on the renewable energy segment. The new orders which are coming in for the instrumentations, I think is certainly giving a good amount of visibility. In fact, I think most of these businesses which are in the area of the engineering, particularly the power sector and renewable power sector in particular, I think they are basically driven by the larger amount of order inflows that they are experiencing, including the industrial automations, where probably this company plays a major role. Again, I think gives a good amount of visibility from the business point of view. Though I think the valuation on trailing 12-month basis, I think still remain, I think, between 25 and 30 times with price earning ratio. I believe that any inorganic transaction which Yash referred a while back, I think could possibly give little bit more visibility as far as I think the new investor taking the position in this company. So from that perspective, I think the tailwind should remain stronger, though we don't have coverage, so we will not be able to speak about the valuation and the price beyond a point.
Okay, that's Rishabh Instruments. What else, Devin? Earlier, I think you were only telling us about Jaro Education yesterday. Any other stock? Interesting one we've not discussed before that is in your coverage that you'd like to share and talk about?
Yes, Rima. I think some companies like, say, Bajaj Housing Finance, I think, which remains, I think, more acceptable kind of a deep value investment approach when one has in a portfolio. This remains, I think, more acceptable kind of a stock in the portfolio. Company is growing probably 3 times faster compared to the other players in the industry, the larger players in the industry. With not so small AUM book, I think they are already 1,50,000 crore kind of an AUM in housing finance. And it typically created a niche within the housing finance, wherein they operate 4 different verticals within the housing finance. One, of course, being the EMI vertical, where the mortgage business happens. But more than that, lab business, is one, development finance business is another, and LRD, that is a lease rate discounting business, is third. So these businesses include, I think, a higher potential to generate the better amount of NIM for this particular company. And at the rate of growth rate of around between 22 to 24% or 25%, I think this company promises to double the size of the book in 3.5 to 4 years' time. So from that perspective, we like this company, though slightly premium valued. But generally, Bajaj Group companies would be premium valued. And that's where probably I think one can find deep value if one is invested over about 3 years or so.
Okay, all right. Thanks for that, Deven. Let's go across to Crompton to find out what's happening on Crompton. Their investor day, they have put out some guidance for the next few years. I love this. Upasana joins us to fill us in with all the key takeaways. Upasana?
Well, certainly, the company held its investor day today in which it has laid out the outlook for FY29 and FY31. Now, company believes that the revenue growth will be around 13 to 14% CAGR in FY29, and it will double its current level by FY31. Now, if we talk about the Indian consumer durable sector, it is expected to grow at 11% CAGR by FY29. So certainly, the company is expecting a higher growth versus the industry growth. For FY29 and FY31, the company believes that the profit growth will certainly be higher than the revenue growth. And in terms of EBITDA margins for FY29, it is guiding around 11 to 12% and 12% plus by FY31. Smart and connected mix to form nearly 15% of the revenue by FY29 and 20% by FY31 is what the company is emphasized on. Now, coming to the new businesses, the company is certainly betting big in the new segments that it has entered into, and it is guided that it will nearly form 14 to 15% of the revenue by FY29, and this mix can go as higher as 20% by FY31. Now, coming to the fan market share, the company aims to improve its market share by 100 basis points over FY26 levels by FY31, and the premium contribution it expects to somewhere target around 30% of the share by FY29. So overall, if we see, the company is certainly betting big on the newer segments and even its market share in terms of the fan.
Got it. All right. Thanks a lot for that, Upasana. Deven, what's your take on Crompton? Actually, post the management change, people thought it was going to be a big outperformer. But then it's had a bit of a time-wise correction. In fact, from the recent high of 300, it's come to 250. But now they're putting out this ambitious guidance. Part of the street still believes there will be a strategic investor who will come in. That said, going by their guidance, what is your view at $250?
Well, I think the important part is that each of the verticals, the fan, the electrical verticals, the pump vertical, in each of them, I think they have got a larger amount of order inflows. And that gives you the promising aspect of, I think, delivering between 13 to 14% kind of a growth eventually over next 3 to 4 years, as they are claiming. At the same time, I think the balance sheet is with cash as against, I think, the debt that they used to have. So that also, I think, brings up the quite a good amount of comfort as far as the profitability aspect is concerned. Overall, with the higher amount of discretionary spending increasing in the hands of consumers, the consumer durables FMEG companies typically, I think, would look relatively better from that perspective. Since we don't have coverage, won't be able to speak on the valuation at this point of time, but we find that I think the tailwinds remain strong from the business perspective.
Okay. Deven, want to get your views on sugar because sugar prices are on the rise. In fact, sugar prices have gone up 10% in the last 1 month, and now we're entering the festive demand. There will be Ganpati soon in September. It leads to Diwali, Navratri. Now, Ria joins in with the latest, and there is a government order as well, Ria, which is basically saying that because sugar prices are going up, they want to prevent hoarding by bulk consumers. So basically your sweet shops, confectionaries, etc. So take us through the news and why sugar is so excited today.
Well, yes, the government has indeed tightened sugar stock limits, and they have said that no dealer using more than 10 metric tons of sugar per month will be allowed to hold inventories for more than 15 days. Now, this is with effect from the 1st of September this year until November 30th of 2026. And remember that this restriction is only on dealers and traders and not on sugar mills. And the reason for this is because they want to curb hoarding and bolster sugar supplies and also cool the record sugar prices that we've seen of late. Now, in fact, in the earlier order. The government last month had limited dealers to holding sugar stocks for up to 30 days, and this order was effective between the 1st of August until the end of November of this year. But still, we have seen sugar prices rising sharply. We have seen a rise of nearly 10% just in the last 1 month, and in fact, the all-India average ex-mill sugar price has risen up to nearly 5,000 rupees 5,400 to 5,500 per quintal. This is on the 18th of August, and this is up from nearly 3,900 rupees that we had seen last year, and this is according to a study done by an industry body. Now, in terms of the 2026 closing sugar balance, that is estimated at nearly 35 lakh tons, and in turn, the opening stocks will be below the requirement as the new sugar season begins on the 1st of October. And going forward, the low stocks that we're seeing right now, as well as the festive demand that is coming up, that is expected to see a further risk of further prices in the sugar prices. Now, in terms of the impact on the sugar mills, as per Elara Capital, the higher sugar prices will be trickling down to sugar mills as a benefit for them in the form of significantly higher EBITDA margins, and they are expecting Q2, in fact, the rest of the year as well, to be quite positive for sugar mills. And today we are seeing stocks like Balrampur Chini, EID Parry, Triveni Engineering, Sri Renuka Sugar, all of these sugar stocks performing very well in today's trading session.
Thank you very much for that. Look at the rally on some of these names. Balrampur Chini, 18% up. I think this is the best single-day move gain that we've seen in the stock in more than 4 years. Dwarikesh Sugar, 15%. Bajaj Hindustan, it's up nearly 10%. Sri Renuka has moved up 7.5%. Big moves. EID Parry has got relatively, the gain is just about 1.5%. Deven, anything in the sugar space, whether it's a sugar story or ethanol story, what do you like?
Well, I guess I think the sugar prices are up, agreed. But the fact remains that I think the sugar stock in the godowns of most of the companies, I think remain at a historical low level. As against the industry mandate for 6 million tons of sugar stock, I think today the stock is exactly half, 3 to 3.3 million tons. And that would possibly deny the kind of otherwise an upside move that somebody would have got, I think, because of the higher sugar inventory that they carried. At the same time, my understanding is that the government is basically ensuring that during the festive season, the sugar prices do not go up. And that's where probably I think they're putting in some of the corrective practices, including, I think, the holding of inventory by some of the bulk users. So these are some of the points, I think, on which probably the prices may not go up crazily. But yes, agreed that I think today, with the upside in the stock price, of course, but at the same time, upside in the sugar prices, is basically, I think, largely due to the shortage that we are experiencing in the global industry at this point of time. Of course, I think part of it would be also contributed to the ethanol story. But I believe that overall companies' performance should be remaining good, though we have not covered, I think, many of these companies. So won't be specific in giving answer to what kind of price impact it would have on the profits of the company.
Okay, all right. Devin, I wanted your view on HEG because there's a special situation that's playing out there. They want to separate both the two businesses. One is the advanced materials business, which will basically be housing the renewed power business, as well as various other businesses like anode and, anode production, and graphene and other businesses. And that one, in fact, is the underdeveloped, or, till now, the street is not too sure what will come out of that. For the timing, we know that they have an hydro asset over there, which is around 300 crores. But the management believes that that business, the entire business put it together, can move towards around 1,000 crores of EBITDA. And they're quite bullish as well on the core business, which is a graphite electrodes business. I spoke to the management earlier today. I asked them what they believe that both these two businesses can look like in the time to come. Let's hear out what Mr. Riju Jhunjhunwala had to tell us.
We're expecting a good order book, starting the plant itself. And I think whatever we've been talking about so far, we are already, talking internally on how to, increase everything in terms of scale over there. And when I say advanced material, we're also looking at many other materials such as graphene, etc. Things that we have been working on behind the scenes very, very well in the last 2 years. And now we are seeing a time when we can actually commercialize those. What you're saying is absolutely true. I mean, we stick by that. And I think we should be able to exceed what you're saying in the long term. The graphite electrode space is more cyclical in nature. And what we've seen in the last 2 years is really like the bottoming out of a very low cycle. And going forward, most definitely, as we saw, in the first quarter itself, I think prices are hardening. The September onwards, we will start taking some price increases. And going forward, the way the electric arc furnaces are being put in the US and Europe, and no extra graphite capacity has been created in the world in the last 20 years, I think we should see a very comfortable situation of demand supply for us.
Okay, all right. Devin, what do you think? The stock at around 708 rupees. Some rough estimates suggest that close to around a third or little less of the current share price could be attributed to the newer businesses, which is the advanced materials business. Anode production, renewable energy, they're talking about BESS, as well as graphene production. Your view on that, if that comes through and if they can scale up substantially, then you're looking at an EBITDA in the vicinity of around 800 to around 1,000 crores approximately in the new business. And the core business, the hope is from less than 500 crores last year, it moves up towards 900 to around 1,000 crores approximately. So ballpark, you're working with a combined EBITDA of around 1,700 to around 1,900 crores, very, very roughly. You'll be interested, or you think that the price is actually, factoring in all the positives?
Well, I guess I think having heard the management, including in the road shows, I think they basically remain very, very confident about, I think, the synergy of first and foremost demerging both these businesses. And in turn, I think focus largely in the other material, advanced material businesses, which remains, I think, relatively more promising kind of a play. But at the same time, I think it's more of a capex play at the same time. And that's where probably I think the execution related risk comes along. In my viewpoint, I think, yes, the potential remains extremely high over there. But we would like to see how exactly, I think, the numbers follow year after. It's a story which is, I think, requiring to have in your portfolio for next 3 years or so, not at immediate level as I see it. And that's where probably one will be little mindful about participating in the rally. Maybe some corrections during the course of the journey, I think one could be more happy situation to have the company. It remains highly potential though in each of the verticals that they are talking about.
Okay, big potential, execution to be watched. That's, I think, the takeaway with regard to what Devin has to say. Thanks a lot, Devin, for joining in, giving us, your comment on all of those stocks that we just discussed. Well, before we slip into a short break, pull up a few stocks. I think Bajaj Hindustan, the stock was up, I think, 7-8% when we started the show. Now it's up close to around 15%. So there's been a bit of a spike actually in the last few minutes. I think we should get that up for you on the screen. Billion Brains as well should come off for you, which is Grow. That one as well was trading, I think, with a gain of around 1%. Now it's up close to around 3%, pulling back after that large trade that got cleared out of the system. Slip into a short break, come back. Alpha Manager of the Day, Jigar Mistry of Point Capital will be joining in. Stay tuned. Welcome back. The Nifty is holding strong, and after a while, we've had a higher high, which is breaking that losing streak or the lower highs that we saw for 12 straight sessions. The India VIX, well, that's cooled off. So, that's giving you a sense that the bulls believe there's no big scare around the corner, irrespective of what Mr. Trump is saying, irrespective of what's going on in terms of the Middle East action. A few strikes that should come up for you on the screen. Put writing has come back, which explains why the PCR has moved from around 0.8 to around 1.11. The 24,200 put, the premium's down by around a third. Yesterday it ended at $160, today it's down to $50, as is the case with the 24,250 put. Out there, the premium was 196 rupees. That's down to around 69 rupees approximately. So that is well down by close to around a third. Going to the call side, well, earlier there was some signs of buying actually, even yesterday on the 24,250 call. The premium out there has now surged from around $60 to around 130 rupees, which tells you that those that bought this call yesterday, when markets are looking a little bit jittery, they have close to have doubled their money. Good news for them. But we're still in that range. Till you decisively take out this 24,350 to around 24,400, which is incidentally where the 20 DMA is at, then you'll still have to believe that the markets are still in this band. On the downside, the reference point is the 100 DMA, and I've been mentioning this 23,950 mark. That's the important level to track. Moving to individual stocks, Lodha, that's a stock that I'm looking at. There's a bit of a short covering bounce that's taking place on that particular name. The stock is moving up, open interest lower. You have Swiggy as well, that's coming for a bit of a squeeze. Remember, that stock has seen a bit of a correction. It went to around 300 rupees, then it corrected by more than 10%. And now it appears the shorts are scampering for cover on that one. And in terms of fresh buying, HDFC, AMC, fresh buying being seen on that counter. Big surge is what we're seeing in open interest. I think in percentage terms, the open interest is up close to around 15%, while the stock as well has been holding on to its own. So those are all the stocks that we're looking at. That said, let's hop across to Hormuz. He puts the spotlight on all the big movers in the market. Hormuz.
There are lots of them in today's session as the market has turned green. The broader markets too doing well for themselves. Look at Balrampur Chini, and it's not just Balrampur Chini. Actually, the entire sugar space has had a good last couple of days. But Balrampur Chini stands out because it's 18.5% higher now. The stock has even moved higher in the last 10 minutes. So the last check, the stock was up 14%. The top gainer on the Nifty 500 by a distance. The biggest single-day gain in 4 years. I'm sure that is going to change now, considering the up move you've seen in the last 10 minutes. Volumes today have been the highest since December of 2023. That might also change by the time we close today's trading session. 2.5 crore shares have already been traded on Balrampur Chini. The 20-day average is only 6 lakh shares. It'll be interesting to see what kind of delivery data comes up, because as of now, 20% of those shares are marked for delivery so far. And Balrampur Chini had broken above all of its key moving averages in the month of April, and since then it has been on this constant up move that the stock has seen. And in fact, now the month of August has turned out to be the best month that it has had since March of 2021. And in fact, on a year-to-date basis as well, the stock is up 67% so far, and that too is turning out to be the best calendar year that the stock has had since 2021. Solara Active is the other one on the small cap side of things, 15.5% higher on this one today, the biggest single day gain since June of last year, the third straight day of gains for the stock today. Volumes are the highest since April of 2024. So strong volumes in today's session. The stock has broken above all of its key moving averages as well, and 53 lakh shares have been traded on Solara so far. The 20-day average is only 2 lakh shares. Again, significantly higher volumes here too. 20% of those shares so far have been marked for delivery, and the month of August is also turning out to be the best month for the stock since June of last year. And lastly, MCX. That stock has been an outperformer of late. The stock has gained in 6 out of the last 9 trading sessions. Today too is up around 5%. Broke above its 100-day moving average last week, and since then it has sustained above it. 37 lakh shares have been traded today. The 20-day average is around about 22 lakh shares. Close to 40% of those are marked for delivery as well. On the charts, the RSI is nearing overbought territory, currently at 67. So the RSI above 70 means that the stock is overbought. The stock in the month of August is positive. First monthly gain potentially in the last 4 months, and on a year-to-date basis as well, up around 40% so far.
Thank you very much for that. Jigar Mistry, co-founder Buoyant Capital, is now here with us on the show. Jigar, afternoon. Good to see you. So what's the big idea? How do you feel about the markets?
Hi, good afternoon. Thank you as always for calling me on your show. Big idea, I think, is 2, 3, 4. I think The first part is that we are seeing a reasonably decent, quarterly performance in terms of results. If you strip out the OMC losses, in fact, we are sitting at a pretty good result across the board, large caps, better so in mid caps and in small caps as well. Our assessment of this, Rima, is essentially that you are, essentially creating an air pocket. So, if I take you back in time, uh, because such a large economic impulse moved away from capex to consumption, our assessment is 1.7% of GDP got transferred in the hands of people. And when you try and reorient the economy, it takes time for the economy to adjust and the listed space to show that. I think we are finally coming around to a place where the listed space is seeing the benefits of that. So we see, adjusted for oil, you are likely to see this continue. Second large thing we are tracking is that FMCG ex cigarettes is essentially at almost a 3-year high in terms of profitability growth, almost tracking 17 to 20%. And lastly, I would say banking system growth is up 19%, and bond issuances is down 18%. So you're seeing a reasonably strong banking sector performance in the quarterly earnings season so far.
All right. Hi, Jigar. Good to see you on the show, Jigar. A couple of large issuances are coming about. Which one are you most excited about?
Hi, Nigel. Pleasure as always. I think most of them are fairly priced. I don't think.
Most of them are fairly priced, is what you're saying, right?
Sorry, I just missed that. Can you?
Yeah. No, we lost you. You said most of them are fairly priced, and then you were making a point with regard to the upcoming issues. That is NSE. You have a Geo as well that's due.
Right. So, see, the space is very exciting, Nigel, because if you look at sort of 100 rupees saved from the household savings, and you break it down to wherever the amount can be invested. The market segment, which is about 10% of household financial savings, attracts the most attention. But when you strip it down into what captures the largest value as an institution, I think the insurance plays are really up there, followed by the banking system, and followed by the markets. Now, the valuation of the markets is highest, but we would prefer to be shareholders in the insurance space, both life and non-life, the banking space. And if sort of, push comes to shove within the market space, I think, annuity businesses are better placed than the transacting businesses. So that way, we are not really all that keen at the moment.
Okay, all right. But insurance is the theme I think that you have been bullish on, right?
Yes.
If I'm not mistaken, I think Max Financial was something that you had?
Yes, held, I think, since 2018, if I'm not mistaken.
So that's a multi-bagger for you.
Right. So, see, the life insurance, one is the under-penetration theme playing out, but also from the standpoint of the institutions retaining the largest part of the wallet, I think they're really up there. Plus, as they trade at about 2.5 of the price to embedded value, which is comparable to most banking systems, although obviously the businesses are not comparable. So with a multi-year story playing out, you essentially have a reasonably good space in life insurance as well.
Okay, and you've got cash of around 9 to 10%, right?
Yes, that's what the fact sheet says, Nigel, for us, but we don't run a model portfolio. And if the flow is reasonably high, then the newer accounts take time to deploy. So as a philosophy, we are saying about 5 to 6% on median account sales cash. The higher number is largely because the money flowing in is awaiting deployment.
Okay, what about HEG? I think you've had a look at that one, right? It's a special situation playing out. Interested or not?
Sorry, I don't really know that.
HEG, graphite electrodes?
No, Nigel, we don't have that. Sorry.
Okay, let's talk about the old darling then, steel. Steel prices have come off. I'm not sure the kind of allocation you'll have, but at one point of time, you used to be totally on the money with regard to that, at your sell side days more than 10 years ago. How are you reading the setup right now? Some believe that longs are more favorably priced in comparison to the flats because they saw great amount of pain. prices came down drastically. The spread between longs as well as flats was gone to extreme levels. So would you look to play the ferrous space, or do you think the non-ferrous, the aluminium plays actually, they're not doing much because aluminium prices that were dancing at around $3,700, $3,800 came down to around $3,000, $3,100. Do you like that space?
Right, Nigel. So I think, see, any commodity is to an extent a dollar debasement trade, right? Now, you would want to play this via, if that is the entire play you are aiming towards, then you want to play it via something that is listed on the exchanges, because that then attracts a reasonably large derivatives positioning as well. So non-ferrous over ferrous is generally the belief system. Ferrous within India tends to be locally bound, especially the longs, as we have been discussing several times in the past. And I think, therefore, you need to track the local demand supply a lot more rather than debasement play. Our play around metals was the fact that eventually, over longer periods of time, you would see dollar weaken against the larger currency systems. And therefore, commodities did make sense. So our play is in the non-ferrous space and not really the steel space.
One quick word on the latest, the larger investment that was reported in the block trades, which was Genius Power. What a beauty of a move for y'all. I think y'all got a large chunk at $290. Today it's at 335 rupees the last time I checked. I think what the street is a little skittish on is the working capital days, and the cash conversion as well has been a little bit poor. But otherwise, the order book is solid, execution seems to be good, and Genius Power has a good amount of the market share as well. Tell us, what is the key to track from here on with regard to this company, and why are you all bullish?
Right, Nigel. But see, you are right on the block trade getting reported. The reason why we were excited is the fact that about 2 to 3 crores of new smart meter orders are still to be received. Part A. Part B is the fact that the nature of the revenue line for this company will change as well, right? So you are likely to go a lot more into OEMs, which has the better margin profile, and therefore the overall margins will likely improve. The sort of dark horse here would be if the orders from a few states start flowing in, Telangana especially. So Telangana, Karnataka, if those orders start flowing in, then the replenishment of the order book should be fairly good as well. And the working capital, I think you are right, that was pending, the acquired business. But once that starts getting resolved, you are essentially looking at, a business which is more than fairly priced, which is growing and reasonably interesting from that standpoint. However, it's not sort of as part of, as far as allocations go, it's a fairly small allocation for us, but it is an interesting space, as you also mentioned.
Okay, thank you very much for that, Jigar. We will get into a break. On the other side, we'll get you a check on what dealing rooms are saying in our segment D3 Chatter and a few BTST calls. Stay tuned. Welcome back. Holding on to gains. So we're still above 24,200, but slipped a tad bit, just about 20-30 points in the last half an hour or so. But let's find out what the chatter is, because finally, Nimesh, after 7 days of losses, we've got a green-looking screen. So there is a rebound taking place. The question is, will it last? We still have about 20 minutes to go and the weekly Sensex expiry to play out. What are you picking up?
Yes, Nima, a decent pullback, I would say, and expected as well. Even yesterday we highlighted that the PCI had fallen to almost 0.77, 0.78, and generally from those levels you see a bit of a pullback rally. And what has helped to do the sentiment is the fact that overnight the US 10-year fell sharply, and that's led to a bit of a rally across Asia and to India markets as well. From a flow perspective, again a mixed day of trade, but the data will look bigger because of the block deals that are happening every day. So the supply of paper continues. Today there was a large block in 1,400 crores in K-Fintech. My sense is 70-80% of the book was from the domestic mutual fund. So the number will get reflected in the DI data for sure in today's market. From a sector point of view, sugar stands out clearly. A big rally in all the sugar names as the prices have firmed up, and there is a shortage as well. So that space has done really well in the last couple of weeks from in the past. Technically, 24,450 on the upside will be a big level to watch out. Above that, you might see a further short covering rally. And on the downside, watch out for 23,800 as a strong support. So it's been a range for a while. But given the fact that any close above 24,450 might lead to a bit of a short covering rally ahead of the expiry next week.
Right, Nimesh, what about individual stocks? What are you picking up?
The first stock is CMPDI. It's been seen a bit of a profit booking or a correction from the recent peaks. My sense is that the last selling from a domestic mutual fund is largely over, and some HNIs have started buying as well into CMPDI at current levels. So that's the first name. Second stock is Sudarshan Chemical. It's been buzzing off late. There are a couple of large blocks as well. Some larger HNIs bought into those blocks, and there is generally momentum into Sudarshan Chemical from larger HNIs even in today's market, and hence a bit of up move in today's trade as well. And the last is Whirlpool India. After a long time, some bit of buying seems to be emerging in Whirlpool at current levels. My sense is some domestic mutual funds have started bidding for Whirlpool at current levels.
Whirlpool, thank you very much for that. Stock is up nearly 3%. Let's get Mitesh back on the show now to get us a few more BTST or STPT calls. Mitesh, I suspect today would be more BTST. There is some momentum on the way up.
Yeah, finally. Yes, I think both the calls are on buying side. I have Kotak Bank to be bought with a stop at 391. Look for targets of around 408 for 10 year, and Persistent System is more of a trading call. Buy here with the stop below 55.75. Look for target of 58.80.
Got it. All right. Thanks a lot for that, Mitesh. Well, let's hop across to Ashmit. He's picking up, some relief that's coming actually for JSW Energy. Ashmit?
Well, at the heart of this is an MERC, Maharashtra Electricity Regulatory Commission order of December of 2025, which essentially had directed for one of the state discoms to pay 600 crore rupees to JSW Energy with respect to their Ratnagiri facility. This was a tariff dispute that took place. Now, what's important is that discom, importantly, had challenged this before the APTEL. And the challenge, halfway through that challenge, there was a change of heart that discom had. MSEDCL had said that they want to go back to the MERC and they want to seek a review of this order that has been passed. What is equally interesting, and in words of the APTEL, unusual and unconventional, is that the State Regulatory Commission did a U-turn, did a flip-flop in the APTEL, saying that they themselves believe that their order is wrong. They believe that this is legally unsustainable, that they want to apply their mind and revisit this entire issue once again. But importantly, the APTEL not having any of it, the APTEL saying that, look, once this petition has been filed, it needs to be decided that they cannot allow that state discom to go back to the Regulatory Commission and agitate the issue once again. And in doing so, allowing the withdrawal. And effectively, what the APTEL has done is that it has firmed up on the MERC order. That order continues to be in effect. That 600 crore rupee payment continues to fall on the shoulders of that discom, continues to be JSW continues to be eligible for it. But of course, this is an order that has been passed by the APTEL. This will be subject to any further challenge that any of the parties may knock on the doors of the Apex Court and subsequently subject this case to a challenge. So for now, relief coming in for JSW Energy, but we'll have to see whether the parties knock on the doors of the Supreme Court.
Got it. All right. Thanks a lot for that, Ashmit. Sudeep Bandyopadhyay, a market expert, joins us on the show. 600 crores in terms of a relief. I think that's the number that Ashmit has mentioned. What's your view, Sudeep, on this name?
Well, I think this is definitely positive for JSW, but Nigel, this was kind of known to the market, so this is not new because this change of stand by the Electricity Commission was well publicized. So this was on expected lines.
Okay. It's 3:15, so CAS has begun. Regular trading for the cash non-F&O stocks has come to an end. So we'll keep monitoring the developments here. Sudeep, afternoon. Thanks for joining in. This week, we've seen BSE lose about 4.5% in terms of its market capitalization. And there is some concern that maybe the company is losing market share since CAS has started. Is this a buying opportunity? Will it settle? And now even NSE has got that green light for the IPO. So it's coming soon. So investors are going to have another option. So putting all that together, what does it mean for BSE?
I think there is anything to worry as far as BSE is concerned. NSE listing will give a boost to BSE. As we all know, NSE will be primarily traded at BSE. That should bring a lot of excitement in the BSE trading counter, and there will be a lot of excitement around it. Of course, NSE, I understand, is also trying to get themselves in the permitted list of NSE itself to facilitate trading there. Let's see what happens. But I believe that around NSE listing time, there will be a lot of excitement on the BSE counter. So there is absolutely no need to exit or be kind of scared as far as BSE's price correction is concerned on account of bit of market share loss post-CAS.
Okay, post-CAS. All right. So you are still bullish on BSE. What about NSE?
Well, I think NSE, we will see what price it comes, Nigel, and then we'll take a call. Of course, NSE will be a great stock to trade, but let us know the issue price, and then we will take a call on the valuation and things like that. But amongst the exchanges, I think I mentioned earlier as well, MCX has been our favorite for a very long time, and we continue to maintain that view. The opportunity for growth by introduction of newer contracts and newer options and futures is significant in MCX, and I'm sure this is going to happen over the next few years.
All right. Let me ask you about Premier Energies. I recall the management, Mr. Saluja, the promoter entity, as well as his team had come here during the listing time. And it was in this vicinity only in terms of a price range. Then the stock popped up and it saw a very, very sharp correction after that. But it's pulled back from the lows. Now, we spoke to the management earlier today. They are saying that as of the last year, the EBITDA number was 2,300 crores. They're guiding that that number goes to around 4,600 crores by 2028, which is what most analysts are factoring in. What is your view on the counter today? It's buzzing. It's now up 3.5%.
I think the management commentary, which was on your channel, was very, very positive. They seemed very confident about moving things significantly up. And I think market is cheering that only. I think there is definitely possibility considering the opportunities they are sitting on. And I will be positive, mildly positive on the counter, even at current levels.
Mildly positive on Premier Energies. Okay, we will get into a break. We'll come back with more on the market. Stay tuned.
Welcome back. Well, Sudeep, I wanted your view on a couple of these other names. Muthoot Finance. Street is questioning the competitive intensity, competitive advantage actually that it enjoys because its yields has been coming down. But the other part of the street says, well, that was bound to happen, right? The space was getting crowded. They still have the best in terms of return ratios, in terms of growth as well, and in terms of reach. The problem is valuations. You have some peers now that are available at far lower valuations, be it a Manappuram, be it an IFL Finance that has some sort of exposure as well to the gold finance space. Your pick from the gold financiers, given the fact that gold's actually bounced nicely 10% from the recent lows.
Well, Muthoot Finance definitely is a good buy from a long-term investor's perspective. There are two things which is happening, Nigel. One is, as you rightly said, the competitive intensity has gone up significantly. Over the last 3 years, almost, the overall gold loan book has gone up 6-7 times. It used to be 3-4 lakh crore, and that has gone to 24-25 lakh crore. That's the kind of upward movement in the business we have seen. And all these players, Manappuram was always there, but IFL Finance and multiple other players, including Larsen and Toubro, and pretty much everybody else has created gold loan book. Banks are also very aggressive, particularly the banks based out of Kerala. They have been very aggressively expanding their gold loan book. The competition is bringing down the margin. So that's factor number one. And I think the second issue, which probably doesn't get too much highlighted, is the challenge of retaining manpower. There is a need for having a certain amount of skill sets for the gold loan companies' manpower. And it is tremendously kind of challenging to retain these people. And I understand the attrition rate in the industry is very, very high. And Muthoot, being the industry leader, is facing that challenge as well. So the costs are going up. So under these circumstances, overall, we are little worried about the margin performance of Muthoot Finance going forward. That's the reason why we are little careful as far as Muthoot is concerned at the valuation. It's a good company, it will continue to do well, but the valuation looks a bit full at this stage considering the challenges.
Sudeep, you've liked delivery in the past. Is that not correct? Now you've got another player is sort of in this logistics space, Shiprocket. And what a move it's had since listing. Is that a serious contender for a play in your portfolio, Shiprocket?
Well, I think in some time, not right now. I think delivery, I liked the Q1 numbers. Both the two business segments, which is the express parcel as well as PTL, part truckload, they have shown significant growth. The e-com integration, which they had acquired some time back, has successfully happened. And the margin was not as per what we had expected. But I think now that the business is falling in place and is growing as per the commentary of the management, the margins also will come back. And we will see significant growth going forward from here. We have a target of 600 on delivery, and we've been recommending a buy for 1 year hold. As far as Shiprocket is concerned, I think it's also a good company. And logistics is such a space that the scope for a good company to grow will be significant going forward with the growth of trade commerce in India, particularly the online delivery business. So under the circumstances, Shiprocket also has a good future. But at this stage, the excitement is too much around the counter. So I'll wait and watch before I take a call whether to buy or not.
All right, Sudeep, what about Lenskart? Everyone was rubbing their eyes when the IPO came out. The argument was valuations. From the listing day, if I'm not mistaken, I think the stock is up 50%. It goes to show that the street liked the business model. They was willing to give it time till the business model evolved. They made good, expansion even in the international market, and the profitability actually has improved out there. And now they are, serving a wide range, from the mass to premium as well. What do you make of the stock at these levels? I think it's $650 plus.
Nigel, I must admit that I was one of the guys who was a little skeptical about the valuation of Lenskart at that stage. And I still believe that, we call it technology company. It's not a technology company. It's a pure play brick and mortar company which uses technology. So, that debate, that dispute, I still will have with the market in general. We are tracking Lenskart by same-store sales growth and parameters like that, which is very typical of a brick and mortar chain. So that's point number one. Point number two, undoubtedly, quarterly results which came out recently, I think for the first quarter, were fantastic and much beyond our expectations, particularly on the international side. The kind of acumen they have shown in establishing the international business within a very short time span, and also making it successful to an extent, I would say, is commendable. And I think domestic business has been chugging along. The growth, same store sales growth, as well as store expansion has been rapid. So yes, they are doing very good. But whether to buy at these levels, I think I will still be a little worried with the kind of valuation it is commanding at this stage. I will watch from the sidelines, and probably I'll be proven wrong once again, but I'll still watch from the sidelines.
Well, counting down to the close, it's 24,211 right now, up about 0.5% on the Nifty. Sensex up close to about 3/4 of a percentage point. Today is the Sensex weekly expiry, and the indicative price on the Sensex is about 77,535. So that's a gain of about 50 points from where the Sensex currently is, 77,485, which was the level at 300 and at 315. But it's been a good session so far. We managed to hold on to our bounce.
Well, that's right. We managed to hold on to the bounce, and in fact, there are a few stocks actually that are still bobbing around. You pull up Karnataka Bank. The stock has doubled, I think, in the last 18 months or so. Just pull up the intraday chart out there. Big move is what we're seeing on that name. It's now moved to the high point of the day as well. So individual stocks, well, they are doing a thing of their own as we speak, Rima. The sugar names have done well. Welspun Living, in fact, just take a look at that stock. It's up 5%. I recall the stock going down to around 110 bucks. We are at CNBC TV 18 on Editors Roundtable. I put out this piece that one of the most hated sectors, was textiles, was ignored. There were tariffs in, and suddenly that cycle has turned. All these stocks have done pretty well. Whether it's KPR Mills, pull up a 3-month chart. KPR Mills, Welspun Living, Indocount, all of them seeing a big run. But we're waiting by Rima for the final close on the Sensex, so I'll just track that.
Okay, so some more stocks. Suven Life Sciences, 13% up. Leap India, one of the recent listings, very strong subscription stocks, up 4.5%. Sugar names across the board. So Bajaj Hindustan, Bahrampur Chini. Zaggle Prepaid is trying a bit of a rebound. Bazaar Style Retail, 4.5%. Misho has had a good gain, and that stock has hit a 3-month high, consolidating above the 200 rupee mark. But on the flip side, gains are being taken off. Shadowfax, Milky Mist, all these two companies listed earlier this week. They had a big move post-listing for 1 or 2 trading sessions. And today, the street is just deciding to do a little bit of profit booking. Urban Company is the other one in the new age tech companies under a tad bit of pressure. Well, the bell has gone.
Yeah, that's right. The bell has gone, waiting by actually for, yes, it's not too much of a change actually. 77,537. Yeah, so,
Lying in line with the indicative closing price.
Yes, I'm just hoping that this is actually where we're closing. I'll pull up the Sensex close actually because today is the weekly expiry on that one. Yes, 77,000. So that's only a 52-point change. It's nothing actually. And the premiums as well on the 77,000, 400 put would have crashed. That's down to zilch. And all the premiums actually, because we've ended in that vicinity itself. So no big shocker in the CAS session. The regulators keeping an eye as well. And that's worked, I think, in favor of everyone. Less tension on that front. But I tell you what, we'll wrap up on this edition of Closing Bell. That's it from Rima, myself, and the entire team that put the show of Closing Bell together. The team of Markets Forward is waiting for you on the other side.
After 7 straight sessions of losses, the market finally stages a comeback. The Nifty reclaims the 24,200 mark while the Sensex surges 628 points. Gains are broad-based with buying seen across sectors as the market closes higher on weekly expiry.
SEBI bans Copthall Mauritius and Mansi share and stock broking from the market. Impounds funds worth over 3.86 crore for manipulation during the August 13 closing auction session. The order comes within 24 hours of the SEBI chief warning strict action against any attempt to manipulate the closing auction session system.
The price of sugar jumps to a record high, rising 10% in a month as the opening stock for November hits a historical low. Government imposes a 15-day inventory limit for bulk users, but tight supply props stocks of sugar mills. Hello and welcome to Markets Forward, your go-to show where we aim to get you all of the key data points to gear you up for the next trading day. I'm Ekta Batra and with me is Sonal Putra. Well, Sonal, it turned out to be a day where we did see some amount of recovery for the market. So we ended above 24,200. Let's see whether we managed to build on gains as we close the week. But nonetheless, for the Bank Nifty, also up around 0.4% along with the mid-caps.
And participation came in from most of the sectors, right? We did have the realty pack, which was a gainer. IT also did well. FMCG, private banking index. So it was a culmination of most of these sectors doing well. We closed below the day's high, but nevertheless, nothing to complain about. We closed above that 24,200 mark. But let's tell you what we do have on the show for you today. It's a packed show. We start with the top movers and shakers of the day with Sudarshan Kumar. From sugar stocks to Sensex expiry under cash, we take a closer look at all the key developments of the day. Last but not the least, we delve into the key market events to watch out for tomorrow's trading session. So going across to our first segment of the day, Sudarshan Kumar joins us now from the big wall with the top movers and shakers of the day. Sudarshan, take it away.
So finally, a good day of trading session after 7 days of fall. Nifty reclaimed the level of 24,200, which were the top Nifty movers. Eternal, along with Swiggy, has moved higher and closed the session with a gain of almost or more than 2%. Amongst all the Nifty financials, or say banking stocks, Kotak Mahindra topped the list, closed the session with a gain of almost 2%. And amongst NBFCs, Bajaj Fin has seen buying closed 1.4% higher. And despite aluminium prices moving higher, Hindalco ended the day's top Nifty loser, down 1%. Amongst mid-cap gainers, MCX and Muthoot Finance have moved higher, tracking gold prices. We had seen a sharp spike in gold prices overnight, and that's the reason you can see 4%, 5% up move. Premier Energy had spoken to us and given the outlook for FY28, very strong outlook, and that's the reason 3% higher. And Crompton Consumer on its investor day has released outlook for FY29 and FY31 for both revenue and profit, and looking very strong outlook, and that's the reason you can see an up move of 3%. We say kuch meetha ho jaye, and that's the move that all the sugar stocks have been seeing over the last few days. And today there is a positive order from government as well. You can say Balrampur Chini at record high, up almost 18%. Similar move with huge volumes. All the names, Bajaj Hindustan, Awadh Sugar, Shakti Sugar, Triveni Engineering, all the stocks are higher, somewhere in the range of 5 to 18%. And lastly, some of the stocks have moved higher on the brokerage notes. Turtle Mint, initiation of coverage was there. Target price was almost 190 by Jefferies, and that's the reason stock has closed with a gain of 4%. MV Photovoltaic also on positive brokerage note, up almost 3%. And Motilal Oswal has initiated coverage on Aditya Infotech, stock up 5%.
Okay, all right, Sudarshan, thanks very much for that. Well, shares of sugar stocks rallied after the price of the commodity hit record highs today amid tight supply. To avoid further spike, the government tightened limits on sugar stocks held by dealers until after the festive season. Riya Bhatia joins in with more details on this. Riya, over to you.
Well, yes, the government has indeed tightened sugar stock limits, and they have said that no dealer using more than 10 metric tons of sugar per month will be able to hold inventories for more than 15 days. Now, this is with effect from the 1st of September this year until the 30th of November 2026. And remember that this restriction is only placed on dealers and traders and not on sugar mills. And the reason for this is because they want to curb hoarding and bolster sugar supplies and also cool the record sugar prices that we have seen of late. Now, in an earlier earlier order last month, the government had limited dealers to holding sugar stocks for up to 30 days. And that earlier order was effective between the 1st of August until the end of November this year. But still, we have seen sugar prices rising sharply. Just in the last 1 month, we have seen a rise of roughly 10% in sugar prices. In fact, the All India average ex-mill sugar price has risen up to nearly 5,400 to 5,500 rupees per quintal. This is on the 18th of August, and this is up from nearly 3,900 rupees that we saw last year. And in fact, for the 2026 closing sugar balance, that is estimated at around 35 lakh tons, and as a result, the opening stocks are expected to be below requirement as the new season begins on the 1st of October this year. And in fact, going forward, we are expecting these low stocks that we are seeing currently and the festive demand that is beginning to see a further risk of price spikes in sugar going ahead. And in terms of the impact on sugar mills, that is expected to see higher sugar prices that will be trickling down to sugar mills to see significantly higher EBITDA margins, and we will expect higher performance, better performance in Q2 as well as the rest of the year. This is as per comments from Elara Securities, and as a result of this, sugar stocks like Balrampur Chini, EID Parry, Sri Renuka Sugar, Triveni Engineering, all of these stocks have performed well in today's trading session.
Okay, all right. Thank you so much, Riya, for bringing us that analysis. To take the discussion forward, we are now joined by Sudeep Bandopadhyay from IndiTrade Capital and Ruchit Jain from Motilal Oswal Financial Services. Gentlemen, thank you so much for joining us. Sudeep, coming to you first, do you think that rally that we are seeing in some of these sugar names could continue? Balrampur Chini is already at a record high. Realizations are expected to improve. So do you think that up move could continue in stock prices as well?
Well, yes, I think up move will continue. The sugar prices, there is a valid reason for the prices to go up. The stock is at a record low level. Normally we should be having about 6 million metric tons of stock, whereas I think the current stock of sugar is about 3 million metric tons. So naturally, this is putting pressure on the prices on ground, and this is translating into mills also benefiting because of the higher price expectation. That's exactly what is continuing. Globally, also sugar prices are tight, and ethanol blending at some level is also helping all this price tightening. Under the circumstances, the sugar mill prices will continue to remain buoyant in the foreseeable future, at least till November, December, till the festive season continues. I expect the sugar mill prices to remain robust.
Okay, all right, fair enough. But today it was the Sensex expiry. Let's go across to Nigel now to decode the change post the CAS session and more importantly, its impact on option premiums. Nigel, over to you.
Well, Ekta, just to put it simply, there was barely any impact, which is good news, right? Because things seem to be settling down since the regulator has pulled up a couple of players. That's why today you've moved all of 52 points on the Sensex itself, which is extremely measly in the CAS session, which meant that on a weekly expiry, that additional volatility didn't kick in. If you move only around 52 points or thereabouts. And that's why, in line with expectations, the premiums crashed, given that we ended at around the 77,537. All those premiums came down, but that's perfectly in line with what the street was working with. The fear was that, in fact, you see a big surge in the CAS session, which in turn could lead the premiums to actually ballooning, as we have seen for a couple of weekly expiry sessions, both on the Sensex as well as on the Nifty. So a well-behaved session is what you had, particularly in the CAS session, which didn't send the premiums, skyrocketing. The good news today was, in fact, that after a while, the Sensex made a higher high. For 12 straight sessions, it was making a lower high. So that's a little bit of a positive. The bulls will live to fight another day.
Okay, thank you so much, Nigel, for explaining that to us, and not such a big impact post and pre the CAS session as we saw it today. And speaking of CAS, market regulator SEBI has issued an ex parte interim order against 2 investment and brokerage firms. SEBI has alleged manipulation of the Sensex during closing auction session on August 13, which was also the expiry day. Hormuz has more on the SEBI order and the allegations as well.
There's a big order that came in last evening, and this came in very, very quick time, in just 3.5 sessions of what transpired last Thursday on the 13th of August. SEBI issuing an order against these two entities, Copthall Mauritius Investments and Mansi Share and Stockbrokers. Their gains were impounded. They were barred from the stock market as well, and many other steps that were highlighted by SEBI in its order. Now, they say that the price manipulation took place during the last 10 minutes of the Sensex weekly expiry, which took place last Thursday, and the gains that have been impounded include almost 3 crore rupees for Copthall Mauritius and close to around 72 lakhs for Mansi Share and Stockbrokers. And now take a look at what has happened here is that both these entities have now been banned from the market pending probe, and they can't operate in the cash as well. Now take a look at the chart which SEBI has highlighted in its study. It highlights 3 important points where the spikes were taking place on the Sensex. The first spike, which took place at around 320, saw the Sensex move up by 362 points in just 2 seconds. 5 minutes later, there was a drawdown, and once the drawdown took place, we'll get to that as well, there was another spike that took place. In just 12 seconds, the Sensex moved 133 points. And then came the last big one. In 28 seconds, the Sensex went up by well over 400 points in that last spike, which took place around about 3:25 and 3:26 p.m. And in between all of this little drawdown that you see, that was also took place between 3:21 and 3:26, where the Sensex moved from 77,991 to 77,893. But it was interrupted by that spike which took place, causing that temporary deviation to take place. Now take a look at what SEBI has observed in the activity of Copthall Mauritius during that period. Now, the first spike had Copthall Mauritius placed 32 out of the 86 limit buy orders worth around 66 crore rupees and around 99% of those shares value. All of these orders were placed at a 3% reference price higher and for all the Sensex constituents at the same time is what SEBI has highlighted in its order. For the second spike as well, 108 out of the 165 orders were placed by Copthall Mauritius and 32 out of the 176 in the third spike were placed by the entity for all Sensex companies, 3% above the reference price, all of them at the same time. Now take a look at what it has observed for Mansi Shares and Stockbrokers. Between 321 and 326, sell orders were placed at a lower price. They were worth 145 crores, and these orders were cancelled between 326 in a matter of 3 seconds. And these cancellations led to the Sensex IEP going up by well over 230 points during that period. What they have also observed is that there were 6 stocks on the Sensex where Mansi Shares and Stockbrokers had placed sell orders worth over 100 crore rupees. They included the likes of Reliance, SBI, Eternal, ICICI Bank, L&T and Infosys. And these orders were placed 1.5 to 3% below their reference price, and 99% of those sell orders were cancelled during cash, is what SEBI has observed. And therefore, it prompted SEBI to come to a conclusion that these sell orders were prima facie meant to suppress the Sensex IEP instead of performing a legitimate sell transaction. And therefore, in this order, it has also barred these entities from the market. They have given them 3 months to liquidate all of their derivative positions and many other steps that have been highlighted as well. So a big order in very quick time, and SEBI has, with this order, it has definitely given out a message that not just cash is here to stay, but the regulator means business as well.
Absolutely. Well, thanks very much for that, Hormuz. Richard, in fact, coming to you, what is your sense on this entire controversy that took place with regards to cash? Do you think that things will settle down in the next couple of weeks?
I think, yes, the way we have seen today, it was the Sensex expiry, and the way the closing impact was not much there today in the cash session. So this clearly indicates that as the time passes, we would see that volatility that we see during the end 5-10 minutes, that will settle down. So I think it's just that after a few sessions, this would become a new normal where the volatility would not be there. So I think the steps, Thomas quite nicely explained it. So the steps that SEBI has taken, that would have a fear in minds of such entities, who tend to create such manipulation or try to create such manipulation. Because of the fear, I think that would reduce, and that would definitely reduce the volatility in the closing minutes as well.
Just quickly, if you can tell us, what are the next important levels on the Nifty? Do we see higher highs from here on? What are the charts suggesting?
Yes, the charts are quite interestingly placed, because if you see last 5 months, when the markets Nifty made a bottom of around 22,200 in the month of March, after that every subsequent corrective phase have witnessed a higher bottom getting formed. 2200 was the low made in the month of March. Then in June correction, it made a low of 23,100. In July's correction, it made a low of 23,600. And that higher bottom sequence, if continues, then 24,000 is now seen as an important support. And we are trading quite close to that levels. So I think the risk reward ratio is definitely favorable. If this pattern continues, then 24,000, 23,900 is a very strong support base. And if we start the next leg of uptrend from here, then 24,600 is the initial level that we are watching out for. If that gets surpassed, then certainly we would start a next leg of uptrend. So the risk reward ratio at least is quite favorable after this recent correction of last 10-12 days.
Okay, all right. Well, from K Fintech's block deal to AB Capital's gold loan foray, there was plenty of stock-specific action on Dalal Street today. Devyani joins in with a wrap on all of the stocks that she was watching in today's trading session. Devyani, over to you.
Well, let me begin with PFC and REC. Now, Morgan Stanley has downgraded both to equal weight, saying loan growth has slowed much more than was expected. The targets have been cut to 410 rupees for PFC and 360 rupees per share for REC. Next up is KFin Technologies. Now, about 8.75% equity changed hands in a block deal worth roughly around 1,400 crores, with the deal done at 925 rupees per share, with General Atlantic the likely seller. Now, next up is Strides Pharma. Now, the Bangalore plant has received a VAI classification from the US FDA, closing the inspection with no mandatory corrective action. It is a key facility serving regulated markets, including the US, which contribute roughly around $250 million in sales for the company. So this was an important development as well. Aditya Infotech Tech is next. Now, Motilal Oswal has initiated a coverage with a buy rating and a target price set at 4,200 rupees per share, with the brokerage seeing revenue growing at 44% CAGR over FY26 till FY28, well ahead of the industry expected growth of 16 to 18%. Now, next up is Crompton. Crompton is targeting 13 to 14% revenue CAGR by FY29, with EBITDA margins of 11 to 12%. Now, keep in mind, current EBITDA margins stand at 10%, and by FY31, it aims to double revenue and take margins to above 12%. So this was also a positive for the company. Now, last up is Aditya Birla Capital. Now, the company is entering the gold loan business through its NBFC arm and is targeting 1,000 dedicated branches over the next 3 years.
Thank you, Devyani, for joining us. That was a list of all the stocks which were in focus today. Sudeep, coming to you, anything that stands out for you in this list? And Aditya Infotech in particular, the stock did well. Have you tracked this one?
Yeah, I do track this one, and I think it's a fantastic company. They have about 44% of the market share already, and it's a dominant player in that CCTV and survey ecosystem. Expectation is that their market share will go up to close to 60% over the next couple of years. And I think there is a definite trend toward using domestic equipments for all surveillance in India, and that is benefiting this company. There's a significant tailwind, and I'm pretty confident that they will continue to perform and outperform the industry.
Okay. Any view on the gold financiers, Sudeep?
Well, yes, I think this is a business which has grown from about 3-4 lakh crore about 3 years back to about 23-24 lakh crore. So the kind of growth which we have seen over the last 3 years is huge. The only challenge in this is that the margins will come under pressure for all the gold loan providers, gold lenders rather, and also the this kind of chasing of talent in this industry is leading to massive attrition, and that is contributing again to cost base increasing. So overall, the industry will see a shrinkage of margin, and that will affect pretty much everybody, including the Muthoot and Manapurams. So under the circumstances, I'll be a little careful buying into Muthoot or Manappuram at current levels.
Okay, all right, Sudeep and Ruchit, thank you so much for joining us today with your thoughts on the technical levels and individual names on a fundamental basis as well. With that, we'll do one thing. We'll take a short break. When we come back, we'll get to the top corporate voices along with the key market events to watch out for on the other side. Welcome back. You're still tuned into Markets Forward. Let's get you some corporate voices of the day. The management of Tilak Nagar Industries told CNBC TV 18 that around 70% of the company's business comes from whiskey after the acquisition of Imperial Blue. The company is likely to take a price hike in the next 2 months, with the increase expected to be similar to the previous hike. The management further said there are no plans for a QIP right now.
Escorts Kubota is stepping up investment in Uttar Pradesh with a 2,000 crore first phase plan for a new greenfield plant. Speaking to CNBC TV 18's, the company's management said that the facility will boost tractor capacity by 60,000 units and construction equipment capacity by 15,000 units annually. Premier Energies expects FY28 revenue and EBITDA to beat analyst estimates of 18,000 crore rupees and 4,500 crore rupees respectively. Speaking to CNBC TV 18, the management said demand remains robust from Suryaghar and Kusum, while supply ramp-up is taking longer than expected. The company has a 15,000 crore rupee order book, which is equivalent to 2 times its FY26 revenue. All right, and before we wrap, we'll bring you some of the key market events to watch out for. Ria is here with more details.
Well, yes, first up in terms of economic data, in the UK, we have the July retail sales to keep an eye out on, as well as the PMI data. In fact, even in the EU as well as the US, the PMI data will be in focus. And back home in India, we have the Forex reserves data that will be coming out. So that will be key to watch as well. And in terms of IPOs, we have the IPO of Augment Enterprises, the 825 crore IPO opens tomorrow. And the 550 crore IPO for Gaja Capital closes for subscription tomorrow as well.
All right, we'll keep an eye out on all these events. Thank you, Ria, so much for joining us. And with that, it's a wrap on this edition of Markets Forward. Thank you so much for tuning in. We'll be back with more news and updates on the other side.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Oil prices remain elevated as the deadlock between US and Iran continues. US President Trump warns that any country offering Tehran a lifeline will face tremendous economic consequences. Iran's foreign minister calls Trump's sanctions threat a diversion, says it would only bring further defeat to Washington. Sensex and Nifty snap a 7-day losing streak. Nifty reclaims 24,400. Rupee weakens marginally against the dollar and remains closer to the 96 mark. SEBI bans Copthol, Mauritius and Mansi share and stock broking from the market, impounds funds worth over 3.86 crores for manipulation during the August 13 closing auction session. The order comes within 24 hours of the SEBI chief warning strict action against any attempt at manipulation.
Regulation will not come on the way of any business activity.
When we first saw the circular, थोड़े तोते उड़ गए हमारे.
NBFC executives warn of ripple effects over RBI's proposed ban on revolving credit. This even as RBI Deputy Governor maintains the new rules will not hamper business activity. Sugar prices hit a record high ahead of the festive season. Government imposes limits on inventory to boost supply and may have to rely on imports for the first time in 10 years. McLaren, Aston Martin, Bentley and other luxury British vehicles will soon get cheaper in India. Government set green flag the import of more than 10,000 vehicles under the new free trade agreement. India and Japan sign a maritime security agreement and deepen defense cooperation. The pact includes information sharing, naval exercises, ship repair and logistics support. A significant breakthrough in the fight against cancer. Pharma companies Moderna and Merck announce a new novel vaccine that prevents the return and spread of melanoma, which is a common skin cancer. Move sparks hope for a wave of vaccines to treat other cancers. US government debt crosses $40 trillion for the first time. The debt has more than doubled since President Trump first took office in 2016. A former safety engineer at Meta testifies Mark Zuckerberg lied about concern over child safety and encouraged growth at all cost on Facebook and Instagram. A California court is hearing a landmark case filed by 29 US states accusing Zuckerberg's Meta of harming children with social media companies that are addictive by design. The top story this evening, US President Donald Trump has announced a major economic campaign against Iran as the war nears the 6-month mark. Here are the latest developments. In a social media post, President Trump said, and I quote, "Any country that allows its financial institutions, businesses, airports or government entities to provide any type of lifeline to Iran will itself face tremendous economic consequences." End of quote. The US president also called on US allies to support Washington's efforts to isolate Iran. Iran has dismissed the president's announcement as a diversion. In a social media post, Foreign Minister Arakchi said, and I quote, "The so-called economic D-Day is a diversion from America's own crisis, unprecedented debt and surging interest costs." End of quote. In the oil market, Brent crude prices remain above the $90 per barrel mark as the US announced effort to put financial penalties on Iran and its supporters. According to shipping data from Kepler, 6 commodity vessels crossed the Strait of Hormuz as of 19th of August. Here's the US president threatening countries doing business with Iran.
Well, we have things that we could sanction. We have very draconian sanctions, and we'll see what happens. Right now, the strait is open. A lot of boats are coming through. People aren't reporting that, and that may slow down a little bit at some point. But right now, a lot of boats are coming through. The naval blockade has been extremely effective. Zero, I mean, literally, while it's up, and that's been for quite a while, you know, except for a couple of little pauses where we opened it purposely with a deal. But the deal didn't terminate, you know, the deal didn't turn out to be what they said, you know, when they tell us one thing and they do another.
At least 12 people were killed and dozens injured after Russian ballistic missiles struck Ukraine's capital Kiev. The attack damaged buildings, sparked fires across the city and knocked out power in some parts. A residential building, warehouses and a children's hospital were also hit. Ukraine's President Zelensky calls on Western allies to provide more interceptor missiles. All right, on to the day's market action. Sensex and Nifty snapped 7-day losing streak with Nifty reclaiming the 24,200 mark. Sensex gained over 600 points. The gains were broad-based, but mid-caps and bank stocks marginally underperformed the frontline indices. Market regulator SEBI has banned Kotak, Mauritius and Mansi share and stock broking from the market over alleged manipulation during a closing auction session last week. It has ordered the impounding of 3.68 crore rupees in alleged wrongful gains. Hormaz Fatakia decodes SEBI's observations on how the two companies allegedly manipulated the CAS system.
There's a big order that came in last evening, and this came in very, very quick time, in just 3.5 sessions of what transpired last Thursday on the 13th of August. SEBI issuing an order against these two entities, Kotak Mauritius Investments and Mansi Share and stock brokers. Their gains were impounded. They were barred from the stock market as well, and many other steps that were highlighted by SEBI in its order. Now, they say that the price manipulation took place during the last 10 minutes of the Sensex weekly expiry, which took place last Thursday, and the gains that have been impounded include almost 3 crore rupees for Kotak Mauritius and close to around 72 lakhs for Mansi Share and stock brokers. And now take a look at what has happened here is that both these entities have now been banned from the market pending probe, and they can't operate in the CAS as well. Now take a look at the chart which SEBI has highlighted in its study. It highlights 3 important points where there spikes were taking place on the Sensex. The first spike, which took place at around 320, saw the Sensex move up by 362 points in just 2 seconds. 5 minutes later, there was a drawdown, and once the drawdown took place, we'll get to that as well, there was another spike that took place. In just 12 seconds, the Sensex moved 133 points. And then came the last big one. In 28 seconds, the Sensex went up by well over 400 points in that last spike, which took place around about 3:25 and 3:26 p.m. And in between all of this little drawdown that you see, that was also took place between 3:21 and 3:26, where the Sensex moved from 77,991 to 77,893. But it was interrupted by that spike which took place, causing that temporary deviation to take place. Now take a look at what SEBI has observed in the activity of Kotak Mauritius during that period. Now the first spike had Kotak Mauritius place 32 out of the 86 limit buy orders worth around 66 crore rupees and around 99% of those shares value. All of these orders were placed at a 3% reference price higher and for all the Sensex constituents at the same time is what SEBI has highlighted in its order. For the second spike as well, 108 out of the 165 orders were placed by Kotak Mauritius and 32 out of the 176 in the third spike were placed by the entity for all Sensex companies, 3% above the reference price, all of them at the same time. Now take a look at what it has observed for Mansi shares and stock brokers. Between 321 and 326, sell orders were placed at a lower price. They were worth 145 crores, and these orders were cancelled between 326 in a matter of 3 seconds, and these cancellations led to the Sensex IEP going up by well over 230 points during that period. What they have also observed is that there were 6 stocks on the Sensex where Mansi shares and stock brokers had placed sell orders worth over 100 crore rupees. They included the likes of Reliance, SBI, Eternal, ICICI Bank, L&T and Infosys, and these orders were placed 1.5 to 3% below their reference price, and 99% of those sell orders were cancelled during CAS is what SEBI has observed. And therefore, it prompted SEBI to come to a conclusion that these sell orders were prima facie meant to suppress the Sensex IEP instead of performing a legitimate sell transaction. And therefore, in this order, it has also barred these entities from the market. They have given them 3 months to liquidate all of their derivative positions and many other steps that have been highlighted as well. So a big order in very quick time, and SEBI has, with this order, it has definitely given out a message that not just CAS is here to stay, but the regulator means business as well.
Thank you, Hormaz, for that comprehensive update. The National Stock Exchange is gearing up to go public next month. The IPO is likely to be launched by the second half of September. Sources say the NSE is likely to seek market regulator SEBI's permission to allow its stock to trade on its own platform under the permitted to trade category. Currently, 144 companies listed on the BSE are permitted to trade on the NSE. RBI Governor Sanjay Malhotra defended the decision to end the special swap window for foreign currency non-resident deposit scheme a month before it was originally planned. Speaking to the Financial Express, Governor Malhotra said the decision was data-driven and well thought out. He also added that RBI expects inflows worth $80 billion from the 3 schemes introduced to attract dollar deposits to shore up the rupee. NBFC executives have warned of ripple effects over RBI's proposed ban on revolving credit. In an exclusive conversation with CNBC TV18 at the Banking Transformation Summit, CEOs from India's top NBFCs called for a more cogent interpretation of RBI's draft circular. Speaking at the same event earlier, RBI Deputy Governor S.C. Murmu assured that the draft was only clarificatory in nature and would not impact NBFC businesses.
Actually, this is not a new regulation. It has been there all along. Okay. Revolving credit as such was not permitted even now for NBFCs. But what we are proposing in the draft is we are trying to bring more clarity. Our regulation will not come on the way of any business activity. So that is very, very important for all of us. The idea is not to prevent anything. Idea is to do business in a certain way, keeping in mind the risk.
In original form, when we first saw the circular, थोड़े तोते उड़ गए हमारे कि यार ये क्या है? So I really hope that the way the industry first read the circular is incorrect, and the interpretation that I'm hearing now is the correct one, that it is supposed to be clarificatory in nature with respect to definition of businesses and processes. But if it were read in its original form or to the letter, it would be very disruptive.
Very cogent interpretation is needed as to what it touches and what it does not touch. I think the Deputy Governor's clarification in the evening gives us a ray of hope. But, the total outstanding that we're talking about is anywhere between, the numbers vary, but I think it's ballpark between 1.5 lakh to 2 lakh crores that have this sort of structure.
From an SME perspective, this does not bar invoice discounting. There is a license of factoring which RBI has issued, and we are one of the factoring licenses, and we do it we have a decent sized book. So it doesn't discount, it doesn't bar us. So I really feel the problem is the derivatives of personal loans, right? Where OD getting converted into EMI after 3-4 years. And it would have, I don't know the numbers here which he's talking about.
1.5 lakh to 2 lakh crores.
Could be bigger, is what I sense. But FIDC would have the number. We've not gone deep onto the number. But this will have a huge ripple impact on those borrowers.
My understanding, what we do at Navi, we are largely PL. We always say that every underwriting is a fresh underwriting. So if a customer has come to you, you have given the loan. Now the customer is coming again to you. We do a fresh underwriting like the customer is coming to us first time. It's only that you have more data because he has served loan with you, so you know the customer better. But you assess that customer at that point of time as if you are assessing a fresh customer. That is there. Having said that, I think other ecosystem, if the interpretation would have been the worst possible, what we were thinking, it definitely would have hit that. But I believe that the industry is very resilient. See, ultimately, the point is that if NBFCs continue to lend someone over a period of time, it means they believe in the creditworthiness.
Another big headline that we are tracking, US government has surpassed $40 trillion for the first time after hitting a record $39 trillion in March. It has more than doubled in a decade. Now, the debt stood at about $19.4 trillion in 2016. Borrowing costs have soared as the US federal government is shelling out more on defense, social security and Medicare than interest payments. According to the Treasury Department, US finances recorded a deficit of $432 billion in July, the highest monthly figure since March 2021. The shortfall is nearing $1.8 trillion for the year so far. Premium British cars like Aston Martin, Bentley, Jaguar, Land Rover and Rolls-Royce will soon carry a cheaper price tag for Indian roads. We learn from sources that the Indian government will shortly issue an order to pave the way for the concessional duty import of over 10,000 UK vehicles under the FTA. Abhimanyu Sharma is here with the details. Abhimanyu.
India is set to shortly green flag the import of over 10,000 cars from the United Kingdom under the FTA between both the sides. Cheaper British premium cars like Aston Martin, Bentley, JLR, McLaren and Rolls-Royce are going to cross yet another lap in their journey to Indian roads. Sources have indicated that the government order is expected in a week to allow imports of 10,480 British automobiles in 2026 as per the India-UK Trade Pact, and India is going to issue the order for allocation of the tariff rate quota under the FTA. Now, under a TRQ order, the government allocates import quotas to importers under yearly allocation limit as per the Trade Pact. No duty cuts will be made in the first 5 years of the Trade Pact for British EVs, hybrids and hydrogen vehicles priced below 40,000 British pounds. Under the CETA, import duty on 3.78 lakh conventional engine passenger cars are going to fall from 110% to 10% over a period of 15 years. India had opened the application window over a period of 15 days last month for 27 tariff items for the calendar year 2026. It remains to be seen what's going to be the kind of response and which exactly will be the cars which are going to be imported into India from the United Kingdom.
Right, thank you, Abhimanyu, for that. A quick look at other headlines. The promoters of Rishabh Instruments are eyeing a stake sale with controlling interest in the company. Sources say that they are in talks with multiple suitors, including a German entity. The promoters are likely to sell a big chunk of their near 70% stake. They could seek a deal valuation of over 3,000 crore rupees. The energy efficiency solution company is yet to respond to CNBC TV 18's query. India and Japan have signed an agreement on maritime security. Defence Minister Rajnath Singh held talks with his Japanese counterpart in Delhi. The two countries also discussed boosting defence technology ties. The pact includes information sharing, naval exercises, ship repair and logistics support. This comes weeks after Prime Minister Modi and Japan's Prime Minister agreed to strengthen defence ties. Top Indian ministers met Singapore's Prime Minister Lawrence Wong to review progress under the comprehensive strategic partnership between the two countries. Finance Minister Nirmala Sitharaman, Commerce Minister Piyush Goyal and External Affairs Minister S. Jaishankar were part of the Indian delegation at the 4th India-Singapore Ministerial Roundtable. The talks focused on key areas including advanced manufacturing, connectivity, digitalization, healthcare, skill development and sustainability. Starlink has reapplied for a fresh regulatory approval in India for its satellite network. According to reports, the company has sought approval to deploy nearly 30,000 Gen 2 satellites in low Earth orbit. The company reportedly also plans to bring technology designed to allow phones to communicate with satellites without the need for a mobile tower or a separate dish. Sugar stocks rallied in today's trade as prices hit a record high amid concerns over inventories ahead of the festive season. The government has tightened stock holding limits for bulk consumers in a bid to bring prices under control. Manisha Gupta joins us with more details. Manisha.
It has been a one-way street when it comes to the Indian sugar prices, trading at record highs right now, and they have gained up anywhere between 10 to 12 rupees a kg in the month of August alone, which is more than 10% of a gain coming in for the last 1 month. The ex-mill sugar prices have now surged above 55 to 58 rupees a kg, with retail trading at 60 rupees a kg right now. It's not just about India. If you look at the US sugar futures, they are trading at a 13-month highs. The London sugar prices are trading at a 15-month highs as well, and there are estimates of a global deficit for sugar for the year 2026-27, and that is because while the El Nino concerns for us are real, it's about lower sugar production in India, in Europe, also in Thailand, in Brazil as well. So that is what has been keeping the sugar prices higher. We have seen various measures come in from the Indian government, starting right from suspending all kind of exports for raw, refined and white as well, to keep the Indian sugar prices and availability quite comfortable. And then the Indian government also then asked all sugar dealers to update their stocks on a weekly basis on official tracking system. Apart from that, there also has been physical verification of sugar with the sugar mills that the Indian government has been doing. They also have been told to dispatch sugar after 7 days of sales itself instead of holding back on sugar. And then we also have seen the centre cut stock holding limits for bulk holders of sugar of 10 tons and more to just about 15 days of their inventory. All of this also has not helped the sugar prices coming off. What the markets now believe is what the Indian government can do One, they could restrict the use of sugar cane and molasses when it comes to ethanol divergence. The other is that the sugar crushing season could be brought forward for the month of October. Usually it starts in November, and usually after Diwali. This time around, the mills could start crushing sugar early to ensure that there is availability. And the third and most important point that the street seems to be discussing is on whether or not India will allow sugar imports after perhaps 10 years or so. This is something that seems optically tricky right now, but a lot seems to be in works at this point in time.
All right, thank you, Manisha, for that. Relief for JSW Energy in a tariff dispute with the Maharashtra State Electricity Distribution Company. The appellate tribunal dismissed the petition filed by the state power distributor after the state regulator termed its own order wrong. Now, the appellate tribunal termed the regulator's submission as unusual and unconventional. The move provides a 600 crore rupee relief to JSW Energy. And on that note, we'll take a short break. Coming up next, a significant breakthrough in the fight against cancer. Pharma companies Moderna and Merck announce a new skin cancer vaccine. Welcome back. You're watching Business 360. The big global story of the day. China has sentenced Evergrande founder Hui Ka-yan to life in prison over financial crimes, including fundraising fraud and illegal extension of loans. His sentence comes 5 years after the firm's collapse triggered a property crisis and rattled financial markets in China. Once Asia's richest man, Hui pleaded guilty to 8 charges in April this year. Evergrande and its real estate arm have been fined a combined $2.4 billion. Pharma giants Moderna and Merck have announced that a personalized vaccine reduced the risk of recurrence and spread of melanoma, a common form of skin cancer, in a late-stage trial. The move has sparked hope for a wave of vaccines to treat other cancers. Moderna shares rallied 177% in trade on the back of this news. Ekta Batra gets us more.
Well, yes, Moderna shares surged 177% yesterday, the biggest ever one-day gain for that stock, while Merck rose 12%. The reason, encouraging results from a personalized melanoma cancer vaccine. Merck, which is the maker of Keytruda, the cancer drug, and Moderna, announced positive phase 3 results from a trial involving over 1,100 melanoma patients. What makes this particularly interesting is the technology. The vaccine uses mRNA, which is the same science behind Moderna's COVID vaccine, but instead of training the immune system to fight a virus, it trains it to recognize and attack a patient's own cancer cells. And this is personalized. Doctors remove the tumor, analyze its genetic mutations, and use that information to create a vaccine which is specifically for that patient. Earlier data was particularly encouraging. The vaccine combined with Keytruda showed a 49% lower risk of reoccurrence or death versus using Keytruda alone. Now, melanoma accounts for around 3.38 lakh new cases globally each year, and India sees an estimated 5,600 cases annually. But this is not a treatment which is available just yet. Moderna and Merck still need to take the vaccine through the regulatory approval process. If approved, though, this could be much bigger than melanoma, potentially opening the door to personalized cancer vaccines for several other cancers, say experts.
Thank you, Ekta, for that. Moving on, a former Meta safety engineer testified that Mark Zuckerberg lied about his concern for child safety and pushed growth at all costs on Facebook and Instagram. Arturo Bejar's testimony comes as a California court hears a landmark case filed by 29 US states accusing Zuckerberg's Meta of designing its platforms to be addictive and harming children in the process. Rachna Dhanrajani has the latest from the trial. Rachna, please take us through the key developments.
Day 2 of the Meta child safety trial in Oakland, and the session belonged to one man, Arturo Bejar, a former Meta safety engineer and the state's most important witness in this case. Bejar isn't an outside critic. He spent 6 years building child safety tools inside Facebook, and he told the court he did not fully understand the danger to young users until his own 14-year-old daughter joined Instagram and began receiving sexual solicitations and explicit image from accounts she didn't know. He said he found it shocking. He came back as a consultant to try and fix it, but left believing that he could not. His central charge is aimed at Mark Zuckerberg. Bejar told the court that he interacted with the CEO dozens of times and that when Zuckerberg had publicly denied that Meta put profits ahead of safety, he was not saying the truth. Bejar's answer under oath, calling that statement is not an accurate one. He went further on the product. Autoplay, like counters, infinite scroll, inherently unsafe for teenagers, he said. And Meta's own safety features, he argued, were designed to fail. Tools like Instagram's quiet mode are optional settings, not defaults. Most people never switch them on. It's like having to turn on the airbag every time you get into the car, he said. But Meta landed its points on cross. Its counsel asked whether Bejar had actually solved any of the safety issues he worked on. He conceded he hadn't. Then a sharper thrust. When Bejar was consulting for Meta, his own daughter, then 16, set up a public Instagram account to post about cars. That is Meta's defense in miniature, that this is hard and not sinister. 6 weeks of testimony to run with penalties in play from $193 billion all the way up to $1.4 trillion, which is almost up to Meta's market cap. But the argument is now clear in this case, that this case is about defaults and design and not the content.
All right, thank you, Rachna, for that. With that, it's a wrap on this edition of Business 360. More news and updates continue right here. Thank you for watching.
It's a pretty diverse set. We are covering mortgages, LAP, we're covering two-wheelers, consumer, and of course, I mean, L&T Finance, which of course is, retail, pretty much all segments out there. I want to start with, of course, a regulatory point. First of all, gentlemen, thanks very much, all of you, for being here on this panel. Jairam, start with what is top of mind, which is the Reserve Bank of India circular, the draft circular with regards to revolving credit. How big is it? I mean, of course, we don't know if this will go through in this current shape or form it's being put out. But one reading and one feedback that I've got is that it's pretty sweeping if it were to go through like it is being put out. Your sense?
Thank you for having me, Prashant. See, in original form, when we first saw the circular, थोड़े तोते उड़ गए हमारे कि यार ये क्या है? So it's a part of the business which has, I don't think, caused any particular challenge. It hasn't really driven any particular problem in the industry. It has largely been targeted at a segment which clearly needs that value proposition, etc. So I really hope that the way the industry first read the circular is incorrect, and the interpretation that I'm hearing now is the correct one. That it is supposed to be clarificatory in nature with respect to definition of businesses and processes. But if it were read in its original form or to the letter, it would be very disruptive to a lot of products and that target the MSME segment and products which are perfectly safe, like loan against shares, etc. Very hard to see what the difference is in terms of overall risk and why you would want to kind of shut that down. So a lot has happened, it looks like, that I have clearly missed in the market. But feeling a lot better now after having heard this than I was feeling 15 minutes ago, honestly.
For the audience, and I'm sure everyone is well aware, the circular that we are referring to, we're talking about, is basically the RBI saying that, I mean, for products for which, companies, which finance companies, lenders put out and give customers, NBFCs cannot have a OD-like product, which is, I mean, you set out a limit, you borrow some, you repay, you keep borrowing, you keep repaying. That is not possible. That is essentially the circular we're talking about. Just one quick thing, Jairam, on for NBFCs, wasn't it always the case that you had to have a defined kind of limit, defined duration? It was always the case, right? So how is what the RBI is now saying inconsistent? Actually, you could argue that it is consistent, and what was happening till now was inconsistent.
Okay, now you're going to get me in trouble. See, there is a letter of what revolving credit means and what term loans mean. In general, everything that NBFCs are doing sticks to the letter of being term loans and not revolving credit. However, there is a broader way you could invoke the spirit of revolving credit, which is that you're not underwriting the customer again and again, but you're taking the same underwriting and then you are carrying it through renewals, etc. A lot of the ways that products like loan against shares or products like Flexi in personal loans, etc., have been implemented as term loans, right? That's, if you look through how the loan actually shows up to the customer, it does show up as a term loan.
Yeah, the design is like a term loan, but it works like an OD product.
Yeah, so the effect is like some sort of a credit which is available to them on tap. I would not use kind of the technical word revolving credit because it's not meant to be that, but it is kind of an on-tap credit available. Disabling that from a kind of spirit perspective would create shutdown of a lot of products that are out there. It would also disqualify a lot of the areas where investments are going on right now. I saw the previous interview where Ritu was asking Sohini about lending on UPI. All that stuff will go away if NBFCs can't do it, right? So it's important to keep in mind that the broad usage of that language will kill a lot of products that are currently being done.
So you're saying
and are
loans
being
against
contemplated.
shares, loans against mutual funds, credit on UPI, Flexi, of course, personal loans, all those.
Yeah, everything goes. So it's, and a lot of the supply chain type products are, sometimes also set up like
lending
that.
against gold digitally, I mean, those kind of things as well, which is...
Exactly. Digital loans, which have revolving component. A lot of that stuff goes out. And many of these are sunrise sectors, sunrise products. They're not very big right now, but they are sunrise products. So people like us are all making investments in them. So it would be very disappointing if they were all to be disallowed.
But you're less disappointed than you were 15 minutes back.
Thanks to CNBC, I think.
Sudipta, come in here. What is your... I just want to sort of get a quick round on this important topic and then we'll move on.
Just as a little aside, you compared banks and fintechs to different... NBFCs are para-commandos. We go where, others fear to go, right? But, joke apart. I think this has got multi-dimensional impact. This is not an easy thing. Primarily because, it's not only about the flexi loan product, it touches supply chain, it touches inventory funding, it touches, some part of personal loans, derivatives which were there with some of the fintechs, it touches that. And frankly, whether it touches loan against shares, etc., it's a slightly gray area because it's a secured asset on the other side. So frankly, first and foremost thing, I think very cogent interpretation is needed as to what it touches and what it does not touch. I think the Deputy Governor's clarification in the evening gives us a ray of hope. But, the total outstanding that we're talking about is anywhere between, the numbers vary, but I think it's ballpark between 1.5 lakh to 2 lakh crores that have this sort of structure.
Around this, in this form, which
especially done by NBFCs.
So around 2 lakh odd crores from
between
NBFCs.
1.5 to 2 lakhs. We do not have the exact number, but our ballpark is between that number. Now that's a pretty large number, and the fact is that again you talked about UPI on credit. Though it's not open for NBFCs as of now, but the fact is that if this regulation were to apply in its entirety, that goes out of the window, right? So, as I said, it's got multidimensional impact, and as an industry and being a board member of FIDC as well, which is the NBFC SRO body, what we have decided is that we will initiate dialogue. Obviously, we need dialogue with the regulator, and we need to sort of reason through as to, where is the sort of hesitation for opening up this sort of products, because I do not think it's a risk issue. Personally, I do not think it's a risk issue. I think the risk of this sort of products have been administered pretty well. So I guess I think it's a principle issue more than anything else. I think there has to be a dialogue on that principle. And frankly, I do believe that a positive outcome can be found.
Just to I asked Jairam this, is the RBI kind of interpreting the rule as it were to be interpreted, and it was not being interpreted over all these years? That is one way to look at it. I mean, I know there's definition issue, etc., which Jairam also pointed to, but what do you think?
As the governor said, that, in spirit, in principle, NBFCs were not allowed to do revolving products. And what they have done with the guideline is that put that in black and white. So that's what he's saying, right? But the fact is that what was a implicit understanding for many, many years, a lot of water has flown down the bridge, right? And the fact is that now, see, for example, let's take a small shopkeeper. A small shopkeeper might not have the cash flow wherewithal to take a CC limit or a OD limit from a large bank, right? So he wants a small loan, but with the same structure, right? NBFCs gave them the small loans with the same flexibility and structure. And now this is a large established product offered by many, not only a single NBFC, offered by many NBFCs. So I guess, as I said, this needs to be evaluated, a dialogue needs to happen, and then the regulator obviously will do what it wants to do in its infinite wisdom, and we will follow that.
Abhimanyu, your thoughts on this issue. How serious is this for you as a business person? I mean, your thoughts broadly.
So this was coming. While my co-panelists was surprised when it came, but I think the regulator has spoken to us in many different formats, right? I chair the CI-NBFC committee. We've been in closed door with the deputy governor, with the CGM, and this was coming. They have spoken individually and they've spoken to us in the group that they're not okay with revolving credit. Process-wise, could we have, as a body and as FIDC or as CI, attacked it before this came? Could be yes, but it's hindsight, right? My reading is, from an SME perspective, this does not bar invoice discounting. There is a license of factoring which RBI has issued, and we are one of the factoring licenses, and we do it we have a decent sized book. So it doesn't discount, it doesn't bar us, because that's a license issued by RBI, right? Which is a revolving credit, which is I'm factoring so that doesn't bar us from there. Trades, it doesn't bar us from there. So I really feel the problem is the derivatives of personal loans, right? Where OD getting converted into EMI after 3-4 years. And it would have, I don't know the numbers here which he's talking about.
1.5 lakh to 2 lakh crores.
Could be bigger, is what I sense. But FIDC would have the number. We've not gone deep onto the number. But this will have a huge ripple impact on those borrowers. Because if those borrowers are used to that line, to really lend into that line to pay other obligations. So a systemic impact, not only on NBFCs, but a larger retail borrower pool, which is a cause of worry. And fortunately, the regulator hears, and if these numbers can be substantiated and that impact can be shown, I think there could be a grandfathering of such stuff. But for us personally at Hero FinCorp, we have a lot of SME, we have a factoring license, we do supply chain, which is invoice-based financing. I don't think we are impacted there. Fortunately, we are not into Flexi OD yet. So
you're saying on the SME, on the business front, perhaps it should not impact, but
that's my reading, because factoring is a license which RBI gives us.
Okay.
Invoice discounting is against an invoice, so it's really a line which I'm doing various tranches.
Yeah.
So it should not be an impact.
Yeah.
So
let me get Abhishek in. Abhishek, you're doing, your personal unsecured mostly. You started mortgages in a small way right now.
Yeah.
Your thoughts on how, you just heard Abhimanyu paint the picture with regards to exactly that, which is personal, on the personal side. The impact will be felt in the most acute way. Your thoughts?
I believe that initial reaction is fear of unknown. When something new comes up, you don't know how it will be interpreted. As Deputy Governor just pointed us out, probably the aim is to clarify and not to do something else. Honestly, my initial reaction was very different than what Jairam mentioned. There are two things, right? At least my understanding, what we do at Navi, we are largely PL. We always say that every underwriting is a fresh underwriting. So if a customer has come to you, you have given the loan. Now the customer is coming again to you. We do a fresh underwriting like the customer is coming to us first time. It's only that you have more data because he has served loan with you, so you know the customer better. But you assess that customer at that point of time as if you are assessing a fresh customer. That is there. Having said that, I think other ecosystem, if the interpretation would have been the worst possible, what we were thinking, it definitely would have hit that. But I believe that the industry is very resilient. See, ultimately, the point is that if NBFCs continue to lend someone over a period of time, it means they believe in the creditworthiness. And given that the numbers are good, it means that the creditworthiness of the borrowers are actually justified. The process has to be changed a bit to kind of work around this. So yeah.
Sure. But the point is that process and what you're underwriting, that's not the issue here. They may be excellent, but the fact is it is essentially what the RBI is saying, well, this is allowed and this is not allowed. And we'll have to wait for finally what the RBI says. These are, of course, draft regulations. Now, let's come to what has been really doing well as far as NBFCs are concerned. It's two areas. It's mortgages and it is gold. And we've addressed, Jairam, gold in the past. So I just want to start by just address those two segments and maybe gold a little bit more, if you can. I mean, you've started the gold, you've got into the gold business. It's small, very, very small for you right now. But it's just a sign of things that everybody is there and building out very, very fast. Go on.
See, the market in gold was 4 lakh crores 4 years ago, and nobody cared. Nobody cared to enter into it. Everybody was sitting by the sidelines and saying, okay, whoever is playing can continue playing. Like, doesn't really matter. All of a sudden, over the last 2 years, it has jumped to becoming 21 lakh crores. At 21 lakh crores of AUM, it is a business that I cannot ignore. No large NBFC board is going to allow them to not be in this business. They'll be like, what the hell are you doing? It's the second largest business out there. How can you be, let's say, a upper layer NBFC and not be in that business? So everybody will be there in that business because of the nature of how the business works. It's the only high yield, low credit cost product out there. और कोई product में आपको 18% का interest और आधे टके का risk नहीं मिल रहा है. तो ये एक ही business है, तो सब लोग करेंगे इसको, कोई इसमें दो राय नहीं है, सब करेंगे. Now the question is, what does that mean for the industry, and what are the risks if something goes wrong in this business? What it means for the industry, of course, is that the competitive structure will change, the market structure will change, the more dominant position that a few players have had will probably go away, and this business will start looking like every other lending business in the country, where even the top players have single-digit market share. So much more fragmentation is probably one outcome. Lower yields in general is probably a second outcome. But then the risk side, what happens if gold prices break is an important question. Gold is $4,300 an ounce today. At peak, it was $5,300 an ounce. So it's already corrected about 20%. But it has grown at a CAGR of 13% over the last 10 years. It used to be $1,300 an ounce 10 years ago. So it has grown at a CAGR of 13% over the last 10 years. If instead it had grown just by inflation, which is what the 100-year trajectory has been, that gold rises by global inflation, if that's what happens, then gold can go to half its current price.
I want to ask you, Sudipta, not about, of course, I mean, Jairam has said there's no question, and if gold prices were to halve, if you put out the trend for the inflation, etc. But do you think gold loans are helping paper over some stress on the personal loan side? Because they are so easily and abundantly available, and they're so easy to get. You think, I mean, there is that kind of thing also happening, which we're not seeing right now?
Maybe on the margin, but, I don't think, most of the gold loans, and, we entered the business pretty aggressively last year. This year, we are opening about 10 branches, almost 10 branches every week.
Actually, your journey absolutely resembles what Jairam said, because you acquired that company with some 1,300 crores in assets.
1,300 crores in assets. We are opening 10 branches a week.
I think 1,300 crores is going to 4,000 crores now.
Yeah, it's gone to 4,000 crores.
In a year.
Yes. So it's grown pretty fast. But, again, I don't think, it is, maybe some part it is papering over. But it's very minuscule. Most of the gold loans goes for, either, retiring high cost of personal debt, money borrowed from family, etc., or it goes into business or income generating activity. It does so, right? And so that's why, and the other thing which you said is that actually LTVs in the new guidelines actually went up. Originally it was 80, it went up to 85. Now it is a signal. It is a signal from RBI and government that, if you want to credit flow in a large section of society that is otherwise credit ineligible, right, this is a surefire way of doing it. And historically, this asset class had got very low loss rates. So it gives the regulator a little bit of confidence to take this call. But what has happened is that if you look at gold prices were at $5,000 odd, corrected to $4,000, now gone back to $4,400. So if you see the 20% correction already has happened. And For us, for example, our average LTVs are about 65 to 66%. So in a way, legacy...
This is on the book or the new?
On the book.
On the book.
On the book.
And the new would be higher, I'm assuming?
New will be probably slightly higher, because the LTVs also have gone up. And a lot of balance transfer also happens. So there is also a lot of round robining within the industry that happens where customers take advantage of when the price goes up. Right? So, but I do believe that, gold prices... Will there be a catastrophic collapse? As long as there's wars, uncertainties, geopolitics, I think gold prices are going to remain at a particular level, and it's generally will have an upward bias. Maybe the speed of the upward bias will go down, but I don't see a sudden collapse of gold prices. So the only thing is that, if you are operating on the margin and trying to build your book by trading on that 85% LTV limit most of the time, then fluctuation in gold prices is going to give you trouble with margin calls. Which we saw when the prices collapsed from 5,000 to 4,000. We had to do margin calls on some of the customers. And one of the realization that we had is that the margin calls are actually solvable. Customers come and put more collateral. Right? So it is not an insolvable problem. Margin call going into auction is very, very limited. So in a way, this industry has its own inherent safeguards built in, and this industry will grow. But will it grow at 50%? No, it will not. But maybe at 25, 30% growth rate, it will
And you agree with what Jairam said, which is lower yields, etc., as a consequence of everybody getting in? That's the natural... I mean, it has to happen, right?
If there is, a lot of competition, yields will temper a bit, right? But the fact is that will it go... This is an expensive business to do also. It requires a lot of infra.
So I wanted to ask you, so I've heard attrition, for example, because you have to find trained people and operate it. It's a hard business to do. I mean, it's as high as 70, 80% in some cases. Is that true?
Some of the legacy players obviously provide the pool to the new players. So some of the legacy players will see higher attrition, right? But the fact is, over a period of time, it will settle down.
Jairam, hard to get people as you build this out, or no? Expensive?
I hear that there are a couple of really big players out there in the market who are nice talent pools. So, see, as a new player, again, it's the most natural thing for me to do, right? If I'm trying to set up a business, I will look at who does this business really well, and I will tell my team, go hire people from there. Like, I'll give a blank check and say, go hire anybody who can find from there. That's what we are doing. I mean, I know it's a little bit shameless, but that's the way it is. Like, that's how you're going to build a business, right? You're not going to
I'll
start
give you an
building
example.
from scratch.
We are opening 10 branches a week, right? Now, to get 10 branches a week, people, it might not always be possible to get from the market. So some of our own internal people we are training also.
Jairam, the other one is mortgages, which I said, which is growing phenomenal. Again, I mean, it's just like a safe product, 20-year product, paid back in, I mean, loan comes back in 8 years on an average, 8-9 years on an average. Delinquencies are low. I mean, all well there? Nothing, no problems at all?
No. All is not well there.
All is not well.
See, when you say the word mortgages, let's split that up into housing loans and loans against property. Housing loans are just fine, not a whole lot
meant
going
housing
on
loans.
there.
I think
No. The thing to focus is loan against property. The MSME lending lab business has been growing at a CAGR industry level of 30+% over multiple years. Pricing has held on and risk has not deteriorated, right? But it has been slowly but steadily inching up. Right, it first started in 2024 with some of the micro lab players actually coming up with results which were a bit of a shocker to people, and then it stopped. It felt like, oh, we have all avoided the problem. Nothing is happening around. And since then, I think the problem is building. I think loan against property over the last 2-3 years, the industry growth is extremely high. And we've all got to step back and kind of think about whether the small businesses in India are indeed growing at that rate that they can absorb this level of capital. And by the way, a lot of the gold conversation that we had before, a lot of it is finding its way into business as well, right? A lot of the gold loan is essentially business loan in disguise, where the guy had a tough conversation with his wife in the bedroom the previous night, right? And they've turned up here. So there is a lot of credit that has gone into MSMEs in recent times through one form factor or the other. LAP is a business I worry about. in terms of where it is headed.
Over leverage, too much growth, too fast growth. The underlying business is not growing as fast.
Yeah,
et cetera,
I think it's the too fast, right? Too much, too fast. Growth has happened, and the properties. I mean, there is when we had the MLAP problem a few years ago, or a couple of years ago, people realized that selling property is not the easiest thing to do. If somebody has a small
Do you think
shop,
we're approaching a point where perhaps we get into another bit of a credit cycle here?
Don't try to get me to say things that I'm not saying. See,
but you want.
I think
I'm just trying to push you to say things you want to say. So
see, I think the lab business has grown way bigger than I think people realize. And a lot of customers are sitting out there with multi-crore rupee labs, essentially with the mortgage of their shop, basically, behind it. If the business starts doing poorly, then good luck trying to sell the shop to somebody else. So it can really start snowballing, pretty quickly. So if a slowdown happens in small businesses, LAP will really suffer.
For now, it looks like, I mean, small businesses are doing, maybe they're doing a little better. Maybe they were slowing down, but I mean, earnings, etc. If that's an indication, they seem to be doing.
I think we are all surprised by how well the small businesses are doing and how good risk is looking in the last few months compared to what we would have thought.
Hello and welcome to News Center. I'm Ashmit Kumar. After threatening to choke Iran's economy, US President Donald Trump has now threatened nations trading, supporting or transacting with Iran, warning that he will crash those nations financially. Responding to Donald Trump's economic warning to Tehran, Iranian Foreign Minister Abbas Araghchi said that the economic pressure would not hurt Iran. He claimed that Trump was using the issue to distract Americans from domestic problems facing the US for the very first time. The US national debt has crossed $40 trillion, driven by defense spending, social programs, and rising interest payments. Now, this comes just 5 months after the debt had crossed $39 trillion in March. According to Axios, the US has established a shipping corridor for oil tankers transiting the Strait of Hormuz. The report says that the corridor has been in place for several weeks now, with around 20 tankers passing through each night along the Omani coast. It estimates that around 10 million barrels of oil a day have been transported through the route. Meanwhile, Brent crude prices have surged. It is now hovering around the $95 mark. Now, according to commodity data firm Kepler, oil flows through the Strait of Hormuz nearly tripled while the Iran-US MOU was in place, although they remain below the pre-war levels. Meanwhile, the head of an Iraqi armed force claimed its headquarters had been attacked several times and that it had lost around 100 fighters since the Iran war had begun. And well, joining us now to take this discussion ahead is with us former diplomat Ambassador KP Fabian, also with us energy expert Mr. Narendra Taneja. To both our experts, thank you so much for joining us. Mr. Fabian, let me come to you first. Donald Trump threatening economic warfare. Is this perhaps an implicit admission by the US that military warfare has not worked for them? We've seen reports of Pentagon informing the White House that, look, we're running out of targets to hit inside Iran, and it's not quite yielding the kind of results, the kind of control that the US would hope for over the Strait of Hormuz.
Thank you. It is more or less clear that President Trump has lost the military confrontation with Iran. And now he is hardening the economic confrontation. And if you noticed, even before President Trump made the formal announcement in his typical fashion, with so many capital letters in the Truth Social, even before that, he had spoken to UAE, and his Treasury Secretary also had spoken to the UAE, and UAE announced cutting off all trade and financial connections with Iran. Now, UAE is an important source of import for Iran, about 30%. And, if you go to Dubai, there are these dhows, boats go back and forth, you know what I mean. And also there are lots of Iranian companies active in Dubai. And now they also can avail of, the centrality of UAE or Dubai for financial transactions. So UAE's action, declaration rather, if implemented, mind my words, if implemented, will make it rather difficult for Iran to get anything from Dubai. That will be a serious blow. Second part is that Trump's declaration, does it apply to China? We are not sure because Xi Jinping is expected next month. And Trump knows that Xi Jinping will retaliate with restrictions on critical minerals and in other ways. So on the whole, let me conclude by saying that Trump is indirectly admitting defeat and still in his style, rhetorically getting louder and louder.
Well, that's an interesting thought that you've raised. Let me take that up with Mr. Taneja. Mr. Taneja, increasingly we find that the US is realizing the limits of its powers, its influence, especially when it deals with Xi Jinping, when it deals with Beijing. We saw that in the recent Trump-Xi meeting. The second round of that meeting is shortly due to take place in Washington in the month of September. Tell us, UAE saying that, okay, fine, we won't transact with Tehran. That's the second largest partner. But China overwhelmingly is the largest trading partner, makes up for something like 30% of Iranian trade. Can Donald Trump actually find himself acting against Beijing, against Xi Jinping? Do you see that happening at all?
You see, President Trump is desperate. I mean, he has lost the war. He has lost the narrative. The fact is, in the eyes of the world, Iran is a
We've lost Ms. Taneja there. I think we have him on a slightly patchy line. But let me take that question across to Mr. Fabian again. Mr. Fabian, again, we've seen the limits of how much influence Donald Trump can exert, especially when it comes to China. We've seen China weaponizing supply chains. You mentioned critical minerals is another one. Do you see Donald Trump actually exerting or managing to exert any influence whatsoever on Xi Jinping, especially ahead of that September meeting due to take place in Washington?
Unlikely to start a trade war with China. But at the same time, the American people, at least that section constituted by MAGA, can easily be brainwashed. So Trump is trying to do that by making these declarations. But of course, the economic pressure on Iran will increase. But the fact is that Iran is willing and able to take care of that pressure and suffer. And on the calculation that Trump eventually will have to, quote, surrender, unquote, by agreeing to Iran's terms before the negotiations start.
Sure. Well, that's an interesting point in terms of how the dynamic between the US and China shapes up. Let me check with the producers if Mr. Taneja is back with us. We're still trying to connect him on a line. We still have him on a slightly patchy connect. But until we get him back, Mr. Fabian, another question back to you. Tehran has been held hostage to many such sanctions in the past as well. This is not something that's new to the regime. This is not something that's new to the country to face with such consequences, economic consequences. How much of influence will this have on any decision-making that Tehran does with respect to the Strait of Hormuz, with respect to this conflict? Will there be any change of stance that can be accounted for on account of this fresh pressure that Donald Trump is looking to apply?
Unlikely, because the Iranian stance is defiance and the calculation that they can withstand this economic pressure for a while, whereas Trump cannot afford to see the damage done to the global economy and also to the dwindling support from the public with the midterms approaching. So that is their calculation. But you know something? Trump is slightly disconnected with the reality because he said the other day that it is digital intervention by China that made him lose the 2020 election. And then he said the non-citizens voted and that is why he lost. Obviously, he implies that all non-citizens would have voted against him. So, he is disconnected with reality. So his next action, nobody can predict, not even himself.
Mr. Taneja is back with us. Mr. Taneja, let me get your thoughts on this latest development. Even as we speak, Brent is trading around $95 a barrel now. Many say that the reason the energy prices have not spiraled out of control is because China is buying less. If this threat is to come to pass, if Iran's supply is off the table, if China starts buying from non-Iranian sources, so far they've been buying from Iran, if they decide to buy from non-Iranian sources, what does that do to the energy matrix, to the energy pricing?
Well, if you look at the global energy landscape, particularly of oil, that has changed dramatically. In fact, the Middle East used to be the gravity center in terms of the global oil, markets and so on and so forth. But look at it now. The United States is actually the Western Hemisphere, with the United States at the very center of it. America is now has emerged as a swing producer, has also emerged America leading it, but the entire Western Hemisphere more powerful than OPEC. OPEC is functionally dead now. So in such a scenario, whether China buys more or not, I don't really think that's going to make very fundamental difference. At the same time, markets are beginning to realize that, look, the threat is there, but President Trump is, desperate to leave. And eventually Iranian-style oil will also start flowing into the global supply system once this thing is over. I don't see any kind of truce or peace before American elections. Iran knows it very well. Iran's strategy seems to be very clear: to make life difficult for Iran, for the United States, and so that President Trump's party loses elections. Once that happens, President Trump will be a lame duck president. A lame duck means that Iran probably would be enjoying more power in terms on the negotiating table. And it's not only Iran which would be happy with that situation if President Trump is reduced to be lame duck. The entire world practically. Even most majority of NATO members too. I'm not talking only of Denmark, which has control of Greenland. So that's the kind of situation. The fact today is, when you look at the West Asia, Middle East, as they call it, I really don't see any kind of economic, energy, or geopolitical stability for a long time to come. The entire security architecture, the economic architecture, the energy architecture of the Middle East is going through a massive change, fundamental change. And you're going to see once this thing is over, it may take 4 years, 5 years, 6 years. This is going to throw lots of opportunity for countries like India. At the same time, lots of challenges for countries like India. So I think, this is we have to keep that in mind. Post the crisis, the Iran that's going to emerge is going to be kind of the regional superpower together with Israel. And we should be preparing that. Energy markets have already started preparing for that kind of scenario.
You spoke of India. Let me get the India perspective. If Donald Trump's threats are anything to go by, India cannot buy Russian oil. There'll be tariffs for that. That's under the Lindsey Graham bill, which is currently under consideration before the House of Representatives. India, again, if these threats are anything to go by, no Russian oil, no Iranian oil. We're also looking at 301 tariffs as well. Where does this place India in terms of sourcing its energy requirements?
Well, that's actually a billion-dollar question. I think, the question is, why should we even listen to the United States? For that matter, to any country. On Russia, we have, kept silent some time, but we haven't really listened to the United States. We have been buying and we continue to buy, and long-term deals are being still negotiated. With Iran also, when you look at the quality of oil, a geographical proximity, it makes a lot of sense for us to buy more oil from Iran. On one thing, we agree with the United States when it comes to Iran, that Iran acquiring nuclear weapons would not be in India's interest. It won't be in the interest of the United States, and it would not be in our interest too. However, at the same time, we know after the kind of Mecca declaration, Pakistan, Turkey, Saudi Arabia, all coming together. They're coming together for what? For nuclear weapons. From where? From Pakistan. So the scenario changes. In such a situation, I think we should not listen to the United States on these matters. We should build closer energy ties, bilateral ties with Iran. And at the same time, we should buy from wherever we can, including Venezuela and the United States. When it comes to oil, it's important because oil is the backbone of India's economy. For India's economic security, not only energy, economic security, oil, independence is important. So we should really assert our, strategic independence on these matters. We should not listen to any country, most particularly the United States. We should buy from Russia more. We should buy from Iran, and we should buy from, and of course, Venezuela. And we should be driven only by two things: the economic interest, the price of it, and at the same time, energy security for our country. They don't listen to us. Why should we listen to them? The simple and public opinion in India, by the way, on Iran. Public opinion in India on Iran is in favor of Iran. I don't think we can afford to say no to Iran anymore. The landscape has changed completely. Public sympathy is growing for Iran. Therefore, I think it makes sense. We should not listen to the United States when it comes to our energy security. We should put our foot down like Anga, and not listen to any country for that matter. Why only United? Any country.
Well, that's an interesting thought in terms of India needing to diversify its sourcing of energy. Can India do that? That's, of course, another question altogether. The US accounts for 20% of all our exports. So a question that many experts ask is that, is India vulnerable to pressure?
One line, Ashmit, if you allow me. One line. I just want
30 seconds, Mr. Taneja. We're completely out of time. Just a 30-second
piece. Just one thing. The question is that we should really navigate these things in the sense, trust me, once things are over, Iran is back to normal. American companies and Western companies will be the first one to move into Iran with their billions. So we should be prepared for that. Iran war is all about oil. Remember that.
Sure, Mr. Taneja, appreciate your time as well as your insight. Ambassador Fabian as well, thank you for joining. You're nodding your head, but we've completely run out of time. We'll hopefully connect with you again to get your thoughts on the matter. But with that, it's time now for slipping into a very short break. Coming up next, AI's rapid evolution is also bringing a reality check from the need for stronger guardrails to understanding what these models really are. Checkpoint CEO Nadav Zafrir shares the key lessons on the other side. Welcome back to News Center. The AI Frankenstein moment when an OpenAI model went rogue. That helped the industry draw several lessons. One key lesson was an agent cannot secure another agent, and AI needs security guardrails outside the model itself. That's the word coming in from Checkpoint CEO Nadav Zafrir. He also stressed on the need for humility when it comes to AI, urging people to not stop treating models like intelligent humans and instead see them for what they really are. That's intelligent algorithms. Here's a slice of that conversation.
Well, you know, this is one of the most important economies in the world today, number one, and a very important hub for us at Checkpoint. In fact, it's our second largest R&D hub in the world today. The talent here is incredible. And so in India, we're looking not just at the market and the growth as the market as a vendor, but also we have an R&D center here, which is incredibly important for us. And there's unique talent here. So both.
Speaking of machine speed, let me get your thoughts on, I think, one aspect that everyone in the world of cybersecurity has been talking about. That's been the Hugging Face incident.
Yeah.
That was one of those milestone moments where you look back and perhaps look at how the technology has evolved. AI models acting independently, acting autonomously, gaining access to the internet, breaking into production servers of Hugging Face. I just want to get a thought on that. Are we looking at perhaps a next layer, a next level of cybersecurity concerns? Because many people say that this opens a Pandora's box, that this is sci-fi coming to reality.
Right. So the box is open, right? Is this a sort of a Frankenstein moment? It is. If I take one thing out of the Hugging Face OpenAI incident, is you cannot allow the agent to secure the agent. So you need to have a security guardrails that is outside of the model. Whether it's the rule base that secures it or the actual model that you put on top of it. So for instance, we are actually training our own model. It's really lousy at writing poetry, but it's really good because it's constantly being trained on the latest and greatest attacks. And we're constantly training it and perfecting it to be the guardian agent that is guarding from outside the actual model. So that's one thing that I think we need to take out of this. Okay. Second, I think we need to be humble about it. Right? We tend to personify the models and the agents and think that they are like us. But we need to remember, they are very capable. They're very persistent. They are not lazy. They will do everything to actually finish whatever assignment that they got. But here's what they don't have. They don't have context. They don't have judgment. And there is no morality there. So again, we need to fathom that, and we mustn't think about them as very intelligent human beings, but what they really are, very intelligent algorithms that have access to all the data that we humans have ever put out there. And the humility piece is to understand that we still don't understand everything.
You talked about how the technology, because it's democratized, a lot of bad actors have access to kind of technology, which was initially the preserve of, say, perhaps nation states, right, and perhaps bad elements. But look at it from a nation state perspective. What are some of the latest threats and what are some of the key vulnerabilities when you look at India from nation state-backed cybersecurity play?
Well, you know, what we're seeing is nation states, criminals moving really, really fast to take advantage of these capabilities. So, for example, if finding exploits, 0 days, used to be something that was, you know, only few had access to, and you would only use very, very thoughtfully. Now it's not just democratization; it's also industrialization. So it's not that the sophistication is going up; it's also the cadence that's hitting us, which is becoming much faster, right? And so we're seeing that happening from nation states, from criminals, from the intersection between nation states and criminals. And I think we'll see a lot more of that. If there's one thing that I will say is probably just around the corner, which we are very concerned about, is critical infrastructure. Because at the end of the day, when you put all these things together and you think, okay, so what is the most vulnerable piece in our nation state resilience and security? It's the critical infrastructure. What's the critical infrastructure? It could be our utilities. Right here, we're sitting on operational technologies that are very hard to update and patch, right? Because we're building like massive infrastructure, SCADA systems, PLCs. These are very vulnerable, and they're at the core, right? Our water systems, our electric grid, are the core of our financial systems, are the core of our democracies. And so what's at stake is truly a civilized way of life. You know, if you think about electricity and water, on the one hand, our democracies on the other hand, and at the center of all that is the trust of the citizens, that they can actually trust the system. So that is becoming sort of a novel attack vector that we need to be very cognizant of.
As you look ahead, I know it's a difficult question to ask because we're looking at very rapid developments. But if you could pin your thoughts down to 2 or 3 major threats that you would be keeping your eye on as we move into 2026 and then beyond at 2027?
I would say critical infrastructure is number one because it is at the core. Second is elections in our democracies, and where we need to make sure that we keep this, the trust of the citizenship, that these elections are actually what the people are looking for. And I would say finally, the biggest threat, I think, is that we outsource too fast to machines before we understand what the actual threats are. So for me, these are the 3 things. But I'll tell you this as we close. I'm optimistic. I think that these technologies, ultimately, if we can create the secure AI transformation, which is our vision and our goal, I think we can bring more positive outcome to the world through the advent of these new models and artificial intelligence.
I know I said last question, but I'll just pop in one more. You mentioned guarding against engineering of elections. Is that a growing concern that you see from at least government leadership when they talk to you?
Oh, absolutely.
How this is something that they're very concerned about?
Absolutely, because if you think about it, one of the things that these models are really good at is impersonating, creating deep fakes. And at the end of the day, we both know that, our children consume their information from social networks, very short, and it's very, very difficult to make sure that we have some kind of a single point of truth, or at least fact-checking, etc. And so I think it is something that is concerning for leaders around the world, especially in countries like ours that are based on a democratic system, which is complicated and complex, that we need to thrive in.
Well, with that, it's a wrap on this edition of News Center. More news and updates will continue right here.
Hello and welcome to this edition of Editor's Playbook. I'm Shireen Bhanas. Gen Z would say no cap. From healthcare to aviation to insurance, several sectors are staring at sweeping regulatory changes. Their entire business model could be threatened with just a stroke of a pen. Now, a parliamentary panel wants to impose limits on healthcare costs, including room rents and surgical procedures. While the move may be well-intentioned, is the price cap the right remedy? Will it scare away investors in a country that desperately needs more hospital beds and better infrastructure? Now, top hospital operators believe price caps will not solve the affordability problem and may in fact make it worse by hampering expansion plans. This view is prevalent across sectors. The government is also drafting rules to potentially impose limits on airfares. In fact, in a sealed cover, something has been proposed to the Supreme Court. Now, the promoter of India's largest airlines argues that the cost of a ticket is not determined by airlines alone. There are many other factors at play. Rahul Bharti of Indigo told me recently that the responsibility of the current cost structure lies with the ecosystem, which includes airport charges by the airport operator, user development fee, landing charges, and much more. Take a look.
The industry always gets, again, I use a word and you'll hang on to it, hammered for airfares. And this, again, something that I think we have not done a good job in educating the world at large. UDF charges at airports have gone up to 95%. Landing charges at airports have gone up to 34%. And the reason I make this point is this is not being critical, but I think if we truly want India to become a major global aviation market, I think the whole ecosystem has a responsibility to make sure that we have a cost structure that will allow us to compete.
Well, that's Indigo's Rahul Bhatia there saying that by focusing merely on the airline's responsibility when it comes to pricing, we're addressing the wrong question. The issue of price cap is not limited to just healthcare or aviation. Several sectors are grappling with the possibility of regulatory action that could significantly alter their models. To discuss all of this and more, we're joined by Prashant, Nimesh, Ekta and Sriram. Guys, it's great to be here, sitting with all of you after a long time.
No cap, Shri.
No cap. No cap is right. No cap is right. But, you know, Ekta and Prashant, you, of course, just put together that stellar starcast of all the hospital operators to discuss this issue of price caps. And it's not just hospitals or healthcare. As we pointed out, it's a whole bunch of sectors that are dealing with the possibility of the stroke of pen risk today. Prashant.
Absolutely, Shireen. And first of all, great that you're here. I think we should fly down every editor's playbook, I think.
We will definitely need a price cap. We'll definitely need a price cap then.
But I'll tell you, just to give an example, Shireen, I think this was last week, right? There was CNBC TV 18 has been conducting this risk awards with, ICICI Lombard, and I was at that event, and there was a Q&A, and these were all the risk leaders across, all listed companies, large companies, some 200, 250 people in that room.
Across sectors.
Across sectors, right? And there was this sort of, there was a screen, and they were asking questions about, just a Q&A. And one question was, what is the one biggest risk that you worry about? And there was regulatory risk, there was geopolitical risk, and there was a bunch of other options. And I thought it would be because of Trump and whatnot, that perhaps people will say geopolitical risk is a big one. Regulatory risk was by far the one which kind of sort of, won out, right? And I think that kind of speaks to what we are talking about here, which is the fact that, as you I think put it very well, which is stroke of a pen. The risk of just changing regulations on a stroke of a pen. I think businesses are quite worried about. Yeah. I'm going to list out across the board maybe which are the sectors most impacted. But just a caveat before I do that, which is that the case here is not that regulation once set is set in stone, right? You set up an industry and the government wants private capital to come in, and that's the philosophical argument behind. I think if you're a regulator, you'd say, well, it's not as if we want private capital to come in. We want the industry to grow. We want players to come in. Yeah. But at some point, we have to ask who is actually benefiting, and I think that's how the regulators look at it. So it's not the case that, well, these are the rules of the game, and they should never be changed. I don't think that is the point. But in any case, I think we'll get into some of this stuff in greater detail. But just to list out some of the top ones, right? Hospitals, I think Ekta will talk about in much greater detail. It comes up every now and then. I think this is the fourth or fifth instance, but this is in a parliamentary panel report, which is, cap room tariffs. There's, of course, procedure costs, etc. A whole bunch. I mean, I think Ekta has been talking about 300 plus pages as she's gone through all of them.
Probably the only person in the country who's gone through all 300 pages.
and that's a big one, right? And I think we heard from CEOs, etc., which perhaps we play some sound bites out of as well. Airport operators, I think we just heard from Mr. Bharti, which is, I mean, and of course we can discuss and debate and what's the global experience, etc., the pros, cons, how this happens, and is it a strict no? Is it or I mean this is allowed? So we can go into it. Insurance, right? And some of on the distribution side, there is a fair bit of thing which comes up. We're waiting for the distribution reform paper from the IRDAI. It's a little delayed. Dark patterns is something which I think the regulator has been talking about. But again, I mean,
some action also.
Not action yet. It's still in the deliberation stage. But we will see if something does come through there. Power exchanges, right? I mean, I think exchanges are supposed to be a dominant monopoly business, and they're supposed to be money spinners. They are money spinners. IEX is the clear leader, but we've seen what happened. Coupling is essentially, so the nature of how price is discovered is proposed to be changed with the coupling norms. Again, something which we can go into. F&O norms, I mean, again, this is in the interest of public shareholder, the interest of retail investors. I think this week we will get the F5 26 report on what SEBI's own report about their assessment of retail loses money, not loses money, that famous 90% lose money kind of report. So, I mean, some of this stuff is, of course, intended to protect retail investors and, I mean, consumers in that sense. But again, I mean, this has an impact on businesses, which is the exchanges, the brokers, etc. Many of them which are listed. Most of them, the bigger ones, are all listed. The one positive thing, which I think is interesting, is this MDR and UPI, which I think perhaps goes the other way, which perhaps will open up a new revenue stream, which was not there till now. And again, I mean, I think we've seen what's happened with share prices of Paytm. So it works the other way as well sometimes. But of course, I mean, it's more negative than positive when some of these regulatory changes take place. Quick commerce, gig workers. Again, it's an evolving issue. There are lots of consultations which are going on. It's not kind of, set in stone. But I think, there are pros and cons. Convenience, perhaps it costs more if you kind of go in for some of the stuff which is being proposed versus, of course, protecting worker rights, rider rights, etc. So I think whole host. Autos is another area, right? I mean, I think which is, there's the CAFE norms, there's the mixing of ethanol. And, and of course, I mean, there is a pushback against consumers themselves in this particular case, right? So yeah, I mean, so this seems to be this seems to bear out that poll that I started by saying, which is regulatory risk across sectors, perhaps the number one.
No, absolutely. Regulatory risk is real, and we've seen that play out, as far as the online gaming sector is concerned. I mean, with one stroke of a pen, that was the end as far as online money gaming is concerned. And, you want to talk about Delta Corp, Nimesh, and what's happened there?
As what Prashant pointed out, not only Delta Corp. So Delta Corp was one stock, even IEX for that matter. So Delta Corp, I was just looking at the share price from a high of 350, it's quoting at 60 now. And that's across the board, look at IEX, it was quoting at 300, now back to 125. Across even the insurance companies that he's talking about, from the recent peaks, all the insurance stocks in the last 3 years are down 35-40%. And this in the context that the markets have gone up and these stocks have underperformed. So clearly, wherever there is a risk of regulatory overhang, it actually, shakens the investors as well, and people have lost money. Investors have lost big amount of money in all those names.
Yeah, and again, as Prashant rightly pointed out, we're not saying that no regulation, or we're not saying that there should be regulation, cannot change or it cannot be dynamic. I think the question that requires an answer is to do a cost-benefit analysis based on data, because very often what may seem like well-intentioned moves or well-intentioned regulation may in fact end up having unintended consequences, which are then hard to reverse. And that's, I think, the argument that the hospital operators are making, Ekta, that look, don't go by anecdotal evidence, go by what the data is telling you.
Yes, absolutely. But, you have to ask that fundamental question that why exactly does the government want to regulate the healthcare space? That's because private healthcare is basically, bearing bulk of the burden right now. That's around 60% of healthcare is private at this point in time. And the prices are 7 times what you get in public hospitals. So that is the key reason. 70 to 80% of what you spend in terms of cancer care is out of pocket. Your average expenditure is 7.5 lakh rupees. So now patients have weak bargaining power because if it's an emergency, you're not going to check which hospital you're going to. Neither do they have any kind of pricing transparency. It's all opaque. You go into a suite, it's a different pricing. You go to a double occupancy, it's a different pricing. So what the government is saying is that there should be transparency. There should be some standardization. It shouldn't cost you so much to get a PET a PET or a PET CT or an MRI if you have cancer, because that is all out of pocket at the end of the day. That brings you to the question about insurance, because there is this missing middle, 40 crore people, 30% of the population, which are not covered by either government or private insurance. So if you have some kind of cover for them, maybe that would be helpful. And that's what they're proposing, 4,000 to 6,000 rupees in terms of a bracket. Now, the other thing is, the key contention point is there's too much foreign capital which is coming into the entire hospital space, 51%. They're looking at some kind of maybe capping. They're okay with other sectors such as medtech getting, a lot more capital, but they are worried about hospitals getting so much capital. So that is the key reason. Now, we do need them. That's a simple debate that, the bed count is much lower than what the WHO has said.
Exactly. What is the bed count to start with? I mean, the kind of infrastructure build-out that is required to service the needs of the country, I mean, we're significantly lower in comparison to all the global averages, right?
Yes, absolutely. So we are currently 15 beds for 10,000 people. The WHO recommendation is 30 beds for 10,000 people. So who's providing those beds? The private space. By FY30, they're saying 20,000 beds will probably come about. After FY30, there will be more beds which the private space is providing. So they are doing the heavy lifting. What the public or the government probably wants is some kind of guardrails that, yes, you do the heavy lifting in terms of capex, but there should be some guardrails to provide an essential service at a subsidized rate.
Yeah, but I think that begs the question, right? I mean, yes, hospitals, education, an essential service, how do you price it? Can you leave it completely to the market? Or do you need some safeguards in place? But to the point about, how much foreign capital is coming in, the color of money, given the fact that you require all of this infrastructure build out, can we actually take that position of this is how much foreign capital we want in this sector, or this is whether there should be a cap on private equity ownership, which is again something that is being discussed at this point in time?
At some level, capital, I mean, it's not to make this or that, right? I mean, it's not as if private capital, local private capital is very different from foreign private capital. Capital is looking for a return.
Exactly.
They look for profits.
It's looking for returns. The point is...
It's not more benevolent or less benevolent. Yes, they're all looking for returns.
Absolutely. And I think as Ekta pointed out, which is the big issue is this insurance, which is that if you're paying everything out of pocket, then it kind of pinches more. And this, look, healthcare is also, because inflation has been such a big issue for the middle class. You started by Ekta saying that I think compared to government beds, I mean, public hospitals, insurance costs, hospital costs, private hospital costs, some 7 times higher. But the quality of the care or the experience or whatever, right? I mean, you want to call it at the end of the day, which is, I mean, it's just instructive to look at, and I was saying this on the program as well when we had all the hospital CEOs. So we got so much feedback on that parliamentary panel when, I mean, we put out details of what the recommendations were. Our audience, people perhaps who would be watching this, they're all saying, I mean, the feedback was, don't, this is working. This is costly, this is expensive, but this is working. This is all we have. So don't make this not work. Don't break what is not broken. You may fix it and the solutions. And I think all the hospital CEOs made that point, Ekta, which is that, maybe something is required to be done, but is this the way to do it?
Is price cap the way to do it is the question. Nobody is saying that, look, you should be able to charge whatever prices you want. But I think that comes back to the supply-demand issue as well, Ekta. If supply were to outstrip demand, the commercials, the economics would be very, very different. Today, the fact that hospitals are being able to charge a premium, private hospitals are being able to charge a premium, is because you have such a significant supply-demand mismatch, right?
So there are certain pockets where there is a strong amount of demand coming through. So there's Delhi, there's Mumbai, there are a couple of these smaller pockets. But if you look at it, Abhay Soy mentioned that the median age currently is 29. So you will, at eventually those people will become 40 plus. Those are the people who will need those hospital beds. And at that point, that supply will even out. So as of now, you might face a little bit of overcapacity, but that might even out eventually. We do have doctor shortages, we have, you know, nurse shortages. All of that needs to be sorted in the next couple of years for us to have that kind of accessibility, affordability, and that kind of capping in terms of rates because of the demand-supply situation.
You know, I've always, I mean, education and health, right? I mean, it's not about this government or that government. But the point is, I mean, these are, if you're going to end up spending, I mean, look at the uproar every now and then on social media we face on the cost of education, right? Schooling, which has gone through the roof. I mean, you know, we can do a whole program on that. But I think it is something similar, which is the fact that if you don't have the state offering quality education and healthcare at a certain...
And the state cannot abdicate these spaces. The state cannot shirk its responsibility. I mean, we've been talking about this healthcare budget going to 2.5% of GDP for every budget for the last 20 years. And we're nowhere close to that number. Similarly for education, I mean, we did that story the other day where the government's own data is telling you that in government schools, the dropout rate at higher, you know, secondary education is significantly higher than what we're seeing in the private sector. So the government, part of fixing this problem is also to fix government infrastructure, whether it's education or healthcare. But, you know, that apart, let's talk about aviation. And you know, we're 2.5 airlines virtually at this point in time. And as Rahul Bhatia was saying that, you know, you're only looking at what the airline is charging. You're not looking at ATF, you're not looking at UDF, you're not looking at landing charges, which is not what the airline is making at all. So sometimes we're addressing only part of the problem and trying to fix responsibility on one player, whereas it's an ecosystem and a holistic sort of assessment that you need to do.
I mean, I think... I'm not the aviation expert, but I think the aviation fare issue pops up
only when there
is like a crisis, or there's a crunch.
And you've also had checks and balances coming in as far as surge pricing is concerned. The government has stepped in and then it's stepped back as well. So there is a way of dealing with it, and we've seen that that play itself out, as opposed to having a sort of blanket, you know, let's come in and have a sledgehammer approach there.
I think there is I think we're all in agreement here, no cap.
Yeah.
But the point that the government has to...
Does it mean the same thing, by the way, in Gen Z? Does no cap mean the same thing or not?
For no cap for real, I guess. But the point, like you said, I think each case has to be looked at it very differently. Hospitals, I think what is happening is that there is an acknowledgement. I see what the parliamentary panel report has said, and the government's approach towards this is an acknowledgement of a problem that exists.
Yeah.
So I think to that extent, it's welcome. What do you do about it is, like you said, increase supply. And increase supply how? I think it has to come. And I think oil and gas gives us a very good sort of example of an essential sector where you can't let the pricing control go completely haywire. The government has to remain a significant stakeholder in the space and make sure that, it can control prices by being a player, by providing that supply at a reasonable place.
That's what we're saying.
Yes, exactly.
So look, oil is oil marketing companies. They're government companies.
Correct.
We are talking about...
So every time there is an election, they can cap the prices the way they want.
So that's for the government
That's
company.
for the government.
This is for the private companies.
Those are 51% plus owned by government.
Correct. So
Government of India.
similar model needs to come into healthcare and education, both, is what I'm saying.
I have a slightly different view on healthcare. What people are missing out, infrastructure is getting built by the government in some states for sure. Even for that matter, Ekta, you can say more about it. Look at the scheme that the government has put out on generic medicines. Okay, today I can see there are at least 2 or 3 private players who've become really big in the generic market.
Yeah.
And they're actually providing drugs at 80%, 90% lower than the branded price.
Yeah.
Nothing changes. Only the brand, is on the cover and the prices changes, right? So even like for a state like Gujarat, I can tell you with my experiences, places like Baroda, places like Surat, Ahmedabad, the public, the government infrastructure and medical is very, very strong.
Same is true for
and very
Tamil
good.
Nadu and Kerala also.
But again, the problem is because of the perception, a lot of people don't want to go to government hospitals.
Yeah.
Though they are good, though they are well equipped.
This is a very interesting example.
Again, this is a problem as well. There are some good infrastructure created, but people don't want to use it. And they still want to go to the private place because they feel...
there is a perception problem as well. And that is
there are operational issues also.
So what I'm saying is we should not lose the sight on the fact that the government is serious and they're actually providing a lot of supply
and I think
on the healthcare sector.
You bring up a valid point there that, look, the government needs to intervene to create an enabling environment, to facilitate more investment, to facilitate more players to come in. And that is where the government should actually focus its bandwidth and its resources as well as its, stroke of pen possibilities.
In fact, I believe if the government, run organization which is into generic medicines, if they get listed, you'll get a huge market cap for that company.
But Nimesh, the generic medicines, you're absolutely right? I mean, they cost 1/10 of the cost of the whatever branded one, etc. But the point is that where is the delivery of the generic medicine happening? It is still happening through private hospitals. It's happening through public hospitals also. But I'm saying that we don't have enough of those in size,
and there is shortage of supply as well. So I'm not saying that there is enough supply as well, but I'm saying that one leap of faith that government has taken, private is also pulled in. Couple of players have come in and they're actually expanding big time into the generic markets as well. So
I don't think
it's going to be an
medicines is a problem at all.
No, I know it's not a problem, but I'm saying
India has a problem in terms of the cost of medicines. There might be some medicines which cost a lot, but normally all medicines are very cheap in India.
Compared to global markets, of course, it's cheap.
Yeah, so
but generic is
but we've had price caps.
Even there, we were discussing about price caps.
For medicines now for years now, for many years. Yeah, stents came in about 10 years ago.
2017. So it's stents, cardiac stents, knee implants, all of them have been price capped, but then, the procedure costs go up if the cardiac stent prices go lower. So that's basically what the government wants to rectify. That if a person has a cardiac issue, needs a stent, if it's costing 25,000, you can't make up the cost in other ways. You should allow the cost to be low and allow him to have the stent, which is 25,000 rupees, and the entire procedure should be a reasonable cost.
But one interesting question I have. So we are obviously, we don't agree with price caps imposed by the government. But if you have an insurance policy, you know that your insurance provider puts a price cap on a lot of things, right?
In most of the things.
So when in such situations, how do we, why should that cap, I mean, that's a market determined cap. Why can't this become a benchmark and something government builds along those lines? Why is that not acceptable? I'm just thinking out loud here.
This is an important conversation to have. We're keeping it going here on CNBC TV 18. We just had the CNBC TV 18 Market Forum take this up with all the top players in the healthcare sector in the country. We are going to continue to have these conversations. So if you have feedback, if you have suggestions, if you have recommendations on what you believe the government, the private healthcare sector, the private education sector, insurance sector should do instead of price caps, or do you believe that price caps are the answer? Write to us, tell us. We'd like to hear from you and keep the conversation going. But I hope that we don't have to go to a hospital anytime soon or avail of insurance. But on that note, it is time for us to wrap up this episode of the Editor's Playbook. Thanks very much for joining us. Do send us your feedback. We would love to hear from you.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Oil prices remain elevated as the deadlock between US and Iran continues. US President Trump warns that any country offering Tehran a lifeline will face tremendous economic consequences. Iran's foreign minister calls Trump's sanctions threat a diversion, says it would only bring further defeat to Washington. Sensex and Nifty snap a 7-day losing streak. Nifty reclaims 24,400. Rupee weakens marginally against the dollar and remains closer to the 96 mark. SEBI bans Kotak, Mauritius and Mansi share and stock broking from the market, impounds funds worth over 3.86 crores for manipulation during the August 13 closing auction session. The order comes within 24 hours of the SEBI chief warning strict action against any attempt at manipulation.
Regulation will not come on the way of any business activity.
When we first saw the circular, थोड़े तोते उड़ गए हमारे.
NBFC executives warn of ripple effects over RBI's proposed ban on revolving credit. This even as RBI Deputy Governor maintains the new rules will not hamper business activity. Sugar prices hit a record high ahead of the festive season. Government imposes limits on inventory to boost supply and may have to rely on imports for the first time in 10 years. McLaren, Aston Martin, Bentley and other luxury British vehicles will soon get cheaper in India. Government set green flag the import of more than 10,000 vehicles under the new free trade agreement. India and Japan sign a maritime security agreement and deepen defence cooperation. The pact includes information sharing, naval exercises, ship repair and logistics support. A significant breakthrough in the fight against cancer. Pharma companies Moderna and Merck announce a new novel vaccine that prevents the return and spread of melanoma, which is a common skin cancer. Move sparks hope for a wave of vaccines to treat other cancers. US government debt crosses $40 trillion for the first time. The debt has more than doubled since President Trump first took office in 2016. A former safety engineer at Meta testifies Mark Zuckerberg lied about concern over child safety and encouraged growth at all cost on Facebook and Instagram. A California court is hearing a landmark case filed by 29 US states accusing Zuckerberg's Meta of harming children with social media companies that are addictive by design. The top story this evening, US President Donald Trump has announced a major economic campaign against Iran as the war nears the 6-month mark. Here are the latest developments. In a social media post, President Trump said, and I quote, "Any country that allows its financial institutions, businesses, airports or government entities to provide any type of lifeline to Iran will itself face tremendous economic consequences." End of quote. The US president also called on US allies to support Washington's efforts to isolate Iran. Iran has dismissed the president's announcement as a diversion. In a social media post, Foreign Minister Arakchi said, and I quote, "The so-called economic D-Day is a diversion from America's own crisis, unprecedented debt and surging interest costs." End of quote. In the oil market, Brent crude prices remain above the $90 per barrel mark as the US announced effort to put financial penalties on Iran and its supporters. According to shipping data from Kepler, 6 commodity vessels crossed the Strait of Hormuz as of 19th of August. Here's the US president threatening countries doing business with Iran.
Well, we have things that we could sanction. We have very draconian sanctions, and we'll see what happens. Right now, the strait is open. A lot of boats are coming through. People aren't reporting that, and that may slow down a little bit at some point. But right now, a lot of boats are coming through. The naval blockade has been extremely effective. Zero, I mean, literally while it's up, and that's been for quite a while, you know, except for a couple of little pauses where we opened it purposely with a deal. But the deal didn't terminate, you know, the deal didn't turn out to be what they said, you know, when they tell us one thing and they do another.
At least 12 people were killed and dozens injured after Russian ballistic missiles struck Ukraine's capital Kiev. The attack damaged buildings, sparked fires across the city and knocked out power in some parts. A residential building, warehouses and a children's hospital were also hit. Ukraine's President Zelensky calls on Western allies to provide more interceptor missiles. All right, on to the day's market action. Sensex and Nifty snapped 7-day losing streak with Nifty reclaiming the 24,200 mark. Sensex gained over 600 points. The gains were broad-based, but mid-caps and bank stocks marginally underperformed the frontline indices. Market regulator SEBI has banned Kotak, Mauritius and Mansi share and stock broking from the market over alleged manipulation during a closing auction session last week. It has ordered the impounding of 3.68 crore rupees in alleged wrongful gains. Hormaz Fatakia decodes SEBI's observations on how the two companies allegedly manipulated the CAS system.
There's a big order that came in last evening, and this came in very, very quick time, in just 3.5 sessions of what transpired last Thursday on the 13th of August. SEBI issuing an order against these two entities, Copthall Mauritius Investments and Mansi Share and stock brokers. Their gains were impounded. They were barred from the stock market as well, and many other steps that were highlighted by SEBI in its order. Now, they say that the price manipulation took place during the last 10 minutes of the Sensex weekly expiry, which took place last Thursday, and the gains that have been impounded include almost 3 crore rupees for Copthall Mauritius and close to around 72 lakhs for Mansi Share and stock brokers. And now take a look at what has happened here is that both these entities have now been banned from the market pending probe, and they can't operate in the cash as well. Now take a look at the chart which SEBI has highlighted in its study. It highlights 3 important points where there spikes were taking place on the Sensex. The first spike, which took place at around 320, saw the Sensex move up by 362 points in just 2 seconds. 5 minutes later, there was a drawdown, and once the drawdown took place, we'll get to that as well, there was another spike that took place. In just 12 seconds, the Sensex moved 133 points. And then came the last big one. In 28 seconds, the Sensex went up by well over 400 points in that last spike, which took place around about 3:25 and 3:26 p.m. And in between all of this little drawdown that you see, that was also took place between 3:21 and 3:26, where the Sensex moved from 77,991 to 77,893. But it was interrupted by that spike which took place, causing that temporary deviation to take place. Now take a look at what SEBI has observed in the activity of Copthall Mauritius during that period. Now, the first spike had Copthall Mauritius placed 32 out of the 86 limit buy orders worth around 66 crore rupees, and around 99% of those shares value. All of these orders were placed at a 3% reference price higher, and for all the Sensex constituents at the same time is what SEBI has highlighted in its order. For the second spike as well, 108 out of the 165 orders were placed by Copthall Mauritius, and 32 out of the 176 in the third spike were placed by the entity for all Sensex companies, 3% above the reference price, all of them at the same time. Now take a look at what it has observed for Mansi Shares and stock brokers. Between 321 and 326, sell orders were placed at a lower price. They were worth 145 crores, and these orders were cancelled between 326 in a matter of 3 seconds, and these cancellations led to the Sensex IEP going up by well over 230 points during that period. What they have also observed is that there were 6 stocks on the Sensex where Mansi Shares and stock brokers had placed sell orders worth over 100 crore rupees. They included the likes of Reliance, SBI, Eternal, ICICI Bank, L&T and Infosys, and these orders were placed 1.5 to 3% below their reference price, and 99% of those sell orders were cancelled during cash, is what SEBI has observed. And therefore, it prompted SEBI to come to a conclusion that these sell orders were prima facie meant to suppress the Sensex IEP instead of performing a legitimate sell transaction. And therefore, in this order, it has also barred these entities from the market. They have given them 3 months to liquidate all of their derivative positions and many other steps that have been highlighted as well. So a big order in very quick time, and SEBI has, with this order, it has definitely given out a message that not just cash is here to stay, but the regulator means business as well.
Thank you, Hormaz, for that comprehensive update. The National Stock Exchange is gearing up to go public next month. The IPO is likely to be launched by the second half of September. Sources say the NSE is likely to seek market regulator SEBI's permission to allow its stock to trade on its own platform under the permitted to trade category. Currently, 144 companies listed on the BSE are permitted to trade on the NSE. RBI Governor Sanjay Malhotra defended the decision to end the special swap window for foreign currency non-resident deposit scheme a month before it was originally planned. Speaking to the Financial Express, Governor Malhotra said the decision was data-driven and well thought out. He also added that RBI expects inflows worth $80 billion from the 3 schemes introduced to attract dollar deposits to shore up the rupee. NBFC executives have warned of ripple effects over RBI's proposed ban on revolving credit. In an exclusive conversation with CNBC TV 18 at the Banking Transformation Summit, CEOs from India's top NBFCs called for a more cogent interpretation of RBI's draft circular. Speaking at the same event earlier, RBI Deputy Governor S.C. Murmu assured that the draft was only clarificatory in nature and would not impact NBFC businesses.
Actually, this is not a new regulation. It has been there all along. Okay. Revolving credit as such was not permitted even now for NBFCs. But what we are proposing in the draft is we are trying to bring more clarity. Our regulation will not come on the way of any business activity. So that is very, very important for all of us. The idea is not to prevent anything. Idea is to do business in a certain way, keeping in mind the risk.
In original form, when we first saw the circular, थोड़े तोते उड़ गए हमारे कि यार ये क्या है? So I really hope that the way the industry first read the circular is incorrect, and the interpretation that I'm hearing now is the correct one, that it is supposed to be clarificatory in nature with respect to definition of businesses and processes. But if it were read in its original form or to the letter, it would be very disruptive.
Very cogent interpretation is needed as to what it touches and what it does not touch. I think the Deputy Governor's clarification in the evening gives us a ray of hope. But, you know, the total outstanding that we're talking about is anywhere between, you know, the numbers vary, but I think it's ballpark between 1.5 lakh to 2 lakh crores that have this sort of structure.
From an SME perspective, this does not bar invoice discounting. There is a license of factoring which RBI has issued, and we are one of the factoring licenses, and we do it we have a decent sized book. So it doesn't discount, it doesn't bar us. So I really feel the problem is the derivatives of personal loans, right? Where OD getting converted into EMI after 3-4 years. And it would have, I don't know the numbers here which he's talking about.
1.5 lakh to 2 lakh crores.
It could be bigger, is what I sense. But FIDC would have the number. We've not gone deep onto the number. But this will have a huge ripple impact on those borrowers.
My understanding, what we do at Navi, we are largely PL. We always say that every underwriting is a fresh underwriting. So if a customer has come to you, you have given the loan. Now the customer is coming again to you. We do a fresh underwriting like the customer is coming to us first time. It's only that you have more data because he has served loan with you, so you know the customer better. But you assess that customer at that point of time as if you are assessing a fresh customer. That is there. Having said that, I think other ecosystem, if the interpretation would have been the worst possible, what we were thinking, it definitely would have hit that. But I believe that the industry is very resilient. See, ultimately, the point is that if NBFCs continue to lend someone over a period of time, it means they believe in the creditworthiness.
Now, the big headline that we are tracking, U.S. government has surpassed $40 trillion for the first time after hitting a record $39 trillion in March. It has more than doubled in a decade. Now, the debt stood at about $19.4 trillion in 2016. Borrowing costs have soared as the U.S. federal government is shelling out more on defense, Social Security and Medicare than interest payments. According to the Treasury Department, U.S. finances recorded a deficit of $432 billion in July, the highest monthly figure since March 2021. The shortfall is nearing $1.8 trillion for the year so far. Premium British cars like Aston Martin, Bentley, Jaguar, Land Rover and Rolls-Royce will soon carry a cheaper price tag for Indian roads. We learned from sources that the Indian government will shortly issue an order to pave the way for the concessional duty import of over 10,000 UK vehicles under the FTA. Abhimanyu Sharma is here with the details. Abhimanyu.
India is set to shortly green flag the import of over 10,000 cars from the United Kingdom under the FTA between both the sides. Cheaper British premium cars like Aston Martin, Bentley, JLR, McLaren and Rolls-Royce are going to cross yet another lap in their journey to Indian roads. Sources have indicated that the government order is expected in a week to allow imports of 10,480 British automobiles in 2026 as per the India-UK Trade Pact, and India is going to issue the order for allocation of the tariff rate quota under the FTA. Now, under under a TRQ order, the government allocates import quotas to importers under yearly allocation limit as per the Trade Pact. No duty cuts will be made in the first 5 years of the Trade Pact for British EVs, hybrids and hydrogen vehicles priced below 40,000 British pounds. Under the CETA, import duty on 3.78 lakh conventional engine passenger cars are going to fall from 110% to 10% over a period of 15 years. India had opened the application window over a period of 15 days last month for 27 tariff items for the calendar year 2026. It remains to be seen what's going to be the kind of response and which exactly will be the cars which are going to be imported into India from the United Kingdom.
Right, thank you, Abhimanyu, for that. A quick look at other headlines. The promoters of Rishabh Instruments are eyeing a stake sale with controlling interest in the company. Sources say that they are in talks with multiple suitors, including a German entity. The promoters are likely to sell a big chunk of their near 70% stake. They could seek a deal valuation of over 3,000 crore rupees. The energy efficiency solution company is yet to respond to CNBC TV 18's query. India and Japan have signed an agreement on maritime security. Defence Minister Rajnath Singh held talks with his Japanese counterpart in Delhi. The two countries also discussed boosting defence technology ties. The pact includes information sharing, naval exercises, ship repair and logistics support. This comes weeks after Prime Minister Modi and Japan's Prime Minister agreed to strengthen defence ties. Top Indian ministers met Singapore's Prime Minister Lawrence Wong to review progress under the comprehensive strategic partnership between the two countries. Finance Minister Nirmala Sitharaman, Commerce Minister Piyush Goyal and External Affairs Minister S. Jaishankar were part of the Indian delegation at the 4th India-Singapore Ministerial Roundtable. The talks focused on key areas including advanced manufacturing, connectivity, digitalization, healthcare, skill development and sustainability. Starlink has reapplied for a fresh regulatory approval in India for its satellite network. According to reports, the company has sought approval to deploy nearly 30,000 Gen 2 satellites in low Earth orbit. The company reportedly also plans to bring technology designed to allow phones to communicate with satellites without the need for a mobile tower or a separate dish. A relief for JSW Energy in a tariff dispute with the Maharashtra State Electricity Distribution Company. The appellate tribunal dismissed the petition filed by the state power distributor after the state regulator termed its own order wrong. Now, the appellate tribunal termed the regulator's submission as unusual and unconventional. The move provides a 600 crore rupee relief to JSW Energy. And on that note, we'll take a short break. Coming up next, a significant breakthrough in the fight against cancer. Pharma companies Moderna and Merck announce a new skin cancer vaccine. Welcome back. You're watching Business 360. The big global story of the day. China has sentenced Evergrande founder Hui Ka-yan to life in prison over financial crimes, including fundraising fraud and illegal extension of loans. His sentence comes 5 years after the firm's collapse triggered a property crisis and rattled financial markets in China. Once Asia's richest man, Hui pleaded guilty to 8 charges in April this year. Evergrande and its real estate arm have been fined a combined $2.4 billion. Pharma giants Moderna and Merck have announced that a personalized vaccine reduced the risk of recurrence and spread of melanoma, a common form of skin cancer, in a late-stage trial. The move has sparked hope for a wave of vaccines to treat other cancers. Moderna shares rallied 177% in trade on the back of this news. Ekta Batra gets us more.
Well, yes, Moderna shares surged 177% yesterday, the biggest ever one-day gain for that stock, while Merck rose 12%. The reason? Encouraging results from a personalized melanoma cancer vaccine. Merck, which is the maker of Keytruda, the cancer drug, and Moderna announced positive phase 3 results from a trial involving over 1,100 melanoma patients. What makes this particularly interesting is the technology. The vaccine uses mRNA, which is the same science behind Moderna's COVID vaccine, but instead of training the immune system to fight a virus, it trains it to recognize and attack a patient's own cancer cells. And this is personalized. Doctors remove the tumor, analyze its genetic mutations, and use that information to create a vaccine which is specifically for that patient. Earlier data was particularly encouraging. The vaccine combined with Keytruda showed a 49% lower risk of reoccurrence or death versus using Keytruda alone. Now, melanoma accounts for around 3.38 lakh new cases globally each year, and India sees an estimated 5,600 cases annually. But this is not a treatment which is available just yet. Moderna and Merck still need to take the vaccine through the regulatory approval process. If approved, though, this could be much bigger than melanoma, potentially opening the door to personalized cancer vaccines for several other cancers, say experts.
Thank you, Ekta, for that. Moving on, a former Meta safety engineer testified that Mark Zuckerberg lied about his concern for child safety and pushed growth at all costs on Facebook and Instagram. Arturo Bejar's testimony comes as a California court hears a landmark case filed by 29 US states accusing Zuckerberg's Meta of designing its platforms to be addictive and harming children in the process. Rachna Dhanrajani has the latest from the trial. Rachna, please take us through the key developments.
Day 2 of the Meta child safety trial in Oakland, and the session belonged to one man, Arturo Bejar, a former Meta safety engineer and the state's most important witness in this case. Bejar isn't an outside critic. He spent 6 years building child safety tools inside Facebook, and he told the court he did not fully understand the danger to young users until his own 14-year-old daughter joined Instagram and began receiving sexual solicitations and explicit image from accounts she didn't know. He said he found it shocking. He came back as a consultant to try and fix it, but left believing that he could not. His central charge is aimed at Mark Zuckerberg. Bejar told the court that he interacted with the CEO dozens of times and that when Zuckerberg had publicly denied that Meta put profits ahead of safety, he was not saying the truth. Bejar's answer under oath, calling that statement is not an accurate one. He went further on the product. Autoplay, like counters, infinite scroll, inherently unsafe for teenagers, he said. And Meta's own safety features, he argued, were designed to fail. Tools like Instagram's quiet mode are optional settings, not defaults. Most people never switch them on. It's like having to turn on the airbag every time you get into the car, he said. But Meta landed its points on cross. Its counsel asked whether Bejar had actually solved any of the safety issues he worked on. He conceded he hadn't. Then a sharper thrust. When Bejar was consulting for Meta, his own daughter, then 16, set up a public Instagram account to post about cars. That is Meta's defense in miniature, that this is hard and not sinister. 6 weeks of testimony to run with penalties in play from $193 billion all the way up to $1.4 trillion, which is almost up to Meta's market cap. But the argument is now clear in this case, that this case is about defaults and design and not the content.
All right, thank you, Rachna, for that. With that, it's a wrap on this edition of Business 360. More news and updates continue right here. Thank you for watching.
25 push-ups every day non-stop without a break.
I can do some.
Let's do it.
Okay, on the knuckles. I can keep doing it. I did 70, 80.
How do you define impact investing?
I was taking very high risk for undefined return.
How many portfolio companies today?
87 we have invested. Running portfolio companies around 40, I think. The number of entrepreneurs that are coming and being successful from Jaipur or Indore or from Banaras, you have angel funds existing everywhere. In Telecap, our advisory business is the brain. It has to do the thinking. Capital is our blood, whatever we do. Our heart is Avishkar Capital, which actually pumps the money.
50% of your money is in deep tech today.
Because we realized very quickly this is where the world is going, and the impact of that is in geometric progression, not arithmetic. The world requires $2.5 trillion of capital every year. We have to just sacrifice 0.5% of growth on that capital to change the world. If I, as an impact investor, do not participate in it, what is going to be my value? We are able to stand on our feet today not because the world believes in us, because the Indians believe in them. If an entrepreneur is trying to break his leg, you just tell him, your leg will break, you will have a lot of pain, but don't stop them. Acceptance of mediocrity is one of the key criteria for being a senior person in Avishkar.
Acceptance of mediocrity, is it?
Otherwise, you would have been an entrepreneur.
He grew up across Rajasthan, trained as a forester and spent over 3 years working deep in the forests of Odisha. Then came a move to Ahmedabad, where working with grassroots innovators and farmers in Gujarat changed the course of his life and eventually led him to pioneer impact investing in India. With 5,000 rupees in savings and 1 lakh rupees as a loan from his wife, he set out to prove that capital could deliver both commercial returns and social impact. 25 years later, that experiment has grown into the $1.3 billion Avishkar Group. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. Founded in 2001, the Avishkar Group today spans impact investing, financial inclusion, MSME lending advisory, and the Avishkar Foundation. Its investments and businesses cut across agriculture, financial inclusion, climate, essential services, and increasingly deep tech. The group says its interventions have impacted more than 140 million underserved people and supported millions and millions of jobs. Now, as Avishkar looks to deepen its bets on deep tech, advanced manufacturing and climate, the question is, can impact investing deliver both commercial returns and transformative scale? Joining me now is Vineet Rai, the founder and vice chairman of the Avishkar Group. Vineet, 20 years on, it's great to have you back here on Young Turks. It's good to see you.
Yeah, it was, I was worried you would disclose our ages or not, but yeah, 20 years.
But that's life, right?
That's life, yes.
And so much has changed. I still remember, back then when you started, and of course when we first started talking to you, this idea of impact investing. I mean, people would still ask you, kya hai ye? Corporate social responsibility hai, charity hai, philanthropy hai, ye kya hai? Are you still getting asked those questions?
Yeah, I think the fun part was the word impact investing did not exist, actually. Yeah, so 2007, and a lot of people across the globe do not know that it was pretty much invented in partnership with us. And the reason was not to deliver impact. And I think that debate continues, but the reason was to actually convince people with money to have a line, because there is an allocation. So as you become institutional, you have VC, private equity, debt, real assets. So we needed to find a way to get into a line, which goes to people who are taking extraordinary risk, not for the highest return, but unknown returns on unreal. I mean, we basically do not know whether your business will deliver high return, low return, or no return. So it was not high risk and high return, which was VC's definition. So I needed a line, and I went to Rockefeller, and along with Rockefeller, some other people like Willie Foote and others from Root Capital, we convinced Rockefeller to call a meeting in Bellagio where we came up with the term impact investing, and that's how the term got coined. But the debate remains of what is impact and what does capital do, and I think it's simple. All businesses make impact, but there are few businesses where you go with the intent of bringing about a change, and that's what impact investing is.
From the vantage point that you enjoy today, what do you believe has changed the most about the lives of the people that you're trying to impact? How has India changed in the last 25 years for you?
So in 2000, if you ask somebody, what do you think your children will do? Said, अच्छा पढ़ाऊंगा और हमसे बेहतर जिंदगी जिए. If you ask today the same question, the aspiration of a person living in the remotest part of India, in a village, and the child living in Delhi or Mumbai coming from a rich family is not very different. So the pyramid of aspiration, the flattening of the pyramid of aspiration is probably one of the biggest achievement we have had. The second is, of course, with artificial intelligence, everybody has the power to be intelligent and articulate. Two things that used to create a class division. So I may have an aspiration, but I would not be seen as the right guy for it. Today, I have that intellectual capability as well. And I think the third pyramid is the resource ones. And I think these three things played a very important role. So today's India is very, very different from anything I lived through.
You know, since you talk about India being very different from the time that you started Avishkar and from the times that we grew up as well, but you talked about flattening of pyramids. Really, has the resource pyramid seen any kind of flattening?
So resource pyramid, I think, is still probably exist, and I'm hopeful in next decade it may flatten. And that would require three things. One, I think some of the initiatives that the government is taking, pushing the capital out and pushing people like us who are managers of capital to take it to the farthest places. So that's actually a very critical and important, whether it is the RDI fund or the SIDB's fund of fund, etc. It's pushing and forcing us to actually democratize entrepreneurship to some extent. But the second part is going to come from, and which is already happening, and I can see it, in the remotest part of India today, you have angel funds. The number of entrepreneurs that are coming and being successful from Jaipur or Indore or from Banaras or Lucknow for that matter, you have angel funds existing everywhere.
And it's not family friend money.
It's not family friend money. These are people who don't even know who they're giving money to. And of course, there is all kinds of incubators that have mushroomed up. Again, a government policy. Some of those incubators are land and building, which I have been always very critical about, that land and building do not create incubators. It is the intel inside. You need to have something inside that will create it. But what it has done is made, and of course, you can give credit to some websites, I won't name them, but not TV shows, let me not call websites, who have made the whole entrepreneurship journey very exciting, at least from a cinematic perspective. So there is massive belief, and some of the work some of us are doing, I mean, Mekin Maheshwari is doing through the education and entrepreneurship, and some work that we are doing in Eastern UP.
The AUM that you currently sit on, what is the aspiration that you now have for 2030, for 2035? I mean, how large is the risk appetite that you enjoy today?
I mean, I started in 2001, 5,000 rupees, 2 decades, 2020. We were growing 70% year on year. I was one of the cockiest person around, walking like a peacock. And then came COVID, brought me down on earth. And we had a review last year. It's our 23rd year, because technically we started in 2002. And UK Sinha, the chairman of the group, actually said, Vineet, you guys are driving a car with a view mirror on. For 20 years, you were the highest risk taker. With COVID actually slapping you hard, you guys have lost your mojo. So please do not plan by what happened. Recency bias has become so much part of your journey that you have to shrug that recency bias. So we had a senior offsite, and he actually made this comment, and that pushed us to rethink. So we spent 8 months with our senior team to plan. So Avishkar is looking to go from $1.3 billion to $10 billion by 2035, roughly 1 lakh crore. And this $10 billion is focused on Asia and Africa, with India as the center of it.
You know, the kinds of businesses that you invested in the last 25 years to now the sorts of businesses and the sorts of entrepreneurs that you want to bet on and invest in. Is there an investment thesis change?
So impact is our screen. So anything that has to get into the Avishkar court has to jump over a screen called impact. So, for example, there was a company that is sending satellites. Now, in 2017, we looked at that company and we could not convince ourselves that it jumps the satellite of impact. I mean, how will a satellite actually create value for poor people? But today, that company is actually sending a certain quality of imageries that is changing the way how farmers are farming. Now, it's just that we restrained ourselves from visualizing the image that the entrepreneur is selling us. So my first learning is, and again, I'll go back to the pyramid. Like I talked about capital aspiration, there is a pyramid of intellect also. There's the intellectual pyramid. In the pyramid of intellect, the entrepreneur sits at the top. I am a fund manager, I am a mediocre guy. I sit in the middle. And then those who give me money are at the bottom. They are the base of the pyramid. The moment you reverse it and call it what is the pyramid of resource, the person who gives me money sits at the top. The mediocre me sits in the center. And the entrepreneur is right at the base. I learned it that my power is actually, which I keep repeating, Begani Shadi mein Abdullah Devana. I need to actually take somebody's money and give to somebody else. And the best thing I can do is try to believe in the vision of the entrepreneur. Of course, we have to validate the vision, but the entrepreneurs know what they are doing. We have to validate whether he has the skill, capability, maturity, and ability to crowd in capital. And once we do that, our job is to tell him, be a voice, whisper in his ear. For example, I keep telling my friends, that my colleagues, that if an entrepreneur is trying to break his leg, you just tell him, your leg will break, you will have a lot of pain, but don't stop them or break their finger. Do not let them break their neck. The only thing we don't let them do is don't break your neck. But whatever else you want to experiment with, please do. Be judicious and smart. The other thing that we focus on is the entire paraphernalia around it, which allows you to grow an institution. Governance, systems, how do you bring people, deal with ego and other issues. So that's really what we try to do. And ultimately focus on the entrepreneur and not try to be too intelligent. Acceptance of mediocrity is one of the key criteria for being a senior person in Avishkar.
Acceptance of mediocrity, is it?
Otherwise, you would have been an entrepreneur.
But financial services, that's a large part of the work that you've been doing. You've been a co-creator of the MFI ecosystem here in India in many ways. And today, deep tech, AI, I mean, people would not necessarily have seen AI investing from the impact lens. And that's quite a transition and a shift, isn't it?
AI is the biggest shift in technology human history has ever seen at the pace it is happening. Now, if I, as an impact investor, do not participate in it, then think about what is going to be my value, because this will impact 95%, 99% of the humanity. One day, I was sitting in Arohan's board meeting, and they played a robo talking to one of our women in Bhojpuri. This was a voice, it seemed like, I could see that, but the voice was very good talking in Bhojpuri. This is a company called Gyani.
Gyani, yeah.
And I said, so who made this? And my colleague said, oh, this is a company called Gyani. So we said, oh, now a company in AI is talking to 2.2 million women in their local language. Yeah. And it is difficult, because the latency is so low, it is difficult to actually believe that this is not artificial intelligence. So I started digging, spending time, trying to see what is foundational level. And finally we realized, man, this is going to influence how women are actually going to be financially included.
Yeah.
So impact and technology, and how technology will impact, make impact, you cannot predict without actually being part of it. And that's why we have gone into deep tech as well, because some of the problems cannot be solved by us putting in a lot more effort. It has to be technological. And that's what Avishkar is doing.
most exciting thing there for you from an entrepreneurship point of view? The stories that you're seeing, the places where these young founders are coming in from, how much of that has surprised you today? The ambition and the audacity.
I met this very young boy. I mean, he looks younger than what his age is. 24. Name is Jainul Abedin. He knew that I come from that area, so he met me and he said, "Sir, I have made a rocket propulsion engine." So I sort of looked him up and down. I said, "Where are you from?" He said, "मैं देवरिया से हूँ." "कहाँ से पढ़े हो?" "गोरखपुर से पढ़ा हूँ." "रॉकेट प्रोपल्शन इंजन कैसे है?" "नहीं सर, बचपन से यूट्यूब देखता था, मुझे तो रॉकेट बनाना था." Now this 25-year-old, his company's name is Abvyom, Above and Beyond Vyom. Vyom is the universe. And he's actually been picked up by BITS Pilani Hyderabad Center. His rocket propulsion engine, the heating thing, because it basically throws up very high heat, has actually been, I think it is being acquired by some of the IITs for training the students to what kind of rocket. Now this level of ambition coming from a boy whose father lost his job, brought them back from Calcutta, put them into a village, watching YouTube to actually become a successful entrepreneur. I was just amazed by this boy and his younger brother who came to meet me at Sankalp in Lucknow. Amazing capability. I mean, I was just stunned by the quality of thoughtfulness in a 24-year-old and the 13-year-old who met me. Just beyond belief.
We're now in an era of tribalism, and might is right is going to define the next 10, 15, 20 years. In that, how do you then see India playing the game?
From a country perspective, I think what we are seeing right now, India will have to create its own tribe. And in that tribe, there will be all kinds of people. We need to find how we can make our tribe bigger. And if we are able to successfully make this tribe, and we will have very contradictory positions in this tribe. On one side, we may have a country that others hate. And on the other side, we'll have a conglomerate of countries who desperately need us because our markets are large. I think there will be a give and take, but that tribalism is actually going to be clearly the definition of a multipolar world. Now, India's foreign policy today talks about a multipolar world. Somebody who's actually raising money across the globe, I can tell you, there is a direct resonance of what India's government says to people like us who are fundraising. And I have gone through that challenge so many times. You won't believe it. India's defense purchase of an aircraft actually has an impact on Avishkar's ability to raise capital.
Really?
Can you believe it? So we have to answer those questions when those kinds of decisions are taken. Because the government of the country that has just lost that contract says, why should our money go into changing India's future? We are all ambassadors of our country, beyond an ambassador of Avishkar. And every consequence, every decision taken at the country level actually then reflects on us and what we say and what we do. I have taken a position that I will be slightly more provocative when I engage outside. And it has cost me quite a lot of money.
You know, but this is a real challenge, as you point out, and increasingly we are in a fractured, fragmented world. Given that challenge, do you then start looking inwards? I mean, we've all been talking about this big domestic unlock, and we have seen that play out over the last few years, especially in the last few years. But is that going to be enough?
We are able to stand on our feet today, not because the world believes in us, because the Indians believe in them. And because Indians believe in them, the world will believe. So we will have an off and on FDI story. I mean, the chief economic advisor did talk about a flow of capital. We have people saying that India's FDI, I mean, for all the private equity money is also long-term FDI, not FDI. But you take all that into account and you still know that some point of time the world will have to find answers beyond their own shores, and there is no larger market in the world. So if we are able to do three things, which in my mind is very important, the first and most important is we have to start taking our laws very carefully. So when we actually make changes, shouldn't be knee-jerk. It should be consistent. Any of the decisions, if we don't like something, stop it nip it in the bud, don't allow it to flower for some time, and then randomly take a very strong decision. Because what it does is it actually tells you that you are an emerging economy, but an emerging economy that actually has laws that go up and down. Now, that actually destroys our credibility in the world. And that credibility is very important in today's world. So when the foreign capital comes, it is not coming really thinking how much rupee will depreciate, etc.
Yeah.
That is always factored
They
in.
want predictability.
And the word predictability is so important in global markets. So we need to be predictable about our laws, about our regulations. We need to be a little more efficient on time. The world is bureaucratic, so I'm not saying we have to become absolutely so transparent that everything happens. We are a large country, so we'll have our own complications. But if we can actually just reduce the cholesterol, bureaucratic cholesterol a little bit, 10% also, it will be a massive change.
So what is the global ambition now? I mean, to that $10 billion aspiration that you've set out, how important is expanding your global presence going to be?
So our vision was that we exist to bridge the opportunity gap for the other 3 billion. Now, so 3 billion means beyond India. India is 1 billion comes from Africa, so 2 billion. And then there's a bit of a Southeast Asia. We had always in our imagination Latin America, and I have, by the way, personally got very... So what we are doing in Latin America is inspiring people to do things on their own, and we are willing to support them, not going there ourselves. So I think I have a Mexican delegation coming in January who wants to pick certain part of our business and take it there. So.
How does the profit matrix differ when you're looking at it from an impact investor's point of view? Is 5% good enough? Is 10% good enough? Is 15% good enough? How do you look at your return on investment? PE says 7 years is what our timeline is. VCs are pretty much around the same. What is the kind of return on investment timeline that you now, in your assessment of having done this for 25 years, believe is the right way of doing it?
So first I must confess, whether it is VC, venture capital, or people like Avishkar who are impact investors, we all have yet to consistently deliver returns of the kind that we promise. So confession for my whole industry, we need to actually do more to do it. But then this is unfortunately how the evolution of the evolution of the whole market, the kind of IPO, for example, the kind of IPOs we are seeing, we never saw it. So 2020 onwards, the world has changed for us and we are seeing exits, etc. It takes time. In case of impact investing, my personal learning is that if I want to pick somebody from Samastipur and make that person reach 400 crores, it will take me 12 years to 14 years. If I pick the same person from IIT and take him to 400 crores, might take 4.5, 5 years. So that 10 years is actually the problem of impact. It is not about returns. The returns we can deliver high. It is the time. And so generally, I say impact investing means you have to be very patient. But at the same time, the ideas around technology is changing that. So once you bring technology, and if somebody is coming from area where you want to do it, and if they bring some technological innovation, then you may crunch the timeline. Having said that, then you run into a new trouble. Generally, the aspiration of people gets down as they actually, if they have seen a very different world, they have not seen the ambition, or they don't believe they need. So let's say my ambition ends at 100 crore. Then the moment I reach 100 crore, I say, then why do I need to work hard? Now let me actually relax. And so the problem that we as impact investors face is we are trying to find solutions that can solve complex problems
at scale.
At scale. And sometimes our ambition itself becomes our challenge, because that ambition means that you have to continue to scale. The entrepreneur may lose interest. And then we think, oh my God, if this guy sells, then it may lose its mission, et cetera, et cetera. So there are many different things comes into play. It's a complex engagement that continues. My funds I have returned a fund. The fastest I have returned is in 11 years. 11, 12, and 13. So these are the 3 years. So this is when we have taken more time. I'll be also very honest, a lot of VCs have also taken the same time. So I think our returns on the funds have been, we have returned MOIC, multiple of invested capital, has been 4.4 to 2.1. If we can do this within 10 years, then I will deliver you 25% IRR. The problem is I have not been able to do it in 10 years. So the moment it becomes 12 years, then the same MOIC will deliver you a return which is 18%. And I think we have built the skill set now to crunch the time to 10 years. I think the ecosystem has also changed, the capital that is flowing in.
So let me end by asking you, Vineet, in the next 5 years, given the fact that you're reclaiming your mojo, what can we expect? What's the list of priorities as far as the Avishkar Group is concerned?
I think we have an IPO coming within the group. We have filed a DRHP, we are hoping. So I hope and pray that IPO goes well. We have a 2,500 crore fund that we are raising, hopefully by the end of year. We have a global fund that invests in Africa, Asia. It has to reach its final close at around $200 million, that to happen. But more importantly, my colleagues, and I have some of the best people who have been with me for 15, 20 years, Anurag Agarwal, Atreya Rayapurlu, Manoj Nambiar, who's my vice chairman and my successor as well. Vikas Bali, the CEO of Intellicap, extremely conservative guy. I would like him to be sitting here. But brilliant people who made their choices to be with me to build this up.
Vineet, we wish you the very best of luck with the IPO, with all the priorities that you have for the Avishkar Group. Are you going to leave us with one of your favorite quotes?
So my father has this saying, I used to say, Father, Dad, कुछ है saving आपके पास? तो बोलते थे, पूत सपूत तो क्यों धन संचय, पूत कपूत तो क्यों धन संचय. If your son is great, why do you need to actually earn for him? And if he is really bad, then whatever you learn, he will spend in any case.
So why bother saving?
Why bother saving?
Well, that's a good one. That's a good one. All of us need to take note of that, and that is good advice coming there from your dad. With that, it is time for us to wrap up this edition of Young Turks Reloaded. As always, send us your feedback, your questions and comments. We always like to hear from you. Till next week, from all of us here on the team, goodbye and thanks for watching. Very few of the NTLFs that have always been virtually a permanent fixture there. So it's great to be back here in partnership with NASSCOM to address an issue that is causing significant anxiety at this point in time. But as Naushir was pointing out, it is also an era of opportunity. The question, though, is will Indian IT services make the pivot that is necessary as of today? There's been a lot of talk around the market cap erosion that we've seen from the 2024 peak. We're down 15 lakh crore rupees for the IT services industry in terms of market cap. And the question that's being asked is the market mispricing the anxiety at this point in time? Is there something that Indian IT knows that the market doesn't seem to know? Because when you talk to these guys, they're all basically telling you there is that $300, $400 billion opportunity, and that's the kind of value creation that we hope to accrue. So where is the dissonance is the question that we want to talk about. The other aspect that we do want to address is that if there is this $300, $400 billion opportunity that opens up by 2030, which is estimated, where does the value creation lie for the Indian IT services sector, and what changes will they need to make structurally in order for them to be able to leverage and gain momentum of that market opportunity that presents itself? There is, of course, the issue that Naushir mentioned, and that is the decoupling that we are seeing between revenue as well as headcount growth, and that has been something that we've seen accentuate and accelerate over the last few years, and it is flat, as Naushir pointed out, at this point in time. The other big question, though, is growth, and are we in this single-digit growth trap for the foreseeable future? Are the double-digit days, is that era a thing of the past, and do we need to recalibrate the growth aspiration that we have? There is, of course, the global story that's playing out, the OpenAIs and the Anthropics of the world, and what that potentially means in terms of this industry specifically. AI monetization, how quickly will that be able to outpace seat cannibalization? I think that's one of the big issues up for debate and discussion. Well, I've got a fabulous panel here to address those issues. So without further ado, Rajesh, I want to start by talking to you. 15 lakh crore rupees gone in market cap erosion since the 2024 peak. What is the market not appreciating about the story? Indian IT, as Salil Parekh told me in our interview recently, Indian IT abhi zinda hai. Why is the market not appreciating that?
Absolutely zinda hai, but I think it's important for us to note a couple of things. One, if you ask anybody in the room, and if you look at the last quarter results of all the companies, the top one included, the medium ones, of course, grew. When you look at the top ones had about 3% year-on-year growth. The medium tier, and many of the companies which actually did fairly well at 9 to 12% of growth, and the smaller ones actually even had higher growth. But more importantly, when you go back and look at the order books, almost all of them had the largest order book ever in the history of this industry. So they've all been doing really well. On the contrary, as you rightly mentioned, all of them had a headwind from the stock market point of view. I do not know how the stock market valuation happens, so I can't really comment on what they do. But I can always tell you one thing. They always price for the worst case, and then when they look at the terminal value, they want to make sure that whatever they are seeing on the order books, whatever the story that we've been sort of saying for the last 1 or 2 years, holds good for the long term. I know that they're sort of looking at these numbers, and occasionally you'll find that because of the green shoot that we produce as an industry, there's suddenly a sort of a shoot up of our numbers and so on.
Yeah,
but that is what
you're
it is.
18% off your lows.
There you go.
Yeah.
There you go. So that is, in some sense, so I think quarter on quarter, if they are able to put the proof points on the board, I personally believe that. Will you see an aberration? Absolutely, yes. I think there is going to be a bit of an aberration when you see that this industry will go through bad times before it gets better, as I always say. So I think we're going through that turf at this point in time. But I think in my mind, if you're what we are seeing around the order books and the opportunities that we are seeing, and of course we'll talk a little bit more in detail as to what exactly is the opportunity. And Noshed put some really good data around. People always ask me, will the industry pivot? The industry has nothing to pivot here. I think the individual companies will pivot. Will all the industry players will pivot? Probably not. 80% of them will pivot. Maybe some of them will not pivot. But the opportunity you saw in those charts, the TAM that we are talking about, the opportunities that for the services company to truly cross the chasm, if you may, that's for real. And I don't believe that the markets have actually priced in yet.
Okay, so that opportunity is real. Amit, let's talk to you now in terms of recalibrating growth. And as I said, is the era of double-digit growth something behind us? Do we need to recalibrate ourselves into appreciating the fact that at least for the foreseeable future, for the industry, for companies like yours, it's likely to be low single-digit? And what does that then mean for the next 5 years as far as this sector is concerned?
I think I tend to take a pretty bullish approach on things, and possibly by nature an optimist. But if we look at how things are shaping up, we look at a few transitions, and possibly our industry is experiencing one right now. And it's a transition of two pivots. I think that was also spoken about in the first presentation, of what's under pressure and what's new. And the growth of opportunity in the new is something that we have been reporting quarter on quarter. It's been last 3 quarters we've been reporting, and that's a mark of confidence and conviction. The path that we have taken, the path that we have chosen. The transition on anything to do with operations is expected to be pushed for efficiency and productivity always, with or without AI. That has always been the candidate, and it will always remain a candidate. But the pivot towards new opportunity is what we are seeing more and more. What used to be an industry known for effort, largely our industry has always been known for how much effort we have put in. I think that pivot is moving from effort to intelligence. Our industry is getting redefined for intelligence. Our industry is getting recalibrated for intelligence, and that's a transition that we are all experiencing right now. But a huge opportunity ahead of us.
So let me double down on that. If you're making this transition from, to intelligence, what then happens as far as pricing is concerned? And I think that's the question. And Noshir mentioned that you're moving now to outcome, and everybody's talking about the outcome model and outcome pricing. What does it mean in terms of pricing deflation at this point in time? And, how quickly are you likely to see this model shifting? And two, on the headcount front as well, as we move into this agentic future that everybody is talking about and so on and so forth, what will it mean essentially as far as the current model of headcount is concerned?
I think second question first. If we look at operating model, headcount has been part and parcel of an operating model to deliver services to a customer enterprise. Deliver services in an output, in an effort, or an outcome-based model. It's been a combination of all three. The percentage variation has been very different. Now, when you look at the operating model shift, you'll have a human and AI agent collaborate and coexist in different capacities, in different natured roles, and different skill sets. The ability to price for outcome becomes more profound now because you're committing to what the end experience the customer will gain rather than the effort that you'll put in. But hand on heart, I don't think so the industry has transitioned to an outcome as yet. We are clearly seeing a shift of effort moving to output, but very small percentage still moving to outcome. But that's a big opportunity in front of us.
And the timelines that you believe that you are likely to see the inflection point as far as this shift is concerned?
Tough to predict. I think if we go back in history, we always take inspiration from history. So if you go back in history, when the mobile era was introduced, say, the consumers have huge excitement around it. Enterprises took a long, long time to come around that space. I don't think so it will be any close to that lead time, but there is a lead time that is always expected from consumer excitement to being ready for enterprise grade.
Okay, Arundhati Bhattacharya, let me address the big question with you. And I think every headline has been screaming about the SaaSpocalypse. Now, how do you, sitting at Salesforce, deal with this?
I think, our results are expected very shortly. So really can't speak about that in as clear a language as I could. But I think that that narrative has already been proven false. The thing is, we are all in a stage of transition. And let me make this comment regarding this outcome-based pricing. When this outcome-based pricing really starts working, they want to go back to the license-based pricing, okay? Because the outcomes are so many, they don't like it then. Then they want to go back to the early one. But having said that, this is a real case.
Yeah.
So, but having said that, on the SaaSpocalypse, you have to understand one thing. The frontier models, you just can't put them somewhere and expect the entire enterprise problems to be solved, okay? Whenever you're deploying something new, there has to be governance, there has to be auditability, there has to be observability, there has to be, the various regulatory and other compliances have to be correctly recorded. Not only that, in the architecture that you already have, you don't have a clean slate. You're putting in something where something else is already working. So putting all of that together in order to have the best outcomes, it needs a lot of engineering. It's not something that happens on its own. Neither is it something that, any of the frontier models will resolve on their own. And therefore, the requirement for companies such as either ours or even the service companies, that requirement still remains. And the fact is the industry is beginning to realize that piece of it is still very, very important. And therefore, I don't really think the SaaSpocalypse stuff was sort of, I don't know, it was stocked up maybe a little because there was so much investment going into the other companies and they had to take it out from somewhere and probably we were sitting ducks on it. But whatever it is, I don't think that narrative really makes sense. And I've not been seeing that in actual on-the-ground requirement or even in the order books like Rajesh said. We are not seeing that anyway.
Well,
the narrative was built by the stock market enthusiasts.
The narrative was built by the stock markets, but you're right in saying that you did see these massive amounts of capital going into companies like OpenAI, Anthropic, and of course, but what I do want to understand from you is what are you seeing in terms of demand? Because I understand that you're in a silent period, so you cannot comment or make any future projections, but look at your agentic ARR, up 200%. What is the sense that you're getting in terms of demand at this point in time?
So, let me just talk about our own company. We are, by the way, customer zero. Like Noshir said, we are not holding back. We are willing to cannibalize ourselves. We are customer zero on our own platform. And even there, if you see, I had started with my own vertical with a project for creating 3x productivity. In a matter of 90 days, I had 99 applications, okay, where in certain cases, they were giving as much as 27x productivity. Some cases it was lower, it was as much as 1.5, but it depended from case to case. So the fact remains that there is definitely a huge amount of demand. But I think even if there is demand, people have a lot of queries still. The queries on trust, queries on security, queries on cost. There is something that has evolved called token economics.
Yes.
Okay, so that's an entirely new field of expertise.
We've gone from token maxing now to token impacting.
Exactly.
Token impacting is the buzzword today.
That's right. So that's an entirely new area. And in fact, Doshi didn't mention some of the roles. Some of the roles are in that area. How do you maximize the usage of tokens in order to ensure that you get maximum impact and lowest costs? So there are a lot of things that people are still trying to get their arms around. If you ask me whether there is more interest, yes, hugely so. If you ask me, have we seen that actually come down to numbers? I think we are getting there, but not yet there.
Puneet, as I was saying, the only person on this panel who doesn't have a stock problem is Puneet. Microsoft is still
so glad.
is still holding up. But, the massive CapEx spends that we're seeing globally at this point in time, almost $700 plus billion between the, hyperscalers put together, almost $200 billion for Microsoft alone. Now, when we look at this CapEx build-out, and I'm asking this in the context of what the opportunity is for this sector here in India, how does this sector benefit from this kind of massive CapEx build-out that we're seeing happen globally? Where does the value creation for this sector lie when we talk about this CapEx build-out?
Listen, I think first up, the reason for the amount of investments that you're talking about is, and we were having this discussion outside, this is unlike anything else we've seen in our lives. It's the most consequential technology of our lifetimes. And a lot of this CapEx is going into manufacturing intelligence. And intelligence has always been linked to biology. We've always carried intelligence in our small heads. For the first time, we're making compute become cognition, right? For the first time, we're manufacturing intelligence. So that is the race we're on, and that's the reason the investment. I said, can you explain this to me? He said, they're brilliant strangers. They know everything about the world. They know nothing about me. Can you get me a familiar friend? Can you get me a child who grows up in my organization, understands my context, the knowledge turns, what does a good work look like, and then get that to answer questions or do work for me, which is where the new value pool is, and Naushir spoke about, right, which is translating this enterprise ontology, the enterprise context into these frontier models, and getting these models to work for you on your own terms versus the other way around. Satya spoke about the reverse information paradox, don't pay for these models twice. So I think that is where the real value pool is, and I don't think there's anybody better positioned than the services companies in India who have the context, who have the domain knowledge, who know how to do this at scale.
But let me push back, because this is the fear, right? That given the intelligence that these guys are sitting on, how quickly can the beautiful stranger become your beautiful friend? I think that's the concern, that's the anxiety.
I think the transition from this brilliant stranger to a familiar friend has to be done by the Indian IT services companies, because this is not trivial. We've all seen this, and Naushir spoke about the three things that are true in life. The fourth thing is the enterprise tech debt. There's a ton of tech debt that's sitting there, and it needs to be modernized. It needs to be translated into these models. And again, I'm sure we'll talk about ROI, right? But eventually it comes down to two things, Shireen. First is intelligence, which is intelligence in your own context. Second is trust, to Arundhati's point. We all have agent sprawls in our organization. How do we make sure that we get the intelligence that we want in on our own terms, in a trusted way, which is where the service providers are best positioned to go and play.
And I didn't pay him to say that, So
I'll still charge you later. You can buy me a dinner, Rajesh. No, but I mean it. I genuinely mean it. I think this is where there's a massive opportunity for all of us.
No, and I think Satya has been on the forefront of this business of the limits as far as renting intelligence is concerned, and something that Palantir, Alex Karp has also been carping about, particularly on CNBC. So we'll get into that discussion in a second. But Srikanth, regretting listing?
Not yet.
Not yet. But would it have been better were you still private?
See, I think this, like Puneet has just mentioned, this is the most transformational tech that we have seen in our living memory. And to think of this as just one more small wave that'll pass by is, I think, a big mistake. I think whether this on this panel or anywhere else, if you're making that assumption, it's going to change the world in very significant ways. And 2026 is just the beginning. We are at that point where recursive self-improvement is beginning to happen in the models. These models are already building the next wave of the models. The models are getting better at a rate that's unimaginable. They're doing long horizon tasks. So they're not just being part of your tech budgets. Tech budgets are increasing, as Noshir was saying. Yeah. They're going from 4.5% of revenue to 6% of revenue. So there is a certain increase in tech spends that's happening, and many of the service providers can benefit. But if you look at the other side, the labor budget, 20 to 40% of revenue of a company is the budget on human resources. And that budget can also be now exposed to tech disruption, which means that the overall pie that a tech company, whether anybody on this panel or anywhere in this room, can address is a much larger number than ever before. With that massive addressable market, the sky is the limit in terms of how companies like Fractal can perform, or even any of the people in this room can perform. So eventually the world is moving to more tech dependence. Yeah. Now, coming to the tech services companies that are currently struggling a little bit for growth, it's also something we have to understand as a S-curve that is saturating. So if you look at all the tech companies, tech always goes through these S-curves. We have completed the previous S-curve, the era of sort of doing social, cloud and stuff like that. That S-curve is saturating. The next S-curve comes with an AI wave, right? And companies like here have to reinvent themselves to be relevant in the new S-curve. Fractal is natively there. And secondly, all the companies that are potentially clients of this have to also reimagine their work and workforce with AI, right? So whether it is transforming every business process with AI, building the ontological foundations in their data to be ready for that transformation, or reimagining the talent and workforce so that they are relevant for the new generation. This is not just a tech services or tech companies problem or a SaaS apocalypse problem. It is all companies in the world will have to address this sooner than later to be relevant in the next 20 years.
So that's what I want to double down with each one of you. Let's pick up on this issue of reinvention. And as you pointed out, everybody needs to reinvent, everybody needs to rewire, everybody needs to reimagine. Now, at this point in time, if I were to ask you to pin down for me the 3 strategic imperatives of where this reinvention ought to start, what would you put down?
I would say pick the place where you have the greatest inefficiencies in your organization, or which is your North Star, or where you feel like an important metric that you chase. You pick that part in your organization and see if you can work backwards and redesign the processes to gain traction. That's number one. Number two is that you must look at the data that you're collecting, the system that you've created, and how to harness that data, create that layer of context in your organization so that you can leverage it. And 3, you must activate your talent to think AI native. Everyone in the organization. It's not just tech people who need to learn AI and get better. It is every employee in the organization has to start using AI in a much more effective way. So I would look at these 3 massive opportunities inside every large company, and you can see that the ones who have cracked this problem are already moving faster than the others.
Rajesh, let's pick up on that. The NASSCOM strategic review said that the need of the hour is to focus on value and innovation. Now, those are large, generic terms. What does that mean specifically as far as the actionables for Indian IT services? Noshir talked about R&D. R&D spends have been woefully, abysmally low, less than 1% or just about 1% as far as the industry is concerned. The big criticism is you guys keep doing dividends and buybacks and so on and so forth. You're not spending enough as far as IP creation is concerned. Does that need to be the big shift? Does that need to be the big priority at this point in time? If so, on what exactly?
So first of all, I'll give it that there is a serious issue with R&D spend. Overall in India, as you know, that as a country we spend 0.7% of our GDP, whether an advanced nation would spend something like a 2.6 to 2.7% of the GDP on the R&D. So there is no question that as a nation we are spending less, as an industry we are spending less, as companies we are spending less. But having said that, for the tech services company, what gets counted as R&D is often, when we talk about R&D, there's always a product mentality around some of this. And I want to put that rest once and for all if I can. See, when you have products and services, the traditional way of looking at what is innovation is a little different, right? I mean, of course, you need to spend on building IP and all of that, but let's not forget that. Let me see if I can give you an analogy. I mean, I think flying is a great analogy. To have a great flight, you need to have a good aircraft and you have a good airline. The aircraft manufacturers have never been able to run an airline, and the airlines have never been able to build an aircraft. So Boeing makes the aircraft. I mean, let me pick a good airline here. Singapore Airlines probably flies it nicely.
I like the fact that you dumped all of the Indian carriers, right?
I don't want to say anything at this stage, but especially given where we are today, I want to be very careful. But that experience, so you have a product plus service combination, if you may, delivers that kind of experience for the end user. So being that the case, of course you need to have core products. I'm not arguing by any means that you have to do less of R&D. You need to do more of this. Tech services companies have really not spent enough. They're beginning to realize it. They're beginning to create a lot more IP. I think it'll improve over a period of time. So that's one. I think they'll have to be a lot more innovative. But let's not forget that what is the biggest... Arundhati and I were together in a different podcast this morning, and we were talking about the enterprise context which the services companies have today are valuable so much that, starting all the way from Y2K and today, you really see they understand this enterprise context of all the corporations around the world, especially the Fortune 1000 and so on. They need to leverage that fully at this point in time, because to truly deploy AI, and then we all talked about as to how critical it is for them to sort of truly get into the bandwagon and take advantage, not just for productivity gains, but also to enterprise transformation. So the second piece of the, how do you really move the needle? These companies have phenomenal opportunities. So all of them, I mean, TCS is on the panel and many of the other companies are not. But if you really see the AI services service line, if you may, is actually focusing on that aspect of it. But you have a lot more coming around that as well.
Ladies and gentlemen, thank you so much for joining us here on this panel. Appreciate your time. Thank you very, very much for joining us here this evening.
Hello and welcome to this edition of Editor's Playbook. I'm Shireen Bhanas. Gen Z would say no cap. From healthcare to aviation to insurance, several sectors are staring at sweeping regulatory changes. Their entire business model could be threatened with just a stroke of a pen. Now, a parliamentary panel wants to impose limits on healthcare costs, including room rents and surgical procedures. While the move may be well-intentioned, is the price cap the right remedy? Will it scare away investors in a country that desperately needs more hospital beds and better infrastructure? Now, top hospital operators believe price caps will not solve the affordability problem and may in fact make it worse by hampering expansion plans. This view is prevalent across sectors. The government is also drafting rules to potentially impose limits on airfares. In fact, in a sealed cover, something has been proposed to the Supreme Court. Now, the promoter of India's largest airlines argues that the cost of a ticket is not determined by airlines alone. There are many other factors at play. Rahul Bharti of Indigo told me recently that the responsibility of the current cost structure lies with the ecosystem, which includes airport charges by the airport operator, user development fee, landing charges, and much more. Take a look.
The industry always gets, again, I use a word and you'll hang on to it, hammered for airfares. And this, again, something that I think we have not done a good job in educating the world at large. UDF charges at airports have gone up to 95%. Landing charges at airports have gone up to 34%. And the reason I make this point is this is not being critical, but I think if we truly want India to become a major global aviation market, I think the whole ecosystem has a responsibility to make sure that we have a cost structure that will allow us to compete.
Well, that's Indigo's Rahul Bhatia there saying that by focusing merely on the airline's responsibility when it comes to pricing, we're addressing the wrong question. The issue of price cap is not limited to just healthcare or aviation. Several sectors are grappling with the possibility of regulatory action that could significantly alter their models. To discuss all of this and more, we're joined by Prashant, Nimesh, Ekta and Sriram. Guys, it's great to be here, sitting with all of you after a long time.
No cap, Shri.
No cap. No cap is right. No cap is right. But you know, Ekta and Prashant, you of course just put together that stellar starcast of all the hospital operators to discuss this issue of price caps. And it's not just hospitals or healthcare. As we pointed out, it's a whole bunch of sectors that are dealing with the possibility of the stroke of pen risk today. Prashant.
Absolutely, Shireen. And first of all, great that you're here. I think we should fly down every editor's playbook, I think.
We will then definitely need a price cap. We'll definitely need a price cap then.
But I'll tell you, just to give an example, Shireen, I think this was last week, right? There was CNBC TV 18 has been conducting this risk awards with, ICICI Lombard, and I was at that event, and there was a Q&A, and these were all the risk leaders across, all listed companies, large companies, some 200, 250 people in that room.
Across sectors.
Across sectors, right? And there was this sort of, there was a screen, and they were asking questions about, just a